Now, to start this topic, monetary policy, we need to understand the banking, the Indian banking, right? So now let us consider a bank. This bank has two components. One is asset and the other is liability. So what can be called an asset for a bank? Something which is lending loan. Loans are the assets for a bank, the main big assets. And what is liability? The deposits. This is the fundamental. So if you go and invest into a bank, that will be a liability for a bank because it needs to pay you with interest. And at the same time, if you take loan, that will be an asset for the bank because you are going to return it along with interest. So that's how we classify asset and liability for a bank. Now, if we see that liability, what is that? That is the deposits that we are doing. That is the liability for a bank. So that liability can be divided into two components. One is demand liability and the other is time liability. See, let's say demand liability is nothing but deposits on demand, right? That is demand liability. So deposits on demand, they can be in two accounts. That can be current account or saving account. Current account usually used by the business people, etc., to withdraw money on immediate basis, and then savings account, generally like you and me, they use savings account. And next we have time deposit. Time deposit, two types of time deposits can be possible: fixed and recurring. Fixed implies you fixed for 3 year or some maturity period, for whatever maturity period it is. You have fixed your deposits for certain time period and it will be locked in and you cannot withdraw it. If you withdraw, you might be facing some penalty. That is fixed deposit. And recurring deposit is, let's say this is a 3 year period, the same maturity period, and you are depositing on a regular interval and finally taking it out after a certain maturity period. Got it? That is recurring deposit. So liability for a bank, it can be demand liability or time liability. Demand liability, CASA. Remember CASA, demand liability, and the time liability, you can easily remember fixed deposit and recurring deposits. So when you add both of them together, you call it as total demand time liability. Total demand time liability is nothing but demand liability plus time liability. Okay. Now the question is asking you net demand time liability. See, you rarely see this TDTL, total. All the banks, they use NDTL, that is net demand time liability. So total demand time liability minus the assets with the banking system. Got it? That is assets with the banking system. It can be loans that a bank give to the public, or it can be deposits that bank has deposited in some another bank. Many assets can be there for a bank. So if you subtract the assets from total demand time liability, that will give you net demand time liability. Next, banks spread. The banks spread is, see, as I said, if you see a bank, it is lending loan. Where did the bank get money to lend loan? From the deposits, right? So the difference between lending rate and deposit rate is called banks spread. Got it? And next we have credit crunch. Crunch is nothing but credit ka crunch hona. That is banks suddenly reducing the credit activity. Crediting activity matlab lending activity. Banks suddenly reducing the lending activity. How banks usually reduce lending activity? I mean, what is the reason? Why? The reason is simple. When RBI usually increase interest rate, that can be on CRR or SLR. In such scenario, more reserves will be kept with the bank and less will be given to the public. That is called credit crunch. It usually happens when RBI increases its rates. Now we need to understand certain ratios in the banking. First, we have CRR, cash reserve ratio. See, cash reserve ratio is simple. SLR is also simple. Cash reserve ratio is cash held by the banks with RBI. Got it? So here you need to always underline this RBI. Got it? Banks के पास दो ratios होती है, एक CRR और एक SLR. So if banks need to deposit certain amount with RBI, that is CRR, and they cannot deposit securities, they should definitely deposit cash only. Cash held by banks with RBI, that is CRR. So here in the denominator, if you notice, that is NDTL, net demand time liability, will be in the denominator. So CRR is cash held by banks with RBI divided by net demand time liability. Net demand time liability is, see, this is what banks took from public, and this is what banks have given to RBI. So that ratio is cash reserve ratio. So the measurements are always compared with NDTL. Got it? And next we have statutory liquidity ratio. Statutory liquidity ratio is liquid assets maintained by banks with itself. Liquid assets, that is securities, or else they can be gold also, which can be easily converted to liquid. So whichever assets you feel that can be converted into cash, they are all liquid assets. So here we are saying liquid assets maintained by bank with itself. So CRR और SLR के बीच में difference क्या है? CRR it is with RBI and SLR it is with themselves. Okay. And one more thing, as per the latest news, this is upgraded to 3%, and SLR, I think it is 18% only, but CRR it has upgraded to 3%. When I just say without mentioning what type of bank it is, you need to assume it as scheduled commercial bank. Okay, when I'm not mentioning a bank, I'm just calling it as a bank. So imagine it like it's a scheduled commercial bank because there are many types of banks. Some banks don't even have CRR SLR norms. For example, I think local area banks don't require CRR and SLR because they are non-scheduled. Non-scheduled banks, I think they don't maintain CRR, they might maintain SLR. That you will learn later. Now let us see CDR and RDR. CDR is currency deposit ratio. Currency कौन deposit करेगा? Public. So it is the cash held by public with themselves. So public खुद के पास जो पैसे रखेगी, that is currency deposit ratio. And in the denominator, you need to see that it is demand deposits and it is not total deposits. Okay, some people in the exam hall, that is what they're going to give. They're going to give the information and they are also going to give total deposits and demand deposit in the economic questions. And it is up to you to choose this or this. So choose demand deposits. Okay, the examiner will give total deposit to confuse you, but that information will actually have no relevance in the exam hall. So you need to choose demand deposits. Currency deposit ratio is cash held by public divided by demand deposits. And next we have RDR, that is reserve deposit ratio. Reserve deposit ratio is bank reserve divided by the total deposit. See, currency deposit count karega public, therefore it is for the public. And next CRR and SLR, it is for the bank, that you can remember. And if you are depositing with RBI, it is CRR, and if you are keeping it with yourself, that is SLR. गॉट इट। एंड सीआरआर पे आरबीआई कोई प्रॉफिट नहीं देगी, कोई इंटरेस्ट नहीं देगी, बट एसएलआर पे तुम इंटरेस्ट कमा सकते हो बाय पुटिंग इट विद योरसेल्फ। यू कैन अर्न इंटरेस्ट। हाउ इज दिस पॉसिबल? बिकॉज सी फॉर एग्जांपल लेट्स से गवर्नमेंट सिक्योरिटीज, आरबीआई said 18% government securities must be maintained with themselves. So let's say I'm a bank and I'm holding 18% government securities out of all the NDTLs. Then tell me, out of this 18%, don't you think I don't receive profit out of them? I will definitely receive profit after maturity period for holding a bond, right? So that is how I earn interest, by maintaining SLR securities with myself. That is the reason why RBS is compulsory. You need to maintain certain government securities in the form of SLR. Got it? And the CEDR, it is currency deposit ratio, and it's for the public, and in the denominator, it is demand deposits, and it's not the total deposits. We also have RDR, that is reserve deposit ratio. Bank reserve divided by total deposit. See, and reserve deposit ratio and credit deposit ratio, they are for a bank. Got it? They are for a bank. Now, if a bank, if you need to measure how much the bank is reserving, that is reserve deposit ratio. See, banks get deposits out of the total deposits. What is it? It is reserving, that is bank reserve. But out of the deposits, what is bank giving as loan? That is credit deposit ratio. So credit deposit दोनों एक साथ देख के कंफ्यूज मत होना. ओके, डिपॉजिट पब्लिक करेगा, दैट्स करेक्ट, बैंक भी कर सकती है. बट इफ दे आर सेइंग करेंसी डिपॉजिट रेशियो, देन इट इज फॉर पब्लिक. बट इफ दे आर मेंशनिंग दिस वर्ड रिजर्व ना, देन दैट इज बैंक. सी ऑलवेज रिमेंबर रिजर्व रिजर्व, ये वर्ड बैंक्स के लिए यूज होगा. सो ये देख के कंफ्यूज मत होना कि दिस इज फॉर पब्लिक. नो. सो रिजर्व, बैंक रिजर्व, इट कैन बी रिक्वायर्ड रिजर्व, सक्सेस रिजर्व. रिक्वायर्ड रिजर्व का मतलब होता है सीआरआर, or it can be SLR. Compulsory, this is the reserve that bank must maintain, and it also has excess reserve, that is ER. I mean, let's say total reserves, required reserves is 18, but you have put 22, so 4% is your excess reserve. So you need to add required plus excess, that is the total bank reserve divided by demand deposits plus time deposits. So you need to consider total deposits here. In the currency deposit ratio, which is for the public, you are considering demand, but for the bank you are considering total. And similarly for the credit deposit ratio, as you can see, you need to consider total. So in general point of view, for CRR and SLR, it is a net demand time liability, which is in the denominator, and for CDR, which is the currency deposit ratio, you are having a demand deposits in the denominator. And if you see reserve deposit ratio and credit deposit ratio, you are having the total deposits for a bank. And numerator you can easily guess by seeing the formula. For example, if it is currency deposit ratio, it is the cash held by public. If it is reserve deposit ratio, it is required reserves plus excess reserves. If it is credit deposit ratio, that is credit given by bank or loans given by bank, that will be in the numerator. Got it? And next we need to see the functions of money. But before proceeding with functions of money, I want to tell you some stats from the economic survey. See, as per economic survey, it is saying that in the last 20 months, there has been an increased bank credit boom. Why do you think there is a bank credit boom? If you watch my fiscal policy, you will know that government has done a lot of tax rationalization. It has reduced GST tax slab rates and direct tax slab rates, right? That is why it is booming banking credit sector. But why, if tax rates are tell me, if tax rates are reduced, why do you think the credit rate by the banks is higher? The reason is simple. See, tax rates have reduced. Now people will be having a lot of disposable income. What is disposable income? Personal income minus earnings through taxes. तो जो भी हमारे पास बचता है उसको हम disposable income बोलेंगे. Now this disposable income you are having a lot. So what you are going to do? You are going to deposit in a bank. तो चलो अब डिस्पोजेबल इनकम बढ़ गया, टैक्स स्लैब्स कम हो गए, इसलिए डिस्पोजेबल इनकम बढ़ गया, तो मैं जाके बैंक में डिपॉजिट करूंगा. व्हाट हैपेंस आफ्टर डिपॉजिटिंग इन द बैंक? दे आर गोइंग टू हैव लॉट ऑफ deposits, right? They are basically liability for a bank. So therefore they must give us a loan to increase its assets. Therefore it is going to give us loan. अगर एक्सेप्ट नहीं करेंगे तो कोई बात नहीं, मैं चीप क्रेडिट पे भी देने के लिए तैयार हूँ, बिकॉज बैंक्स आर हैविंग लॉट ऑफ डिपॉजिट्स. सो दैट्स द रीजन व्हाई, इफ टैक्स रेट्स आर रिड्यूस्ड, द क्रेडिट गिवन बाय द बैंक increases. Got it? Now if we see sectoral deployment of non-food credit of scheduled commercial banks year on year growth, so they are checking how the non-food items credit growth has increased on year basis. Year on year का मतलब होता है, if you are seeing November 2025, you are comparing this data, whatever 11.4 is there, that is with respect to November 2024. So you are seeing non-food items. So how the bank, let's say a bank has given 100 rupees loan in 2024 November. In 2025 November, bank has given non-food loan of 150. So now I'm telling that I have seen how much 50% increase. That is how I compare year on year basis, the same month in the last year. So these are all the same points, the same month in the last year. Got it? And that's how they compare non-food credit. Now in the non-food, in overall, we are getting to see three categories mainly: agri and allied, personal loans, and services. As per the graph, you can observe that services, they are highest among all. It's around 12.8, but whereas if you see services, it is 11.7, and agri it's 8.7. So if in UPSC if they ask you which sector has seen a maximum rate of growth of credit loans by the banks in the last financial year, or else the last 15 to 20 months, so your answer is going to be personal loans. So banks have preferred giving more loans to individuals. So personal loans, PL, personal loans, it is greater than services industry, services, next greater than agri. Okay, agri मैं 3 से denote करूँगा. As I said, personal loan greater than services, greater than agri. Got it? Now here again you can see industrial trend. What industries, they have also observed 9.6 rate of growth compared to last financial year. So in industries we have MSME and large industry. Now tell me, banks preferred giving loans to MSME or large industry. By seeing this, you can feel that the banks preferred MSME, because here it's 24.6 and it's 4.6. The actual truth is that large industries, they prefer IPOs and bonds, share market, etc. They would like to raise capital through these primary and secondary markets rather than depending on the loans from the bank. They don't want to depend on loans from the bank. That is why if you see, the credit rate of growth for the industries is lower than the micro and small and medium sector. I mean MSMEs, micro, small, medium enterprises. Got it? Now you might get one more doubt. What is this MSME and what is this micro and small? See, MSMEs, they can be micro MSME, I mean micro, small, medium enterprise. That is full form of MSME. So they are considering micro and small, and they have plotted this graph. Got it? Now let us go to money. So we are studying the topic of money. What are the functions of money? Everyone knows medium of exchange. If not money, there is no medium of exchange, and we cannot survive on barter system for long. And then we have measure of value for different goods and services, right? How do I know gold is valuable than silver? Because of the value of money that I need to pay for gold, it is higher than silver. So it measures value of different goods and services, and it is a medium of exchange, and it is a standard of deferred payment. Let's say I made an agreement that I will pay you after 10 days for some good and services. So that standard of deferred payment, I'm accepting it because because of money. If it had not been money, if it had been some barter system, I would say that I require that item now only, etc. So that is the reason why money, it is a standard of deferred payment. And also we have store of value. Money, it stores value. Let's say you have 50 rupees. Now that you are storing in a bank, now the value will be stored and it will give you some profit also. If you store a biscuit packet in some bank, will it give you interest in future? No, right? So it is a store of value for future use. So you can use it anytime. And then we have transfer of value. See, this is a pen and this is an eraser. uh, I cannot, rather than exchanging pen with eraser, where pen is 10 rupees and eraser is 2 rupees, I can directly put a value to it, and I can say that this is lesser value and this is more value. So, money, it can be used as transfer of value, store of value, standard of deferred payment, medium of exchange, measure of value, etc. Now we have fiat money and legal tender. See, the cash notes that we use now, they are fiat money and they are also legal tender. Fiat money implies they are not commodity backed, and they are government backed. Non commodity backed implies, let's say you are having note. In note के नीचे कोई gold collateral नहीं है. Got it? RBI is not going to give you this note. I mean, going to give you gold because you're having 10 rupees. No. So that is non-commodity backed, and it doesn't have any tangible asset backing. It is a government backed. All of them, they are trusting government. Got it? It is government backed. The best example for fiat money is the currency notes that we use or the coins that we use. Legal tender. Legal tender is legally enforceable. That's all. Legally enforceable standardized units, and which can be issued by the central bank or the central government. Okay. Fiat money, it is a legal tender because it is legally enforceable. Now fiduciary money is different. The checks that they are fiduciary money. You are going to accept check if you trust them, or else you will not accept check. Got it? A check, not only check, bank notes and draft, they are all fiduciary money, and they are not legal tender. Fiduciary money is the opposite of legal tender. Uh, and I will ask you a question. 50 paisa, is it a legal tender? No, it's a legal tender only up to 10 rupees. And similarly, all the coins that 1, 2, 5, etc. coins, all the coins, they are legal tender up to 1000 rupees. Okay. RBI क्या प्रिंट करेगी? रिमेंबर, आरबीआई प्रिंट्स ऑल नोट्स एक्सेप्ट 1 रुपी. ऑलवेज रिमेंबर दिस. आरबीआई प्रिंट्स ऑल नोट्स एक्सेप्ट 1 रुपी. आरबीआई प्रिंट्स ऑल नोट्स एक्सेप्ट 1 रुपी. तो ये 1 रुपी को किसी और को प्रिंट करना पड़ेगा. सो मिनिस्ट्री ऑफ फाइनेंस, इट प्रिंट्स 1 रुपी नोट एंड ऑल कॉइन्स. गॉट इट? वी हैव मैक्सिमम डिनोमिनेशन. सी, दिस इज योर कॉइन एंड दिस इज योर नोट. तो कॉइन के ऊपर ना मैक्सिमम 1000 रुपीज का सिक्का हम देख सकते हैं. बट नोट, द मैक्सिमम डिनोमिनेशन ऑन नोट इज 10,000. दैट्स व्हाट आई एम सेइंग. मैक्सिमम डिनोमिनेशन ऑन कॉइन इज 1000 and maximum denomination on note is 10,000. Near money. Near money, they are the assets that are not money but which can be converted into money. Gold, securities, etc. They can be easily converted into money. The assets which can be easily convertible into money is called near money. And in Indian monetary system, we call our Indian monetary system as inconvertible paper currency standard. Inconvertible implies you cannot convert your rupees into gold. That is inconvertible paper currency system. Just because RBI said that it will take responsibility doesn't mean that it will convert your rupees into gold. That we call inconvertible paper currency standard. Now let us study the reserve systems in India to be followed by RBI. See, currencies are issued by RBI with the backing of reserves comprised of gold or FCS. So initially it used to be proportional reserve system where RBI used to reserve 40%. So the rest 60% used to be through rupee coins. So proportional reserve system 40% is in the form of gold, but that was removed in 1956 only. Currently we are following minimum reserve system. So यहाँ पे 115 crore in the form of gold. Total required is 200 crore. So 200 crore reserves, that is the minimum reserves that RBI must put it with itself, and 115 crore it is the gold. And minimum reserve system, it was adopted in 1957. 1956 क्या खत्म हुआ? Proportional reserve system खत्म हुआ. तो 1957 में क्या आया? Minimum reserve system where 115 crore it must be in the form of gold, and the minimum is total 200 crore. तो बचा हुआ 85 crore it is in the form of foreign currency assets. Got it? And RBI can issue unlimited amount by keeping this minimum reserve. People will think चलो 115 crore है तो RBI सिर्फ 11 crore issue कर सकती है. ऐसा कुछ नहीं है. RBI can issue how much whatever it wants. RBI के पास वो power है. So it can issue unlimited amount by putting this minimum reserve. Got it? So while printing this unlimited money, RBI should ensure that it will lead to economic growth and it will fulfill the transaction needs of people and meet the inflation targets. Got it? And we also get to see fractional reserve system. That is different from proportional minimum. See, in the fractional reserve system, this is for banks. It is not for RBI. See, for, banks reserve certain fraction with itself and give as loan. ऐसा नहीं है कि सारे deposits loans की form पे दे देगी. कुछ हिस्सा reserve की form पे रखेगी. That is fractional reserve system. The fraction that it reserves and the fraction it sends as a loan. That is fractional reserve system for a bank. Now we need to see the dynamics of money. Dynamics of money in the economy. See, money can have demand and money can have supply. So demand and supply curve that in economics, it can also be plotted for money. Demand curve and supply curve. Okay. Now in money demand we get to see three types: transaction, precautionary, and speculative. And money supply we get to see pre 1998 and post 1998. See, if you are demanding money for transactionary needs, it is transaction demand. But if you are thinking for any contingency or emergency, that is precautionary demand. Speculative का मतलब होता है for speculative activities etc. If you are demanding, that is speculative demand. Now let us see money demand. Transaction demand and precautionary demand are easy. Why? Because see, if your income increase, the demand for a transactionary needs, precautionary needs also increase. You will say that, oh, I need to do that also. I need to purchase car now. Initially, you are satisfied with only bike, but now you also want to purchase car. That is transactionary demand. Demand for money for daily needs. So if income increase, transactionary demand increase, and precautionary demands. Example, you are having more money, so you want to save certain money from your income to insurance company, right? That is also possible. So precautionary demand and transaction demands increase if there is a boost in monthly income. What is a speculative demand? Speculative demand, it can increase or decrease. With respect to your money, I mean, with respect to your monthly income, if you compare, speculative demand can increase or it can decrease also. Anything is possible. Therefore, we are not comparing it with income. We are comparing with the interest rates that are there in the economy. When I say interest rate in the economy, I usually consider the bond interest rate. For example, if an investor is investing in a bond, how much interest he is getting, or else when I'm issuing a bond, how much interest I am paying. So that interest rate is usually considered as the market interest rate, or else the rates set by the RBI. CRR, they are also considered, I think, market interest rate only. But here in this example, I'm going to consider bond interest rate. Okay, speculative demand is demand for money for speculative motives. Now let us consider bond interest rate. It increased. Now people want to invest in bonds. They don't want to invest in speculative activities like trading, etc. So they will invest in where they will invest in bond. Therefore, if they're investing into the economy, why they're investing into the economy? Because bond interest rates are high. That means they're investing into the economy. That implies the speculative demand, it decreased. It dropped. Why? Because I'm investing into the economy. I'm not speculating anything. Why I'm investing in the economy? Because bond interest rates are high. So speculative demand is low if the market interest rates or the interest rates of the economy are high. Got it? Speculative demand is high when the interest rates of the economy fall. Now interest rates of the economy are low. I don't want to invest in the economy. I want to invest in the speculative activities only. Got it? Therefore, speculative demand, that is high when the interest rates in the economy are low. Got it? That's all. Now liquidity trap. See, in the same diagram, you can see liquidity trap occurs when bond interest rates or the interest rates of the economy, they are low. So simply putting, if you take investor point of view, he don't want to invest in the bonds because economy, it is not offering good growth or good interest rate. I don't want to invest. That is why speculative demand is high. So in that same graph, if you see, when speculative demand is higher, you see liquidity trap. We are saying liquidity trap because market is not getting the money that it wants. If there is no money in the economy, then that is no liquidity. No money implies no liquidity. No liquidity implies liquidity trap. Okay, when there is low bond interest rate, market is not offering me good, then what? There will be liquidity trap because I'm not investing in the economy. That is why liquidity trap will be there. That is investor point of view. Now, a liquidity trap, it is also the term where I use in the debtor point of view. See, I can say that RBI interest rates or RBI policy rates are reduced. See, RBI policy rates are reduced so that people will buy. RBI, why did RBI reduce its rates? RBI reduced its rates so that people will buy, but people are not buying. People are not buying loans despite having low interest rate. अगर low interest rate है, तो इसका मतलब क्या निकलता है कि अगर मैं लोन लूँ बैंक से, तो मुझे लो इंटरेस्ट रेट पे रिटर्न देना पड़ेगा. सो दैट्स अ गुड थिंग ना. इकोनॉमी में भी अभी स्लो चल रही है, देन व्हाई नॉट? दिस ऑफर सीम्स गुड. आरबीआई इज आल्सो रिड्यूसिंग इंटरेस्ट रेट्स. इफ आरबीआई reduces repo rates, CRR, etc., ultimately banks are also going to reduce rate. So that people are not willing to accept. The reason being against speculative demand. People are thinking, see, RBI reduced rates because economy is not performing good, and in the economy we can see bond rates are also reduced, right? Bond rates reduced, RBI rates reduced, bank rates reduced. Something is fishy. I don't want any loans. I will keep my money with myself. I will have high speculative demand. So speculative demand is high even in the debtor point of view because debtor is not believing the economy. We are going to see money supply pre 1998 and post 1998. See, these are the old aggregates which you need to memorize for UPSC. These are there in RBI notification. For time pass, we are going to see what it is. Let us do some time pass and let us see the actual. We have NM0, NM1, NM2, NM3. Got it? Now NM0 is currency in circulation plus deposits with RBI. Currency in circulation has cup plus a cub. Cup implies currency with public. Cub implies cash held by banks. So currency in circulation plus deposits with RBI. Deposits with RBI again has two components. Banker deposits plus other deposit. हाँ, regular public जाके RBI के पास deposit नहीं करेंगे, banker ही करेगा. और कौन कर सकता है? RBI के पास कोई foreign entity, foreign central bank, multilateral institutions करेगा. So if you are considering the total deposits with RBI and the currency in circulation, that is going to give high power money, new monetary aggregate M0, which is in the RBI new notification guidelines 2021. I think 2021 only. And next we have NM1. See, NM1 and NM2 are narrow money, NM3 becomes broad, and NM0, it is the high powered money. Now if you see NM1, we are having a currency in circulation with public, that is cup. Cup plus other deposits with RBI plus demand deposits with bank. Cup plus other deposits with RBI plus demand deposits with bank. That is going to give me NM1. Okay, which is easy to memorize. तो ये नहीं है और deposits with RBI में bank का deposit नहीं है. Got it? Cup is missing and deposits with RBI is missing. And what did we add? We added demand deposits with the banks. That is NM1. And in NM2, we just added short term deposits of commercial banks. Got it? See, this is for commercial banks. So commercial banks, they can be demand deposits and they can be time deposits. Time can be short and long. So in NM1, we added demand deposits of commercial banks. In NM2, we are just adding short-term time deposits of commercial banks. For NM1, if you add the total time deposits and a call notice term funding of some financial institutions, that will give NM3. See, the last component is financial institutions, call notice term funding. Right here, we have considered some financial institutions. That's all. That is the last one. So this NM1, plus time deposits plus call notice term funding, all of them, they give me NM3. Got it? But monetary aggregates, if you see, they are not having post offices. So why? Post office, it was there in the old, but in new it is not there. The reason is they came up with liquidity aggregates again. See, if you see the liquidity aggregates, we have L1, L2, L3. So basically, if you add a post office savings bank to NM3, that is going to give me, I wrote here, see, I wrote it clearly. If you add post office saving bank, all deposits with the post office saving banks, excluding the national savings certificate, that is going to give me L1, liquidity aggregate 1. And to this entire L1, if I add term deposits and term borrowings of financial institutions, so in the L2, I added financial institutions, deposits and borrowings, and I also added certificate of deposits, that is L2. And in L3, I can see to L2, entire thing, now whatever discussed. To that, I added NBFC, the last Jatka, NBFCs we added. So that is L3. So these are the liquidity aggregates that are there. Got it? Post. First, you're adding post office saving banks deposits, and you're adding all the term deposits and borrowings with the financial institutions, and finally, you're adding NBFC. Got it? That is L1, L2, L3. And I think that is first introduced by working group under Dr. D.Y. Reddy. Okay. Now we need to see old monetary aggregates, which is important for UPSC. Currency in circulation plus bank deposit with RBI. That is high powered money. So NCERT don't tell much. Currency in circulation is currency with public plus a currency with the bank. Got it? That is cup plus cup. That is currency in circulation. We also have bank deposit with RBI. So banks deposits with RBI, that if you add, I will take both other deposits with RBI from foreign, and I'm also going to take our Indian banks. So both of them I'm going to consider it as a high powered money. So this much we can assume from the new only. Now if you see M1, the first one is only narrow, and M2, 3, 4, they are broad. Got it? 2, 3, 4, they became broad. And if they particularly mention single type question, you need to take M3 as the broadest. But in general scenario, if they're mentioning all M2, M3, M4 in the option, you need to take all of them together as broad money only. Okay. Now narrow money, I'm telling it because see, they are also in the NM1, if you see, that has currency in circulation, etc. components plus demand deposits of commercial banks. So remember, if you are adding demand deposits of commercial bank, that is going to give me 1. Okay. There we did not see post office in the monetary. Therefore, in the monetary aggregates, post office is not there. From here onwards, we are going to assume our own tricks. See, these tricks are important for UPSC. Now M2, I remember it as post 2. Post 2 maybe 2 hai last mein, hai na? Post 2. So that is M2. So that means post. I'm adding post office saving banks demand deposits. So whatever we have M1, currency in circulation plus demand deposits with the commercial banks, that is M1. To that I added post office saving bank. So the trick is post 2. So 2 matlab 2. For M2 we should add post office saving demand deposit. And M3, I remember it 3 matlab free time. So I need to add time deposits of commercial banks. So if I add time deposits of commercial banks, that is going to give me M3. Okay, and finally we have M4. M4 is all of them. Demand deposits, time deposits of commercial banks, demand deposits, time deposits of the post office saving bank. If you add all of them, that is going to give me M4. So we have 4, M1, M2, M3, M4. But in the new, we have only 3. Here we have 4. Now let us see the concept of money multiplier. So from here on, whatever I'm talking, I'm not talking with respect to new monetary. I'm talking with respect to old only. So money multiplier, according to NCERT, it is M3 by M0. Okay. So to understand this money multiplier, let us see this chota sa example. Okay, and now see, let us say there is an initial deposit of some guy, 10,000 rupees deposit किया उन्होंने. 10,000 रुपीस में एक बैंक ने, पहला बैंक नंबर 1, तो उन्होंने क्या किया कि 2,000 रुपीस को रिजर्व में रख दिया. तो लोन के लिए कितना दे पाएगा? 8,000 रुपीस. Only 8,000 rupees can be lent as loan. Okay, only 8,000 rupees. So this was given as loan, and that guy, what did he do? He deposited the 8,000 rupees, the entire 8,000 rupees as deposit in some bank 2. Let us say he deposited everything in the bank 2. This bank 2, of course, since there is 20% required reserve, so 20% of 8,000 would become 1,600. 1,600 is maintained as reserve, and the rest 6,400 is given as loan. Okay, it is given as loan. Therefore, again, the 6,400, that guy, he deposited, some other guy, he deposited in bank 3. There is another bank 3. So similarly, if you keep on continuing, the cycle keeps on repeating, and there comes a point where this becomes negligible. And when you keep on adding all such things, they accounted to total. I mean, after the summation, after 5 times, I added after 5 times. Okay, and then I have seen, okay, ab tak ka kitna money supply generate ho. So मैंने देखा कि deposits in the total banks, it is accounting to approximately 50,000 rupees. So economy में तो सिर्फ banks they have deposited only 10,000 rupees, but now if you are seeing the total deposits in the bank, they are 50,000 rupees. So it has almost become 5 times. Initially it was 10,000, and it became 50,000. So that is called the money multiplier. So it is like 50,000, the final deposits that the banks are currently having, and the initial deposit that a bank 1 got. So when you cancel, you get value 5. So 5 times multiply hua. That is money multiplier. Okay, this is what I can say is money multiplier. So you need not always do that calculation. There is a shortcut formula for money multiplier, that is M3 by deposits created by deposits, initial deposits, M3 by M0. Okay, this one it is given by the formula M3, and this one it is given by formula M0. What is M3 by M0? This is money multiplier. M3 is what we have seen na, this is broad money. 3 का मतलब free time है. Free time क्या क्या add करेंगे free time में? Commercial deposits. I mean you're adding the entire commercial deposits. ना time deposit भी add करें free time. Demand deposits plus time deposits. Okay, plus currency in circulation. The thing is that here we are taking certain assumptions like total deposits जो है हम मान के चल रहे हैं कि वो demand deposits है. Time deposits we are considering it as 0 for the time being. So that is the assumption that we are taking. Total deposits are just demand deposits, and there are no time deposits for the time being. So if we are taking with that assumption, M3 becomes currency in circulation plus demand deposits of commercial banks plus time deposits. उसको तो हमने 0 मान लिया. Okay, divided by M0. M0 is what? Currency in circulation plus reserves with RBI. Okay, so banker deposits with RBI. What are the banker deposits? Of course, the reserves that are with RBI. they can be required reserves and excess reserves. Required मतलब कैश रिजर्व रेशियो, SLR, ये तो मिनिमम रिक्वायर्ड होता है ना, वो तो करेंगे ही करेंगे. रिक्वायर्ड प्लस एक्सेस. एक्सेस मतलब खुद के पास हम देना नहीं चाहते हैं लोन, वी डोंट वांट टू गिव देम एज लोन्स, सो दे आर एक्सेस रिजर्व्स. You are just reserving it with yourself, they are excess. So required reserves plus excess reserves, they total become the reserves. So currency in circulation plus the reserves with RBI, I mean banker reserves with RBI, or else reserves of banks with RBI, so they all, that becomes M naught. So when you need to create a formula out of it, currency deposit ratio, it is what currency held by public in the form of cash divided by the demand deposits. This is not total and this is just a demand because you're talking about general public. Therefore currency held by the public C, this value is C, this becomes CDR into DD. तो हमने DD को कॉमन ले लिया इन न्यूमरेटर में, CDR प्लस 1 टाइम्स ऑफ DD डिवाइडेड बाय CDR इंटू डिनोमिनेटर में CDR इंटू DD प्लस R. R का मतलब क्या है? वी कैन टेक दिस फ्रॉम रिजर्व डिपॉजिट रेशियो. ओके, रिजर्व डिपॉजिट रेशियो क्या है? रिजर्व्स डिवाइडेड बाय टोटल डिपॉजिट्स. सिंस द टाइम डिपॉजिट्स आर जीरो, टोटल डिपॉजिट्स विल अगेन बिकम डिमांड डिपॉजिट्स. सो रिजर्व डिपॉजिट रेशियो इंटू डिमांड डिपॉजिट्स. तो हमने क्या किया कि DD को कॉमन ले लिया और कट कर दिया. तो CDR प्लस 1 बाय CDR प्लस RDR, रिजर्व डिपॉजिट रेशियो. Okay, now therefore if CDR increase, what is happening if CDR is increasing? Money multiplier, it will increase usually. So okay, if a currency held by, so this formula says that if CDR is increasing, money multiplier is increasing, and if RDR is increasing, money multiplier is decreasing. You can just remember it conceptually also. For example, currency deposit ratio, the amount held by public in the form of cash, if that currency deposit ratio is increasing, of course money multiplier will increase because the people are having a lot of money in their hands. Money multiplier will increase. And if reserve deposit ratio, if it is increasing, that means banks are reserving more, they are not giving lends, they are not giving loans, therefore money multiplier in the economy, it will decrease. So that is the total concept. Now let us see syndicated lending. What is syndicated lending? It is nothing but group of lenders, they are giving loans and they are sharing the risk of default. Okay, that is syndicated lending. And syndicated loan, it can be a credit line also. Credit line meaning a pre-approved pool of money that can be sent as loan. For example, if you see a credit card, it has 2 lakh limit. So this 2 lakh limit, up to 2 lakh, usually it can be given as loans, and above 2 lakh, of course, that you cannot take loan from a credit card more than 2 lakhs. But however, 50,000, if you only take 50,000 out of this 2 lakh as loan, you need to pay interest only on this 50,000. So that is how credit line works. You are having a certain line up to which you can take loan. So that usually the best example is credit card. Now currently they are asking if a syndicated loan, if it can be a credit line. The answer, it is not correct. They are saying that it cannot be a credit line, but the truth is that syndicated lending can also be credit line. So ये लोग बोल सकते हैं कि बेटा तुम चाहिए तो 2 लाख तक ले सकते हो, कोई प्रॉब्लम नहीं है. They can tell like that. Who is stopping them? So they can be credit line. So cannot be credit line becomes wrong. They can be credit line. No one is stopping them. The first option says syndicated lending spreads the risk of borrower default across the multiple lenders. Correct. Syndicated loan can be a fixed or lump sum amount, but cannot be credit line. It is wrong. It can also be credit line. Okay, statement 1 is correct and 2 is not correct. The next question is money multiplier in an economy. It increases with which one of the following? Cash reserve ratio increase होगा तो रिजर्व बढ़ेगा तो मनी मल्टीप्लायर कम हो जाएगा. SLR बढ़ेगा तो मनी मल्टीप्लायर कम हो जाएगा. CRR बढ़ेगा तो तब भी मनी मल्टीप्लायर कम हो जाएगा. इंक्रीज द बैंकिंग हैबिट ऑफ पीपल, राइट. इफ पीपल डिपॉजिट मोर देन ओनली, ना हमने देखा कि मनी मल्टीप्लायर बढ़ेगा. सो देयरफॉर इंक्रीजिंग द बैंकिंग हैबिट विल इंक्रीज द मनी मल्टीप्लायर. ओके, पॉपुलेशन से कुछ लेना देना नहीं है. नेक्स्ट, द एसेट और एसेट्स दैट अ बोरोवर प्लेजेस इन ऑर्डर टू गारंटी रीपेमेंट ऑफ लोन इज कॉल्ड. ऑफ कोर्स इट्स कोलैटरल ना, कोई लोन लेगा तो वो कोलैटरल तो डालेगा. सो द एसेट और एसेट्स दैट अ बोरोवर प्लेजेस इन ऑर्डर टू गारंटी, इट्स कॉल्ड कोलैटरल. ऑप्शन बिना देखे ही हमने बता दिया. द नेक्स्ट वन, व्हाट इज द इंपॉर्टेंस ऑफ द टर्म इंटरेस्ट कवरेज रेशियो? देखना, इंटरेस्ट कवरेज रेशियो इट मींस हाउ इजीली a company can pay interest on its debt. That is interest coverage ratio. तो वो ability कैसे देखेंगे हम कि how easily can a company pay interest on its debt? That is basically how you measure the company earnings. So earnings before taxation divided by the interest expenses. So that ratio, it will tell you the ability of company to repay the interest. Okay, earnings of the company before the taxes are there. After taxation, it is difficult. 30% like 50%. The earnings might diminish also. So you usually consider earning before the taxation divided by the interest expenses. That is interest coverage ratio. So what does this tell us? Interest coverage ratio, ability of a company to pay interest on its debt. So it helps in understanding the present risk of a firm that a bank is going to give loan to. Correct. It helps in evaluating the emerging risk of a firm that bank is going to give loan to. Emerging risk, correct. It the higher a borrower firm's level of interest coverage ratio, इसका मतलब ability to repay loan ज़्यादा है. Versus ability to serve. This is wrong. So only 1 and 2 are correct. Next, if you withdraw 1 lakh rupees in cash from your demand deposit account at your bank, the immediate effect on the aggregate money supply would be, if you withdraw 1 lakh rupees in cash from your demand deposit account. देखना, aggregate money supply usually क्या होती है? M3 होती है. ठीक है, अब M3 में हमने देख लिया क्या aggregate money supply में. एक तो currency in circulation है, और क्या देखा M3 में हमने? Time deposits देखा है ना. M3 by M naught ही तो है, या currency in circulation plus commercial bank demand deposits plus commercial bank time deposits. ये है ना free time deposits. तो currency in circulation plus demand deposits plus time deposits. If you withdraw 1 lakh rupees from bank, करेंसी इन सर्कुलेशन में कितना ऐड हुआ? 1 लाख ऐड हुआ. डिमांड डिपॉजिट्स ऑफ कमर्शियल बैंक से कितना सब्ट्रैक्ट हुआ? -1 लाख सब्ट्रैक्ट हुआ. तो इफेक्ट कुछ दिखा? M3 हैज नो इफेक्ट, सो इट विल बी अनचेंज्ड. Now let us see evolution of interest rate regimes in India. Okay. Now first we have benchmark prime lending rate. Here the loan lending rate, it is usually the deposit rate. For example, if banks, they are giving an interest deposit rate of say 2%, of course the lending rate will also be 2%. So the benchmark prime lending rate is equal to deposit rate. It was introduced in the year of 2003. Deposit rate, it is also known as average cost of funds. So the cost that banks are bearing for giving funds to the public, for accepting the deposits of public. So of course, for accepting the deposits, they must definitely give some interest to the public. So that is the average cost of fund, which is also equal to deposit rate. So that rate they are equating to the lending rate, benchmark prime lending rate. Okay, that is the first lending rate which was introduced in 2003. Anyways, it was abolished, and in 2010 they had a base rate. So banks started using base rate in 2010. That includes four parameters: deposit rate or average cost of funds, plus cost for maintaining CRR and SLR. That is nothing but adjustment for the negative carry in respect of CRR and SLR, plus operation expenses. ऑपरेशन के लिए भी खर्चे होंगे. अब ऐसे थोड़ी है कि डिपॉजिट रेट के बराबर इसका लोन रेट भी होगा. नहीं, क्यों? Banks, they are maintaining CRR, SLR, and they are also having some operation expenses, and also you need to consider the profit margin. So these three extra parameters must also be added to the deposit rate, and that must be equal to the lending rate of banks. That is named as base rate 2010. Okay, you know the operation expenses and cost for maintaining CRR, SLR, adjustment for the negative carry, okay, of CRR and SLR. But what is this profit margin? Profit margin is nothing but net income divided by total revenue. For example, banks, what they are having is they are having revenue from the revenue can be interest revenue and non-interest revenue. Non-interest revenue implies from ATM fee they might be getting revenue, from giving loans they might be getting some interest revenue. So they are all total revenue. So from that revenue, if you are subtracting the operational expenses, that will give the income of the bank, right? That is the net income of the bank. So revenue minus expenses. So profit margin is net income by total revenue. Okay, that is also said as amount of net income returned as percentage of shareholder funds. Shareholder funds यहाँ पे नीचे amount of net income return. So that is profit margin. After considering all these considerations, you will see this will be different for different banks. For example, HDFC बैंक का profit margin ज़्यादा होगा क्योंकि उसका net income ज़्यादा है, और else तो या फिर SBI का कम हुआ होगा. So accordingly they will set the base rate by using these four parameters. Okay, that was in the 2010, but again in 2015 there is this famous MCLR, marginal cost of lending rates 2015. इसमें क्या हुआ है कि they had four components: marginal cost of funds plus negative carry on CRR. We don't have SLR here, and then operation expenditure and tenor premium. So this time the time duration is also considered. For example, after considering this tenor premium is nothing but additional cost for the duration of the loan. If it is for one night, of course one night के लिए ही हम लोन दे रहे हैं, तो ओवरनाइट लोन्स के लिए हम ज्यादा करेंगे, या फिर बैंक के हिसाब से होगा. फॉर एग्जांपल, लेट्स से द टाइम पीरियड इज वेरी लार्ज, देयरफॉर इन्फ्लेशन माइट बी देयर, सो वी विल इंक्रीज यू सम मोर इंटरेस्ट. सो फॉर 1 year MCLR it might be more. Similarly, you have different types of MCLR. They can be one night, 1 month, 3 months, 6 month, or 1 year MCLR. Okay, MCLR 2015, marginal cost of funds, negative carry on CRR, operation cost plus tenor premium, 92% marginal cost of borrowing plus 8% return on net worth. Okay, this is the third one. So after wait, you have not seen what is marginal cost of fund. Marginal cost of fund is nothing but 92% of marginal cost of borrowing plus 8% of return on net worth. Marginal cost of borrowing is nothing but, see, you are borrowing, I mean you are taking money, I mean you are depositing money. For that money, of course, banks need to pay interest, right? So uska hum 92% लेंगे, similar to deposit rate, marginal cost of borrowing. And other, we are taking 92% of it, of course, but we're also taking 8% of return on net worth. Return on net worth meaning opportunity cost that bank is losing. For example, bank might use that land, property, or building for giving rent or something else. So the opportunity cost that bank is missing. So return on net worth, all of them, I mean the money that bank is having, instead of lending it as loans, bank would have invested in somewhere and might get some returns out of it. So there are many scenarios where that money can be utilized. So 8% on return on net worth plus 92% of marginal cost of borrowings. So both of them, they account to marginal cost of fund. So these four components, they are being considered in marginal cost of lending rate 2015. Okay, the next we had is external benchmark rate 2019. So what we have seen: benchmark prime lending rate 2003, base rate 2010, marginal cost of lending rate MCLR 2015, and next we have external benchmark rate 2019. So this is the last one, and currently we are following external benchmark rate 2019. Okay, MCLR was replaced by external benchmark rate for some reasons. The some reason being, do you know what is policy rate? Policy rate is the rate of central bank of a country. So for our India, it is a repo rate, which is the policy rate of India. Now, this repo rate RBI uses very frequently so that it can inculcate a monetary policy transmission into Indian banks. For example, RBI will assume that if its repo rate increase, banks are going to lend less money to people as loans. Or else RBI will think, okay, bank, if I increase repo rate, banks are also going to increase their lending interest rate, and that is how loan supply or money supply in the economy will reduce. But actually, many banks are not doing that. They want to increase their profit. That is why even if repo rate is increasing, banks, they are not increasing the lending loan interest rate. Therefore, to inculcate this monetary policy transmission (MPT), RBI introduced this external benchmark rate. Okay. This was recommended by Urjit Patel committee in 2018. Okay, monetary policy transmission. So according to this, banks can choose one out of the four external benchmarks that is providing. So anyone, for example, banks can lend loans only at the repo rate. It is very easy. Repo rate पे ही होगा, तो easy monetary policy transmission तो होगा ही. And then we have 3-month treasury bond yield. It can also be used. Treasury bond yield is yield divided by bond price. तो 3 महीने का कितना interest आया, that is 3-month treasury bill yield divided by the bond price. वो yield हो सकता है, या फिर 6-month treasury bill yield हो सकता है, or else any other benchmark interest rate published by Financial Benchmark India Private Limited. So repo rate, 3-month treasury bill, 6-month treasury bill, or whatever Financial Benchmark India Private Limited is saying. So out of them, for any one can be chosen by our Indian banks. Okay, and Indian banks, they might reset this lending rate for every 3 months, at least once in 3 months. They must do this. So what is this Financial Benchmark India Private Limited? You know, this is private limited. Therefore, it is registered under Companies Act of 2013 because it's a company first, and it is recognized by the RBI, of course. And then its main objective is to administer the Indian lending rates and to administer India's foreign exchange benchmark. So they are being taken care by Financial Benchmark India Private Limited. Okay, they are about the external benchmark rate. I think you're clear. Now let us say two types of rates. One is fixed interest rate and floating interest rate. People often get confused here. Fixed interest rate is nothing but if you are giving it at 3% only, so that 3% will be fixed throughout the 3 years time period that you have locked in. But floating interest rate will change. For example, if you think that in there is a demand in the market and therefore interest rate they must be increased. So in such cases, according to the market, they will change the interest rate. That is floating interest rate. Okay, so these are the two types of interest. And EMI also in the fixed, of course, you need to pay fixed EMI, but in the floating, they will say that see there is a high demand, now you need to pay a very high EMI. Therefore, this floating interest rate, it is affected with inflation, whereas fixed interest it is not affected by inflation. Okay, this is the main difference between fixed and floating interest rate that you should know. We have seen four types of lending rates, right? What did we see? Benchmark prime lending rate 2003, base rate 2010. We have seen MCLR, marginal cost of lending rate 2015, and external benchmark rate. Any one of the four must be chosen, right? That is 2019. And currently, we are following external benchmark rate after Urjit Patel recommendation in 2018, so that we can have better monetary policy transmission. Now, this is also a rate, merchant discount rate, but a lot of people think that they get confused with the lending rates. This is completely a different concept. Merchant discount rate is like, for example, there's a merchant, okay? There's a merchant here, and of course, he's having a QR platform. Let's say he's having a Paytm Karo wallet platform. Now, you are going and buying some biscuit packet worth 10 rupees. Like, out of this 10 rupee biscuit packet, 9 rupees will go into the merchant account, 1 rupee will be deducted from the merchant bank account, and this 1 rupee which is deducted from the merchant bank account, it will go to the platform. Okay, and this platform can choose to give certain amount of fee to the customer bank account, the customer who paid this 10 rupees, right? That fee is called interchange fee. They can sometimes be zero also, they can sometimes be 50% also, any like. For example, if this platform service, if it is having some tie up with this customer bank account, and this customer bank account, if say uske card पे ऐसा है कि RuPay है, तो ये POS machine है. Let's imagine it's a POS machine and it used a RuPay service. Therefore, they will say that okay, since we are tied up, for every transaction we are doing, we will pay you some fee, interchange fee. So that kind of deal can also be there. So this interchange fee, it depends upon the tie up between the platform and the customer bank. But usually this 1 rupee will be deducted from the merchant bank account to the platform which is providing the service. Now if we see UPI, it doesn't have any merchant discount rate, and most of the merchants therefore they are using this UPI. And POS machine कहीं पे दिखता नहीं है, merchants खुद use नहीं करना चाहते क्योंकि उसके ऊपर extra charges लगेगा. So that is the case. That is about merchant discount rate. Now let us see some of the monetary policy stance. Okay, monetary policy stance. It basically shows the RBI. I mean the direction RBI would like to take to achieve its objectives like inflation targeting or healthy monetary policy maintain करना. तो वो stance कैसे है वो बोलने के लिए. For example, that stance can be accommodative, it can be neutral, and we can also say monetary policy stance of RBI is hawkish, and we can also say it is calibrated tightening. So what's the meaning of accommodative monetary policy stance? Accommodative meaning expand. Okay, इसका meaning है कि expansionary monetary policy. Expansionary monetary policy, we also call it as easy monetary policy. Because why? Here RBI is trying to reduce all the interest rate like repo rate, and it is trying to lend more loans to the public. So more loans देंगे public को, interest rates को कम करेंगे, तो इससे क्या होगा, लोगों के पास ज्यादा पैसा आएगा, ज्यादा खर्च करेंगे. So yes, they are lending more loans to the public. That is expansionary monetary policy. This will lead to inflation. I mean, if there is recession, usually RBI would try to adopt adaptive, accommodative, or expansionary or easy monetary policy. Okay, this is accommodative monetary policy, nothing but expansionary. Now, what is neutral stance? Neutral stance meaning RBI is not doing anything. It is neither cutting or increasing rates. Okay, that is a neutral stance. So, if RBI thinks that inflation is important and at the same time growth is also important, so RBI is thinking that there is inflation because there is growth in the economy. I don't want to do any changes. In such a scenario, RBI will not do anything. That is neutral stance of RBI. Now, let us see hawkish stance. इसपे क्या होगा कि this is contractionary monetary policy. Sometimes it is also known as tight monetary policy. हॉकिश में टाइट होगा, हॉकिश टाइट करेंगे. सो इट विल ट्राई टू कर्ब मनी सप्लाई एंड रिड्यूस द डिमांड. उसके लिए आरबीआई क्या करेगी, इंटरेस्ट रेट्स को बढ़ाएगी. सो आरबीआई विल ट्राई टू इंक्रीज इंटरेस्ट रेट सो दैट मनी सप्लाई इन द इकोनॉमी विल रिड्यूस एंड डिमांड इन द मार्केट विल रिड्यूस, एंड दैट्स हाउ इन्फ्लेशन ऑफ गुड्स एंड सर्विसेज विल रिड्यूस. सो दिस इज हॉकिश और कॉन्ट्रैक्शनरी मॉनेटरी पॉलिसी ऑफ आरबीआई. वी हैव कैलिब्रेटेड टाइटनिंग ऑफ आरबीआई. इसमें क्या होगा कि आरबीआई विल कैलिब्रेट ईच एंड एवरी स्टेप. आरबीआई विल थिंक दैट अगर इन्फ्लेशन 4.2 होगा तब मैं इंटरेस्ट रेट को बढ़ाऊंगा, बिकॉज आई वांट टू कीप इट 4, बट फॉर एवरी पॉइंट टू आई विल ट्राई टू इंक्रीज. सो कैलिब्रेशन के साथ जब आरबीआई टाइटन करना शुरू करती है उसको हम बोलते हैं कैलिब्रेटेड टाइटनिंग ऑफ आरबीआई. ओके, कैलिब्रेटेड टाइटनिंग मींस during the current rate cycle, a cut in repo rate is off the table. That is calibrated tightening. So that rate hike, it is happening in the calibrated manner. Now we have seen monetary policy stance of RBI. It can be accommodative, neutral, hawkish, and calibrated. Now let us see what are the qualitative instruments of RBI, and after qualitative instruments, we are going to see quantitative instruments of RBI. So qualitative. So qualitative में पहला आएगा CRR SLR. पहले इन दोनों को हम डिस्कस करेंगे, उसके बाद हम डिस्कस करेंगे रेपो रेट एंड रिवर्स रेपो रेट. Okay, that's one thing. So what is the CRR? Okay, one question I would like to ask you: is there a maximum limit for CRR? We have seen no, there is no maximum limit for CRR, but there is a maximum limit of 40% of net demand time liabilities for SLR. CRR is cash the amount of cash required by banks to keep it with RBI. So cash required to keep with RBI is a CRR, right? That is cash with required to deposit RBI divided by NDTL, net demand time liabilities. This is what you have seen in the beginning of the lecture. And SLR, it is nothing but the liquid assets like gold, cash, and securities that banks need to keep them with themselves divided by net demand time liabilities. Okay, unlike CRR, SLR will generate profits for the bank. Of course, they are going to get some interest, right? SLR. But for CRR, RBI is not going to give them any interest for the reserves that they are depositing with RBI. So there is no interest earnings on CRR, but on SLR we have seen that there are some interest earnings on SLR. And also we have seen that SLR is applicable for NBFC D, And CRR, it is not applicable to any NBFC, whether it is NBFC or NBFCDs, उसके ऊपर CRR नहीं है. And then usually we have seen that it is usually 4% of NDTL, but there is no maximum cap. But SLR, it is usually 18% of NDTL, and I think there is a maximum cap of 40% for SLR. Okay, these are the points that you should know. So just remember that there is no max cap. There is no max cap, but here there is 40% NDTL. And also for this marginal standing facility also there is some cap. I think it is 2% of NDTL hoga. I'll tell you what's marginal standing facility also. So fine. So these are the qualitative instruments, CRR and SLR, which you already know. Now let us see which you don't know. In SLR, I want to tell you one thing. Do you know what is crowding out and crowding in SLR? For example, what happens is government borrowings. It becomes important. When government is borrowing a lot from banks, government ज़्यादा borrow कर रही है, तो पैसा ज़्यादा किसके ऊपर जा रही है? Government के पास. And then they are getting definitely government securities. So they will increase their SLR. वो तो सही है, लेकिन government तो borrow कर रही है ना. अगर SLR बढ़ेगी, तो government borrowings will increase. If a government is taking a lot of money, what about private people? I mean corporates. Corporates are getting less money for investment in private sector. So that will lead to crowding out of private sector. If SLR increase, then it will lead to crowding out of private sector. And if SLR decrease, of course, that means government borrowings are reduced. Now private sector will get more loans for infrastructure investment and all. Therefore, SLR, if it reduces, it will lead to crowding in. The corporates are going to get a lot of money for investing in capital. That is SLR. So these are the two effects that are associated with SLR, crowding out and crowding in, which you know. Crowding out, it has immediate effect. Crowding in, it takes place because see, as soon as government take loans, of course private sector is not having money. That's an immediate effect. But crowding in for building capital and all, it will take time. Okay. I mean, even if government borrows, even if government borrows and even if a government tries to incorporate infrastructure development, that will take time. Okay. Okay, that is all. That is about CRR SLR. Now let us see repo rate and reverse repo. The third, this is 1, 2. I'll mark it 1 and 2. Now I want to see the third one, that is repo rate. No. Before repo rate, I want to see liquidity adjustment facility, which I did not mention here. Let me tell you, you are a bank. Okay. And there is an RBI. Now banks need some loan. Therefore, RBI is going to lend loan, usually for 15 days. Okay, for that, banks need to put some collateral. So repo rate is nothing but the rate. RBI is going to charge some interest rate which is equal to R. Okay, repo rate, R%. So repo rate is nothing but interest rate which RBI lends short-term loans to banks, usually 15 days, for only government security. So this collateral must be a government security. That is a repo rate. Okay, and banks prefer to borrow at repo rate due to interlinkage between repo and reverse repo market. Okay, so for example, in the same scenario, we can take this as bank and this as RBI. Now what can happen is RBI can give some, okay, banks can deposit some money to RBI. And for that, RBI can give some collateral to these banks in the reverse repo. So this collateral, it can be the same collateral which banks have initially deposited with RBI. So that collateral can be used by the banks. Okay, so reverse repo, it is nothing but rate at which banks deposit their surplus amount with RBI. Okay, simply putting repo rate is rate at which RBI lends short-term loans to banks for only government securities. Rate at which RBI lends short-term loans to banks for only government securities. And then a repo rate, reverse repo rate, it is nothing but rate at which banks deposit their surplus amount with RBI. Okay, that is repo and reverse repo. One thing you need to notice that in repo and reverse repo, banks cannot use SLR securities. So collateral हो सकती है, repo reverse repo में collateral use कर सकते हैं, and same collateral can be used by RBI. But one thing you need to notice that SLR securities cannot be used for repo or reverse repo. SLR securities नहीं use कर सकते, कोई और भी use कर सकते हैं. So that is repo and reverse repo. And liquidity adjustment facility is the difference between repo and reverse repo. For example, if you see repo rate here, it is around 6.5%, and reverse repo can be anything. Now MSF और SDF, इसके ऊपर भी हम बात करेंगे. आपको समझ में आ गया ना कि रेपो रेट और रिवर्स रेपो क्या है? रेपो रेट इज रेट एट व्हिच आरबीआई लेंड्स शॉर्ट टर्म लोन्स टू बैंक्स at only government interest, and reverse repo is rate at which banks put their surplus funds with RBI. Okay, nice. Now we need to see what is liquidity adjustment facility and SDF to understand this diagram. A liquidity adjustment facility, it is a facility provided by RBI to banks to manage their short-term liquidity mismatch mainly through repo and reverse repo markets. That is liquidity adjustment facility. It is a facility provided by the RBI to banks to manage their short-term liquidity mismatch mainly through repo and reverse repo market. That is why liquidity adjustment facility is repo minus reverse repo. Okay, now you understood, you got some basic idea. Now let us see what is MSF and SDF, marginal standing facility, and SDF, standing deposit facility, in the diagram. As you can see, marginal standing facility margin के बाहर है, margin के बाहर stand कर रही है. Margin क्या है? Repo है, लेकिन उसके बाहर स्टैंड कर रही है, तो वो क्या है? मार्जिनल स्टैंडिंग फैसिलिटी है. रेपो, ये रेपो मार्जिन के बाहर मार्जिनल स्टैंडिंग फैसिलिटी. ओके, लाइक दिस यू कैन रिमेंबर. सो दिस एमएसएफ इट विल बी हायर देन रेपो रेट. ओके, एंड यूजुअली एमएसएफ का मतलब यही है कि आरबीआई प्रोवाइड्स ओवरनाइट लोन्स टू बैंक्स. एमएसएफ इज नथिंग बट ओवरनाइट लोन्स. So RBI provides overnight loans to banks at an interest rate higher than repo rate. RBI provides overnight loans to banks at an interest rate higher than repo rate. That is marginal standing facility. It is almost equal to repo rate only, but it is not overnight loans है. Okay, तो इसमें क्या होगा कि इसमें ना LAF में ऐसा है कि SLR securities नहीं यूज कर सकते कोलैटरल में, बट हियर SLR securities can also be used. Okay, SLR securities can be used. Marginal standing facility. That is about marginal standing. Now if you see standing deposit facility, इसमें तो no collateral is used. Okay, there is no collateral required. What is standing deposit facility, by the way? It is similar to reverse repo. Just like MSF, which is similar to repo, SDF, it is similar to reverse repo. So RBI, it is allowing banks to keep their surplus funds. Okay, that's all. RBI allows banks to keep their surplus with RBI. So that is SDF, and they do not require any collateral also. But that rate is even lower than reverse repo usually. Okay, nowadays what happened is reverse repo, it became very redundant, and people started using this SDF only. Okay, so SDF versus reverse repo. Though reverse repo operations are there, SDF does not require any collateral. Therefore, RBI replaced reverse repo with SDF in 21-21-22. So currently there is no reverse repo and it was replaced with SDF. Therefore, in the textbooks when you see formula LAF का formula, इसमें आप देखोगे कि repo minus सीधा SDF होगी, reverse repo नहीं होगी, क्योंकि reverse repo it was replaced by SDF in the year of 2022. So currently there is no reverse repo. I mean banks definitely why reverse repo में collateral लगेगा, RBI को collateral देना पड़ेगा ना, बैंक्स के साथ डिपॉजिट कर, I mean banks want to deposit with RBI and then RBI is giving collateral to banks. So इसको क्या RBI को क्यों collateral देना है? That is why RBI thought of replacing it with SDF. Now in SDF there is no collateral required only. So without your collateral, RBI is not going to give any collateral to banks, and the banks they are going to deposit their surplus funds with RBI. That's all. That is SDF. So in textbooks you see formulas which have repo minus SDF as LAF. LAF is actually repo minus reverse repo. In some textbook you see it as repo minus SDF. Okay, that is about repo, SDF, and so on. And liquidity adjustment facility also you have seen. One more question: who introduced this liquidity adjustment facility? LAF, it is introduced by Narasimhan Committee in the banking reforms in 1998, and there he said that it must have repo and reverse repo. Now reverse repo is SDF. Okay. See, this is variable rate reverse repo. Now you know the basic meaning of reverse repo, right? Reverse repo का मतलब क्या है कि surplus funds, okay, banks, the surplus funds that banks need to deposit with RBI, okay, that is reverse repo. That was replaced with SDF, that you already know. Okay, reverse repo में collateral लगेगा, SDF में collateral नहीं लगेगा, उतना ही difference है. अब VRR क्या है? Variable rate reverse repo. इस variable rate मतलब जो reverse rate repo है, उसका rate variable कर रहे हैं हम. Variable मतलब कैसे variable कर रहे हैं हम? We are making it variable through an auction. We are doing an auction. What RBI is thinking that, see, for example, if people want to deposit with RBI, definitely they will find this reverse repo very unattractive. कितना है reverse repo? 3% है. And banks will think 3% में RBI में क्यों इन्वेस्ट करना है, हम तो कोई और बैंक में इन्वेस्ट कर लेते हैं, HDFC में इन्वेस्ट करते हैं, वहाँ पे तो 5% का डिपॉजिट रेट इंटरेस्ट मिलेगा, RBI में 3% में कौन करेगा. So banks might feel it as unattractive. But tell me one thing, is that what is the safest bank all over the India? It's RBI. So definitely some banks they are willing to deposit with RBI for sure. So that's why RBI is thinking to conduct an auction. Auction करेगी variable repo rate का. RBI will say I want 10,000 rupees deposits in my bank. Let's say 1 lakh rupee deposits into my account. RBI will say this. But why RBI is saying this? RBI is not doing any business. But why RBI wants? Because RBI want to suck some money from the economy. That is why RBI is doing this. RBI will say that I want this much money into my account. Therefore RBI will say okay, you are finding this 3% as unattractive. I will do an auction and tell me कि कितने % interest के ऊपर आप deposit करना चाहते हो. So RBI will ask banks. Then banks will say some bank will vote for 3.5 and one bank it voted for 3.7. They are the lowest bids in the auction. RBI will prioritize the 3.5. Okay, you are ready to deposit 1 lakh on 3.5%. Then I will choose you. So RBI will choose to fix the variable rate reverse repo as 3.5% instead of 3.7. 3.7 तो बहुत ज़्यादा है. RBI को ज़्यादा interest pay करना पड़ेगा ना. So RBI will choose 3.5%. So that is based upon the auction route. Since reverse repo is unattractive, through auction route RBI is finding the better reverse repo, that is variable rate reverse repo. That's all. And it was used in the year of 2021. In 2019 to 2020 क्या हुआ कि कोविड हुआ, तो उस टाइम पे RBI ने 9 लाख अराउंड 9 लाख करोड़ रिलीज किया कोविड के टाइम पे एक्सपेंशनरी मॉनेटरी पॉलिसी में. So RBI want to suck some money, therefore RBI used this variable rate reverse repo to suck the expansionary money that it was used during the COVID period. That is VRR. So interest rate corridor, when we see this term interest rate corridor, it is nothing but difference between MSF and SDF. Okay, right? So MSF minus SDF is interest rate corridor, and usually the difference that you see is that repo rate और MSF के बीच में 25 basis point का difference होगी usually, and SDF to repo rate the difference must be 25 basis point. For example, if repo rate is 6.5, 25 basis point मतलब 0.25 ऐड करेंगे तो क्या होगा, 6.5 0.25 ऐड करेंगे तो 6.75 बनेगा. 6.75 can be the maximum MSF for the repo rate that RBI is issuing. So similarly you can determine SDF also. For 25 basis point हम कम करेंगे. So the difference between MSF and SDF it must be 50 basis point. This is something you need to know. MSF and SDF. The difference between MSF and SDF it is called IRC, interest rate corridor. Liquidity adjustment facility is different from IRC. How? Liquidity adjustment facility, I said it is repo minus reverse repo under the same collateral. Reverse repo it was recently replaced in 2022. It was replaced with SDF. And interest rate corridor it is nothing but MSF minus SDF. Okay, that is the difference between interest rate corridor and liquidity adjustment facility. And one more thing you need to know is that when they ask you what are the maximum bounds for a liquidity adjustment facility, of course you know that it is repo minus reverse repo. But when the examiner is asking you the maximum bounds, then the maximum bound for repo it is MSF, and the maximum bound for reverse repo it is SDF. So maximum bounds if they're asking for liquidity adjustment facility it will be MSF minus SDF. Okay. Now you have seen liquidity adjustment facility, interest rate corridor, and then after that you have seen that liquidity adjustment facility is repo minus reverse repo, and interest rate corridor is MSF minus SDF, and you have seen MSF. What is MSF? Marginal standing facility. That is nothing but almost equal to repo rate. Overnight loans lent by RBI to banks, and the maximum cap is it is 2% of NDTL. That is a marginal standing facility. And SDF it is standing deposit facility. It is similar to reverse repo, but there is no collateral. And after 2021 2022 it became redundant, and I mean reverse repo rate became redundant, and it was replaced completely by SDF. Okay, and then we have also seen variable reverse repo rate, where rate reverse repo it is fixed based upon some auction. Okay, and what next? Bank rate. Bank rate क्या है? See, even in the bank rate there is no collateral required. Now one thing, collateral कहाँ पे required है, कहाँ पे required नहीं है. अब collateral कहाँ पे required है? Repo rate, does it require collateral? Yes, repo reverse repo they require collateral ना. Collateral तो required है. And next what about MSF SDF? MSF collateral required है, but you can MSF is overnight loans ना. You can also put what? SLR securities. Even XLR securities are allowed for MSF because they are in a liquidity tight situation. तो उस टाइम पे RBI करेगी चलो SLR securities लगाओ कोई बात नहीं. And then SDF में कोई no collateral is required. Okay. And bank rate also do not require any collateral. See, bank rate it is similar to repo rate where collateral is not required, and SDF it is also similar to reverse repo, and there also there is no collateral required. Okay, and one more thing, we need to see what actually bank rate is. Similar to repo, but it is for long term. That's all. That is bank rate. Long term है. इतना याद रखना कि similar to repo, but for long term, that is bank rate. We have some more qualitative instruments like open market operations, for example. What is open market operation? Basically, RBI will sell government securities and will purchase government securities. I mean, see, RBI will sell government securities. Why? So that it can suck more money. उसमें क्या होगा, इन्फ्लेशन कंट्रोल हो जाएगा. सो दिस आरबीआई सेलिंग एंड बाइंग गवर्नमेंट सिक्योरिटीज फॉर कंट्रोलिंग द इकोनॉमी, इट इज कॉल्ड ओपन मार्केट ऑपरेशन. यूजुअली गवर्नमेंट सिक्योरिटीज होगी, बट इन जनरल इफ इट इज मल्टी ऑप्शंस, इफ देयर आर मल्टीपल ऑप्शंस, correct, then you can also tick like for whatever operations that RBI is using for controlling the economy, whether to reduce or increase inflation by increasing repo rate or reducing repo rate, all of them they come under open market operations only. But yeah, specifically if you need to select a single option, then select it as government securities. Okay, using government securities to control inflation or economic policy, monetary economic policy. That is open market operation. And next, MSS. What is MSS? MSS is market stabilization scheme. Okay, market stabilization scheme, it is basically an instrument for monetary management which was introduced in the year of 2004. Okay, this you need to know. Market stabilization scheme, it was introduced in 2004, and it is a tool used by the RBI to suck out excess liquidity from market through issuance of securities like treasury bond, dated securities, and so on. Okay. So by market stabilization scheme, RBI issues treasury bills and dated securities, whether long term or short term government securities. RBI is going to issue them, and what is RBI going to do? It is going to suck some excess liquidity from the market. That is market stabilization scheme. So OMO के साथ कैसे different है ये? OMO में भी वही तो use हो रहा है ना? So this MSS, it is usually used to observe excess liquidity resulting from foreign exchange inflows. Foreign exchange inflows, okay, that you need to know. To manage foreign exchange inflows. इसको मैनेज करने के लिए हम क्या करते हैं, ट्रेजरी बिल्स बाय और सेल ऐसे करते हैं. सो आरबीआई इज गोइंग टू बाय एंड सेल दिस लॉन्ग टर्म एंड शॉर्ट टर्म गवर्नमेंट सिक्योरिटीज टू एडजस्ट द एक्सेस लिक्विडिटी रिजल्टेड which was resulted from foreign exchange inflows. Okay, that is market stabilization scheme. Open market operations are regular routine liquidity management facilities that RBI usually routinely it can do to control the inflation. And in MSS, there is one more difference. MSS, the funds raised through MSS bonds, they are deposited in separate MSS account. There is a separate MSS account with RBI, and this MSS account, the money, whatever it is there in this MSS account, it cannot be used by the government for its expenditure. So cannot be used as government expenditure. So money in the MSS account cannot be used in the government for the government expenditure. It is separately kept with RBI only. Whereas in the OMO, if RBI is doing that, buying and selling government securities, so funds raised through such government securities are directly used for the government expenditure. Okay, that is the difference. Usually MSS is short term again. Why I'm saying it is short term, because see, when there are huge foreign inflows or lot of if you are seeing a lot of FDI withdrawals, then in such scenario RBI is going to use MSS for some short term period. Okay, or else during demonetization. This is usually for short term, whereas OMO, it is systematic money supply and frequent intervals. On frequent intervals RBI can use OMO. तो MSS में bonds जो issue होगी वो specialized होगी. So RBI is going to issue some specialized MSS bonds or specialized treasury bills which are not going into government account. So they are specialized. But in OMO, the government bonds which RBI is going to sell and purchase, they are already existing. And in MSS, there are some new specialized. So these are the main differences between OMO and MSS: open market operation and marginal standing, not marginal standing, sorry, market stabilization scheme. So there's a difference between market stabilization scheme and open market operation. Okay. Now, operation twist. What is operation twist? That you need to know. Operation twist is something important that I will tell you in the end. But before going into this operation twist, which is a monetary policy instrument, qualitative monetary policy. Now let us see some quantitative monetary policy instruments. And after seeing that, let us see that operation twist and finish the chapter. Okay, what are these quantitative instruments? So the first quantitative instrument we are having is what is that? Margin requirement. So what is margin requirement? Usually margin requirement is something which is called the difference between the collateral and the amount granted as loan. Okay, that is margin requirement, and usually this collateral amount is higher, so that people will not demand more loan value. I mean, even if people default, we are going to have some collateral which is higher than the loan value. That is the concept behind the margin requirement, and this is a quantitative instrument that banks can use this. Okay. And usually during inflation, the margin requirement, it will be high. Implies collateral minus loan value, this value will increase during inflation. Okay. And during recession, this value might decrease. So this is one quantitative instrument. The second quantitative instrument is customer credit regulation. Customer credit regulation, what is this? So it is like customer credit regulation. So basically, you are issuing rules regarding the payments and maximum maturity period for installment credit. For example, is the best example EMI. I'll write it with blue pen. EMI. So here, what you are doing, you are issuing some rules. And you are telling the 10-month installation period, हर महीने में इतना install करना पड़ेगा, या फिर 20-month installation period. So different periods you are having to pay this monthly loans. Okay, that is EMI. That is one best example for customer credit regulation. And the third one, you are having guidelines. Guidelines. Usually RBI can issue guidelines such as oral or written statements, so that RBI can warn banks. For example, RBI is going to use this prompt corrective action, right, PCA. तो उसमें RBI क्या करेगी कि RBI बोलेगी ना, see, you know, prompt corrective action. This is prompt corrective action. So basically RBI is going to see two parameters. One is CAR and the other is net NPA. We will discuss more in depth later. So CAR is capital assets divided by risk assets. I mean, so that is CAR. So they are going to see if the CAR is high or not. If CAR is high, it is okay. If capital is high more than risk, then it's okay. But if CAR is low, then it is a problem. Then RBI is going to use these two parameters in prompt corrective action and going to issue some guidelines. And RBI is also going to say net NPA, net, not gross. नेट एनपीए में अगर ग्रॉस एनपीए है तो उसमें सिर्फ लाइबिलिटी होगी, लेकिन नेट एनपीए में ग्रॉस है ना एसेट्स को सब्ट्रैक्ट करके हम देखते हैं, तो वो नेट एनपीए बन जाएगा. सो आरबीआई इज गोइंग टू सी दिस नेट एनपीए लाइबिलिटी एंड माइनस एसेट्स एंड इट इज गोइंग टू गिव सम गाइडलाइंस. So this is prompt corrective action of RBI. RBI, and this is also an example for guidelines. Warn. I wrote warm. It's not warm. It's warn. Okay, warn. Issue prompt corrective action. So all of them can happen under the guidelines of RBI. Now rationing of credit. For example, RBI can sell that CCC. See, my dear bank, you are giving all the loans to private sector. You need to give some loans to the MSMEs also and some to the agriculture also. All such things RBI is going to say. Then that is priority sector lending. So at least 40% of your loans must be to the priority sector such as MSME and agriculture. Then that is priority sector lending. Rationing of credit. That can also happen, which is a quantitative instrument. So quantitatively, you are telling that a certain loan must go to them, certain must go to them, and you can also do moral suasion. What is moral suasion? RBI can morally persuade banks to say them, I accept my repo rate. So monetary policy transmission, no one is accepting. So RBI can tell banks that, see, I reduce the repo rate so that you will also reduce repo rate and increase the inflation in the economy. So that RBI can do some moral suasion to the banks. That is also a quantitative monetary policy instrument, direct action. So if prompt corrective action, I think it is an example of direct action rather than guidelines. So in a PCA, definitely RBI can use some direct action and tell that you will be disqualified to be a bank from here on because your risky assets have increased a lot and you will go into bankruptcy. So clear all the assets and liabilities and close the bank. RBI can tell that. RBI can even take direct action. That is also quantitative instrument. So margin requirement, which is collateral minus loan, customer credit regulation, example EMI loans, and guidelines of the bank, guidelines to the bank, rationing of credit, example priority sector lending, moral suasion, example monetary policy transmission के लिए persuade करना, and then direct action, example prompt corrective action and strict measures. So all of them, they come under quantitative instruments. Quantitative tools, they are used to control quantity of money supply in the economy, but qualitative tools, they are used to control the quality of money supply in the economy. That is the difference between quantitative tools and qualitative tools. Now RBI can use both quantitative and qualitative. For example, repo rate. Increase in repo rate, it will increase money supply in the economy, therefore quantitative. Similarly, reducing repo rate will reduce the money supply in the economy, it is quantitative. Similarly, the rates that we have seen like reverse repo rate, marginal standing deposit facility, what else did we see? Long-term repo operations. Okay, targeted long-term repo operations. Basically, you are targeting something and you are implementing this repo operation. Targeted meaning, see, in the targeted long-term repo, TLTRO, banks must specifically invest in specific instruments like corporate bonds, commercial papers. So RBI is going to target, that is targeted long-term repo. Okay, and we also have forex swap, SLR, CRR, open market operation, market stabilization scheme, and they are all the tools which are called quantitative tools. Here there is also GSAP. GSAP is GSEC, Government Securities Acquisition Program. Okay, that we have studied. Studied in the monetary policy. Okay, fine. They are part of open market operation only. RBI GSAP program. GSAP program. Yeah. Okay, fine. Anyways, these are all the quantitative tools, right? There is this term operation twist that is also quantitative. They are also similar to buying and selling government securities only. Basically, RBI simultaneously buys long-term government securities and then sells short-term treasury bills. So the primary goal is to lower the long-term interest rate to make the borrowing cheaper. That's why RBI would do that. That is operation twist. You are buying and selling, but you are selling short-term and you are buying long-term. All of them, they are quantitative tools. If you see qualitative tools, we have margin requirement. Basically, remember it as requirement of a collateral for certain loan. It is a difference between loan and a collateral value. Different margins have different collateral requirements. Different margins, different loans, they have different collateral requirements. That is nothing but difference between loan and collateral value. Different margins have different collateral requirements. Next, consumer credit regulation. They are the rules set. I mean, they are the maximum and minimum regulation limits set for the payment and for the period of payment for purchase of any goods or services, etc. So that is about consumer credit regulation. Okay, minimum or maximum limit set for the down payment and periods of payment. Okay, minimum or maximum level limit. Variable portfolio ceiling or rationing of credit. Credit rationing is limit the maximum amount of loans and advances for specific categories. Okay, you are limiting certain loans for specific categories. That is credit rationing. You are rationing the credit by limiting certain specific categories. Now, priority sector lending, you are for vulnerable section. Moral suasion, to persuade the commercial banks to follow the general monetary policy. And direct action, to fulfill the conditions and requirement, you are forcing a direct action against banks. Okay. Now the question. It is a type of a qualitative monetary policy instrument under which the central bank fixes a specific limit of credit to different sectors of the economy. Okay, specific limit is being imposed, right? I think I marked the wrong option. See, marginal requirement is certain marginal loans require certain collateral requirement. That is margin requirement. That is a qualitative monetary policy only. But this definition is wrong. Central bank fixes specific limit of credit to different sectors of economy. What is credit rationing? You are rationalizing your credit, specific limit of credit to different sectors. So credit rationing will match. Direct action is you are just doing some action against a bank. Moral suasion is you are persuading banks to follow monetary policy. Therefore, 43 it's C. And one more thing you need to know, what is this operational twist? Operational twist, it has two steps. Okay. See, basically, if conventional monetary policy is ineffective, then if conventional methods are becoming ineffective, then RBI, it will usually use operational twist. So RBI tried this operational twist in 2019 and 20 when there was an economic slowdown. Okay, basically it has two steps. RBI sells short-term securities and it will raise capital. Okay, so RBI ने sell किया short-term security to raise capital. Okay. सो शॉर्ट टर्म सिक्योरिटीज को सेल किया, कुछ पैसा आया, इस पैसे से आरबीआई क्या करेगी, लॉन्ग टर्म सिक्योरिटीज को बाय करेगी. सो बेसिकली द डिमांड फॉर लॉन्ग टर्म सिक्योरिटीज विल इंक्रीज, देयरफॉर इफ डिमांड इंक्रीज, बॉन्ड प्राइस फॉर लॉन्ग टर्म सिक्योरिटीज विल इंक्रीज एंड दैट विल डिक्रीज द बॉन्ड यील्ड. ओके, इफ bond yield increase, what happens? So basically it implies that economies now they might be currently running in inflation. I mean because RBI purchased short term securities, sorry, RBI sold short-term securities. That is how it got some money. But the interest rate for short-term securities, it is high currently, right? Because bond yield for it is very high. Therefore, interest rate on short-term securities, it is high in the market. Therefore, what did RBI do? RBI cleverly purchased long term. So by selling short term and by buying long term, RBI is making businesses run in cheaper rates in the long term. So that is operation twist. RBI ने twist किया. अभी लग रहा है कि अरे इकोनॉमी में तो इन्फ्लेशन जा रही है, but actually में RBI ने फ्यूचर कुछ सस्ता कर दिया. Now let us try some previous year questions. Which of the following activities of the RBI is considered as part of sterilization? So sterilization, as you know, it is basically RBI conducting open market operations, buying and selling bonds to maintain stability in the market. That is open market operation. Okay. Next, consider the following statement. In the post-pandemic recent past, many central banks worldwide had carried out interest rate hikes. Okay, yes, they have carried, because central banks assume they have the ability to contract the raising consumer price via monetary policy means. It is correct and it is explaining. Okay, option A, right? Option A, correct. With reference to the Indian economy, consider the following statement. If the inflation is too high, RBI is likely to buy government securities. देखो इकोनॉमी में इन्फ्लेशन है तो मनी सप्लाई मस्ट बी टेकन इन RBI must suck some money. So RBI to suck some money, it will issue securities, but it will not buy. I mean, if it buys government securities, let's say RBI is buying securities, that means it is giving loans. So that will even further increase inflation in the economy. So this is wrong. And if a rupee is rapidly depreciating, RBI is likely to sell dollars in the market. See, if rupee is depreciating, that means there are a lot of rupees and there are less number of dollars, right? Therefore, RBI need to sell more dollars. Don't get confused. Therefore, second option is correct. If inflation is too high, RBI is likely to buy government securities. See, RBI buy government securities in place, RBI is going to give loans. I mean, give money to the economy. Money supply will increase. It will further increase inflation. Therefore, this is also wrong. This is wrong and this is right. Next option. If interest rate in USA or European Union were to fall, this is likely to induce RBI to buy dollars. See, if interest rate in USA they are falling, then will RBI buy dollars? See what happens when interest rate in European Union they are falling. Of course, what happens is in the people will be more attracted to India, and of course some investments FDIs are going to increase. Then in this situation, rupee might appreciate. So to control this rupee appreciation, RBI it will buy more dollars. So RBI needs more dollars. That is how it can pump into the Indian economy. In that situation, RBI can buy dollars. Okay. Therefore, 2 and 3 they are correct. Consider the following statements. Tight monetary policy of US Federal Reserve could lead to capital flight. See, tight monetary policy is same as a lower interest rate. Okay. Not lower interest rate, I mean higher interest rate. So basically, by tightening monetary policy, the central bank of that USA, it is going to control money supply in the economy. So during that situation, what might happen? Capital flight might happen. So from India, let's say someone is in US. So interest rates have increased during tight monetary policy. Therefore, any Indian investor, I mean foreign investor who invested in India, might want to invest in USA because now currently US government is providing high interest rate. So since there are high interest rate in USA, there can be capital flight in India and from capital flight from the global market also. Okay, so that is a tight monetary policy of US. It could lead to capital flight. That is correct. Capital flight may increase the interest cost of firms with existing commercial borrowings. See, if you observe the statement, capital flight may increase the interest cost of firms with existing commercial borrowings. So don't be afraid when you're answering this question. Firms. They are firms, let's take Indian firms only, and external commercial borrowings means they borrowed from foreign countries. Okay, they borrowed money from foreign countries, so they need to pay in dollars to them. But what is happening? Dollars, rupee is getting depreciated because there is capital flight in India. So there are less dollars in India, therefore rupee will get depreciated. Their interest cost it is becoming very high because these firms they are earning in rupees. So interest cost will increase. Capital flight may increase interest cost of firms with existing ECB, external commercial borrowing. Okay. Second is also correct. Third, devaluation of domestic currency decreases the currency risk associated with ECBs. See, if you are devaluing our domestic currency even further, how will it control the risk associated with ECB? This is wrong. Okay, so statement is wrong. Therefore, we have only 1 and 2 as correct. Okay. Now let us see. If the RBI decides to adopt expansionary monetary policy, then of course it needs to cut and optimize statutory liquidity ratio. Is this correct? Yes. If RBI want to transmit expansionary policy, it will of course cut SLR, but read the question carefully. They did not bold this not. They will not bold this not in the questions. They will only bold what they wanted. Which one of the following RBI would not do? Okay. ये RBI करेगी ना, therefore करेगी. हाँ. इसको ऐसे 1 mark करना. And then increase the marginal standing facility rate. Marginal standing facility rate, their rate above the repo rate. Okay. Then nothing but overnight loans lent by banks, overnight loans lent by RBI to banks. Okay, they can be given to banks on a collateral. Those collateral can also have statutory liquidity assets. They can also be there. But if that rate is increasing, of course, it will control the monetary policy. It will not expand. This is wrong. Okay. Cut the bank rate and repo rate. Bank rate cut होगा, repo rate cut होगा, so of course loan से ज़्यादा जाएगा. So expansionary monetary policy it is correct. But the question is asking not. Therefore option 2 will be correct. See, when they are asking not questions, just tick. Don't just forget about this thing and just tick mark yes no, and finally mark the options that are no. Okay, be very very careful. Now let us discuss about monetary policy committee. Okay, this is very important. Now first, nature. What type of body is this? I mean, what type of committee? Is it constitutional? Is it statutory or is it non-statutory? So people will think it's it is not a constitutional body because we have not seen it in the constitution grade. Now they will think it's a non-statutory. Why they will think non-statutory? Because monetary policy के ऊपर हमने कोई act नहीं देखा. So, but this is also wrong. It is actually a statutory body. MPC is a statutory body which was established under RBI Act of 1934. Okay, who recommended this? Urjit Patel Committee recommended MPC. Okay, great. Now, what is the composition of MPC? It consists of 6 members. And who are they? 3 members are from RBI and 3 members from the central government. In these 3 members, 2 members are definitely RBI governor and deputy governor. And the third person is some RBI official nominated by the central board. Okay, now, you know RBI governor, right? Term period कितना है उसका? 3 साल. So RBI governor can rule for 3 years, and that is sometimes extendable up to 5 years. So 3 or 5. But when this RBI governor is ex officio member, that means he can be appointed any number of times. Even if he's reappointed, he can still be appointed. Why I'm saying this, because see, the term period of MPC, it's for only 4 years, and MPC is not eligible for reappointment. MPC का कोई reappointment नहीं हो सकता. ये 3 members nominated by central government जो है, वो लोग फिर से nominate नहीं हो पाएगा. So they are not eligible for reappointment. But RBI governor, he is eligible for reappointment. But since he is an ex officio member, he can be reappointed many times. Okay, when you are changing at least one member from the board, it means you are changing the committee for every 4 years. So think of this term very carefully, that MPC का reappointment नहीं हो सकता है. इसका मतलब ये other members, these other members, they cannot be reappointed. Okay, that's all. This is what I think. This is my logic. And next, who appoints RBI governor? Very well known that RBI governor, he is appointed by the central governor after the recommendation by committee FSRASC, which is headed by the cabinet secretary. Do you know what is this? It's a financial sector, regulatory appointments, search committee. SC तो search committee है. RA means regulatory appointment. So financial sector, regulatory appointment, search committee headed by the cabinet secretary is the one who is going to recommend the central government to appoint the RBI governor. Okay, so now you have seen about MPC ka nature, statutory, MPC ka composition, 6 members, and who recommended to set up this MPC? Urjit Patel. And what is the term period? 4 years. Is it eligible for reappointment? Answer is no. What is the main mandate for MPC? To set the repo rate, right? Now this becomes important. See, central government inflation target को fix करेगी पहले. हर 5 साल में एक बार तो रीसेट करना पड़ेगा इन्फ्लेशन टारगेट. नाउ करंटली द सेंट्रल गवर्नमेंट सेट इट टू 4 + or -2%. इट मींस दैट इन्फ्लेशन कैन नॉट गो बिलो 2 and cannot go above 6. So this is the inflation target set by the central government for every 5 years. Now to meet this inflation target, MPC it is going to fix repo rate, and RBI it is going to fix other policy rates. Okay, other implies CRR, SLR, ये सब RBI करेगी, and repo rate तो MPC करेगी. Now my next question is, the repo rate fixed by the MPC, is it binding on the RBI? The answer is yes, it is binding on the RBI. Okay, now the next question, how many times does this monetary policy committee meet in a year? Actually as per RBI Act 1934 they must meet 4 times a year, और उसका term period भी 4 है, और उसको 4 साल मिलना पड़ेगा, ये तो है. लेकिन currently they are meeting 2 times extra, 6 times. So that means they are meeting at least 2 times a month, 1 time in every 2 months. Okay, once in every 2 months, so they are meeting, therefore it's 6 times in total. They are currently meeting like that, but actually the act just tells them to meet 4 times is enough, at least 4 times. Okay, now this is about MPC. Now let us study about financial markets. Okay, see, financial markets, they can be split into 2 types. One is money market and other is capital market. Money market instruments are for short term, and capital market instruments are long term. For example, if you see stock market, that comes under capital. Okay, and usually stock market, they are invested for long term. Okay, and money market, like if you see certificate of deposits, commercial papers, all of them they come under short term. And short term financial markets, that is money markets, they are regulated by RBI, and capital markets, they are regulated by SEBI. This is the usual trend. There might be some exemptions, but usually money markets, they are regulated by RBI, and capital markets, they are regulated by SEBI. Okay, now let us see some differences. Money market, sorry, where is my pen? Yeah, money market, it is regulated by RBI, and capital market, it is regulated by SEBI. And money market, it's for the short term capital. Short term implies less than 1 year, and capital market, it's for medium and long term, implies greater than 1 year. Next, what are the examples of money market instruments? Example, commercial paper, certificate of deposit, call notice or term money, treasury bills, cash management bills. All of them, they come under part of money market instruments. Now let us see what are capital market instruments. Okay, when you see shares, bonds, debentures, derivatives, mutual funds, ETFs, rates, in which they all are the part of capital markets, which are regulated by SEBI. So what do you think is risky, money market or capital market? Of course, money market, they are less risky because they are regulated by RBI. Stock market, it is very, very risky. Therefore, the risk is higher. The risk is higher for the capital market and lower for the money market. So my next question, coupon bond, masala bond, are they part of short term market or long term market? Coupon bond, masala bond, they are all part of capital market. Okay, and they might ask this. I have seen an MCQ, that is why I added here. Coupon bond and masala bond, they are part of capital market. Okay, you will get to know what all these are when you study capital markets. And next, we have traditional platforms like stock exchanges, which regulate the capital market instruments like shares and bonds. And for money market instruments, they are usually traded in NDSOM, that is negotiated dealing system, order matching. And we have OTC, over the counter, reps. A lot of such platforms are there. Even on the stock exchange, I think you can trade some money market instruments. Okay, they are about money market instruments. But there is one exemption in the money market instrument which is not regulated by RBI. That is MMMF. What is this? Money market mutual funds. Since they are mutual funds, money market mutual funds, they are regulated by SEBI. So that's the last point. Ki money market mutual funds, they are regulated by SEBI. Now the first money market instrument is T-bill. So when you look at the T-bills, T-bills are nothing but short-term government securities, and they are issued only by the central government. So remember that only central government can issue T-bills, not the state government. Okay. And next, what are and who is going to issue these T-bills? Is it really the central government? Yes, central government is going to issue T-bills. Actually, it's the RBI who is issuing T-bills on the behalf of central government. Okay, that is what you need to remember. RBI issue करेगी on the behalf of central government. And next, they are basically zero coupon bonds. ये चीज notice करना कि हर bill, हर money market bill zero coupon ही होगा, except some exemptions like call money market. जहाँ पे market है ना, तो वहां पे क्या है कि मार्केट इंटरेस्ट रेट पे होगा. रिमेंबर इट लाइक दैट. सो टी बिल्स, सिंस आई एम नॉट यूजिंग दैट टर्म मार्केट, देयरफॉर इट इज अ जीरो कूपन बिल. जीरो कूपन बिल implies it is basically issued at discount value, but redeemed at face value. I mean, central government, it will issue a discounted value. Say, it will tell you to pay 950 rupees. Actually, the bond will have 1000 rupees. But what will you do? You will give 950 rupees, and after a period of time, you will ask for 1000 rupees because you have paid 950 rupees to central government. So therefore, the bond is issued at discounted value. Bond is issued at discounted value, but repaid at face value. Okay, that is the difference. Issued at discount value, but repaid at face value. Okay, that is about treasury bill, and they are zero coupon bills. And there are different term periods. I mean, maturity period can be 91 days. That means 3 months approximately. 182 days implies 6 months, and 1 year, 365 days. So it can be for any period. Okay, 91 days. If it is for 91 days, if maturity period is 91 days, then it's called 3-month treasury bill. If maturity period is for 182 days, then it's called 6-month treasury bill, and 364 days, then it's called 1 year treasury bill. Okay, 1 year is the maximum because it is a short term money market. T-bills are short term money market instruments. Okay, and what if it is less than 3 months? If it is less than 91 days, then they are cash management bills. Okay, remember, if it is less than 91 days, they are not called T-bills. They are called cash management bills, CMB, cash management bills. So that is the only difference between cash management bills and T-bills. It is just that it is less than 91 days. Okay, and who can accept T-bills? Come on, it is raised through public. Okay, now central government wants some money from the consumers, retail consumers. Therefore, it will try to, T-bills can be purchased by anyone. It can be retail individuals or banks or companies, whoever can be, they can buy T-bills from the RBI. RBI is going to issue T-bills on behalf of central government. Okay, now you know what? Now a question arises: where is the auction conducted for these T-bills? I mean, primary market. See, if you want to buy T-bills, you can go via primary market or secondary market also through trading. Okay, if T-bills are issued through primary market, in which portal you can see that? You can see it through eKuber portal. What is eKuber portal? It is the core banking solution portal of RBI, where all the scheduled banks are connected in this platform, eKuber platform, core banking solution. For example, if you buy a bill, then that settlement, it will be usually taken 1 day after that time. I mean, 1 day after the payment. So it is a T+1 basis settlement system. Okay, and next, who are usually the members of that primary market? I mean, eKuber. See, in eKuber, you are having only scheduled banks, and these scheduled banks, they can participate in the primary market. So, for example, if government wants to sell some T-bills, then of course to purchase those T-bills, the scheduled banks, they are eligible. Why they are eligible? Because they are already the members of eKuber platform. That is why they are eligible to participate in this primary market of T-bills. But what if non-scheduled banks want to participate in the primary market? In that scenario, what non-scheduled banks are going to do, they are going to connect with the scheduled banks who are already members of eKuber, and they're going to open this gilt account, government securities account, so that they can participate in the primary market instruments. Okay, I mean, so that they can purchase T-bills from the RBI. And then what about retail investors? How retail investors they can buy T-bills? If retail investor want to buy T-bills, they can directly enter into RBI RDG retail gilt account, and they can directly purchase through there. But it is usually not feasible because this RDG account, how can you access that one? It's so for that you need to actually open a Demat account. Demat you can see in Grow or various other platforms, right? You can so in Demat account, what you're going to do is that you are going to link your Demat account with the RDG gilt account, retail direct gilt account. Okay. So using Demat account, you can directly participate in a primary market RDS scheme, retail direct scheme. Okay. That is how a retail investor, including an NRI, also can participate in the primary money market instruments and can purchase the T-bills from the government. Okay. But anyhow, to participate, he must link his Demat account to RDG account. What is secondary market? See, secondary market, once a retail investor purchases a T-bill, he can easily sell it to some other person, right? That is secondary market. In the secondary market, okay, how the T-bills are traded in the secondary market? Like how money is traded in the secondary market. For example, stock exchange. In stock exchange, what happens? The shares of company are traded between one individual to other. Here in the stock exchange, you are transferring shares. Similarly, in the NDSOM, you will be transferring bonds, not the shares. Okay, that is NDSOM, negotiated dealing system order matching. Okay, and this was managed by whom? This was managed by CCIL. Usually, most of the people think that it is secondary market, therefore it is managed by SEBI. And even options show SEBI. Actually, it's not SEBI, it is managed by CCIL. I think it's Clearing Corporation of India Limited. I think Clearing Corporation, Clearing Corporation of India Limited, something like that. So NDSOM, negotiated dealing system order matching. So anonymously, your T-bill, it will be matched with some other person who wants to purchase. So it will connect anonymous sellers and buyers, and accordingly, it will match. And that is NDSOM. It was introduced in 2005 for trading T-bills in the secondary market, and it is managed by CCIL. Now, what is OTC? OTC is nothing but over the counter. It is managed by both RBI and SEBI together. So what happens is that if you are not able to trade in NDSOM, you can also trade in OTC over the counter. It's not a problem. But what does this OTC do? This OTC will report everything to NDSOM within 15 minutes. Okay. So anyways, you can trade either in OTC or NDSOM, or you know what? You can also trade T-bills in the stock exchange. Once you start connecting your Demat account to RDG account, then what happens? There are some customers who have also connected their Demat to RDG. Therefore, SEBI allows you to trade secondary market instruments. To trade T-bills in the secondary market. In the stock exchange. Okay, so these are the three main platforms where you can trade treasury bills. I think you are clear. So now we are seeing call money market. See, market. What does market mean? Of course, I said normal scenario, you will consider what? You will consider them as zero coupon. But if you see this term, this word market, then you must think that market rate, okay? Usually, two types of rates are there. One is LIBOR and other is MIBOR. LIBOR implies London Interbank Offered Rate. MIBOR implies Mumbai Interbank Offered Rate, okay? But anyways, currently, you know what India is doing? It is using MMIFOR. MMIFOR is Modified Mumbai Inter Forward Outright Rate. Modified Mumbai Inter Forward Outright Rate. Forward Outright Rate. MMI for Modify Mumbai Interbank Forward Outright Rate 2023. So this is the rate that currently India is following to determine the call money rate. Okay. So this LIBOR, it is very oldish one. London Interbank Offer Rate. During the time of 1980s, there were 18 large banks under the Britain Banker Association. There was this Britain Banker Association, and there were 18 large banks, and they used to borrow from one another. That rate they called it as a LIBOR, London Interbank Offer Rate. But anyways, now reaching the reality of the world, we have our own MIBOR. Okay, Mumbai Interbank Offer Rate. That is basically for the call money market. I mean, if you want overnight loans from one bank to the other, definitely we are going to use this call money market instruments. Okay, so you have three types actually in the call money. For example, if you are asking for overnight loan, then it will become call money, and the maturity period is less than 1 day. So the next day itself, you can borrow money today, but you need to return the money tomorrow. So this is just for one night. So that is call. You are calling and asking for one night overnight. That is call money market. And notice money market is notice. So you are noticing 14-day period, usually notice के लिए 14-day period use करते हैं ना. तो हाँ, more than one implies 2 to 14 days है, तो उसको notice money बोलते हैं. Notice money is 14 days, and the term money is more than 14 days. That is term money. So these are the different maturity periods in the call money market. So it can be called call money if it is less than 1 day. Maturity period is less than 1 day. And if it maturity period is less than 14 days, then it is notice money. And if maturity period is less than 1 year, then it is term money. Okay. And now you need to see what happens in the call money market. One thing you need to remember is that whenever you are studying money market instruments, you need to see who is the lender and who is the borrower. For example, when you saw the T-bills, you know, the lender is the central government and the borrower can be banks, households, or retail individuals and companies. Similarly, in the call money market also, they are between banks, okay, one bank to the another bank. You are calling a bank and asking, "Arey, give me loan, मुझे कोई liquidity का problem है." So that is call money market. And then there are certain banks that are excluded from borrowing. For example, local area banks, land development banks, LIC, insurance companies. I mean, they cannot accept borrowings. I mean, they cannot borrow money using call money. Local area bank, land development bank, they cannot borrow money using call money instruments. Okay, who can accept then? Of course, general scheduled commercial banks, cooperative banks. इन दोनों के बीच में क्या है? RRB. तो regional rural banks. So these three banks, yes, of course, ये तीन तो पक्का है. These three they can accept call money market instruments. Who can lend call money market instruments? Scheduled commercial banks, cooperative banks, and RRBs. They can lend call money market instruments, and they can borrow call money market instruments. LIC can lend money, but it cannot borrow money. LIC, GIC, these insurance companies, वो लोन तो दे सकते हैं लेकिन borrow तो नहीं कर सकते. Already they are taking a lot of money from retail individuals insurance के नाम पे, so they are not going to borrow from call money market. Okay, so just remember that local area banks and land development banks, they cannot borrow money from call money market instrument, and remember that the interest rate is LIBOR or MIBOR. Currently we are following MMIFOR, okay, Modified Mumbai Interbank. That is about call money market. Oh, sorry, CDs they are issued by banks and CPs they are issued by companies. So that is the difference. CDs they are issued by bank and CPs they are issued by companies. Now, as I said, call money market we had this term market. That is why they have some interest rate, which is MMIFOR. But now in CDs and CPs we are not seeing any terms such as market. Therefore, they are also zero coupon bonds and unsecured. See, कहीं पे collateral देखा? Mostly कहीं जगह पे collateral नहीं होती है. Okay, they are unsecured, zero coupon. Okay, there is no requirement of any collateral for the certificate of deposit. Most of them are unsecured. कहीं पे भी secured नहीं है mostly. अगर secured है तो मैं खुद बोल देती हूँ ना. कहीं पे secured नहीं है. All of them are unsecured only. Okay. And next, so banks are going to issue a certificate of deposit sent to whom? Of course, to banks. Usually क्या होता है कि minimum ना 1 lakh certificate of deposit का minimum value ही 1 lakh होता है, 1 lakh. And the other, I mean, even if you want to draw more than 1 lakh, then they must be in multiples of 1 lakh. Example, 2 lakh, 3 lakh, etc. So if it is a normal retail individual, he is usually thinking of taking a loan rather than taking a CD. He don't want to do paperwork. Okay, that is why usually these CDs are taken mainly by commercial banks and AIFIs. Okay, they are only going to take them. But yeah, you know what? Which banks cannot take, that becomes important. Local area banks, call money market nahi leki, or local area banks, they cannot also take CD. Okay, and regional rural banks, they can also not take CD. RRBs, they can participate in money market instrument, but they cannot take a certificate of deposits. Okay, and minimum 1 lakh तक है, and multiples of 1 lakh ही हम issue कर सकते हैं. Maturity period is usually from 7 days to 1 year. 7 days to 1 year is the maturity period. But for all India financial institutions, if they are planning to borrow money, then their maturity period will be more than 1 year, from 1 year to 3 years. Okay, that is about certificate of deposit. If you see commercial papers, CPs, see CD is for whom? CDs are issued by bank. Okay, CPs are issued by companies. That's all. Companies, corporates, and NBFC. NBFC is also a company, non-banking financial company. Therefore, companies who are registered, I mean, who got a A3, minimum A3 rating, who got a minimum A3 rating for issuing commercial paper, they are the one who can issue commercial paper. Example, let's say there is a SEBI registered credit rating agency. That SEBI registered credit rating agency, what it must do? It must approve that credit rating agency, and that credit rating agency, it must give some rating to the company who is issuing this commercial paper in the market. Okay, minimum grade to A3 होना पड़ेगा. And then CP. CP, as you can see, there is no term market involved, therefore it is also a zero coupon. That means they are issued at discount and repaid at face value. Okay, and yeah, who are going to usually take commercial papers? They are usually companies, corporates, and also remember cooperatives. Cooperatives can also borrow from companies. They can also purchase CP. I mean, corporates, they can also invest in commercial papers. But that corporate, it must have its net worth more than 100 crore. Then only it can invest in a commercial paper. Okay. And one thing you need to know is that, of course, it's unsecured. Yes, the minimum limit is 5 lakh and multiples of 5 lakh. See, an individual investor can also invest in commercial paper. But the thing is that 5 lakh वो invest क्यों करेगा CP में? वो तो loan लेगा ना. So usually the big companies, they are the one who are going to invest in this commercial papers. I think you're clear, right? पहले क्रेडिट रेटिंग एजेंसी होगी जो एसएबी के अंदर रजिस्टर्ड है, वो मिनिमम तो ए3 रेटिंग देना पड़ेगा एक कंपनी को, तब वो कंपनी क्या करेगी, सीपी इशू करेगी. अगर सीपी इशू करेगी तो वो डिस्काउंट वैल्यू पे इशू करेगी. दैट्स इट, देयर इज नो इंटरेस्ट एंड द सीपी, इट इज अनसेक्योर्ड. Now we are seeing bills of exchange. Bills of exchange, they are also called as hundi in the post-Harsha period. Hundi. Okay. So basically, there's a company A and company B. Company A wants to deposit certain money in the company B. What did this company B do? It issued bills of exchange or a commercial bill. What happened in the commercial bill? That's the story. Okay. In the bills of exchange or the commercial bill, basically you want to do some purchase. So for that purchase, you are getting some bill. Okay. And after a period of time, you need to get some money, but this company is not giving money. In that scenario, what do you do? See, based upon the market interest rate, you are purchasing some commercial bill. Now this other company, it is not giving. So tell me one thing, what is the difference between CP and bills of exchange? See, CP is between a company and of course companies, but retail individuals can also participate. But bills of exchange is just like a bill. I'm giving you a bill, I will pay you after 3 months. Maybe they had not paid in 3 months. What will I do then? What will I do? I will take this bill of exchange to a bank. For example, there is a Tata seller. He did not get money even after 3 months. So what he's going to do? He's going to give that bill to a bank. The bank will tell that, see, actually you need to get 100 rupees, but since I'm paying you yearly and that company did not pay you, I will give you only 90 rupees. So this 10 rupees will become the profit that this bank generated. Anyway, Tata just want money immediately for some investment. Therefore, it just took 90 rupees and it left. Now, what does this bank do? Using that bill of exchange, bank actually need to get 100 rupees, right? Therefore, bank is going to take that 100 rupee bill to RBI and it's going to say that, see, I have this bill and I need to get 100 rupee. But that company, M&M, it did not even pay money till now. So what does RBI do? Okay, beta, I will take that bill of exchange and I will give you the money. But RBI will tell that I will not give you the complete 100 rupee, I'll give you only 93 rupee. So this 7 rupee, whatever is there, that is the profit that RBI earned. Okay, that rate is called rediscounting rate. So the first rate at which bank took from the company, that is discount rate. And again, if you are discounting and getting money, the original money, then that is rediscount rate. Okay, you are discounting the discounted bill again. That is rediscount rate. So that is the concept of discount and rediscounting. It applies only for bills of exchange. Okay, which is called hundi in the post-Harsha period. Bills of exchange are nothing but in money market instrument issued by one company to another company at a market interest rate. So CBLO is nothing but collateralized borrowing and lending obligation. कोलैटरलाइज्ड बोरोइंग एंड लेंडिंग ऑपरेशन. कोलैटरलाइज्ड से समझ में आ रहा है कि इसमें कोलैटरल होगी. ओके, लेंडिंग ऑब्लिगेशन, हम लोन लेंगे तो लेंड भी करेंगे, मतलब कोलैटरल पे हम लोन लेंगे और लेंडिंग का हमारे ऊपर ऑब्लिगेशन है. कोलैटरल बोरोइंग एंड लेंडिंग ऑब्लिगेशन. Who is the lender here? As you can see, CCIL is the lender who is going to lend some short-term loan to a financial institution who is a borrower, and of course, it is going to put some collateral in the CBLO, and when it repays, it need to prepay with interest. Okay. Now I'm saying CCIL. What is CCIL? It is Clearing Corporation of India Limited. Okay. And CBLO instrument, it is operated by CCIL, which is Clearing Corporation of India Limited. For example, if there is a financial institution which is not having a financial institution, say it is not having access to call money market, call money. So this is not having access to call money, and now it somehow needs some money, right? Usually, I think what does this can do? What can this do? It will ask CCIL, and CCIL will tell that, okay, I will lend you borrow, I will let you borrow, but the maturity period is less than 90 days. So within 90 days, you need to return my loan, and of course, you need to also put some collateral. That is what CCIL says. The CCIL, it was established in the year of 2001. It was established to provide guaranteed clearing and settlement functions for transactions in money, G-Secs, forex, and derivative markets. Okay, and what else I can tell you? So that is all you need to know about CBLO. Okay, of course, CCIL comes under RBI only, I think. See, CCIL, it was set up in 2001, and see, this CCIL, it is regulated by RBI. Okay, and it is regulated by RBI under the payment and settlement system. Okay, that's all, under payment and settlement system. Now let us see the next one. You know the other one, repo, reverse repo. See, repo and reverse repo, they are also considered as money market instrument because they are also for short-term duration only. For example, if I say overnight repo, that means banks, RBI is lending short-term loans to banks for overnight, whose maturity period is less than 1 day. And term repo implies maturity period is usually for a term. Term तो हम बोलते हैं 14 days को, लेकिन for 7 days or 28 days or 48 days, if banks are taking overnight loans from RBI, then it is a term repo. And what is long-term repo operation LTRO? It is for long-term, usually 1 to 3 years. Then what is targeted long-term repo? RBI is providing loans to only some specific sectors. For example, RBI is lending loans to business banks who lend loans to MSMEs. So if RBI is doing some targeted LTRO, this is RBI, okay. If it is doing targeted LTRO, then it is called as targeted LTRO. That's all. And what is a specialized long-term repo? See, specialized long-term repo operation is usually for small finance banks. Small finance banks, the small finance banks, they are going to fund some small businesses and marginal farmers, right? So for them, RBI thought of providing a specialized long-term repo, and targeted is for promoting construction or drugs, medicines, or whatever field it can be. RBI wants to target some sector, okay. Actually, this targeted LTRO, it is recommended by one committee, which I'm not able to recall. I think it's Kamath committee. Kamath committee, they will not ask this question. So Kamath committee recommended targeted LTRO. And next we have MMMF. I already said you in the beginning that it is nothing but money market mutual fund. This is also a money market instrument where individuals they can invest in short-term mutual funds. This is a mutual fund company, and this is saying you that you can invest but only for short term. Then if you're interested, then yeah, you can invest in short term mutual fund. Since it is a short term, it must be RBI, right? But no, even if it is short term, it is regulated by SEBI only. Okay, money market mutual fund. The last point that I would like to highlight is DFHI. DFHI is what is DFHI? DFHI is Discount and Finance House of India. Discount and Finance House of India. I will tell you what it is. It was established in 1988 by RBI, public sector banks, and all India financial institutions. Okay, as you can see, DFHI, it was set up in the year of 1988 by whom? By RBI, public sector bank, and all India financial institutions to deal in money market instruments and in order to provide liquidity. It was set up based upon the recommendations of Vagul Working Group, VWG, Vagul Working Group. Okay, Vagul Working Group recommended this DFHI. Why did Vagul Working Group recommend DFHI? Because see, you know one thing. Do you know this stock exchange? It is a popular secondary exchange market, right? But that is for what? Stock exchange is usually for trading company shares and equities. But what about bonds, government treasury bills, whatever they are? So why can't you trade them in the secondary market? Why is it so difficult? Even now, I don't think NDG, NDS SOG something, negotiated dealing system, I don't think it's popular. Therefore, this house was set up, Discount and Finance House of India, to develop a secondary market in the existing money market instruments. Currently, money market instrument, I think they're only primary. Even if they are secondary, I think it's not in some online platform. Online platform also, that's very rare. Okay. Therefore, in the 1996, what did DFHI do? DFHI, it became a primary dealer, and in 2004, RBI transferred its entire stake to SBI Gills Limited. So initially, RBI, what did it do? It had some stakes in this DFHI. But later, this stake also, it was completely transferred to SBI Gills Limited. Now this SBI Gills Limited, it renamed that DFHI as SBI DFHI. Okay. So what are the main activities of DFHI? So dealing with treasury bills and rediscounting short-term commercial bills. You know rediscounting concept, right? Yes, that can happen. And participating in call money market, dealing with CBD, CDs. See, whatever you have studied in your money market, all of them are all of those activities. So they are dealt with DFHI, Discount and Finance House of India. Okay. Now let us look into this question. Bond yield, you know, it is interest by bond price. Now the question is asking bond yield is likely to decrease when? When does bond yield decrease? Okay. First option, price of the bond falls. If bond price falls, then bond yield will increase. But the question is asking decrease, therefore the first option is wrong. Second option, the demand for the bond increases. If demand for bond increases, bond price will increase and bond yield will decrease. So this is correct. And the third option, Indian rupee weakens against dollar. When when there are a lot of rupees and there are less number of dollars, that is only when you say Indian rupee weakens against dollar. Now you need to see whether inflation increases or decreases. If there are a lot of rupees, of course inflation increases. Okay, if inflation increases, what happens? RBI tight monetary policy adopt karegi. Which type of monetary policy does RBI adopt? RBI will adopt tight monetary policy. So what happens in a tight monetary policy? Tell me. You know, repo rate badayegi, CRR badayegi. All of them are fine. But what about bonds? RBI क्या करेगी bonds के साथ? See, bonds के साथ RBI एक चीज कर सकती है. It can either increase interest rate. Why? If RBI increases interest rate of the bond, lot of people are going to definitely invest. आरबीआई को ये पता है कि अगर हम वो 5000 रुपीज वाले बॉन्ड के ऊपर हम अगर 10% का इंटरेस्ट दे तो बहुत सारे लोग आके इन्वेस्ट करेंगे बॉन्ड्स में. देयरफॉर आरबीआई विल ट्राई टू इंक्रीज द इंटरेस्ट रेट. आरबीआई तो ये चीज करेगी. इस सिनेरियो में क्या होगा? बॉन्ड यील्ड बढ़ेगी. सिनेरियो नंबर 1. व्हाट इज सिनेरियो नंबर 2? व्हेन पीपल आर गोइंग टू परचेज बॉन्ड्स, बॉन्ड प्राइस का क्या होगा? इफ बॉन्ड प्राइस इज हाई देन डेफिनेटली पीपल विल थिंक इतना सारा तो हम इन्वेस्ट नहीं करेंगे. Therefore, RBI सोचेगी चलो बॉन्ड प्राइस कम करते हैं. Let us keep the bond price low so that more people will invest and we can suck more money from the economy. So RBI will reduce the bond price. If bond price is reduced, then what happens? Bond yield will again increase. So in both the scenarios, however we see, for RBI to suck money, it should increase interest rate or bond price must decrease. In both the scenarios, bond yield is increasing. Therefore, Indian rupee weakens against the dollar. When Indian rupee weakens against the dollar, bond yield will increase. Therefore, this option becomes wrong. Option is answer is 2 only. Okay, 2 only. One question they always ask in the exams. You know what is NSDL and CSDL? People get confused. I think it is National Securities Depository Limited and this is Central Securities Depository Limited. If it is central, Central implies remember it as Bombay Stock Exchange. Of course, you can remember. But remember national as national. Okay, National Stock Exchange and other banks. They promoted NSDL is promoted by National Stock Exchange and other banks, whereas CSDL is promoted by Bombay Stock Exchange and other banks. Okay, so that is the difference. And you need to know about NDSOL, right? CCIL. NDSOL OM is managed by CCIL on behalf of RBI and it's not SEBI. So I initially got confused between the CCIL and CSDL. So CCIL is Clearing Corporation of India Limited, which is managing this secondary money market. NDSOM, negotiated dealing system. Negotiated dealing system. What is OM? Order matching. OM matlab order matching. Okay, you will match anonymous orders. Okay, negotiated dealing system, order matching. It is managed by Clearing Corporation of India Limited, CCIL, on behalf of RBI. And what is CSDL? That is entirely different. In the stock market, you will be seeing NSDL and CSDL, right? That's all. They are different. Securities Depository Limited and CSDL is Central Securities Depository Limited. So they are the platforms who facilitate paperless trading. I mean, settlement of trades, whatever they are there. So they are used for that. Now let us see some previous year questions from this topic. With reference to the Indian economy, consider the following. CBLO are the instruments of course, we have seen that part of money market instruments, right? Since you have studied collateral borrowing and lending obligation in the money market, you must be very clear. Okay, it is less. Uska maturity period yaad rakhna at least. It is less than 90 days. I said you, right? Okay, next question. With reference to India, consider the following: retail investors through Demat account can invest in treasury bills and government of India debt bonds in the primary market. Can retail investors invest through Demat account? I said yes. Retail investors, they can invest through Demat account, which must be connected with RDG. This is correct. Okay, retail investors through Demat account can invest in treasury bills and debt bonds in the primary market. I marked it wrong intentionally, but this is correct. Okay, and the next question. The negotiated dealing system order matching, NDSOM. NDSOM is Government Securities Trading Platform of the RBI. This is also correct. And this third one, CSDL is jointly promoted by RBI and Bombay Stock Exchange. I said Bombay Stock Exchange and some other banks. Did I ever left this RBI? No, right? That means the statement is wrong. So option is 1 and 2. B, third answer. Oh, sorry, second answer B. Say. Now let us see the next question. With reference to Indian economy, consider the following. Commercial paper is short-term unsecured promissory note. See, short-term, is it right? Of course, it's a money market, therefore it must be short-term. This call money market, वहाँ पे interest देखा हमने. CBL वो वहाँ पे भी market interest rate पे है. And one more thing, it's what is that? Bills of exchange. Bills of exchange also there is interest rate only. So other than these three, wherever you go, you will see that they are issued at a discount value. Usual trend तो वही है. Okay. So commercial papers, if you see, they are also issued at discount value. Therefore, they are zero coupon bonds and they are unsecured. This is correct. And the next option, if you see, certificate of deposit is a long-term instrument issued by RBI. Certificate of deposit. CD, is it a long-term? No, it's a short-term. Just know we have studied in money market. And money market, they are short-term. Money market are short-term except that MMF, right? So this is also wrong. Call money is a short-term finance used for interbank money transactions. So call money, it is a short-term, correct. Interbank is also correct. That this is correct. And the fourth option, zero coupon bonds are interest-bearing short-term bonds issued by the scheduled commercial banks. You are saying it's a zero coupon, matlab interest is zero, and again you are saying interest bearing, so that means it is wrong. So therefore fourth option is wrong. Option is 1 and 3 only. Now next question, hundi. I said you hundi, bill of exchange. Yeah, ऐसे याद रखना कि इस हुंडी से लेके मैं इस हुंडी में exchange कर रही हूँ. Okay, हुंडी. So it was generally referred. It is in the post Arsha period they used this word हुंडी. तो मैंने बहुत सारे हुंडीज को बदला. जैसे कि from one company हुंडी I changed to other company हुंडी, and this company हुंडी to it went to bank का हुंडी, and from bank हुंडी to it went to RBI's का हुंडी, rediscounting and discounting. Therefore it usually referred to a bill of exchange. Okay, I think you will remember bill of exchange for long term. Now we have finished money market. Now we need to next see financial markets. No. We have see financial markets में money है और capital है ना. We have finished money market which is short term. Now we need to see capital market which is long term.
Oh, let us see financial markets. Okay, financial markets. Na, we have already seen money markets in the financial markets, right? Now we need to see capital market. Capital markets are for medium and large term, right? So in the capital market, what are the instruments that are examples for capital market? Shares, bonds, debentures, derivatives, mutual funds, ETFs, REITs, InvITs, etc. For example, coupon bond, masala bond, they are also part of bonds only. And when you say bond, it's usually for long term and not for short term. Okay, and capital markets, they are very risky, and the liquidity is also very low compared to money market, because money market, they are for short term. Therefore, when you are talking about near money, if you remember, I said that money market instruments are examples because they can be easily converted into liquid. Okay, liquidity is higher for money market, but liquidity is lower for the capital market. Okay, these are all the things that you need to remember. Now let us see this capital market. One more thing, who regulates capital market? It's SEBI. So we need to see about SEBI also, and also you need to know the difference between shares and bonds. Okay.
So SEBI, it's an executive body constituted under Ministry of Finance in the year of 1988, but in the year of 1992, it got its statutory backing from SEBI Act. Okay, now you know that RBI has not RBI. RBI ka MPC, it has 6 members. So if you water image, you will get 9. So there are 9 members in the SEBI. Composition of SEBI board, it has 9 members, and I will write this 9 as 121, 1 plus 2 plus 1 plus 5, other 5. It will be 9 in total. Okay, 1 is whom? SEBI chairperson. SEBI chairperson, the maximum period is 5 or 65. See, I thought of water imaging 92. I thought it will be like some 65, right? Something 65. Okay, 5 or 65. And next, 2 members are a government nominee from the Ministry of Finance, and 1 RBI nominee. That RBI nominee is a deputy governor. So 1 plus 2 plus 1 ho gaya. Now the rest other 5 members you don't need to remember. So this is about SEBI. Now let us see how a casual customer trades in a stock market. Okay, see, first he is going to a depository participant, then he is asking for help, then only he can open a Demat account. So how it works is that in your mobile phone, if you open Play Store, you can see many apps like Zerodha, Grow, ICICI Sharekhan, and many such apps which help customers open Demat account. And Grow is the famous app that I know. Anyways, so customer, once he registers himself with the repository participants help him to open a demat account. And if this customer start trading using the demat account, those shares, they are stored in a physical, not in a physical form, but in a electronic form. Under whom? They are securely stored under National Depository Securities Limited or Central Depository Securities Limited. You already studied about them. NSDL, it is usually associated with whom? NSE, for N, National Stock Exchange, and some other banks. CSDE, it's Bombay Stock Exchange and some other banks. So they are the one who is going to regulate this depository limited. I mean, not regulate, but usually they are the major shareholders. Okay. So yeah, finally, what is a depository participant? That's my question. Depository participant is an intermediary who is helping the customer connect with the demat account, or else who is helping customer open his demat account to safely trade in the stock market. That is all. And do you think all the depository participants are good people and they are helping customers? No, some depository participants can also be fraud. Therefore, SEBI, it came up with Scores portal. Okay, this customer, he can complain his grievances in the Scores portal. What is Scores? SEBI complaints redressal, RE matlab redressal system. SEBI complaints redressal system. That is the Scores portal. So if you have any problem with that depository participant or any other grievance, you can go to Scores portal. Credit rating agency. See, if you remember this commercial paper wala topic, there you have seen that for a company to issue commercial paper, it must have at least minimum A3 credit rating, and this must be given by a credit rating agency which is registered under SEBI, right? Yeah. Well, so what is this credit rating agency? See, they are regulated by SEBI. That's why we are discussing now. If they are regulated by RBI, we would have discussed about that earlier only. Remember, and usually there was a 2022 PYQ which talked about RBI in the option. That was wrong. That is a general UPSC trap. As per RBI, credit rating agency, blah blah blah, they will give, and in the end, RBI is going to be wrong because that's how they are framing the questions. Sometimes it's very difficult to identify the focus area. That focus area is RBI or SEBI. So remember that when UPSC is giving you question in economics, they are definitely swapping RBI and SEBI. At least one question. So remember. Next. What are the global examples for some credit rating agencies? Moody is very famous. S&P Global, Moody, they are famous. And you also have Fitch Rating. So they are the worldwide famous examples of credit rating agencies. They even rate Indian companies also. Now, what are the Indian examples? Brickwork, Care, CRISIL, etc. तो इतनी बार मैं बोल रही हूँ क्रेडिट रेटिंग आखिर इसका मतलब क्या है? सी क्रेडिट का रेटिंग कर रहे हो तुम, सो यू आर एवेल्युएटिंग द क्रेडिट रिस्क ऑफ अ प्रोस्पेक्टिव डेप्टर. ही कैन बी एन इंडिविजुअल और अ बिजनेस और अ कंपनी और एनीवन, उसका रेटिंग दे रहे हो. सो यू आर एवेल्युएटिंग द क्रेडिट रिस्क. ओके, दैट इज क्रेडिट, दैट हु इज एवेल्युएटिंग दैट? इट्स अ क्रेडिट रेटिंग एजेंसी हु इज एवेल्युएटिंग द क्रेडिट रिस्क ऑफ अ डेप्टर. So what aspects it is going to consider to evaluate that credit rating? It is going to use some qualitative features and some quantitative features, and after that only it will give a proper rating. Okay. So let us see the working now immediately, how this works. So credit rating agencies, they collect data from credit bureau. So what is this credit bureau? That is also bureau. What does it do? It gathers information about the past debt payments of that debtor. Okay, and accordingly that information, it is shared by the credit bureau to credit rating agency. So if a credit rating agency, according to the information given by CB, it will give the rating, right? If it gives high rating, it means that there is a low risk of default. So usually people think high rating implies high risk. No, high rating implies low risk. Okay, low rating implies high risk. High risk of default. Okay, low risk of default. That is about how CRA gives credit rating. I noticed one trick is that whenever there is this word limited, it is usually public. But when it is specifically mentioned private limited, then it will be private. Okay, usually government companies तो limited ही है, तो public होगा. लेकिन अगर वो private होगा तो definitely private limited mentioned होगा. That is the general scenario. It will be useful while attempting prelims questions. Okay, now let us see the types. As I said, there are global and domestic. Global का बताया ना, Moody, S&P and Fitch. So the highest credit rating that a global credit rating agencies can give is AAA. And Moody का तो those you can see two small O's. They can be made into small a, not capital A. Therefore, this is the highest credit rating for Moody. Okay. As I said, there are many CRAs, credit rating agencies at the domestic level. CRISIL, ICRA, CARE, Brickwork. Brickwork is famous. Brickwork and CRISIL, they are famous.
We can see in the last 15 months, SEBI has come up with many reforms. The first reform is Fit and Settlement Rule 2026. So this rule, it is very simple. See, initially, if SEBI felt that the integrity, reputation, or conduct of the capital market participants like FPI, brokers, or foreign investors, if that is violating rules, or if it is not as per SEBI standards, then there used to be automatic disqualification. Now SEBI is saying that now there will be no automatic disqualification. We will examine properly, and then we will check whether to disqualify them or not. So therefore, you are promoting this foreign investors and FPIs, etc. Okay, you are not automatically disqualifying them. That is Fit and Settlement Rule 2026. And next, meeting of FPI allowed. That is the second reform. Sorry, this is not meeting. That's what I'm checking. This is netting. Netting for FPI allowed. So netting, it is nothing but I'll tell you with an example. Let's say you have invested in the stock market worth 100 rupees. And on the same day, you want to sell your shares worth 80 rupees. So for that, the net amount that you need to keep here as a balance is 20 rupees, right? So if netting is allowed, you already want to withdraw 80, right? If netting is allowed, you can just invest additional 20. That's all. You need not invest complete 100. So before netting, you use it to have a lot of extra funds in your hand. You implies I'm talking about foreign portfolio investor. So foreign portfolio investor, he used to struggle by having extra funds in his hand. So he need to always struggle with that. And the settlement, settlement basis, it is very late. Okay, it is delayed. So that is why netting, it is allowed for foreign portfolio investors. That is the new SEBI reform. And the next is single window for automatic and generalized access for the trusted foreign investors. That is SWAGAT FI. as the name suggests, it provides a single window for foreign investors. That is why we are saying Swagat foreign investors. How it simplifies process for foreign investors? First, it provides a simplified entry. So lot of KYC certificate, know your customer, etc. and hurdles are there. So they are simplified, and you are having a single window. And next, compliance cycle, that is 10 years. See, compliance cycle 10-year imply everything. For example, let's say you have a registered foreign portfolio investor under this single window Swagat FPI. Now, for every 10 year, you are reviewing this FPI investor again. Basically, we are only allowing low risk investors. Okay, that is why there is a compliance cycle for 10 years to review them back. Okay. In that 10-year compliance cycle, you will check all the KYC documents, whatever they are there. But the hurdles are comparatively reduced. So, what and all did we see? We have first seen simplified entry, and then we have seen a compliance cycle, that is 10 years. And next, the third is unified registration, that we already know by seeing the name single window. Unified registration for FPI and foreign venture and capital investors, that is FVCI, FPI and foreign venture capital investor. Okay. Initially, they used to have separate registrations. Foreign investors, FPIs, and venture capital investors, they used to register separately. But now we are registering them under the same FVCI, foreign FPI and foreign venture capital investor. Okay. The fourth is solution oriented fund. I'll tell you what the solution oriented fund imply. Okay. See, you want some retirement plan. So that's why what you did, you went, this is you went to a fund manager, and that fund manager said that the charges are fixed, that is 1.8%. Okay. You cannot withdraw your money. You are investing 100 rupees, and that 100 rupees cannot be withdrawn till you finish your maturity period. Okay. Now suddenly you lost your employment. You went back to him again. He is not going to return. He is not going to return your fund. So initially it used to be a closed fund. Mutual funds used to work as closed fund. Now they are making it open fund. Okay. That open fund is called life cycle fund. So you can withdraw your money whenever you want. That is life cycle fund. Okay. And the charges also, that 1.8%, it is fixed by this mutual fund manager. Now they are saying that now we will be fixing new charge based upon the expense ratio. Okay. Initially this expense ratio is fixed by this fund manager. Let's say 1.8%, and you have invested 100 rupees, right? So 1.8 into 100, 1.8. So that is the expense. The 100 minus 1.8, that will be the amount that will be given back to you. I mean, whatever profit, let's say 100, it became 110. 110 minus 1.8, that will be given to you. Okay. But under this new TER, now this fund manager cannot decide this fixed rate. Now certain rates like operational expenditure and the government charges, which cannot be negotiated, these amounts they will be fixed. But the commission, which is going to be charged by the mutual fund manager, that can be negotiated as per this life cycle fund. Okay, that amount it can be negotiated. So the total expense ratio, it can be negotiated, keeping the other base expense ratio and government charges fixed. That is solution oriented fund, which is also called life cycle fund. So some people might ask, what is this total expense ratio even? As I said, it is the expenses for maintaining a particular fund. So annual expenses for that fund divided by the assets that are under management. Okay, that percentage is going to give me the total expense ratio, and that percentages we have discussed, that the commission amount, that is negotiable, and the base expense ratio and the government charges, that cannot be negotiated. Okay.
To have background information about government securities, if you already know, it will be a revision. Basically, if government wants money, it can borrow either from our market or it can borrow from RBI. Okay, if government it is borrowing from market, there are two categories. One is see, they can be for short term, or government can borrow for long term. If government is issuing short term treasury bills or short term cash management bills, they can be issued only by the central government, and therefore short term treasury bill and short term cash management bill. Remember that I said you this trick. Treasury is only with the center, therefore central government is going to issue short term or treasury bills or cash management bills. Now this long term dated government securities can be issued by any government, central or state. This is the first thing that you need to remember. And next, treasury bills, they are split into three types: 91, 182, and 364. This call measure करते हैं T91, T182, and T364 depending upon the maturity period. But if this maturity period is less than 91 days, we call it as cash management bills. They are also by the central government only. Okay, they are also issued by the central government only. Now one more thing, since they are short term, I mean maturity period less than 1 year, therefore they fall under the money market, and money market comes under the direct control of RBI. Therefore treasury bills, they come under the purview of RBI. Now this dated government securities, they are long term government securities allowed by both the central and state government to raise funds for development purposes. Therefore, as this is long term, this comes under capital market, and this is regulated by SEBI. This is about borrowings from the market. We have short term and long term. Now let us see borrowings from the RBI. I cannot just borrow from a public. What if no one is interested, but currently I am in need of money? So there are two types of borrowings again from the RBI also. I can either borrow from short term or either borrow for long term. So see, RBI, it is there. Why is the RBI there? It is there to help people. I mean, to help government, to help banks in need, to help central and state governments. Therefore, if they are in urgent need, yes, RBI is there to help them in short term very immediately. So short term bonds can be raised from RBI by both central and state government. Okay, short term bonds can be raised from short term bonds. Can be issued by both central and state governments to raise funds from RBI. But if it is long term, see, under FRBM Act 2003, RBI is not going to entertain what is that, monetization of a deficit bolte hai na? Under FRBM Act 2003, RBI is not going to entertain monetization of deficit. Deficit monetization, it is just basically monetizing the fiscal deficit of government. Therefore, long term government is not even applicable to any government, whether it is state or central. For long term, we are not going to encourage government deficit, fiscal deficit. No, but here is the catch. Only during war, national security, collapse of agriculture, or structural reforms, we RBI, we are going to support central government. We are going to provide long term loan to the central government only during war, national security, collapse of agriculture, or structural reforms. This is what RBI said, and therefore long term bonds can be issued only by the central government to raise funds from the RBI, whereas short-term bonds can be issued by both central and state government. This is the logic. And now we need to see what is WMA, what is overdraft. See, this WMA and overdraft, base and means advances and overdraft, they can be issued by both central and state government from RBI. But there is one thing, SDF. This SDF can only be done by the state government. These are special drawing facilities that are available to the state governments only. SS. Okay, special drawing facilities are available to the state government only. These are basically the bonds. Bonds which are using borrowings, central government securities to borrow money from RBI. So bonds which are using central government securities to borrow money from RBI. Okay, do you remember the central government securities is main thing. So if your RBI says, if you are giving me central government securities and if you are borrowing money from me, then I am going to lend you money. This is what RBI says, and therefore special drawing facilities are allowed for the state government short term. Okay, what is this way and means advances and overdraft? They are applicable for both the state and central government. So basically, base and means advances, they have maturity period of less than 90 days, and they are issued at interest rate equal to repo rate. They are base and means advances. So basically, base and means advances, they are the loan facility of the RBI to the center and the state government. WMA are the loan facilities. WMA are the loan facilities of the RBI to the center and state government to address temporary mismatches in their cash balances. Base and means advances are the loan facility of the RBI to the center and state government to address temporary mismatches in the cash balances. Okay, this is about base and means advances, and the maturity period is less than 90 days because they are for short term and they are issued by RBI at interest equal to repo rate. Now, if you see overdraft, it is a WMA, you have specific limit. Up to specific limit only you can borrow from RBI. Okay, this have limit, but if you are crossing this limit, then it is overdraft. See, borrowing beyond WMA limit at interest more 2% above repo rate. Okay, at interest 2% above repo rate. Borrowing beyond WMA limit at interest at 2% at interest 2% above repo rate. Okay, 2% above repo rate. That is overdraft. So this base and means advances and overdraft can be used by both central and state government from RBI. Now we have special drawing facility. These are the borrowings made by the state government, as I said, using central government securities at interest rate 1% below repo rate. At interest rate 1% below repo rate. Okay, these things you need to remember. You are going overboard, therefore +2. You are getting special privileges, therefore interest rate will be 1% below repo rate. Okay, that is central government. That too you are getting the special benefits if you are using central government securities, therefore interest rate will be 1% below repo rate. This is about short term and long term. This is what it is mentioned in this slide. Borrowings from the market, you have short-term treasury bills and short-term cash management bills issued only by the central government. They are the borrowings from the market. Okay, we have borrowings from the market and borrowings from the RBI. If they are borrowings from the market, we have short-term treasury bills and short-term cash management bills issued only by the central government. And if they are borrowings from the market by both the central and state government, it is only for the long-term borrowings. And long-term borrowings, of course, there are different types. For example, if long-term borrowings are from central government, then those type of examples for such dated government securities would be fixed rate bonds, floating rate bonds, inflation indexed bonds, sovereign gold bonds, sovereign green bonds, and so on. And the state development loans, for state development loans, the state can also issue dated government securities. And there are special government securities like oil bonds for raising funds for the oil sector, or fertilizer bonds for raising funds for the fertilizer, VCAP bonds, etc. These are all considered as off-budget financing, these special government securities, because they are not included in the fiscal deficit. Okay, and but they are included in the debt of the government. Therefore, these special government securities, they are also part of long-term dated government securities by both central and state government. Now let us see borrowings from the RBI. Borrowings from the RBI, as I said, there are short-term and long-term. During short-term, RBI is going to help both central and state government, but long-term it is only for the central government in the exceptional circumstances. Example, during national security, war, collapse of agriculture, or structural reforms. And the short-term, as I said, this base and means advances applicable for both central and state. And we have overdraft, borrowing beyond WMA limit. It is also applicable for both central and state. This is at interest of 2% above the repo rate, and we are having special drawing facility. These are the borrowings by using central government securities as a collateral at 1% below repo rate, R-1. Okay, great.
So capital market, first I'm taking these two, shares and bonds. Okay, this you need to know what's share. Share is nothing but equity. We will discuss about equities later. I mean, broadly classifying, I will classify them into either company shares or bonds. They can be company bonds or government bonds, whatever they are just bonds. Okay, so you can have any one of them. Now, let us talk about bond. Bond is also part of capital market. Bond is also called a debt instrument. Okay. Bonds, they can be further categorized into two types. I mean, debt instruments, they can be categorized into two types. One is bond and the other is debenture. Okay. I mean, see, you are giving bond, that means you are taking money. So along with this bond, you need to also put some collateral. Okay, that is the general scenario. But what about debentures? Debentures also, they are similar to bond, but we are not calling them bonds because here you will still be taking money. But you know what? You will be giving them debenture. It means that you are not taking any collateral. Okay, so that is, if you are not taking any collateral, then it is called debenture. That is the difference between a bond and a debenture. Debenture means DEB, debt, so it is a debt instrument, just like a bond, but there is no collateral required. Why? Because compared to bond, they are for a shorter duration. Debentures are for shorter duration. Okay,
when I am calling it longer, it means the period is for 10 to 40 years. इतना लंबा मेच्योरिटी पीरियड हो सकती है बॉन्ड्स के लिए, बट फॉर डिबेंचर्स इट्स यूजुअली 5 to 10 years. Yeah, both are greater than 1 year only, but I am calling one as short term and other is comparatively shorter. Okay, that is the difference. And collateral, see, since there is no collateral required, that means it is risky, therefore you will usually earn high returns for debentures. Okay, and next, and even whether it is a bond or debenture, we don't care. In the end, they can be classified into two types: convertible and non-convertible. So debentures can also be convertible and non-convertible. And convertible, what does convertible imply? See, I said na ki capital market, they can be broadly classified into debt instrument and equity instruments. So if you take some bond from the company and the company is not paying you the money, then you can convert that bond into equity or share of that company. So now you are the owner of the company. That can happen. So bonds, they can be convertible and they can be non-convertible. But if a company is giving you non-convertible bond, of course the company should offer comparatively higher interest rate. Why? Because that is the only option that you have. Therefore, company will offer you high interest rate for non-convertible because you cannot convert into equities. अगर डिफॉल्ट होगा तो डिफॉल्ट ही होगा, इसका मतलब ये है ना कि तुम ज्यादा रिस्क ले रहे हो. सो फॉर नॉन कन्वर्टेबल कंपेयर टू कन्वर्टेबल यू विल बी अर्निंग हायर इंटरेस्ट रेट. Similarly, debentures also you have convertible and non-convertible. If debentures they can be converted into shares, then it is convertible and they have lower interest rate compared to non-convertible debentures. Okay. Now debentures and bonds, you have understood the difference between them. Now let us see what. Now let us see bonds first. There are different types of bonds, so you need to know what they are, right? The first bond is fixed interest bond. It is also called as plain vanilla bond. What is a plain vanilla bond or fixed interest bond? You borrowed 1 lakh for 3 years, and you are saying that I will pay annual interest every year. So first year, second year, and third year. So you might have paid some 10,000 rupees first year, 10,000 rupees second year, and third year you finally paid 10,000 rupees along with that interest. I mean, along with the principal amount of 1 lakh. So if you are paying that fixed interest periodically upon before getting the maturity period, then such kind of bond, it is called fixed interest bond or plain vanilla bond. Okay. The next one we have is the floating rate bond. Floating rate, see here the interest is fixed, but here the interest is floating. Floating rate simply implies that your interest rate is actually not fixed. Say in 2025, you issued that bond at a face value of say 1,000 rupees. What happened next? You are saying that the maturity period is 2026. So by the next month of next year, within 1 year, you need to return. For simplicity, let's take it as 1 year. Okay. Actually, bond market it's more than 1 year. Now for simplicity, I took it, and I'm telling you that you need to pay me the amount. So what is this amount? You need to pay this amount along with interest, right? So that interest I'm fixing it as floating. Floating implies you are saying that okay, my interest rate is 2%. That and with this 2%, you need to also add repo rate. So actually, the interest that you need to pay me is whatever repo rate that RBI fixes in 2026, that repo rate plus 2%. So you also don't know the repo rate of RBI. For who fixes repo rate? It's a monetary policy committee, right? See, repo rate it usually changes for every 2 months, but for loans whose interest rate is linked with repo rate, they reset this interest rate for every 3 months. Okay, anyways, this will be reset for every 3 months, but if you are generally talking about repo rate, it will be changed for every 2 months. Anyways, 1 year is a big period, and in this 1 year, you really don't know at that time what is going to be the repo rate, right? So that is why it is a floating rate bond. That's all. That amount you can calculate easily. Like if we say that the repo rate in the year of 2026, when you are repaying the loan, let's say it's 6%, therefore, what's going to happen? It's totally 8%. If it is 8%, then it will become 1,080. That's how you need to calculate. Now let us see zero coupon bond. What they are issued at discount value and repaid at face value. This is something you know. If I talk about the next one, deep discount, it is similar to CB, zero coupon bond, but it has long maturity period. A long maturity period implies, say 5 years. If it is 5 years, then what's going to happen? You are going to give a longer discount. For example, let's say that you actually need to give government 1,000 rupees for that bond, but let's say you gave only 600 rupees. That bond was issued at discount, so you paid 600. But anyways, when the government is giving you back after 5 years, it will give you 1,000 rupees. So that is how it works. So the discount is more discount compared to ZCB. For example, in the ZCB, let's say you gave only 900 rupees. You got only 100 rupee discount in the ZCB. So in DDB, you are getting more discount. That's all, deep discount. Okay, what is next? It is FCCB, foreign currency convertible bond. FCCB, this is important actually. Why? Because I will tell you. Let's say there is this Indian firm. Okay, there's one Indian firm. It want to attract foreigners. It want dollars because its business it requires dollars. Let's say it requires dollars. So it will issue FCCB, foreign currency convertible bonds. इसमें क्या होगा कि इसमें foreign investors को एक opportunity देगी. Wait, I will move this up. Okay. So here what happens is the foreign investor, the foreigner, he can invest very easily into FCCB. Why? Because they are issued in dollars. This bond, इसका bond price ही कुछ dollars में है, and the interest it is also in dollars. So the company basically it is getting dollars from the foreigners and it is issuing bond. It is issuing FCCB. So this foreigner will be getting FCCB. इसका bond price principal amount भी dollars में होगी और interest भी dollars में ही होगी. Company needs to pay him in dollars only, interest also. Even if it is an Indian firm which will be earning in rupees, it will pay the investor in dollars. So that is about FCCB, right? So this foreigner he will be getting, he will be getting his principal amount and interest in dollars only. Now here's the catch. That is FCCB. You understood about FCCB. Now the question arises: the difference between FCCB and FDI. See, if a foreigner, if he promises that after some period of time, if he wants to convert this FCCB into equities of a company, which are greater than 10%, then such an FCCB can be called as an FDI. Why? Because he currently invested in this bond FCCB, and this company developed, and he promised that after a period of time I will convert my bond into shares. Now I will become the owner. I invested in your bonds, but now I want to convert that bond into share. And if we convert into the equity of the company, and that equity if it is greater than 10%, then such an FCCB can be called as FDI. Okay, this is something you need to know about FCCB. Since FCCB it is coming from the foreigner, since the funds are coming from foreigner, obviously there's a chance that it can be converted into FDI. Okay. Usually, foreigners, when they invest into Indian stock market, they are called FPIs. And if they are investing more than 10% even in the share market, then obviously they will become FDIs. Similar logic. So FCCBs, if they are being converted into equities or shares, of course, if the shares are 10% more than 10%, then they'll become into FDIs. Inflation index bonds, actually you're readjusting your principal amount and interest amount with inflation. Okay, actually it was introduced in the year of 1997, but later I think that they were not used or something, and RBI reintroduced them in 2013. Inflation indexed. So I will tell you this with an example so that it will be very easy for you. Now let's say the face value of the bond is say it's 1,000 rupees, and say the interest is 4%. Now what's going to happen? Okay, interest is this. Let's say the inflation in the economy, it is 3%. Now what is the 3% of 1,000? It's 300, right? Not 300, 3%. परसेंट मतलब by 100 करोगे तो 10 बचेगा. Okay, 30. Now next, 4% of inflation, that is 4% of 1,000 is 40. Okay, great. Now what you need to do, you need to calculate what's the actual value when you need to finally return the amount to that person who issued that bond. Now what you need to do, फेस वैल्यू पे हमें पहले प्रिंसिपल को एडजस्ट करना पड़ेगा. प्रिंसिपल इज नॉट 1,000, इट्स 1,030. क्यों? इन्फ्लेशन को एक साथ एडजस्ट करना पड़ेगा. दैट इज व्हाट इज इन्फ्लेशन इंडेक्स्ड. सो यू नीड टू एडजस्ट दिस 1,000 विद इन्फ्लेशन, देयरफॉर इट विल बिकम 1,030. एंड इन्फ्लेशन के साथ एडजस्ट करने के बाद इसके ऊपर इंटरेस्ट लगाना पड़ेगा 4%. ओके, दैट 4% इट इज नॉट फॉर 1,000, इट्स फॉर 1,030. सो दिस कैलकुलेशन बिकम्स रॉन्ग. नाउ प्रिंसिपल को हमने इन्फ्लेशन के साथ एडजस्ट किया, अब हमें इंटरेस्ट को भी इन्फ्लेशन के साथ एडजस्ट करना पड़ेगा. So as I said, interest is not 4% of 1,000, it will become 4% of 1,030 because we are adjusting both principal and interest. 4% of 1,030 will become 41.2. पहले हमें 40 आया, no, now it's 41.2. Now the total amount will become P plus I. 1,030 plus 41.2, it will be around 1,007.21. So that is inflation indexed. So you are adjusting the principal with inflation. So 1,000 plus 30, 1,030. You are also adjusting interest. It is not 4% of 1,000, but it's 4% of 1,030. So that this is the amount that the person who issued inflation indexed bond must pay to you back. Okay, now you understood the different types of bonds. Now I would like to tell you more bond. Done. CIB, capital indexed bond. What is this? See, in the same concept, if what you're doing in the same concept, na inflation indexed bond ki concept mein, if we are trying to do this, to do like what? Principal को हमने adjust किया inflation के साथ 1,030. But this interest, if you are not adjusting to inflation, and if this interest you are making it just as 4% of 1,000 only, and that will become 40, then the annual will become P plus I 1,070. So if you are not adjusting this interest, then it will become capital index bonds. That is the only difference between capital indexed and the principal indexed. दोनों में inflation के साथ indexation होगी, principal का होगी दोनों में. Principal is definitely adjusted, but interest amount it is adjusted only for inflation indexed. So when you see this capital indexed, people will not even get the idea that okay, मुझे principal को adjust करना पड़ेगा. People will not even get that idea. But yeah, even if this doesn't mention the word indexed, you are actually indexing the capital. Capital index meaning you are indexing the capital with inflation, only the capital. So you are adding 30 rupees only to the capital. I mean, you are adding that inflation only to the capital, and you are not adding that inflation to the interest. Okay, but inflation index implies you are adjusting everything, including the capital and including the interest. If you are adjusting everything, that is inflation indexed. That is the difference between IIB and CIB. And now there are some unique bonds which are angel bonds, junk bonds, and fallen angel bonds. Angel bonds. What are angel bonds? That means if a company is having low default risk, it means that if you borrow from that company, or if that company borrows money from you, it will generally not default. Okay, that is low default risk. Okay, and if such a company, if it is having low default risk, it's called investment grade status. Okay, this is what you need to know. So low default risk implies the company is having investment grade status, and of course the risk is low, therefore the yield, the bond yield is usually low because interest is also low, right? If risk is low, interest is low. So bond yield is interest by bond price, and if interest is low, risk is low, interest is low, and bond yield is low. So these are angel bonds, they are angels. Okay, therefore they are having low risk and they are having investment grade status. What is fallen angel? Fallen angel implies they used to initially have this investment grade status, and they used to be low default risk companies, but slowly and slowly they have reduced it to junk bond status. What is junk bond status? Junk bond status is the status where the default risk is very high. So if that company took a loan from you, amount from you, there is a high chance that it will not return you back. That is default risk is very high for junk bond. Okay, in such scenarios, those companies they are going to give you high interest. They might say, if you give me money, I will pay you higher interest. Therefore, the bond yield for companies who are issuing junk bonds, the bond yields are usually very high. Okay, that is junk bond status. Fallen angel bond means initially they used to be angel bonds, now they are reduced into junk bonds. If angel bonds who are having initially investment grade rating, if they convert into junk bond after a period of time due to weakening financial condition, then such angel bonds are called as fallen angel bonds. Okay, fallen angel bonds. And their stock price, it's usually very low from substantively very high. So their prices fell from very high to low. The stock price fell down drastically.
You see three situations at which a bond can be issued. It can be issued at a discount or at a premium or at face value. Discount implies that is less than the face value. Premium implies that is greater than the face value. Bond yield is bond interest divided by the bond price. Okay. If bond interest is high, then bond yield is going to be high because they are directly proportional. If bond price is higher, then bond yield it is going to decrease because they are inversely proportional. Okay. Now let us see the three different situations. Now I said face value is 1,000. The bond coupon rate is 30%. So that means what can happen in this situation? In this situation, bond, it can be issued at a premium. Let's say it is issued at a premium of 1200. So why am I even thinking to purchase a bond which is greater than the face value? Because I'm seeing certain profit in it. That's why I'm not a mental patient to purchase a bond at a higher premium, because I'm seeing that I'm getting better result than the market. Let's say market rate is 8%. Now I did 1000 plus 8% of 1000, which is 1080. But when I did invest in this bond, I'm getting more result. So here I need to write bond interest coupon rate divided by the bond price into 100, right? Now what is my coupon rate? That is 30%. 30% of what? 30% of the face value, that is 300. लेकिन मैंने इसे क्या सब्ट्रैक्ट किया यहाँ पर 200, that will be 1200 minus 1000, but that is the loss. That is why I thought that I should subtract this, and that will give me the answer. See, when I am countering fluctuations due to the change in place value, I need to decrease the denominator also. I need to make it 1000, okay? Then only I will get the correct bond yield. I should not take 1200, I should take it as 1000, okay? Then if I take it as 1000, I'm going to get 10%. So that can be one type of calculation. Other type of calculation would be to not even consider this fluctuation. When you don't consider this fluctuation, now that is going to give me 300. 300 divided by 1200 into 100. So this is the general formula that you are going to do. When they mention INA, I'm just going to write the tie directly, and the bond price at which I'm purchasing, that is the price that I'm going to write, 1200. So that is in general going to give me the coupon rate. For example, here I can see 300 by 4, 1 by 4 of 100, so that is approximately 25%. So 25% is going to be my bond yield, which is greater than the market, right? तो मैं हॉनेस्टली कंपेयर भी कर सकती हूँ. 1200 यहाँ पे मुझे 200 का नुकसान, एंड 30% ऑफ 1000, दैट्स माई प्रॉफिट 300. 300 minus 200, that is 100. 100 रुपीज़ का प्रॉफिट, 80 रुपीज़ का प्रॉफिट इन द मार्केट. सो ऑब्वियसली यार ओनली आई एम gaining profit. That is why I thought that I want to invest in this bond. Okay, and next, a bond if it is issued at face value, then there is no problem. 300 divided by 1000 into 100. यहाँ पे कोई कैलकुलेशन में गड़बड़ नहीं करेंगे कोई भी. Now when it is issued at a discounted value, that is at the face value, then the problem arises. Now people will think 30% of 1000, 300, which I am already gaining. Now since it is issued at a discount, I will do 1000 minus 800, which is 200. That is going to give me 500 divided by the again discounted bond price, that is 800. So that will be a wrong calculation. Why? In such scenario, you need to consider 1000 here. If you are considering 1000, that means it is you are basically considering face value, but face value is not the formula. Face value do not calculate the formula for bond yield, right? You need bond price. So in generalistic scenario, you are not considering this 200, okay? You are just considering 300, and in denominator, if you decrease it to 800, that will give me what? That will raise my entire fraction if I decrease the denominator. So do that. Instead of reducing the numerator, I mean instead of increasing the numerator, you can reduce the denominator. The ultimate fraction, it anyways increases, okay? Now the bond yield, how much it is going to become? Some 3 by 8 times of 100, okay? I think it's roughly around some 38 or 39%, etc. That is going to be the bond yield. So bond yield, it is always the coupon rate divided by the bond price. So don't think extra when you are doing it at premium or a discount, okay? Don't do anything extra. Just write this 300 and just change the bond price, okay? Now people will think, what happens when it is issued at zero coupon? तो zero coupon पे क्या bond yield zero होगा? ये सवाल आएंगे लोगों के अंदर. You know, for zero coupon bonds, there is a separate formula, because see, zero coupon bonds definitely they are not generating zero returns, right? That is why for zero coupon bonds, you need to, let's say 1000 rupees is the face value, and you have redeemed at I mean you purchased it at 800, let's say. So that is the bond price. So zero coupon bond, तो कोई भी coupon rate नहीं देगी, लेकिन कितना परसेंटेज का प्रॉफिट मिला? 200 का प्रॉफिट मिला. तो यहाँ पे क्या हम बोलेंगे कि बॉन्ड का कोई yield नहीं है. So for zero coupon bond, the calculations are different. There is this YTM formula, yield to maturity formula. That is the face value divided by the current price whole power 1 by n, which is the maturity period minus 1. So face value is the value that you are finally receiving, that is 1000. Current price तो कितने पे परचेस किया? डिस्काउंट, राइट? ये क्या है? होल पावर 1 by n. मेच्योरिटी पीरियड लेट्स से 5 years, so that will be 1 by 5 minus 1. That is going to give some answer, okay? Anyways, you don't need to think in depth in the exam hall, okay? मैं तो यही करूँगी. मैं तो 1000 minus 800, 200 divided by 1000 into 100 करूँगी मटाश, okay? I'll do that really because I cannot remember that formula. No one is going to ask the bond yield for zero coupon. They might ask whether zero coupon bond is having zero bond yield. So the answer is no, okay? Anyways, this is the formula, so don't confuse with the formula, okay?
Proceeding to the next question, let us check this bond yield. Okay, what is the effect on bond yield due to inflation and due to government borrowings or due to central different factors can be there, and how are these different factors affecting bond yield? For example, let us see. Let's try to analyze. Analyzing is important. Example, increase in inflation. What happens if there is increase in inflation in the economy? What is bond yield? Bond yield is interest divided by bond price. So whenever I am analyzing, I will only check with the denominator, not with the numerator. That is important. And now let us start. Bond yield is interest by bond price. Okay. Now there is inflation in the economy. Great. Now there is inflation in the economy. Therefore, I feel that despite being inflation in the economy, I purchased this bond, but still the amount of interest that I am getting, it is very low. I don't want to buy this bond. If people think like that, definitely the demand for bond is going to reduce, right? If demand for bond reduces, then of course bond price must be decreased. Why? Because we want people to purchase bonds. If demand for bond reduces, bond price should decrease. If bond price is decreasing, then bond yield will increase. Therefore, when there is inflation in the economy, bond yield will increase because people are demanding less number of bonds. Okay. So bond yield will increase. So remember sometime that bond yield is nothing but inflation by bond price. Bond price, write it as demand for bonds. Demand for bonds increase, bond price increase. So bond price, just write it as demand for bonds. Bond price is nothing but demand for bonds. Just for your remembrance. Okay. For example, if there is decrease in inflation in the economy, now bond yield is interest by bond price. Okay. Now inflation by bond price. Now there is decrease in the inflation in the economy. Since inflation is decreased, people are demanding for bonds. Why? There is a decrease in inflation in the economy, and I am getting higher interest from this bond. Therefore, a lot of people are demanding this bond. If there is increase in demand for bonds, therefore increase in bond price. Increase in bond price means decrease in bond yield. So therefore, if there is increase in inflation, it will increase bond yield also. And if there is decrease in inflation, it will decrease bond yield also. This is how inflation affects bond yield. Now let us see government borrowings. Okay, Government borrowings. Now, if a government is borrowing a lot, see, this is government and this is public. Government is borrowing implies government needs to issue bonds. If government is issuing bonds, therefore there are a lot of bonds in the market. If there are a lot of bonds, definitely demand for bonds will reduce. Demand for bond reduce implies bond price will reduce. If bond price reduce, then bond yield will increase. Why? Bond yield is interested by bond price, and demand for bonds reduce, therefore bond yield will increase. Okay, and that is about bond yield increase. Similarly, there is decrease in borrowings. See, you are borrowing, government is borrowing. Government is borrowing less. Government is borrowing less. Therefore, keep it like this. Rupees goes out of the. See, government is decreasing its borrowings. Therefore, this is government, and money are not going to the government because decrease in borrowings. Okay, out of the government. Now, therefore, bonds should be taken by the government. Okay, but bonds are with the government only because it is borrowing less. It is borrowing less. Therefore, most of the bonds are with the government only. Now, there are less number of bonds in the economy. Therefore, what happens to the bond price? Less number of bonds implies more demand. More demand implies more bond price implies less bond yield. Therefore, bond yield decrease when there is decrease in borrowings. Bond yield will increase when there is increase in borrowings. Okay, great. Now, central bank policy. Expansionary policy. During expansionary policy, of course, a lot of money will be supplied from RBI to the economy. A lot of money supplied implies a lot of government bond. A lot of bonds are being purchased by the RBI from the economy. So bonds are being taken from the economy. Therefore, there are less number of bonds in the economy. Less number of bonds in the economy meaning more demand, right? More demand may imply more bond price. More bond price implies a decrease in bond yield. Therefore, when there is expansionary policy by the RBI, bond yield will decrease. And when there is contractionary policy implies money is taken from the market. Therefore, bonds must be sold to the public. So you are selling a lot of bonds to the public, and there are a lot of bonds in the economy. Therefore, demand for the bonds will reduce. Therefore, bond yield is interested by bond price. And since the demand for the bonds are reduced because there are more number of bonds in the economy, therefore bond price will decrease and bond yield will increase. Therefore, during contractionary monetary policy, bond yield will increase. Now let us see this question. With reference to bond yield, consider the following. Which one of the following are correct? Okay. When inflation in the economy is rising, the bond yield may increase. See, we have seen just now. If you want to revise, I can revise again. When there is inflation in the economy, people are demanding less number of bonds. Implies a bond demand decreases, bond price decreases. Therefore, bond yield will increase. This is correct. Okay, next. When interest rates in the economy are decreasing, that means I need to use my realization skills now. This is the bank. Okay. Now this, if I deposit in this bank, I will get less interest because interest rate in the economy decreased. Okay. Therefore, I prefer bonds. I prefer bond. Therefore, if I'm preferring bond, then I'm demanding for a lot of bonds. Therefore, bond price will increase. If bond price increase, bond yield should decrease. But here it says bond yield will increase. Therefore, this option is wrong. And third option, when total government borrowings is increasing, bond yield may increase. See, if government is borrowing a lot, this is government. If government is borrowing a lot of rupees, of course, it needs to sell a lot of bonds, right? If there are a lot of bonds in the economy, bond price, it should. If there are a lot of bonds in the economy, demand for the bonds will reduce and bond price will reduce. That will increase bond yield. Therefore, bond yield will increase. This third option is correct. Only 2 and 3 are correct. Only 1 and 3 are correct. Option B. So before going to the next question, I want to tell you something very important. I want you to know the connection between depreciation and inflation. This is important. So whenever you get a question on bond yield, connect it with inflation and then connect with bond yield. Okay, that is how you can do. When there is depreciation, what happens? If rupee depreciate, does inflation increase or decrease? Let us compare this. Rupee depreciates, meaning $1 is currently 160 rupee. Okay. That means the same $1 good that was in US, that was imported from US, its price is very high in India, right? Therefore, I need to pay more price for that $1 good that was imported from US, right? I'm paying more money. So therefore, inflation in India, it will increase if currency depreciate. Similarly, the reverse logic can also happen. If inflation in the economy is increasing, what happens? That's the question. If inflation in the economy is increasing, will currency appreciate or depreciate? Okay. Now currently the good is initially 80 rupees, but now the same good it is 160 rupees. For 160 rupees, I had to sell in a foreign country. Therefore, that $1 good is now 160 rupees because there is inflation in the economy. Therefore, it is not 80 but it is 160. Therefore, but that same $1 good is 160 rupees here in India. Therefore, currency is again depreciated. Therefore, depreciation will always lead to inflation. Whenever currency depreciates, that means there is inflation in the economy. Or else think in this way. Think just like there is depreciation. We are doing a lot of exports. Since we are able to do a lot of exports, our GDP is good. Therefore, India, there is inflation in India. Think in that way. Think in the way that you can memorize. Finally, if there is depreciation, it is going to lead to inflation. And if there is inflation, it is going to lead to depreciation. Okay. Now, what happens to the bond yield? Whenever they are asking you to connect with bond yield, see, for example, in this question, consider the following statements. Bond yield it will decrease when Indian rupee weakens against the dollar. This is the question which you need to analyze. Now they are saying Indian rupee weakens against the dollar implies depreciation. Depreciation will lead to inflation. Now you can easily compare. When there is inflation in the economy, you know that this will lead to inflation. Great. When there is inflation in the economy, what happens? What happens to the bond price? The bond yield is interest by bond price, right? I already said you when there is already this much of inflation, I am still investing in this bond, but the amount of interest that I am getting, I am not satisfied. Therefore, I will not invest in this bond. The demand for the bond is reducing. Therefore, bond price is reducing and bond yield it will increase. It will increase. Therefore, this third option is wrong. They are saying that bond yield will decrease, right? Third option would be wrong. And there are the direct statements. Bond yield decreases, demand for bond increases. Okay, bond yield is interest by bond price. And if demand for the bond price, if it increase, bond yield will decrease. This is correct. And price of the bond falls. If bond price falls, then bond yield will increase. Therefore, this is wrong. The option only 2 is correct. So always, whenever there is depreciation question relating to bond yield, compare it with inflation and try to answer. now we need to compare bond yield along with the maturity period. So bond yield is on the y-axis and maturity period is on the x-axis. So in general, in normal scenario, you are going to consider economic growth along with inflation. So that is the normal yield curve. So in such scenario, you are going to see that bond yield for short-term bonds, it is lesser than the long-term bonds. See, these are the long-term bonds, right? They are having more bond yield compared to short-term bonds, right? So that is normal scenario. But when you are expecting some recession in the economy, that is inverted bond yield curve. Okay. Now let us see why this happens. Why do you think the short-term bonds, they are having lesser bond yield compared to long-term bonds? That is my question. Why? Because see, in the economy there is inflation. So when people thought of investing in a bond which is having maturity period of 30 years, that is basically they're planning for the retirement plan, right? That is why they want to invest in the bonds which are having 30 years maturity period. Okay. Anyways, let's say they have invested. Now will they accept coupon rates which are having say 5% just like how short-term bonds are having? No. Why? Definitely there is going to be inflation and economic growth, etc. Now if I gave you 1,000 rupees and even after 30 years you are giving me 1,000 rupees, how is it fair? I don't even want to invest. So this coupon rate, it must be 50%. Then only I'm going to invest. That is what people think. And ultimately bond yield is coupon rate by bond price. तो ये coupon rate को बढ़ाना ही पड़ेगा. That is only when investors invest in the long term. So they are going to be higher and bond yield, it is going to increase. So short term bonds, they are having comparatively lesser bond yields than the long term bonds. That is a normal scenario. But when you are speculating recession, this changes. Why? See, that is bond yield is coupon rate divided by bond price. So you are living in a country where you are speculating recession is going to happen. Let's say you are living in some Gulf country where wars keep on happening on day-to-day basis. So you are basically expecting recession in the future also. So people will say that I don't want to invest in future because I don't know anything. I want coupon rate now only because in future there might be further recession, right? So if in future you are expecting further recession, why would a bond issuer give you at a high coupon rate, right? He is going to give you at a low coupon rate only, right? That is when bond yield also decreases. Okay, but people want immediate bonds, right? People को immediate bonds चाहिए, तो immediate bonds के लिए ये coupon rate बढ़ाएगा. Okay, बढ़ाएगा. चलो. Now remember, whenever I need to compare bond yield, I usually consider bond price and I'll see whether the demand for the bond increases or decreases. If demand for the bond increases, I will see bond price is increasing and bond yield is decreasing. But whenever I try to apply this logic here, I'm failing. So this is the theoretical stuff where you need to link up with the ideology. Why a bond issuer is trying to issue bond at a higher coupon rate and lower coupon rate. Okay, so link this with coupon rate and not with the bond price. If you link with bond price, you are going to be confused. Okay, for example, you will think that okay, people are demanding more number of bonds, bond price increase, therefore bond yield decrease. Matash. So don't think like that. Compare it with coupon rate only. Okay, you are expecting inflation. People are expecting inflation. That is natural, and therefore the future coupon rates there must be higher. Bond yield are going to be higher usually for the long term bonds. But in the inverted yield curve, where you are expecting recession, there the bond yield is going to be lesser. Okay. There are also two types of bonds that I forgot to mention. One is a coupon bond and the other is masala bond. Okay. Coupon bond is very simple. See, you invested 100, so minus 100. Every year you are going to get coupon 10, 10, 10 because the face value is 100. Maturity period is 3 years and the coupon rate is 10%. So 10% of 100 is 10. So for 3 years, 10, 10, 10, that is a 30. So these are the coupons. So you got how much coupons? 30 rupees worth coupons. Okay. So zero coupon bonds, they are issued at a discount value. See, zero coupon bonds, what happens is that this coupon rate is going to be 0%. Then you will say 0, 0, 0. I'm taking, I'm not taking any coupon. I'm investing 100 and I'm getting 100. What is this? No. See, you basically at the face value, it will be like you have invested 100, but actually you have invested some 80 like that. And when you redeem it back, you are going to redeem the 100. That is the face value. So 100 minus 80, 20. That is going to be your profit, something like that. So that is a coupon bond. That's how it works. And you also have masala bond. Okay. Masala bond, they are rupee denominated bonds which are issued outside India and they have backing of IFC, International Finance Corporation. So this IFC not only backs this masala bond, it also backs some other domestic bonds like for China, Panda bonds. They are also backed by IFC, I think. So similar such bonds are backed. So what is this masala bond exactly? For example, a foreign investor wants to invest in India, but he can invest only in rupees. And the interest that the foreign investor gain, he can gain only in rupees. For example, if there is any appreciation or depreciation, he will incur profits and losses simultaneously. Example, let's say there is a depression and 80 rupees, $1 became 80 rupees. No, from 80 rupees, let's say it became 160 rupees. Now what's going to happen? See, 8% is my coupon interest rate. So I am usually going to pay him 800 rupees because he has invested in India. But now what India is going to pay? India is going to pay only $5 to him. See, 800 rupees if you convert into dollars, that is going to give $10. But due to depreciation, $1 became 160 rupees, and that's why he is going to get $5 only. Okay, he's going to get $5 only due to depreciation. And similarly, if there is appreciation, he is going to get $20 interest. Okay, right? That's how it works. That is masala bond. Okay. Now let us see participatory notes. Okay, before knowing about participatory notes, you need to know who are foreign portfolio investors. So foreign portfolio investors, we can broadly classify them into two types: foreign institutional investors and foreign individual investors. If it is an institution, we call it as FII. They can be hedge fund, mutual fund, etc. funds. Okay, individuals, if they invest, they are also foreign portfolio investors only. Okay, two types we have. Now we are talking about a foreign institutional investor. He is the one who is going to issue P notes. Any foreign institutional investor, he issues P notes to the overseas citizen, and this overseas citizen, he can now invest in the Indian stock exchange. So he's going to invest in India, right? That's how it works. So this guy can be someone who took black money from India, and that again he might be investing in India only. That can also happen. Okay, so that's why P notes, they are not so transparent. Rather than that, we prefer global depository receipts. What are global depository receipts? Basically, when I'm saying FII, if I replace this FII with some overseas depository bank, that will be GDR. Basically, the overseas depository bank, if it is a bank, for the same overseas citizen, it is going to issue GDR, that is Global Depository receipt. Okay, now using these global depositories receipt in the same fashion, he can also invest in India. Okay, but GDR, since they are issued by banks, they are more formal, and SEBI also they will accept it. GDR. Okay, but these P notes and all, they are not regulated by SEBI. Okay, you can see instruments issued under registered FII to overseas citizen to invest in Indian stock market without registering under SEBI. So who and all we don't know, and they are not registered with SEBI also, and that is why it is comparatively lesser transparent. See, listen carefully. When I'm saying not registered under SEBI implies these overseas citizens, they are not registered under SEBI, but these FIIs who are ultimately investing in India, they must register under SEBI. That is natural. Okay, and if an FII it is investing more than 10%, then that will become an FDI. Okay. So now I will ask you a question. What if a foreign overseas citizen, if he invests more than 10%, will it be an FDI? The answer is yes. See, FPI, there are two types. One is FII and individual investor. That is individual, okay, FII and individual investors. So if individual investors are investing, that is also an FDI only. Okay, foreign portfolio investor. Great. Okay. But the only problem is that this overseas citizen, he don't require any KYC documents with SEBI because FII is the one who is investing in India. So we can never trace the corruption money. Now I'll ask you a question. What is going to happen to FDI and FPI during a contractionary policy effect? So during contractionary policy, the inflation rates, the interest rates of the banks, they are going to be increased. Then people are going to not get loans easily. That is the contractionary monetary policy. If interest rates are increasing, foreign portfolio investors, they are immediately going to jump into India to invest. So FPIs, they are going to increase. But what about FDI? Will it increase or decrease? Now people are thinking, the foreign investors, they don't want to invest in India's assets. Why? They are thinking India is not stable economy because RBI adopted contractionary policy, and private businesses, they are not getting sufficient loans to raise the capital. If a private businesses, they can't raise capital because they are not getting loans, then why we need to invest in the Indian assets? Indian assets का कोई scope नहीं है क्योंकि businesses को खुद loan नहीं मिल रही है, right? That is why FDI it is going to decrease. Okay, that's how you need to analyze FDI versus FPI. FPI it is the hot money, but FDI it is the stable money. तो ये stability देखेगी. Okay. So whenever I am talking about capital market, I usually refer to foreign portfolio investments. See, debt, bonds, equities. What are they? Are they physical assets, infra, etc.? No, they are portfolio, right? So basically, they refer to foreign portfolio investments, not FDIs. Okay. And next, let's see debt, bond that we have already seen in the capital market, right? In the debt instruments, we have seen what are bonds and what are debentures. Debentures, they don't have collateral, but bonds, they have collateral. Okay. Since you are not taking collateral in debentures, compared to bond, you are giving it for comparatively lesser period. See, तुम collateral भी नहीं ले रहे हो, तो क्या long term में दोगे किसी को पैसे? नहीं ना, short term के लिए दोगे. Short term implies it is more than 2 years only, but इतना ज़्यादा नहीं है. Bond का period से comparatively shorter. Okay, now we have seen debt instruments, bonds, etc. Now we need to concentrate on equity instruments. Okay, equity, they are also called shares. For example, if a company issues shares in the IPO, on that share, you might have ownership if you purchase it, right? So that is equity ownership. It determines the ownership. Equity shares, they mainly talk about whether you are having ownership or not. Okay, preference shares, again we have preference shares. That means they mainly talk about whether you are getting dividends or not. See, when you have ownership, you are going to get dividends, but they might not be guaranteed. Of course, it depends upon the company, and you also get voting rights because you are the owner. छोटा सा owner ही तो हो, right? So these are the benefits if you own equity shares of a company. But if you are owning preference shares, that means that you said, see, dividends are not guaranteed when I own equity shares. That's why I want to own preference share. That means I want guaranteed dividends. I want guaranteed dividends for say quarter or monthly. So that's how you make a deal with the company, and you will say that if you give me guaranteed dividends, then I will hold preference shares, and I don't require any voting rights like a equity ownership. I don't want any voting rights. So that is a preference share. Here you have the flexibility. Whenever you want, you can stop this and you can convert into equity shares. That means you will get back your voting rights, and dividends, they might not be guaranteed. That is convertible. Okay. So that is the difference, main difference between ordinary share and the preferential share, where there is a difference between voting rights and guaranteed dividends, which are for preferential shares. Okay. And also when you see the waterfall approach, you will notice that ordinary shareholders, since they are the owner of the company, they are given the least preference. But the preferential shareholders, they already said, I value profits and dividends. I don't want any voting right. Therefore, he is given more priority during company liquidation. So he's a normal shareholder, he definitely has ownership, but preferential shareholder is not creditor. Actually, he has a limited ownership, and yeah, they're issued at face value or premium. Preferential shareholder, the money, whatever share is there, it is issued at face value or premium. Okay, and the dividend paid after the preferential shareholder, you know everything. And redeemable, no, except under buyback of shares, they are not redeemable. But yes, for preferential shareholder, the shares are redeemable. Under Companies Act, companies cannot issue irredeemable preferential shares, redeemable within 20 years. Okay, and rights and bonus issues, he definitely has rights and bonus issues. Bonus shares, preferential shareholders is going to get, but rights, as I said, they cannot be issued to preferential shareholders because he sacrificed some of his ownership. Therefore, rights shares, they cannot be issued to preferential shareholders. And voting rights, normal shareholder will have. Preferential shareholder will not have voting rights, but can cast voting rights in exceptional circumstances, such as decisions affecting the rights of preferential shareholders or resolution for winding up a company. Now let us see the question. Preferential shareholders are generally treated as creditors of the company rather than its owners. As I said, they are treated as limited owners. Limited ownership को मैं creditor कैसे बोल सकती हूँ? Limited ownership. He is also having certain ownership, and he did not give any loan to the company. Okay, he took some shares. That means he is still a owner. Okay, but that is called as limited ownership. Therefore, statement 2 is wrong, and I think option is C. So when a company is getting liquidated, the first preference is given to the bondholders. Why? Bondholders, na, they have taken company bonds, okay, with some collateral, and they gave you money. Okay, that is why you are prioritizing them. चलो पहले हमारा एसेट या फिर कोलैटरल जो है वो ले लेंगे वापस. So that's why you are prioritizing bond holder first. Next, debentures who do not take any collateral. Okay, who did not take any collateral, they are debentures. So first you prioritize bond holders, and next debenture holders, and then preference shares, and then finally equity shareholders who are the owners. Okay, they are given the least preference during company liquidation. पहले bond holders को पैसे दे दोगे, and then debenture वाले को, these are the debt instruments, and उसके बाद equity instruments. तो debt instruments पहला, equity instruments बाद में. We have seen debt instruments, we have also seen equity instruments. We have also seen that during a liquidation, the debt holders, they are given more preference than the equity holders or the shareholders. Now we need to see where and all equity can be invested, or from where and where you can purchase the company shares, etc. Okay, they can be made in two ways. One is through primary market and the other is the secondary market. So we are going to see these markets now. So basically we have two types of market. One is primary and the other is secondary. If an investor buys the share of the company directly from the company, then that type of market is called primary market. But if an investor is buying the shares of a company from another shareholder of that company, then that is going to be secondary market. Okay, we have approximately five instruments under primary market. One is IPO, second is FPO, third is eIPO, which is similar to online IPO, and fourth is the right issue, fifth is the private placement. See, before understanding these type of IPOs or the type of primary markets, you need to first understand the type of investors. If you understand the type of investors, that will make your life easy. Okay, see, we have four type of investors. Retail investors who invest less than 2 lakh, they can be individuals or NRIs. And we also have qualified institutional investors or QIB, qualified institutional buyers. They can be mutual funds, insurance companies, or foreign portfolio investors or banks, whatever. They're qualified enough, that's all. That is qualified institutional investors. And the third is anchor investor. They must invest minimum 10 crore, and the lock-in period must be 90 days. So in this 90 days, they must not withdraw 50% of the amount, something like that. So we are encouraging anchor investment to boost public confidence. For example, let's say Ratan Tata Constructions, it invested in my company. So people will think, okay, this company is backed by Ratan Tata, and therefore people might think to invest in my company. So that is possible. That's why companies usually they must not withdraw their amount till 90-day maturity period. Okay, SEBI also put this condition that anchor investors, their lock-in period must be up to 90 days. And the minimum investment they must do is 10 crore. One thing you need to notice is that anchor investors, they are type of qualified institutional investors only. Okay, anchor investors, they are type of qualified institutional investors. For example, a mutual fund can also be an anchor investor if it is investing more than 10 crore and lock-in period is 90 days, right? So they are the type of QIB or QII anchor. And next we have non-institutional investors. They are individuals only. Okay, first and fourth, retail and non-institutional, they are for individuals only. But when I say QII or anchor, they are usually the institutions. Okay. Anyways, now let me talk about the fourth, non-institutional investors. They are high net worth individuals or high net worth companies. I mean, not just individuals, they can also be companies also. Okay. So basically only the first, retail, it is individual, and the three, they can be either individuals or companies, I think. Anyways, now if you see non-institutional investors, if they are investing more than 2 lakh, then that is called non-institutional investor. For example, if I invest less than 2 lakh, I will be called a retail investor, and if I invest more than 2 lakh, I will be called non-institutional investors. Okay. Now I said based upon the type of investor, I will classify the type of placement. For example, retail investor, he is having right issue. Right issue are for retail investors. For example, let's take this IPO. Okay, I am a company. Now my company initially issued IPO to raise money. Now I think that this money is not sufficient for me. Therefore, I again raised FPO after some time period. Okay, in this FPO, I initially called for right issue. This right issue technically calls for people who have already invested in IPO. I'm calling them and I'm asking them to invest in my company again, and I'm telling them if you invest, I will raise, I will give you the share price at a discounted value. So if I'm doing such kind of things, and if I'm calling people from IPO who have already invested, that is right issue. Okay, these are the rights that I'm giving to the people who have already invested in IPO to invest further in my FPO. That is right issue. Okay, and next we have private placement. So if a qualified institutional investor is investing, that is called private placement. That's all. And what is anchor placement? If an anchor investor is investing, that is called anchor placement. That is all. So as I said, if you know the type of investor, it is easy to understand the type of placements that are there. See, now you already finished FPO, right issue, and private placement. Right issue is for whom? It is for the retail investors who invested less than 2 lakh, and they now want to be part of FPO. The next is private placement. This is for whom? This is for qualified institutional investors. And the sixth that I did not write, that is anchor placement. Okay, anchor placement, that is for whom? That is for anchor investors. So these three also we have finished, and we know what is FPO, and we also know what is eIPO, that is online IPO. Okay, now we need to know primary market. Primary market ka kya? Primary market ka IPO. So whenever you think of primary market, you always imagine this IPO. So IPO has two components. One is fresh issue of shares, offer for sale. For example, in IPO, let's say I issued 100 shares. In 100 shares, 40 are already purchased, 60 are not yet purchased. So when I go to buy, I can buy out of the 60. If I buy out of the 60 which are still new and not purchased by anyone, that is fresh issue of shares. But if I go and invest in this 40, you might be questioning that, are this 40 they have already been purchased by someone, you said, so how can I invest? I mean, how can I invest in those 40 shares? You cannot technically invest. But what happened? The person who was invested in this 40, he left and he gave back to the company again. So that these are the shares of someone who has already purchased and left back. Now you are going to purchase. So company tagged them as offer for sale. those shares are offer for sale shares. Okay, so these are the two types of shares: fresh issue of shares and offer for sale. Now SEBI puts restriction on the type of IPO. For example, if IPO is less than 5,000 crore, what type of investors that the IPO must have, like कितना percentage retail investors होना चाहिए, कितना QII, कितना NII, वो सब पढ़ना पड़ेगा. And you know, even in the non-institutional investors, there are also small size and high network individual. So small high network individual, that means if you see small size network individuals, they are investing more than 2 lakh only. That is why we are calling NII. But they are investing less than 10 lakh. That is why they became small. But if the NII, if it is investing more than 10 lakh, that NII we are calling it as high network individual. Okay, now I'm going to tell the different conditions or the different percentages. Okay, this is a rough percentage, this is not actually the accurate one. Okay, I'll tell the accurate one. See, there are two criteria. First, for the firms who are meeting the profit criteria and the firms who are suffering from loss. Okay, now if you are a firm who is having a good profit, and if your IPO size is less than 5,000 crore, these are the percentages. And if your IPO size is more than 5,000 crore, these are the percentages. And if your firm is suffering from loss, then these are the percentages. Okay. So what are the type of investors that we notice here? One is the retail investor. Who is retail investor? Who is investing less than 2 lakh. Okay, if he is investing more than 2 lakh, what am I calling? I am calling him as non institutional investor. Okay. तो हम कुछ कॉमन चीजें पहले नोटिस करेंगे कि ये नॉन इंस्टीट्यूशनल इन्वेस्टर्स का परसेंटेज, इवन इफ इट इज लेस देन और मोर देन 5,000 crore, that is going to be the same, 15%. Okay. Now first investor is retail investor and the second investor is qualified institutional buyer. And we have two components under QIB. One is anchor and the other is non-anchor, and the third is NII. Okay, in the anchor we again split them into two. One is they can be through mutual funds or else they can be through insurance companies. They can be either Indian or foreign. Okay, now in the qualified institutional buyers, the percentage is 50 and here it is 60. Let us see first for less than 5,000 crore. Okay, for less than 5,000 crore retail investors, they must be at least 35%, and we need to have 50% QIB. तो याद रखना कि ये QIB याद रखना. ओके, इफ इट इज अ QIB IPO लेस देन 5,000 करोड़, 50 से मैं 50 ही निकालूंगी तो 50% QIB. ओके, और इस 50% में ये एंकर इन्वेस्टर 40% जो है वो हमेशा कांस्टेंट है, तो 40% जाएगा एंकर इन्वेस्टर. दैट मींस नॉन एंकर के लिए कितना बचेगा? 10%. ओके, सो 40 + 10 दैट इज अल्टीमेटली गिविंग मी 50. एंड आउट ऑफ देम म्यूचुअल फंड और इंश्योरेंस कंपनी के लिए हमेशा 33-77 रेशियो में ही जाएगा. ओके, एंड नेक्स्ट NII we have already seen it is always 15%. Now when we subtract 50 + 15, that is 75. 100 - 75, that is going to give me 35. So that will be for the retail investor. Simple, easy peasy. हमने IPO साइज अगर 5,000 करोड़ से ज्यादा है तो उसमें क्या किया? There we thought that okay, now IPO size is larger, we need a QIB, good amount of QIB. That is why we increased the percentage to 60% because there is a requirement from the QIB actually during the IPO. That is why we made this 60%. If we made this 60, we need to decrease this by 10. So 35 को 10 से reduce किया तो वो हो गया 25. Okay, and the rest. If this is 60 and anchor, it is always the same. Anchor A constant. If it is 40% with mutual 33 and insurance 7, that means the non-anchor part is 20% and NII it is 15. So here I am going to highlight certain things which are always constant. तो पहले मैं इस पार्ट को हाईलाइट करूंगी. म्यूचुअल फंड, इंश्योरेंस, दैट एंकर इन्वेस्टर वाला पार्ट, दैट इज ये फॉर ये, दैट इज ऑलवेज कांस्टेंट. एंड NNI हाई नेटवर्क इंडिविजुअल्स, देयर पार्ट इज आल्सो कांस्टेंट. Okay, these are the two areas which are not changing. So memorize these parts definitely. Whether IPO size is less than 5,000 or greater than 5,000, anchor investors it is going to be 40%, with mutual funds 33% and insurance companies 7%. Okay, and if it is IPO less than 5,000 crore, 50 को as it is रखेंगे, but it is more than 5,000 crore तो QIB को ज़्यादा देना पड़ेगा. That is why it is 60%. अगर ये 60 होगा तो नॉन एंकर के लिए 20 हो जाएगा. अगर ये 50 होगा तो नॉन एंकर के लिए 10 हो जाएगा. And NNI it is going to be same 15. Okay, so now this is going to become how much? 100 - 75, 35. Here यहाँ पे 10 एक्स्ट्रा दिया, इसका मतलब है कि 10 सब्ट्रैक्ट करना पड़ेगा. So it is 25. So that's how I memorize these profit criteria. I mean the firms who are suffering from profit criteria, how the investors must be there. I mean the composition of investors. That's how I memorized. And now let us see the firms who are suffering from loss. Okay. So you are a firm who is suffering from loss. तो अगर कोई इन्वेस्टर तेरी कंपनी में इन्वेस्ट करेगा तो वो लॉस ही सफर करेगा. So that's why we are not allowing more retail investors. We are just allowing 10%. Okay, 10%. It's good. So not more than 10% are going to invest in that loss company. And next QIBs कितना होना चाहिए? To help these firms, QIBs must be 75%. Okay, great ना. 75% we need from QIB, and out of this QIB 45% they must be anchor and 30% they must be non-anchor. So the anchor companies which can boost confidence of the people or which can help the company to grow, they must be 45% out of the 75%. So these weightages I think you can remember. 75 is easy to remember and 45 is also easy. And 75 - 45, that is 30, which is in the non-anchor. Okay. And next we have NII, which is again constant. That is 15%. Okay. Now you have retail investor 10, QIB 75, anchor 45 and non-anchor 30, and NI it is 15. Now I'll ask you a question. What is the maximum participation of retail investors in the firms which are meeting profit criteria in IPOs? So that can be either direct or indirect. I will get this doubt. Why direct and indirect? See, retail investors they are directly investing, so that is 35%. But retail investors they can always invest through mutual funds. ये जो anchor investors के बारे में मैं बोल रही हूँ 40%, which is having 33% of mutual funds. Who are they? I mean, how are they getting money from? They're getting money from like we people. We people are investing, and that is how mutual funds are able to provide anchor investment to this profit-making company. Therefore, retail investors they can participate indirectly or they can participate directly. If the participation is direct and if the participation is indirect, and if we are adding both of them, that will be certain percentage. That is what I'm calling it as maximum percentage of retail investors. That is going to give either 68 or 58. If IPO size is more than 5,000 crore, direct retail investors, it is going to be reduced to 25%. So 25 + 33, 58. Nice. Now let us see some of the 2026 IPO landscape reforms. See, underwriting. What is underwriting? See, if a firm, if it want to issue 100 crore shares at 500 rupees worth of each share, it must first need to go to underwriter. Initially, people used to think that this underwriting it is at the end, but now that underwriting it shifted to the starting period. Okay, the starting only the firm must go and take the underwriting before even issuing the shares. Okay, in case if there is any loss that a firm suffers, that might be borne by the underwriting. And next we have QIB selling. See, the old misconception is that QIBs they can go anywhere. I mean, they can't go 24 hours anywhere. They must lock in. That is what people used to think. But now, the actual rules as per 2026, they say that there is no lock-in period for QIB. For example, if qualified institutional buyers, if they invest, they are going to invest, and there is going to be no lock-in period. Okay, there is no lock-in period. For example, QIB, he invested on day one of IPO. He can immediately withdraw on that day one only. The lock-in period it exists for the anchor investor who is a type of QIB. Okay, anchor investors now initially they used to call that 30 days is the lock-in period. See, you know, right? Minimum 10 crore investment for lock-in period of 90 days. Now the new rules they say that 50% of the amount it should not be withdrawn for up to 90 days. Okay, and for up to 30 days you cannot withdraw 50% of the amount. Did you understand? Let's say an anchor investor he invested 100%, तो इसको हमने बनाया 50-50, तो ये 50% जो है वो 1 महीने तक नहीं ले सकते हो वापस, एंड ये दूसरा 50 जो बचा हुआ है वो 90 डेज तक तुम नहीं ले पाओगे. Okay, so that's the thing. That's the summary of 2026 landscape of IPO. Now, if you see secondary market, you need to understand two things: when the market is bullish and when the market is bearish. That you already know. And next, Bombay Stock Exchange. It is a very old stock exchange from 1875, and National Stock Exchange. It is new. Is it new? No, it is not new. It is also old only. But compared to Bombay, it is new. It is after LPG reforms 1991. Now, if I ask you, where are the more number of stock exchanges? I mean, which stock exchange is having more number of companies? The answer is Bombay definitely because it is old. Roughly 5,500 companies are there. In National Stock Exchange, there are 2,200 companies. And Bombay Stock Exchange, we measure it with a benchmark index called Bombay Sensex. The benchmark index for National Stock Exchange is Nifty 50, 50, 50, Nifty 50. 50 Nifty easy to remember due to the rhyming. Bombay Stock Exchange, you can also remember with Sensex. Sensex 30. So Sensex 30, it is going to have 30 companies. So using this top 30 performing companies, you are going to measure the performance of the BSE. Using the top 50 companies, you are going to measure the performance of the Nifty. That is National Stock Exchange. Now the world's oldest stock exchange, it is Amsterdam, Netherlands. But if you see in Asia, the oldest is definitely our Bombay Stock Exchange, 1875. And now people will not ask old, they are going to ask the largest. The Asia's largest stock exchange is Shanghai Stock Exchange, which is $6 trillion. Now I will ask you one more question. World's largest stock exchange. I did not write here, but everyone knows it's New York Stock Exchange. Okay. So in the secondary market also we have covered stock exchange, BSE, NSE, OTC, that you know. See, certain commodities they are illegal. Such kind of thing they are performed in OTC. Whenever illegal things or some not exactly legal, there are certain things which are not regulated under SEBI. Okay, those kind of exchanges they are performed in OTC. Whenever such kind of exchanges come, I will tell you. And then we have National Stock Exchange, commodity and spot, and also we have social stock exchange. Okay, I will discuss these three. And then, secondary market, the settlement is T+1 basis. Okay. For example, transaction happened here. By the next day, the transaction settlement must happen. That is T+1 settlement, which is also called rolling settlement system. Now let us see social stock exchange. Okay. Now, if you see social stock exchange, it's an initiative to help social and voluntary organization to raise capital as equity debt fund. So, for example, if a company want to do some developmental activities, it needs some capital, right? That capital it want to raise through stock exchange. So, therefore, under our regular stock exchanges like Bombay Stock Exchange and National Stock Exchange, it is opening a separate segment, and people they can invest here. Whoever think that they want to contribute to social development, such kind of people they can invest in this social stock exchange. But the company need to show that 67% of its activities they are in the social activities only, and it needs to send annual impact report to the to the SEBI. Okay, and the company's objective is obviously social return on investment. So whatever return investment it is doing, it needs to get some social returns or development. Okay, that is the company's objective. The main question that they always ask is that social stock exchange is an independent something. So no, it is not an independent stock exchange. It is a specialized segment under NSE, BSE, etc. other stock exchanges. This is what you need to know about social stock exchange. Now we have commodity exchange. Okay, commodity exchanges they can be divided into two. One is national commodity exchange, other is regional commodity exchange. There are 6 national commodity exchange, and the famous among them is NCDEX. That is national level. What is that? I don't remember. National Commodity Derivative Exchanges Limited. Yeah, that is NCDEX, and it is regulated by FMC. Initially, it used to be regulated by FMC, but currently it is merged under SEBI. So this is also regulated by SEBI only. So what do you trade here usually? You can trade anything. You can trade event activities or securities, government securities, or any other commodities. They can be even regular goods and services also. So whatever commodities that you want to trade, you can trade them here. Okay. Some people ask what is FMC? That is Forward Market Commission. Anyhow, now don't remember this. SEBI is the one who is regulating. Spot exchange. Spot exchange. See, if you want immediate transaction, you don't want to wait for future, then you usually do spot exchange, because commodities they take a lot of time. It's not like you will be getting that government security in an instant, or you will be traded some event in an instant. No, that's not possible. So if you want it immediately, then you need to go for spot exchange. Here also you can trade various goods, money, bulletin, whatever they can be. Not bullion. That is also some gold. Okay. So if you want to trade such things immediately on a spot, then there are such kind of spot exchanges. Such kind of exchanges are called spot exchanges. They're a type of commodity exchange only, but on immediate basis. There are 4 spot exchanges in India. And NCD, for example, commodity I said NCDEX, right? सो इसके ऊपर आप स्पॉट लगा देना, तो वो स्पॉट एक्सचेंज बन जाएगा. दैट्स ऑल. Because I said spot exchange is a type of commodity exchange only. Now you know what's dabba trading. Dabba trading, it's like first thing, whether it's legal or illegal, it's illegal. Okay. Because see, a person who is showing zero revenue to the government and he's claiming himself as poor, but what he's doing, he's earning some black money. So this guy, he's going to give to this investor some money, and this investor is going to invest in the stock exchange. And what is the benefit for this investor? Of course, he's going to share some profit stream, or else they might be doing some betting, and they might be saying, see, if I win, I will give you 30% of the shares, but if you win, give me 30% of the share. So something like that, they can do some betting, and finally they can do a win-win situation. So that is how dabba trading works. Okay. It is completely illegal because lot of corruption can happen here. Not corruption, but money laundering can happen here. The market capitalization, you already know, right? Market price into number of outstanding shares of the company, and India is among the top 5 क्योंकि India का population बहुत ज़्यादा है. अब large cap market company. So if you take a company and if you have seen the number of shares times value of each share, if you multiply, you got some market capital. So that market capital, if it is greater than 20,000 crore, then you will call that as that firm. You will call it as it is belonging to a large cap firm. Simply putting. So if the market capitalization is between 5,000 to 20,000, you call it mid cap firm, and if it is less than 5,000, you call it as small cap firm. So is a large cap firm risky? It's not risky because it's large cap. If it is not risky, liquidity will be high. So whenever liquidity is high, whenever you can convert equities immediately into money, liquidity is high. Therefore, they are low risky. But the small cap, they are very risky, and therefore the liquidity is also very low. Buffer indicator, it is market capitalization by GDP. So what is this buffer indicator measuring? It is measuring the size of the capital market via vis-a-vis what? Economy, size of the economy. So you are seeing how the capital market is growing with respect to the how economy is growing. Let's say buffer indicator has a very high value. What does that indicate? It indicates highly valued capital markets in that particular country. Okay. Now, what is BRSR? Business Responsibility Sustainability Report. So basically, what happens is that SEBI, you know SEBI, right? SEBI, it requires 1,000 largest listed companies by market capitalization to mandatorily file BRSR. Okay. What is BRSR? BRSR is basically annual report of their performance. The performance is based upon ESG parameters: economic, social, and governance, corporate governance. Okay. Based on these parameters, they are going to submit this BRSR report. That's all. Whenever you see a stock exchange, you get to see these two terms, alpha and beta. If you are checking the performance of your stock with respect to the stock exchange, then it is alpha. But if you are checking how volatile is your stock with respect to the stock exchange, then that is beta. So alpha performer, this is the trick to remember. Alpha performer and beta, मतलब beta का volatility. हमारा beta बहुत volatile है. Okay, beta का volatility. So this is how you remember. Whenever they talk about performance in the MCQ, take it as alpha. And whenever they're talking about volatility of the stock compared to the market as a whole, then that is beta. Okay. So alpha, it describes the investor strategic ability to beat the market. That's all. So tell me, are equities the only thing that you can invest in the secondary market? No, there are mutual fund, index fund, many other such funds. So instead of purchasing directly the shares of the company, you want to do some strategic assessment. So for that, you might invest in some mutual funds where the fund manager, he is going to invest in diverse set of fields, and accordingly he is going to generate profits, and some of the profits can be distributed to you. Yeah, they will be distributed to you, and they are called mutual funds. Okay, and similarly, we also have exchange traded funds, ETF. Also, we have index fund, IF. So what is the difference between ETF and IF? Simply putting, if this mutual fund lists its shares in the stock market, and if you can trade the shares of the mutual funds, then such a mutual fund can be called as ETF. Okay, so mutual fund is very different from ETF because in mutual fund you cannot trade mutual funds. Okay, you can just invest in that mutual fund, but in ETF you can actually trade like any other stock exchange. Basically, they are just traded like some shares of the company. Funds are being traded like shares of the company. The best example that I know is CPSE ETF, where I have actually invested. So ETFs, they also permit intraday trading. So for example, if you open your Demat account and if you want to do intraday trading there, if you check ETFs, these ETFs are also available for intraday trading. Okay, intraday trading. So that is all you need to know about ETF. You already know about mutual fund. Let's see what does this index fund imply. See, for example, in index fund, you are creating some same portfolio which can generate returns similar to Nifty or Sensex. Okay, so you are creating your own portfolio, and you are creating a portfolio in such a way that the companies in your portfolio behave as if they are the top performance of Nifty 50. So Nifty 50 में मेजरली क्या होता है कि टॉप 50 में जो है वो ही दिखता है ना यूजुअली. तो निफ्टी 50 को डुप्लीकेट करने का एक तरीका ढूंढ रहे हैं हम, जिसमें एक फेक पोर्टफोलियो हम क्रिएट कर रहे हैं, एंड वी आर ट्राइंग टू जनरेट द सेम रिटर्न्स एज इक्वल टू निफ्टी और सेंसेक्स, एंड वी आर ट्राइंग टू मैच द रिजल्ट्स. दैट इज ऑल. So index fund, it offers similar returns as that of Sensex or Nifty 50. That's all. Same returns plus same risk also. If Nifty is falling, obviously there is a high chance that your index fund will also fall. So this fund, it is investing in the companies that are generating returns similar to Nifty 50 or Sensex. So this fund, this is just a fund which can be traded regularly in the stock market. Mutual fund, it is a fund where you cannot trade their shares, but the profits will be given to you back. So intraday trading, it is not possible for index funds. Okay. So mutual funds also, there are some types actually that I forgot to tell you. Types implies, see, two categories about open-ended and close-ended. Open-ended implies there is no lock-in period, so you can take them whenever you want, and there is no fixed maturity period. Of course, if they're giving you with such conditions, if they're accepting such conditions, that means they're going to give less number of profits, lesser amount of profits, right? What if it is close ended? क्लोज एंडेड मतलब इसका ऑपोजिट है, इसके ऊपर एक लॉक इन पीरियड है और एक म्यूचुअल एक मेच्योरिटी पीरियड भी है, ठीक है? दैट इज अबाउट ओपन एंडेड एंड क्लोज एंडेड. And there are various types of mutual funds, like there are equity funds where mutual funds must invest at least 65% in assets only. If mutual funds are investing in 65%, if they're investing in equities, then they're called equity funds. But if mutual funds are investing in debt instruments, I mean at least 65%, अगर ये 65% तो बेस है, अब वो 65% अगर इक्विटीज में है तो हम उसको बोलेंगे इक्विटी फंड, और 65% डेप्ट इंस्ट्रूमेंट्स में है तो हम उसको बोलेंगे डेप्ट फंड्स. एंड इफ दे आर इन्वेस्टिंग इन हाइब्रिड मैनर देन देर कॉल्ड हाइब्रिड फंड्स. एंड देयर इज द SMOF ऑल्सो, solution oriented mutual fund. That means a lot of people, they need solution. When they need solution, they'll go and approach mutual funds, and mutual funds, they are going to give you a lock-in period and say, I will give you a solution, but it is for lock-in period for 5 years. You should be implementing whatever I tell you. Okay, so that lock-in period is there for you. So basically they are assisting people related to marriage, education, or etc., and they are assisting you with solution, and they're setting certain time period, and over that time period you are also investing in the mutual fund. That is how mutual fund is raising money. That is solution oriented mutual funds. Okay, and there are similarly other mutual funds, you do not know about them. Okay, this is a generalistic idea about mutual funds, that you pool some money and the fund manager, you will invest in different areas. They can be stocks. If it is stock, it's called equity funds, and if it is debt instruments, then it's called debt fund, and so on. You have seen. And what is SIP? SIP is a systematic investment plan. Systematic investment plan means, see, for example, you are an investor. If you are investing a lump sum amount, or you can also do one thing, you can invest in small amounts. If you are investing in small amounts, that means you are planning and doing strategically. So that is systematic investment plan. That's all. So there, every month you need to definitely do this much of amount, and that amount will be added to your mutual fund every month. Usually people do. I think I have also invested in this SIP once. There is a side pocketing rule for mutual funds, which is a framework that allows mutual funds to segregate bad assets to separate portfolio. Mutual funds, of course, they are investing in separate companies. Na? There is this side pocketing rule where they can sideline bad assets in that same portfolio, and accordingly they can try to invest. That is side pocketing rule. ETF and mutual funds, they seem to be similar, so I'm trying to compare similarities and differences. Okay, both are regulated by SEBI, and investors, they do not directly own the underlying asset. ये तो है ही. अब ETF, they are passively managed, while mutual funds, they may be passively or actively managed. That is correct, right? See, for ETF, demat account is mandatory. This you need to know. डीमैट अकाउंट के बिना तुम ETF में कैसे ट्रेड कर पाओगे? बट म्यूचुअल फंड्स जरूरत नहीं है कि तुझे डीमैट की जरूरत है. सो विदाउट इवन डीमैट अकाउंट आल्सो यू कैन स्टिल इन्वेस्ट इन म्यूचुअल फंड्स. दैट इज द डिफरेंस. ऑफ कोर्स इन द डीमैट, थ्रू इफ यू हैव डीमैट यू आर इन्वेस्टिंग, दैट्स राइट, बट इवन विदाउट डीमैट यू कैन इन्वेस्ट. बट दैट्स नॉट द केस फॉर ETF. Okay, and that is the similarity and differences. And the main difference, is that ETF can be traded, and mutual funds, like you just need to take certain amount of profit and leave. Just I want to tell you this formula of net asset value. It's the fund asset minus fund liability. Okay, the asset that you are having minus the liabilities, if you do, divided by the total number of outstanding shares, then it becomes net asset value. Have mutual funds and hedge funds. The difference between them is important. See, hedge funds, they are considered to be very risky compared to mutual funds. Why? Because they invest in risky things like short-term selling. They use various risky operations, short selling, OTC, such kind of stock exchanges they are going to use. Okay, that is why it is risky, but they generate high profit. Therefore, they also prefer investors who are high net worth individuals. And for investing in hedge funds, you need to at least invest 1 crore, minimum 1 crore. But in this example, let's say that this high net worth individual, he invested 100 crore. Okay, he invested in 100 crore, and there will be a 2% of fee. Okay, for the investment. That 2% of fee, it is approximately 2 crore. तो 2 crore हो जाएगी सिर्फ फी के लिए. Okay, तो actual investment कितना हो? 98 crore हो गया. तो 98 crore is invested. Not only this HNI, there are many HNIs who invest such high network funds into this fund basket. Okay, now all this money is traded in various stock exchanges, and finally you will get some profit. Let's say the profit generated out of this 100 crore investment is 50 crore. तो इस 50 करोड़ को देंगे हम HNI को वापस. लेकिन ये बोलेगा कि देखो मैंने बहुत मेहनत किया 50 करोड़ जनरेट करने के लिए, इसके लिए 20% का प्रॉफिट मुझे मिलना पड़ेगा. तो 20%, दैट इज 20% ऑफ 50 करोड़ विल बी 10 crore, and 10 crore will be again taken back by this fund house, and only 40 crore will be given back to the HNI. Anyhow, HNI, he got 40 crore का profit for 100 crore investment, so he will be taking back this 40 crore plus 98 crore. So that is how it works. Okay, that is hedge fund.
Now let us study REITs and InvITs. Okay, REITs का मतलब होता है Real Estate Investment Trust. InvITs का मतलब होता है Infrastructure Investment Trust. These models, they are the photocopy of mutual funds. Just like how mutual funds get investors, REITs and InvITs, they also get investors. These investors, they pool some money, right? Here also they pool some money. That money in the mutual funds, it is being used in the investments in different stocks and bonds, right? But InvITs and REITs, they use this money to invest in different physical assets such as buildings, roads, land, etc. Okay, that is the main difference between mutual funds and REITs and InvITs. Now let us see different components of REITs and InvITs and how the model works. Okay, see, we have 5 components in the REITs and InvITs. First component is the sponsor, which is the government of India. It can be whom? It can be National Highway Authority of India or BSNL. That is the first component, sponsor. The second component is the trustee. So government, it is going to lease its building to a private company, which is called trustee. That is the second component. The third component is trust. This is trustee and this is trust. There is a difference. See, basically Tata, let's say it is trustee. It doesn't want to take the risk of the road construction. That is why it is appointing a new company, that is a Tata InvIT. So this Tata InvIT, it is getting the ownership.
Now the ownership it is transferred to Tata and Tata transferred its ownership to Tata Invit. Now we have seen 3 component. सो टाटा इन्वेट क्या करेगी, इसके पास खुद के पैसे नहीं है, टाटा भी पैसे नहीं दे रही है, तो इसको पैसा कलेक्ट करना पड़ेगा. किससे कलेक्ट करेगा? इन्वेस्टर्स से. सो द इन्वेस्टर्स हु आर इन्वेस्टिंग इन द टाटा इन्वेट्स, दे आर द यूनिट होल्डर्स, दे आर कॉल्ड यूनिट होल्डर्स. ओके, दैट इज द फोर्थ component, investor. The fifth component is a man who is a manager. If something goes wrong in entire process, there will be a manager who takes care of it. Okay, for example, see, let's say the government has given a road on lease. So the trustee Tata, it must pay money to the government of India bank. Why? Because it is taking government property on lease. लीज पे लिया तो रेंट तो देना पड़ेगा ना. सो दे आर गोइंग टू गिव मनी टू द गवर्नमेंट ऑफ इंडिया. दैट इज हाउ द गवर्नमेंट इज earning money, which is called national monetization pipeline. I will discuss in depth about national monetization pipeline, how government is earning revenues through these kind of projects. Anyways, that is NMP. Now back to the picture. Government, it has given, let's say, a road to Tata trustee, and Tata trustee it given this road to the Tata Invit. Okay, अब Tata Invit बोलेगी कि देखना, ये मैं ऐसे बिल्डिंग्स या रोड्स एक्सेप्ट करूँगा जो 80% कंप्लीट है, जो 80% कंप्लीट हो. So basically, I am going to do work only for the 20%. See, I am paying you rent also. If it is not at least 80% complete, I will not accept it. So therefore, the building or the road that government of India is giving to Tata, that must be 80% complete. So that's the first condition. And Tata, it is going to work only on the 20% of the extra road that it needs to finish. So 80% of the road it is already functional. 20% it is work in progress that Tata Invit need to develop. Now, to construct this 20%, it requires some money, and that money it is pooling from investors who are called unit holders. तो ये इन्वेस्टर्स को भी कुछ प्रॉफिट मिलना चाहिए ना, बिकॉज दे आर इन्वेस्टिंग. येस, दैट्स वाई द टाटा इन्वेट इट प्रोवाइड्स रेगुलर इनकम इन द फॉर्म ऑफ डिविडेंड्स. Initial stage, it might not give dividends. After a period, let's say in 1 year, Tata Invit finally, upon all the pooled money, finally, let's say the road construction, it got over. 100% road construction got over. Okay. Now, Tata Invit क्या करेगी? It will open a toll booth. So it will collect money in the form of toll tax, etc. And that is how this Tata Invit is going to generate profits. So out of these profits, 90% must be given back to the investors because they are the owners. अगर ये investors नहीं होता तो ये 20% कभी complete होता ही नहीं. That is why 90% of the money it must be given back to the investors. Okay. तो टाटा का profit 10%, 90% of the profit to the investors. Okay, and that's how it works. So 90% how it is given back to public in the form of dividends. Okay, dividends. Now the unit holders, they are holding InvITs, one unit of InvIT. These units of InvITs, they are tradable in the stock exchange. Okay, the InvITs, they are tradable in the stock exchange, but there is no STT, there is no security transaction tax that is collected by the government on this tradable units of InvIT. Then what is government going to collect from the investors? Now government is very clever. It is getting money from the NMP, and it is again getting money from the tax through what public is gaining, right? So public, they are gaining income through dividends. That is a part of income. Public income. So financial year end, in financial year end, every person is going to file IT returns. In that, government is going to consider these dividends also, and they are the part of income tax, but they are not part of dividend distribution tax. So DDT, it was abolished in the year of 2020. That is not there now. So dividends, they are counted as a part of income, and the government will charge income tax on you at the end of financial year. Okay, what else government can collect from this investor? It can also collect capital gains tax. For example, let's say I invested at 10 rupee, but now the value of one unit of InvIT, it became 100. So I gained some profit. That is capital gains. So when I withdraw my amount back, so that is not 10 rupee, it is 100 rupees. So I gained some capital gains. So the government is going to charge capital gains tax. So income tax and capital gains tax are going to be charged on the investors. So I think we have covered everything in this model. First component sponsor, second component trustee, third component investor, and the type of taxes that government can gain from them. Okay, and we have also seen what is InvIT, REIT, and SM REITs. Did we? So for example, if government gives a road on lease, then that model is InvIT. And if government gives building on lease, then that is REIT. And if government is giving small buildings, then that is SM REITs. Okay, so these are the different, and the conditions are that 20% must be work in progress and 80% must already be finished. This is the first condition. And second condition, 90% must be given back to the public. Okay. सी फॉर एग्जाम्पल 1 साल में रोड का कंस्ट्रक्शन हो गया. अब गवर्नमेंट सेड दैट 5 ईयर इज अवर एग्रीमेंट पीरियड. तो 5 साल तक गवर्नमेंट रोड को टाटा ट्रस्टी को दे दिया. सो बचा हुआ 4 साल में ये टोल टैक्स कलेक्ट करेगी. तो इस 4 साल में प्रॉफिट्स बहुत आया होगा. इस प्रॉफिट्स में ना टाटा इन्विट को 90% ऑफ द प्रॉफिट्स डिविडेंड्स की फॉर्म पे इन्वेस्टर्स को वापस देना पड़ेगा. एंड ओनली 10% कैन बी रिसीव्ड एज प्रॉफिट्स टू द टाटा इन्विट. ओके, so government it is trying to help public, and at the same time government it is also collecting tax from the public, income tax and capital gain tax. So in this model government wants to do its best to help public. So investors they can invest as low as 10,000. one unit का cost 10,000 rupees या फिर 15,000 rupees भी हो सकती है. Okay, that is the lowest value of a unit. So basically government of India is doing a clever plan. It is leasing buildings and it is collecting rent through NMP model. So in the first phase, NMP 1.0, which was from 2021 COVID to 2024, in that phase, I think that was for 3 years, right? 22, 23, 24, yeah, 3 years. So NMP 1.0, it lasted for 3 years, and the government initial target was to collect 6 lakh crore through these NMP models, 6 lakh crore. But government was able to only collect 4.3 lakh crore. Okay, now government, what did it do in 2025? It launched NMP 2.0, National Monetization Pipeline 2.0, that is for 5 years. So 2.0 it's for 5 years, and 1.0 it's for only 3 years, and the target was 6 lakh crore, but it was able to achieve only 4.3 lakh crore. And in 2.0, the target that it wants to collect is 16.7 lakh crore. Okay, 6 you can remember. 16.7 lakh crore. That is the target. Achieved we cannot tell because it is still in the process. So whatever the government it is collecting through this NMP, that will be distributed to Consolidated Fund of India, to the Union Government, or Consolidated Fund of State, to the state government or public sector enterprises. It depends whose project it is. So accordingly it will be distributed. Okay. One important thing is that NMP models, they are part of revenue receipts and they are not part of capital receipts, because rent is part of revenue receipt, right? Not capital. Capital receipt kya hoga? It is disinvestment. So now government don't want to raise money by selling its property. Instead of selling property, government want to rent. That is revenue receipt. Okay. Ultimately the owner of the building, it is the government of India. So that is how government cleverly it is telling that now we will raise money through revenue receipt only, not through capital receipt. Anyways, the money that government is raising through NMP models, that money it will be ultimately invested in the infrastructure only, right? That government said that 70% of our investment in NIP implies National Infrastructure Pipeline. So government is saying 70% it will be in the energy sector and 90% it will be the road. 90 को उल्टा करेंगे तो 16 water image, 16% it will be the urban infra. Road is also type of infra. So water image, urban infra, and then 13% railway. So this is the order that you need to memorize. 70% in energy, 19% in the road, 16% in urban infra, and 13% in the railways. So that is the priority of the government. So the NMP money, it will be invested in the National Infrastructure Pipeline only in the end. Anyways, so how did this National Infrastructure Pipeline start? Basically, in the year of 2019, Niti Aayog, it observed that there are a lot of projects, and the projects, they are not having interlinkage, and unnecessarily we are wasting extra expenditure. We need to connect all of these projects together so that expenditure will be reduced and we can have coordinated efforts, right? That is why Niti Aayog thought of launching this National Infrastructure Pipeline. This initiative see, Niti Aayog launch नहीं किया, नीति आयोग डेवलप किया इस एनआईपी पाइपलाइन को. तो फिर लॉन्च किसने किया? लॉन्च इट इज लॉन्च्ड बाय द मिनिस्ट्री ऑफ फाइनेंस. And Niti Aayog, it is an advisory body. How can you think that it will launch? Okay, it is the Ministry of Finance which usually launches the projects, and Niti Aayog, it takes part in the development initiatives. So Niti Aayog, what did it do? It thought of totally bringing up all the sectors together to promote coordinated efforts. Okay. So Ministry of Finance, it initially allocated this 1 lakh crore to this National Infrastructure Pipeline in the year of 2019, and accordingly 7,000 projects, they were categorized into 39 subsectors to promote this coordinated effort. Okay. Nevertheless, now currently, it was initiated in 2019, but ultimately the implementation, it started from 2020. Okay, National Infrastructure Pipeline 1.0. Okay, so initially it was 1 lakh crore, but in the 7,000 projects, slowly they kept on adding more projects. See, NIP, it is a living pipeline, so more projects they can be added. So in the year of 2019 to 25, they added more projects, and the 7,000 it became 13,000 projects. Okay. More projects are being added so that they can promote coordinated efforts. Okay, and the budget, it is raised to 168 lakh crore. Government बोलेगी अब तो 1 lakh नहीं हो पाएगा क्योंकि projects हमने बढ़ाया. So in the National Infrastructure Pipeline 1.0, government said that 168 lakh crore is going to be the budget for infrastructure. Okay, and तो ये 168 lakh crore कौन देगा? It is in the ratio 39:22. 39 through central government, 39 through state government, and 22 through private sectors. That's how the funding mechanism works. Okay, and next we have NIP 2.0. So in the NIP 2.0, government said that we are adding 852 extra projects for the year of 2026 to 2030, the next 4 years. So we are adding 852 extra projects to this living pipeline, that is NIP. And of course, the ratio, the funding mechanism, it is the same, 39:22. We are planning to allocate how much? 17 lakh crore in this NIP 2.0 for the extra 852 projects. So when I ask you a question, what is the total budget that government is expected to spend? That implies 168. जो 111 क्या बन गया? 168 lakh crore बन गया. So government thought initially to spend 168 lakh crore. But again in NIP 2.0, government added 852 extra projects. So 70 lakh crore is again added. So totally it's going to be 168 plus 17, 185 lakh crore. That is the amount that the government is expected to spend. That is about REITs and InvITs. I hope that is clear. So the facts that you can memorize is that there are many facts. For example, NIP 1.0, I remember 6 lakh crore. That is easy. Target is 6 lakh. But in NIP 2.0, it is 17, and the rest everything are 17. Just remember the number 17. Okay. For example, in NIP 1.0, it is 170 lakh. Minus यहाँ पे 2 नहीं है ना, 2.0 नहीं है, तो 2 को subtract करेंगे, that will become 168 lakh crore. So NIP 1.0, it is 170 minus 2, that is 168 lakh crore. Okay, and in NIP 2.0, I said remember the number 17, extra project, तो number कम ही होगा, 17 lakh crore. Okay, and in NMP 2.0, it is also 17 lakh crore. But remember this NIP, it is part of budget, which is a expenditure, budget expenditure. But NMP, it is a receipt, budget receipt. Just see that NMP, it is a budget receipt. Whatever you are getting, that is budget receipt, and NIP, it is budget expenditure. Okay. Now you are clear with REIT and InvIT, and we have also studied about NMP and NIP, which is there in this year budget. One criteria about SM REIT, the minimum value, therefore minimum value assets. So minimum value कितना होना चाहिए SM REIT के लिए? 50 crore. I am not saying lakh crore, I am saying 50 crore. Okay, that's the minimum value asset only. Okay, and SM REITs में कम से कम कितना investors होना चाहिए? Minimum 200 investors. Okay, That is about SM REITs. Now it is clear SM REITs, REITs and InvITs.
In InvITs, what happens is you get you can act as both as a lender and also a shareholder. I mean, see, if you give loans, of course you're going to get interest, and they're asking whether that interest is exempted from tax or not. Similarly, you can also act as a shareholder, and to the shareholder, are you getting dividends or not? See, one person can either be a lender or shareholder, but in case of InvIT, it is a bit different. Okay, therefore they act as both lender and shareholder, and they get both interest and dividend. So the first option is saying interest income from the deposits in InvITs are distributed to the investors. See, exempted from tax is always wrong. It is the most extreme statement because no income is exempted from tax. So therefore, I will take this option as wrong. And next, InvITs are recognized as borrowers under the SARFAESI Act of 2002. See, SARFAESI Act 2002, this is important. Under SARFAESI Act 2002, it gave the definition of borrower, okay? Borrower. So previously, there was an ambiguity about whether a trust like InvIT, whether it can be treated as borrower or not. Because see, you are funding in InvIT and InvIT is lending money to SPVs, and from that, it is generating income and dividends. So there was a ambiguity whether it can be treated as a borrower or not. Later, it was clarified under SARFAESI that yes, InvIT REITs, they are borrowers. Why? Because since this trust raises a huge amount of debt from banks to fund projects, the government wanted to ensure banks have the power to seize their assets if they fail to pay. Therefore, InvITs, InvITs and REITs, they are treated as borrowers. Okay. They're treated as borrowers because if they're purchasing from banks, then of course they're borrowers. Therefore, they are treated as borrowers, InvITs and REITs. Okay, that is in the SARFAESI. I think only 2 is correct. Statement 2 is correct. Statement 1 is wrong.
That is about REITs and InvITs. I think we have gone in depth a lot. Okay, now let us see alternate investment funds. Alternate investment funds, basically, they are also suitable for high net worth individuals. So what's going to happen? Minimum investment to 1 crore hona chahiye. So they are basically alternate investment funds. They are trust or a company registered under SEBI who can do investment in different categories. Let's say there are 3 categories. So you have if they are investing in category 1, they can be InvITs or venture capital or SME fund. Okay, which are socially and economically desirable also. That means they will be helping for economic development and social development, road buildings. वही होगा ना infrastructure मतलब InvIT venture SME fund. Okay, now for meeting operational requirements, if you are investing in real estate and if you are investing in debt funds, then they are category 2. Okay, hedge funds where they are very highly risky, so therefore they are kept in category 3. So alternate investment funds, they can be either in any of these 3 categories. Okay, they are alternate investment funds. Also remember that when I said about alternate investment funds, they are not the only funds which are socially and economically desirable. For example, if I say angel funds, they are also part of category 1, which I did not write, and I might be missing many such examples. See, angel fund, it is similar to venture capital, na? So it is also social and economically desirable. So whenever the question comes, think that is it socially and economically desirable? According to it, mark whether it's alternate investment fund or not. Okay, for example, in category 2, there is this private equity fund, distressed funds, which are also part of meeting operational requirement, distressed funds and private equity funds. And category 3, hedge funds are not the only risky funds. For example, if you are investing in pipe funds, they are also considered to be risky. Okay, why? Pipe funds is private investment in a public equity, so they are also considered risky only. They are all alternate investment funds. Since we are discussing about many funds, I thought I want to tell you this equity linked saving fund. This fund will help you to save yourself from income tax. Okay, minimum ELSS के बता रही हूँ. Minimum lock-in period is 3 years and equity exposure at least 80% must be in equities. Okay, I mean mutual funds, whoever is operating, 80% must be in equities only. And tax reduction, it is only up to 1.5 lakhs. Okay, and whatever returns that you get, they are market linked returns, and the portfolio of that mutual fund, wherever you are investing, it must be very diverse. So if all such requirements are satisfied, then it will be called as equity linked savings scheme, where you will be having income tax exemption under IT rules section 80C. So there is one more fund, investor protection fund. Basically SEBI requires stock exchanges and commodity exchanges to set up this investor protection fund, IPF. So under this, what SEBI do, for example, investor, he is suffering from non-speculative type of losses. I mean, someone is not delivering shares because of some court case. For example, company, it is not issuing money back to the shareholder because it is suffering from some court cases. So in such scenario, investor protection fund can help investors. So that is investor protection fund. It also promotes investor education and awareness. Short selling, it's a very good. For example, let's say I bought at 100 rupees from investor 1 and I sold at 120 rupees. तो मुझे तो 20 रुपए का प्रॉफिट हुआ ना. हाँ, 20 रुपए का प्रॉफिट हुआ. अब मैं क्या करूंगी कि मेरे पास ना 120 रुपीस है, क्योंकि मैंने 120 रुपीस पे सेल किया, लेकिन 100 रुपीस तो वापस देना पड़ेगा ना. तो मैं बाय करूंगा 100 रुपीस पे किसी और से, और उस 100 रुपीस वापस मैं इसको दे दूंगा, तो मुझे 20 रुपए तो प्रॉफिट मिल गया. यू अंडरस्टूड राइट? शॉर्ट सेलिंग, यू आर बेसिकली ट्राइंग टू डू शॉर्ट सेलिंग. आई मीन बोरो करके तुम ट्रेडिंग कर रहे हो, बाय एंड सेल कर रहे हो, बोरो करके, और सेल करने के बाद उसको वापस दे रहे हो. दैट इज शॉर्ट सेलिंग. Investment activity in which investor buys securities and sell them at higher prices in hopes of repurchasing the securities later at lower price. That is called short selling. Long selling, इसका concept completely opposite है कि you are waiting for some time, you are waiting over time so that you are anticipating there will be higher returns with time. You are investing somewhere and you are waiting for higher returns. तुम यहाँ पे भी borrow ही कर रहे हो, लेकिन you are borrowing stocks so that you will wait for longer time. Short time नहीं है, time longer है. Price बढ़ेगा, उसके बाद तुम sell करोगे. ठीक है? That is long selling. Of course, वापस उसको जो दोगे वो 100 शेयर ही दोगे, लेकिन you have earned 150 crore because the time period is long. That is 50 crore का तुमने profit कमा लिया. Now we have covered all the funds in the capital market. The only topic left is derivatives. After this, we'll be finishing everything. Okay, derivatives, they are the financial instruments that are linked to another financial instrument. For example, let's say the share price is rising. Then if you put option, and if you are voting for that put option, then if a lot of people are voting for put option, then you will be getting some profits. So that is how derivative works. So they are the financial instruments which are linked to another financial instruments. So there are different types of derivatives. First, let us say that there is forward. So this forward derivative is a forward contract, which is an agreement between two parties, buyer and seller, to purchase or sell something in the future at a price agreed upon today and without the right of cancellation. So you have no right of cancellation here, and you have agreed that you will either purchase or sell something in future at a price that you are fixing today. So that is forward. Got it? And you cannot cancel that future price that you are fixing today. One thing you need to remember is that forwards, they are customized contracts and they are not standardized. Implies they are not traded on stock exchange. You cannot trade it on stock exchange. You can do it on OTC. That is important. So as I said, forwards, they are not standardized. If forwards, they are standardized, then they are called futures. Okay. Futures, they can be traded in the stock exchange because they are standardized. And it's the same thing. You do not have the right of cancellation, and and you have agreed that you would purchase or sell at some price that you are fixing for the future today only, but you have no right of cancellation. It's the same as forward, but they are standardized and they can be traded in the stock exchange. But that is futures. I will tell you easily. You have two types of option. One is call option and put option. Call option gives you the right to buy, so it is the right of buyer. Put option, it will give right to sell, so this is the right of seller. I will tell you the option. So I think there was a question: does a buyer have the right to refuse in the call option? So you're calling, that means you're the right of the buyer. Therefore, the buyer has right to refuse. What about seller? Do the seller have right to refuse? If it is a put option, of course, seller will have right to refuse. Okay. So the definition that I said about option is, it is a type of contract that can be bought or sold at a specified price within a specified period of time in exchange for non-refundable upfront deposit. Non-refundable upfront deposit meaning if you cancel the contract, then you will lose the money. That's all. Because you have already given your commitment. I mean, it will ensure the commitment from the seller or buyer to take that risk. Okay. That is therefore called as non-refundable upfront deposit. So an option is a type of contract that can be bought or sold at a specified price within a specified period of time in exchange for non-refundable upfront deposit. Swaps are financial contracts where two parties exchange cash flows or financial instruments. If you are exchanging financial instruments, that is called swap. So they are commonly used for hedging against interest rates or currency fluctuations. So there are many types of swaps. For example, interest rate swap, currency swap, commodity swap. So they are popular swaps that everyone know. Okay. And swaps, they are not standardized. See, when you are saying standardized, it means quality matters. Okay. So futures, yes, they are standardized. Options, futures and options, they are standardized. Forward swaps, they are not standardized. Okay. Not standardized implies they cannot be traded on stock exchanges. Okay. And therefore, retail investors, it is difficult for retail investors to do swaps. So swaps are done in OTCs. Options also, I think they can be done on OTC. उसका कोई problem नहीं है. But stock exchange पे भी हम कर सकते हैं. Okay, coming to swap, yeah, they are not standardized, and you are just swapping your financial instruments, and they can be done on OTC, but not on stock exchange. And swaps का आपका श्रीलंका एग्जाम्पल याद है? इंडिया श्रीलंका needs dollars to purchase something. तो इंडिया ने क्या किया कि श्रीलंका को डॉलर्स दिया और हमने श्रीलंकन करेंसी को एक्सेप्ट किया. But over a period of time, what Sri Lanka needs to do? Sri Lanka needs to pay dollars to India back. So you are swapping currencies for a certain period to help Sri Lanka. So that is an example for swap.
See, this question, it is all asking about obligation to sell and obligation to buy. See, futures contract, I don't know, but options contract, I know. So I'll first explain options contract. See, you think, you know, right, FPO, no, futures and options. So in options, we have two types of options. One is put option and the other is call option. Put option meaning right to sell, and call option meaning right to buy. Okay, right to buy. Call means buy. Put means sell. Okay, right to sell, but not an obligation. You can put or you can call. It's up to you to take the put or call. Okay, it is not an obligation to do it. Okay, not an obligation. Both put and call, they are not obligation, but the question, it is asking that a seller and buyer, they are obligated on a specific date. Therefore, two is wrong definitely, but we are not sure about one. But see, this can be derived from this spot market and future market that you know. What is future market? I mean, this is forward market, but both are similar, even if you don't know. Spot market is agreement on the price and quantity, and the transaction will take simultaneously. But in forward market, what is happening? Agreement on price and quantity will happen today, but the transaction will take place on some specific future date. That is for forward market. Now, if you take a future contract, what is going to happen? You are making a legally binding agreement to buy or sell a specific asset, like it can be stock or commodity, at a predetermined price on a specific date in the future. So it is unlike a simple buy now transaction in the cash market. This future, it will allow you to lock a price today for a transaction that is happening later. Okay. You got it. For example, see why people usually go for future contract. I will tell you. Let us say now currently I bought it at 50 rupees, the same 100 shares. But I will tell that okay, I want to sell. Okay, I made the sell contract, the same 100 shares. But I'm saying yes, I will sell. Not I have made a contract that I'm going to sell. But I said not on 11th March of today. I'm going to do on 11th April, let's say. So after 1 month I'm going to do this, and because I'm saying this date because I know after a month this 100 shares for 50 rupees. This 100 shares are going to become 200 rupees. Let's say not 50 but 200 rupees. So I know they are going to appreciate. Therefore, what I'm going to do, I'm going to fix a future date. That is future contract. Okay, transaction will happen on a future date. So even if I don't know the technicality behind it, I can do a minimum basic check that future, it is something like you must deliver that on a future date. Okay, fine. Therefore, but is it obligated or not? Yes, definitely, because you have signed the contract. Therefore, it is an obligation on both buyer and seller. Okay, it is an obligation. Future is an obligation. So one is correct.
जब भी हम फेस वैल्यू ऑफ शेयर को बात करते हैं के बारे में बात करते हैं तो वो क्या है? So when company is issuing a publicly shares, there will be some initial value fixed by the company. That value is usually called share value, face value of the share, which is usually 10 rupees. Okay. शेयर प्लेजिंग यही होता है कि promoter of the company pledges his share as a collateral to borrow loans from banks and NBFCs and so on. For example, company listed 40% to shares. इसका मतलब ये शेयर जो है वो collateral ही है ना एक तरह से. So this is whatever company is doing, it is called share pledging. So people are buying those shares. Indirectly, company is getting loans. Okay, that is called share pledging. Penny stock. What is penny stock? I have seen Vodafone where उसका शेयर प्राइस इतना लो है ना कि मैं बोल नहीं पाऊंगी 0.51 रुपी ऐसे स्टॉक्स को हम बोलेंगे पेनी स्टॉक्स. ओके, दे हैव वेरी लो मार्केट कैपिटलाइजेशन एंड दे ट्रेड एट वेरी लो प्राइस एंड दे गिव जीरो और नो डिविडेंड्स और लेस डिविडेंड्स. Okay, who are blue chip companies? They are opposite to penny stock. Implies they have very high market capitalization and they have excellent reputation. Example, Amazon, P&G, Google, etc. They are blue chip companies. Right, what is forward spot market and forward market? Spot market तो अभी के अभी simultaneously होगा. Spot का मतलब यही है, हमेशा याद रखना. Forward market मतलब अभी हमने agreement fix किया, transaction जो specific date हमने agree किया उस date पे होगा. तो that is forward market. And what is sweat equity and ESOP? Sweat equity implies the company, it is giving you some shares of it for exchange of your hard work. तुम बहुत हार्ड वर्क कर रहे हो, सो हार्ड वर्क का रिवॉर्ड है, तेरे पसीना का रिवॉर्ड है, sweat equity. Okay, and what is ESOP? ESOP is employee stock ownership plan. That means the company is growing and the company wants its employees to grow along with them. That is why it is giving some of its shares to the employees. That is the easy way of making employees as a part of your growth. Employee stock ownership plan. And do you know insider trading? The insider trading is, see, for example, you are working in a company and you know that we are going to increase our stock price. So you are buying the shares now because you already know the information. That is insider trading. Okay, buying and selling shares to gain windfall gains. This is illegal. Insider trading is very illegal. And what is algo trading? Algo trading is you are using certain algorithms and computer programs to automatically buy and sell securities. That is algo trading. It is legal. Of course, what is the wrong with using technology? You need to limit the number of orders. There is certain limit for which you can use algo trading. Okay, what is ASBA? Applicant supported by blocked account. So applicant supported by blocked amount, it is nothing but, see, whenever you invest in an IPO, certain amount is blocked. Why? You need to wait for 2-3 days to confirm whether your application is accepted or not. That blocked amount, it is stored in this ASBA, applicant supported by blocked account. Blocked amount. So here your amount is deducted only if shares are allocated to you. Okay. If not, the amount will be returned back to your original account. So front running, it was in news, I think 2 years back or I don't know. So it is different from insider trading. Almost similar. Like for example, mutual fund managers. For example, let's take LIC. LIC, it placed a very big order with mutual funds. लेकिन म्यूचुअल फंड क्या करेगी, इसमें जो इंसाइडर्स है ना, वो लोग पहले खुद के लिए शेयर बाय करेगा. अगर प्रॉफिट होगा तो पहले उन खुद के लिए सेल करेगा एंड आफ्टरवर्ड्स दे विल सेल ऑन बिहाफ ऑफ LIC. सो व्हाट्स हैपनिंग कि this money is actually belonging to this LIC or L&T, whatever company it is, but this mutual fund, it is first selling their stocks and shares, and then they are gaining profit, and later they are saying, oh, LIC को भी हो गया तो हम LIC का जहाँ पे करेंगे ये LIC के लिए करेंगे. तो when they are placing themselves front, that is called front running. That can happen buy sell or sell buy. तो बाइंग के लिए पहले खुद को प्रीफर करना या सेलिंग के लिए खुद को प्रीफर करना, ये जो भी है तो वो सब फ्रंट रनिंग में ही जाती है. So there are different types of trading. What is curve trading? That is the question. So let's see the different type of trading. Insider trading तो हमें पता है ना क्या? It is the use of unpublished price sensitive information to trade shares for personal gains. That is insider. Unpublished है information, फिर भी तुम ट्रेड कर रहे हो. Okay. What is price rigging? You are faking false information or misleading information to rig the price so that you can gain profits. You are inflating the prices by fake information. That is price rigging. What is circular trading? Buying and selling the same security simultaneously to increase the profit. See, if you are buying it, of course the demand will increase. You are buying again and again just to increase it. So a lot of people, extra people also will come and they are increasing even more. So finally at a time it went so high that you will finally sell your shares. So that is circular trading. Buying and selling the same security simultaneously to increase the profit. Okay. What is curb trading? It is unofficial trading in securities outside the recognized stock exchange. Okay. There are a lot of recognized stock exchange. वहाँ पे तुम trading कर सकते हो. लेकिन you are trading in a curbed stock exchanges. So that is curb trading. So before proceeding into banking, let us see some important bodies. Okay. Financial Services Institution Bureau, FSIB, ये क्या है? FSIB, it replaced Bank Board Bureau. तो ये अपॉइंट करेगी, BBB नहीं है अब, FSIB है, तो अपॉइंट करेगी किसको? If you want to appoint directors and MDs of various banking organizations or public sector banks or whatever it is, then you are going to it is going to be done by FSIB only. So FSIB takes care of appointment of directors and chairpersons of NABARD, NHB, SIDBI, जो भी financial institutions हो गया, that's all. So it will recommend the names for the appointment. It will recommend the names for the appointment and it advises. So therefore, if ever the question comes, whether it is advisory body or implementation, so it is an advisory body because it is just advising. And is it a statutory or non-statutory? If the question comes, FSIB, it is a non-statutory body. Okay, there is no statutory provision for it. And FSIB, I को देख के मुझे याद आ गया कि इसमें 11 members ही है. Okay, and all the members, including the chairman, all of them are part-time. That is important to know. That means one time by seeing this part-time, I understand that okay, they must be working already somewhere and there must be ex officios here. So one thing you need to know is that whoever the chairperson that FSIB is having, 11 members है ना, that chairperson must be some expert in banking and finance. तभी तो उसको हम मानेंगे chairperson, right? That is how you need to know about FSIB. Next is Financial Stability Development Council. This was asked in UPSC in 2016. So it can have many members, like members from RBI, SEBI, Finance Ministry, many others. So FSDC फाइनेंशियल स्टेबिलिटी एंड डेवलपमेंट काउंसिल, इसमें आई नहीं है तो ये डिफरेंट है, ठीक है। फाइनेंशियल सर्विसेज इंस्टीट्यूशन ब्यूरो, इट रिप्लेस BBB एंड इट विल अपॉइंट, BBB को रिप्लेस किया तो बैंक दिख रहा है ना, तो अपॉइंटमेंट्स, रिकमेंड नेम्स फॉर द अपॉइंटमेंट्स ऑफ डायरेक्टर्स ऑफ फाइनेंशियल इंस्टीट्यूशंस। FSDC इट इज फाइनेंशियल स्टेबिलिटी, तो वो फाइनेंशियल स्टेबिलिटी का देखभाल करेगी, दैट्स ऑल। इट इज एपेक्स एग्जीक्यूटिव बॉडी कॉन्स्टिट्यूटेड बाय द गवर्नमेंट ऑफ इंडिया, चेयरपर्सन यूनियन फाइनेंस मिनिस्टर होगा FSDC का, ओके। इट वाज सेटअप इन 2010, सो इट विल टेक केयर ऑफ फाइनेंशियल स्टेबिलिटी, फाइनेंशियल इंक्लूजन एंड इंटर रेगुलेटरी कोऑर्डिनेशन, फाइनेंशियल सेक्टर डेवलपमेंट, मैक्रो प्रूडेंशियल सर्विसेज, सर्वेलेंस, सॉरी, सो ऑल सच थिंग्स आर टेकन केयर बाय फाइनेंशियल स्टेबिलिटी एंड डेवलपमेंट काउंसिल। नाउ यू नीड टू नो इंपॉर्टेंट बॉडी, पेमेंट रेगुलेटरी बोर्ड, ओके। सी सबको पता है कि उर्जित पटेल कमेटी ने रिकमेंड किया मॉनेटरी पॉलिसी कमेटी को, क्या सबको ये पता है रतनवाला कमेटी रिकमेंडेड पेमेंट रेगुलेटरी बोर्ड, दिस माइट बी आस्क्ड दिस ईयर। पेमेंट रेगुलेटरी बोर्ड, आर का मतलब आर है, रतनवातन कमेटी, ओके। सो it is a statutory body under Payments and Settlement Act of 2007 and इसका mandate यही है, regulation and supervision of payment settlements, for that is why you have payment regulatory board। तो members कौन होगा, 6 members है, similar to MPC which has 6 members, PRB will also have 6 members, 3 from RBI and 3 from the government, governor होगा, deputy governor होगा, official from the central board of RBI होगा, okay। 3 members from RBI, 3 members nominated by the government, same composition, okay। payment regulatory board and both are statutory, okay। and meetings में different है, monetary policy committee you know right, 4 times a year, पेमेंट रेगुलेटरी बोर्ड इट इज 2 times a year, ओके। एंड टेन्योर तो मैक्सिमम 4 साल है दोनों का, एंड दोनों में रीअपॉइंटमेंट नहीं होगा, ओके। रीअपॉइंटमेंट नहीं होगा, एंड डिसीजन मेकिंग दोनों में इट इज बेस्ड अपॉन द मेजॉरिटी, एंड इन केस इफ देयर इज टाई, चेयरपर्सन विल डू अ कास्टिंग वोट, ओके। And students commonly ask whether MPC and PRB, the composition is same, so the members are they actually the same? No. See, even if these persons, even if a chairperson and deputy chairperson of RBI, they may be the same. The remaining members, they can be different, right? So we cannot say that they are the same. Usually these members, they are appointed according to the expertise required. So there was a question regarding payment regulatory board. So it was established under RBI Act 1934. No, we have payment and settlement service. Okay, which was which year it was? 2007. Payment and settlement system 2007. So yeah, this is wrong. And next, Union Finance Minister is ex officio chairperson. No, it's the RBI governor who is the ex officio chairperson, right? And it is responsible for regulation of both the domestic and cross border payment settlement. Yes, actually it's correct. For both domestic and cross border payment settlement, it is Indian payment system, right? Therefore only 3 is correct. Shall we try some PYQs from financial markets? Then we can finally enter into banking starting with RBI. Okay, what is beta? Beta, as I already said, beta मतलब beta का volatility. Beta बहुत volatile है, तो क्या है, numerical value that measures the fluctuation of stock exchange. तो fluctuation सही होगा, okay। fluctuation stock exchange, fine। See, transfers there are 2 types that you know, where indirect and another is indirect transfer. तो remittances जो है वो direct transfer होगा। With respect to which of the following indirect transfers are often talked in the news? Indirect transfers के बारे में पूछ रहे हैं, okay। An Indian company investing in foreign expertise and paying tax, no, it's not। A foreign company transfers shares and such shares derive substantial value from assets located in India। Say there are 2 companies and there is one company in India। ये फॉरेन कंपनी है, इसका अंडरलाइंग एसेट्स जो है ये एक इंडियन कंपनी है, तो इसका फॉरेन कंपनी बाहर है, ये कंपनी भी बाहर है, तो ये कंपनी ने क्या किया कि उसकी पूरी एसेट्स को ट्रांसफर किया इस कंपनी को। सो दिस कंपनी इज ओनिंग दिस कंपनी नाउ, सो इनडायरेक्टली इंडियन कंपनी विल आल्सो बिकम दिस फॉरेन कंपनी, so you understood, right? A foreign company transfers shares and such shares derive their substantial value from assets located in India, and that is indirect transfer, okay। Next question about inflation indexed bonds, so you are adjusting both your capital and your interest with inflation, that is inflation indexed। The government can reduce the coupon rates on its borrowings by the way of IIB, possible। IIB provide protection to the investor for uncertainty regarding inflation, yes। Interest received, it is not taxable, no, non taxable तो गलत ही होगा हमेशा, okay। Convertible bonds, consider the following। Convertible implies as there is an option to exchange the bond for equity, convertible bond pay a lower rate of interest, that's right, you can easily convert, right? Therefore the rate of interest will be low, okay। The option to convert to equity affords bondholders a degree of indexation to raising consumer price, that's right। 1 and 2 are correct। Which of the following can trade corporate bonds and government securities? Who can trade? Everyone can trade corporate bonds and government securities. There is no such restriction, right? So 1, 2, 3 will be the correct option, okay। Consider the following: ETF, motor vehicle and currency swap. Which of the following are financial instruments? Motor vehicle तो financial instrument थोड़ी है, तो 1 and 3, okay। Next, consider the following, there are 4, okay। So they are asking how many of them are capital market। See, capital market का मतलब long term है, तो हमें पता है ना कि कॉल मनी, ट्रेजरी बिल जो शॉर्ट टर्म मनी मार्केट में हमने पढ़ लिया, तो ये मनी मार्केट का है। गवर्नमेंट बॉन्ड इट इज लॉन्ग टर्म, स्टॉक मार्केट इज ऑल्सो लॉन्ग टर्म, सो देयरफॉर ओनली 2, okay। Consider the following, which of the following are correct, okay। Credit rating agencies regulated by SEBI, correct। The rating agency popularly known as ICRA is a public limited company, sorry, I wrote it as SEBI, the option it said RBI is wrong, SEBI is correct, so this option is wrong। Next, the rating agency popularly known as ICRA is a public limited company, yeah, we studied many companies, right? We have studied many credit rating agencies if you remember, उसमें हमने इकरा भी पढ़ लिया, लेकिन ये लोग ये पूछ रहे हैं कि क्या इकरा पब्लिक लिमिटेड है कि नहीं। ICRA, even if you know the full form of ICRA, it is very easy। ICRA is Investment Information and Credit Rating Agency of India Limited, so whenever there is limited, it means it is a public limited company, whenever there is private limited, then it is a private company, okay। It is just limited, therefore it is a public limited company, anyways। ICRA you cannot really guess, it's a public limited company, okay। And Brickwork Rating, it's an Indian credit rating agency, that's also correct, so 2 and 3 are correct, anyways। If I eliminate option 1, I think I am coming with only B, credit rating agencies, they are regulated with SEBI, we have discussed. So with reference to Indian economy, what are the advantages of IIB? So government can reduce coupon rate, that's correct. IIB provide protection to investors regarding inflation, that's also correct. The interest received as well as capital gains, they are not taxable. Again I said non taxable, to galat hi hoga. With reference to convertible bonds, consider the following: as there is an option to exchange convertible bonds, pay low rate of interest, that's correct. To the option to convert to equity affords the bondholder a degree of inflation to raising consumer price, it is also correct. Okay, now consider the following 4 options are given. Which of the following can be included in the foreign direct investments, FDI? FDI में क्या क्या हो सकता है? फॉरेन करेंसी कन्वर्टेबल बॉन्ड. अरे फॉरेन करेंसी कन्वर्टेबल बॉन्ड क्या है? सी फॉरेन करेंसी कन्वर्टेबल बॉन्ड, वी हैव डिस्कस्ड ना कि फॉरेनर्स जो है अगर वो इन्वेस्ट करना चाहता है तो उनके लिए बॉन्ड्स ऐसा है कि डॉलर में होगी और इंटरेस्ट पेमेंट भी डॉलर में होगी, तो इंडियंस के लिए नुकसान है. अगर डेप्रिसिएशन होगा तो हमें ज़्यादा पे करना पड़ेगा. सो दैट इज फॉरेन करेंसी कन्वर्टेबल बॉन्ड, एंड इफ दे आर मोर देन 10%, दैट मीन्स दे इनडायरेक्टली दे आर FDIs only. If they are more than 10%, that I already said to you. And also we have FIIs, foreign institutional investments, with certain conditions. Anyways, if they are more than 10%, then of course they are also like FDI. Okay, they can be FDIs. And global depository receipts, I don't know what they are. And one thing we have, non-resident external deposits. Let us see both of them what they are. Global depository receipt implies, see, there is this some FII. Now what it is doing, investor, he wants to invest in India, therefore he is investing in dollars, and of course they will be deposited into India. So certain thing you need to give them back, right? That is GDR. You will be giving global depository receipt to the investor. Okay. The main difference between participatory notes and GDR is that this issuing body for participatory notes it is FII, but for global depository receipt it is some overseas depository bank. Okay, if bank is issuing and telling that you are the owner of that whatever investment that you did in some company, then it is GDR. So P notes में यह है कि it requires lot of scrutiny. Okay, but global depository receipts, they are general international banks, right? It is more transparent. GDR is more transparent. One thing you need to know is that P note, participatory note and GDR, both of them, they are tradable on stock exchanges. Okay, I mean P note you cannot trade in normal stock exchange. For this you need to trade it in OTC. Okay. Anyways, in the local stock exchange, the P notes cannot be traded. But global depository receipt, they can be traded in recognized stock exchanges like London Stock Exchange, Luxembourg Stock Exchange, etc. Okay, both are very different. Anyways, they are similar to P notes, but yeah, they are more transparent. GDR, yeah, they can also be taken as FDIs. And the fourth one is non-resident external deposits. I mean NRA deposits पूछ रहे हैं. For example, if you know, if you are talking about external deposit, then see, NRIs, they are living in foreign country, and in foreign country they are opening Indian bank accounts and they are holding cash in the form of rupees. Okay. Anyways, NRIs, they are depositing, right, or by opening Indian bank accounts. So of course, but tell me one thing, NRIs, did they invest in India? No, they are actually saving their deposits. So ultimately, they must be returned back to NRIs, and it cannot be considered as an investment. Okay, they are just depositing. They are like a debt to a bank. Okay, therefore, if they are asking me FDIs, NRI deposits है, FDI, NRI का वो भी external deposits, मतलब जो खुद की बैंक अकाउंट में डाल रहे हैं, क्या उसको हम बोल सकते हैं कि वो FDI है? नहीं. So option is 1, 2 and 3. Option A. Indian government bond yields are influenced by, of course हमने देखा है ना कि actions of US Federal Reserve, yes. RBI, yes. Inflation and short-term interest rate, all of them are yes. So option D. Why? Because see, if US Federal Reserve, if it is increasing interest rate, of course हमारे Indian bonds का demand कम हो जाएगा. That's how it works usually. तो FPI कम हो जाएगा इंडिया में. FPI कम हो जाएगा तो इंडियन बॉन्ड्स में ज़्यादा लोग इन्वेस्ट नहीं करेंगे. So actions of the central banks of foreign banks in India, they are going to invest. They are going to influence our Indian bond yields. For example, if RBI is increasing its interest rate, a lot of foreigners would like to invest in India. So option for this is D. Ninth one. In context of Indian economy, non-financial debt includes which of the following? See, people can have financial debt and non-financial debt. Financial debt तो पता ही है. Non-financial debt मतलब debt other than banks and financial intermediaries. So other than financial institutions and banks, if you are taking other debt obligations of other sectors, then other than them, they are called as non-financial debt of India. Okay, they can be housing loans owned by households. क्या ये debt बैंक का है? तो नहीं है ना, तो ये हो जाएगा non-financial. Amounts outstanding on credit cards, क्या ये debt बैंक का है? नहीं है ना, तो वो भी non-financial debt. Treasury bills, who is taking? Government is taking money from the people, short term borrowing. क्या ये debt बैंक का है? नहीं है ना, तो ये भी non-financial debt. So option 1, 2, 3. Now finally we entered into banking. फटाफट 10 मिनट में खत्म करूंगी. See, RBI, first before starting banking you need to know what's RBI and how it was established. So RBI, it was established under RBI Act of 1934, which year? 1st April 1935. Statutory status तो 1934 में ही मिल गया, लेकिन actually implementation 1st April 1935 में हुआ. कौन सा कमीशन ने रिकमेंड किया? हिल्टन यंग कमीशन. कोई भी नहीं बोलेगा इस फैक्ट को कि हिल्टन यंग कमीशन ने रिकमेंड किया RBI को अपॉइंट करने में. Okay. Next, so RBI mainly क्या करती है? तो RBI issues notes except 1 rupee. That is what everyone needs to know. Coins and 1 rupee note, they are issued by the central government. So just remember blindly that RBI issues notes except 1 rupee. Okay, RBI, it is a statutory body established in the year of 1935 under the RBI Act of 1934 under the recommendations of Hilton Young Commission. देखना कि RBI, it was established on 1st April 1935. Hilton Young Commission recommended for the establishment of RBI. Okay, why did it recommend? Because in 1929 there was Great Depression of USA where 450 banks of India were collapsed, more than 450 banks. Therefore, they felt a need for a central bank of India, and Parliament, it passed RBI Act of 1934. Okay, and then in 1935 RBI was established with its headquarters in Mumbai. Okay, RBI also has sub branches in Delhi in the north, Chennai in the south, next Kolkata in the west, and Mumbai in the west. Kolkata in the east and Mumbai in the west. Okay, so there are 4 branches of RBI. In 1935, RBI was established and it introduced its second schedule. It already has second schedule. So RBI said that there are three requirements. If any bank satisfies these three requirements, they can be called as scheduled banks. So RBI, what are those three requirements that RBI said to be called as scheduled bank? It said that minimum paid up capital must be at least 5 lakh. Minimum paid up capital must be 5 lakh. Then only we will allow you. And next, the activities of the bank must not be harmful. And next, they must act as corporation, not as sole proprietorship. For example, if there is a bank, there cannot be a sole proprietor, right? It must be like some corporation. That is what RBI said. I would like to ask you, why would any bank like to become a scheduled bank, right? It will receive right to refinance facility, implies loans at some interest rate. So if it is not a scheduled bank, you will not have right to even give loan. Okay, that's why if you want to even give loan, refinance facility, right to receive refinance facility, then of course you need to be a scheduled bank. Next, entitled for currency chest facility. If you want to have stock of banknotes, then of course you must be a scheduled bank. Next, right to become member of clearing house. If you want your settlement payments like checks, if you want to do such a settling payments, then of course you must be a scheduled bank. Okay. And of course, if you are a scheduled bank, you have certain obligations, like you need to maintain CRR and you need to maintain SLR with yourself, and you need to submit your returns at regular intervals to RBI. You need to show, you need to report, and you need to do everything as per Banking Regulation Act requirement. Okay. And next we have 1948 to 49. तो 1935 में RBI एस्टैब्लिश हुआ. उन्होंने बताया कि सेकंड शेड्यूल में जो भी बैंक्स होंगे वो लोग हमारे पास CRR मेंटेन करना पड़ेगा, एंड वट एवर वी से सर्टेन थिंग्स उनको फॉलो करना पड़ेगा. सो 1935 got over, and in 1948 to 1949 what happened is that government noticed a lot of private ownership in the RBI is more than 50%. Therefore, what happened, all the private investors, they transferred their shares to Government of India. So basically Government of India purchased all the shares of RBI, and finally government became almost like the owner of RBI. That is called RBI Transfer of Ownership Act of 1948. Okay. And in the year of 1949 there was this Banking Regulation Act of 1949, where this gave power to the RBI to give licenses to the companies to open bank. Okay, if a company wants to open a bank, definitely it needs to take license from RBI. So that was introduced here in 1949, Banking Regulation Act of 1949. Okay. If a bank even want to open new branches, then also it must take license. Okay. This Banking Regulation Act, it will protect the interest of depositors. Okay. And in 1951 there was this first 5-year plan, and 1953 में क्या हुआ, Air India was nationalized from Tata. Okay. And 1955, this is important, 1955 SBI is nationalized in the year of 1955, and Imperial Bank, it was called as SBI, and SBI finally it became a nationalized bank. Okay, in the year of 1955. 55 को याद रखना ही पड़ेगा क्योंकि now it is 2025 ना. So the question might come. 1956 what happened? Control of RBI over urban cooperative bank. So urban cooperative banks, they were also supervised by RBI from 1956. Okay, and insurance companies, they were also nationalized in 1956. तो पहला SBI के बाद अब urban cooperative banks भी हो गया, and then insurance companies भी हो गया 1956 में. So if they ask you timeline, SBI comes first and next insurance companies next. Okay, and 1957 में first communist government was formed in Kerala. So it is the first communist government. And 1961 Operation Vijay was launched for the liberalization of Goa, Daman and Diu. They might not ask this. And 1969 nationalization of banks, round 1. So Banking Companies Ordinance 1969. This is also important. So in the entire RBI history, important if you ask, this is 1935, 1948 ownership, transfer of ownership, and 1949 Banking Regulation Act. See, ownership 1948, BRA, Banking Regulation Act 1949 for giving licenses, and 1969 important है, nationalization of banks. That is Banking Companies Ordinance. Banking Companies Ordinance 1969. 49, उसके बाद 69, very important. So 1969, and there is a 1969 सिर्फ round 1 है, round 2 is in 1980. So 14 private banks were nationalized. 14 banks were nationalized, right? 14 banks were nationalized in round 1, तो round 1 important है, लेकिन 6 banks और nationalized हुआ round 2 में. So 14 plus 6, it's 20 banks. This is about banking. I think I have already discussed the monetary policy committee with you, right? The composition, it has 6 members, and composition 6-member, term period it's for 4 years, and they are not eligible for reappointment. And central government fix करेगी inflation को, और monetary policy committee क्या करेगी, repo rate को fix करेगी, other policy rates को RBI fix करेगी, right? Decisions of monetary policy, they are binding on RBI. Okay, all of them are discussed by us before. And the committee which recommended monetary policy committee, Urjit Patel committee. Ratan Vatal committee वो क्या recommend किया? It recommended by payment board something. If they ever ask you what are the functions of RBI, see, it issues banknotes. पहला function, issues banknotes except 1 rupee. This will be asked in mains. Okay, issues banknotes except 1 rupee. It is banker of banks and also banker of government. Third point would be it represents India in world banks and global platforms. Fourth point, it is a lender of the last resort. If ever there is a temporary crisis, it will go and help. Okay, लेंडर ऑफ लास्ट रिसॉर्ट का मतलब ये नहीं है कि वो प्राइवेट बॉडीज को हेल्प करेगी या गवर्नमेंट को करेंसी डेफिसिट के टाइम पे करेगी, वो नहीं है. ओके, एंड फिफ्थ, इट इज रेगुलेटर एंड सुपरवाइजर ऑफ ऑल बैंक्स एंड नॉन बैंक्स. Okay, sixth is it is a controller of foreign exchange reserves, and the seventh point is it is controller of money supply. So these are the 6 points that everyone should know कि RBI ना बैंक नोट्स को इशू करेगी. It is a banker of banks and government. It is the lender of last resort, and it represents various global platforms. And of course, it is the supervisor of all banks and non-banks, and it controls foreign exchange reserves, and it also acts as promotional roles. For example, financial inclusion को promote करेगी, ये सब चीज़ें करेगी, customer protection को protect करेगी, ये सारी चीज़ें. These are the functions of RBI. So questions can also be asked on the notable portals of RBI. So if there are any unclaimed bank deposits, so you for you, okay, unclaimed bank deposits, for such things, Udgam portal is used. So let's say your forefather died and you will be the right heritage owner of that land property, then you can go to Udgam portal to check. Okay, there is Pravah portal. Okay, Pravah portal, it is to obtain license from RBI. तो तुम प्रवाह करोगे, एक बैंक प्रवाह करेगी प्रवाह पोर्टल में, and then it will obtain license from RBI. Okay, there is Daksh web portal. Daksh web portal, Daksh, it is like wing, right? मैसेंजर. सो इसका मतलब ये है कि मैसेंजर क्या मैसेज करोगे, रिपोर्ट करोगे तुम, क्या रिपोर्ट करोगे? सी NBFCs एंड अदर बैंक्स दे मस्ट सेंड रिपोर्ट्स टू RBI. सो RBI का सुपरविजन, for RBI to supervise banks and non-banks and NBFCs etc. This Daksh web portal is used. Okay, and e-Kuber portal. e-Kuber portal is very important because it is a core banking solution portal for the RBI, where all bankers they open their current accounts in the e-Kuber portal. Okay, and RBI handles a repo open market operations from this e-Kuber portal only. Now I said you that I will tell you about paid up capital, right? So see, certain stock is purchased by the company and out of it 40 lakhs it is subscribed by the people. So that subscriber thing, it is called issued capital. Okay, that's all. For example, a company under memorandum of association, it will authorize certain capital, let's say 1 lakh shares, that is called authorized capital, and out of the authorized capital 50 lakh shares are issued. So out of 50 lakh shares issued, only 40 lakhs are subscribed by the public. So whatever that is paid up by the public, that is called paid up capital. Okay, simply putting, subscribed, paid up as stock, purchased as stock, that is paid up capital, and that's all. So authorized, start the diagram always from authorized capital and divide them into issued and not issued. So company तो 50 लाख इशू किया, लेकिन उसमें सिर्फ 40 लाख सब्सक्राइब हुआ, तो उस 40 लाख को हम बोलेंगे पेड अप कैपिटल. Reserve capital is different. It is capital reserved from profit. I mean, you are not lending them as loans to generate profit, etc. You are just reserving them. So that is capital reserved from profit. Okay. So starting with RBI, scheduled banks are important. We have discussed the 3 conditions that a public sector banks or private banks whose paid up capital is 5 lakh rupees, and they must not involve in harmful activities. They must be corporation and not sole proprietors. And enforcement, it was enforced on April 1st, 1935, and in 1948 transfer of ownership where government became the owner, and Banking Regulation Act 1949 where RBI can give licenses, and 1969 nationalization of banks round 1, 14 private banks they were nationalized, and in 1980 nationalization of banks round 2, 16 banks were nationalized, and RBI policy rates को fix करेगी, MPC repo rate को fix करेगी. These rates were fixed according to the inflation fixed by the government. And subsidiaries, there can be a lot of subsidiaries. So subsidiaries of RBI, who are the subsidiaries? Basically, RBI has set up various institutions to support the financial structure of the country. Okay, first we have BRB and MPL, that is Bharatiya Reserve Bank, Note Mudran, Bharatiya Reserve Bank Note. Okay, BRBN is Bharatiya Reserve Bank Note. MPL, Mudran Private Limited. Okay, so Bharatiya Reserve Bank Mudran Private Limited implies it will manage printing of currency notes. Okay, one is in Mysore and other is in Salboni. Okay, that is one thing. So it is also helping maintain the financial structure. Therefore, it is a subsidiary of RBI. And we have DICGC. What is DICGC? It is insurance. So basically, if it is a scheduled bank, then up to 5 lakh rupees it is insured. 5 lakh rupees of the depositor, it is safely insured with RBI. Okay, that is DICGC. So DICGC on behalf of RBI will help depositors for insurance up to 5 lakhs. What is DICGC's full form? Okay, Deposit Insurance and Credit Guarantee Corporation of India. That is DICGC, and we have REBIT. REBIT is Reserve Bank of India Technology Private Limited. That's all. So it helps RBI's IT or information technology and cyber security needs. REBIT. Okay, we have IFTAS. IFTAS implies Indian Financial Technology and Allied Services. Okay, it designs and deploys support for technological services for banks and various other financial institutions. Okay, Indian Financial Technology and Allied Services. Okay, this institution will help to support the technological services for banks and financial institutions. And we have REBIT, RBIH, Reserve Bank of India. Reserve Bank Innovation Hub. Okay, it will encourage financial innovation. Reserve Bank Innovation Hub. It will encourage innovation through institutional setup. Okay, you understood BRBN. What is BRBN? Bharatiya Reserve Bank Note, Mudran Private Limited. Basically, it manages 2 printing presses. One is at Mysore and another is at Salboni. Okay, Salboni is in West Bengal, Mysore is in Calcutta. And what is the DICGC? Deposit Insurance and Credit Guarantee Corporation of India. It insures deposits up to 5 lakhs per account holder. Okay, and next REBIT, Reserve Bank of India. Okay, Reserve Bank Information Technology Private Limited. Okay, it helps RBI's IT and cyber security needs. IFTAS, Indian Financial Technology and Allied Services. So it supports IT services for banks and financial institutions. Next we have RBIH, that is Reserve Bank Innovation Hub. Okay, it encourages financial innovation through institutional setup. Okay, you have seen the 5 subsidiaries of RBI. You already know the notable portals of RBI, right? Daksh, it is like messenger. So banks must send the report and RBI will do supervision. Pravah, so our banks pravah karenge license ke liye. e-Kuber, core banking solution for all banks, and all banks will open accounts and RBI will check the repo and CRR etc. in this. Okay, Udgam, unclaimed bank deposits ke liye Udgam. If you are asking me the organizational structure of RBI, पहले एक central board होगी. Who is going to appoint the central board of directors? It is being appointed by the government of India. So there are full-time official members in this central board. They are RBI governor and 4 deputy governors. Okay, deputy governor. There are 4 deputy governors, not just one. So they are the full-time members of the central board of directors. The 15 members. So 5 plus 15, there are totally 20 members. So other 15 members are non-official members. 10 members, they can be from various fields, and 10 directors, they can be from various fields that are actually required, and 4 directors, they are from each of the 4 local boards. See, local boards, they are going to be north, south, east, west, right? So you are going to take 4 members from these local boards, and they are going to be the directors, non-official directors, who are nominated by the government. Okay, that is about central board of directors, which is in the part of organizational structure of RBI. And you also have local board. Local board, what does local board do? It advises central board, okay? And local board, it represents territorial and economic interest of local corporation and indigenous banks. तो उनका इंटरेस्ट को रिप्रेजेंट करने के लिए अलग अलग एरियाज में, अलग अलग जोन्स में, नॉर्थ साउथ ईस्ट वेस्ट में एक एक लोकल बोर्ड है. ओके, नाउ नेक्स्ट, दिस लोकल बोर्ड दे एडवाइस सेंट्रल बोर्ड. इफ यू वांट टू नो द कॉम्पोजिशन, आई विल राइट हियर. सेंट्रल बोर्ड में 15 होगा, लोकल बोर्ड में 5 मेंबर्स होगा. हर एक लोकल बोर्ड में 5 मेंबर्स होगा. टर्म पीरियड तो 4 साल होगा. आई एम अगेन सेइंग बोर्ड फॉर फाइनेंशियल सुपरविजन. इट वाज कॉन्स्टिट्यूटेड इन द ईयर ऑफ 1994. कोई भी नहीं पूछेगा. एंड देन 4 directors from central board, they are going to be part of board for supervision, financial supervision. I think this board is important because 4 directors from central board are going to be part of board for financial supervision, and they need to meet at least once in a month. Okay, financial supervision implies both for banking and non-banking. Okay, that's all. So this is board for financial supervision. So these are the 3 boards: central board, local board, board for financial supervision. Now let us open RBI's balance sheet. Okay, whenever you open a bank's balance sheet, it is definitely going to have liabilities and assets, right? So what are the liabilities of RBI and what are the assets of RBI? See, this is the balance sheet of RBI, and it is going to have liability and asset. So the currencies in circulation, they are liability. Why? Because RBI says that RBI signature karegi, I promise that every bearer, etc. So it is liability for RBI, currency in circulation. And next, currency in circulation includes currency with public plus currency with banks. Okay, they are the liability for RBI. And next, we have bank deposits with RBI. So banker deposits with RBI, they are liability for RBI because they need to be paid back. And next, government deposits with RBI, they are also liability to the RBI. And next we have other deposits. So whatever deposits are there, bank or government, etc., they are all liabilities for RBI. And assets, for any bank, assets are loans given to banks, government, etc. Loans given to banks, government and others, they become liability, they become asset for RBI. Loans are obviously assets, so therefore loans are asset to RBI. And we have investments. आरबीआई लोन देगी ना, अगर आरबीआई लोन देगी तो ऑफकोर्स वो एसेट बनेगा. अगर आरबीआई कहीं पे इन्वेस्टमेंट कर रही है तो वो भी एक एसेट ही होगा ना. लाइक फॉर एग्जांपल, इफ आरबीआई इज इन्वेस्टिंग इन डोमेस्टिक instruments like government securities or bonds, they can be G-Secs or bonds, okay, they are assets for RBI. And if RBI is investing in foreign instruments like foreign G-Secs or in foreign some gold, then they are also investments. I mean, if RBI is investing in gold also, then of course it is an asset. If RBI is having gold, if RBI is maintaining gold, that is also asset. So RBI can have both liabilities and assets. This is the balance sheet of RBI, and let's see where RBI is actually getting income from. So what is signorage? Signorage, I'll tell you signorage ka meaning kya hai. Signorage is nothing but cost of printing currency. Cost of printing currency minus face value of currency note. That is signorage. So if so what happens is usually cost of printing currency, it is pretty much low, but the face value of the currency note is pretty much high. Therefore, out of this, RBI is earning certain profit, right? That profit is called signorage. Okay. And next, we have what happens if currency depreciates? Will it be an income for RBI or will it be a loss? RBI can generate rupees if it depreciates. Why? Simple. How? Because see, RBI के पास अब बहुत सारे डॉलर्स है ना. रूपी इकोनॉमी में डिप्रिशिएट हुआ तो डॉलर्स और वैल्यूबल हो गया ना. सो डॉलर्स बिकेम मोर वैल्यूबल. देयरफॉर आरबीआई इज एक्चुअली होल्डिंग एसेट्स व्हिच आर मोर वैल्यूबल कंपेयर्ड टू रुपीस. ओके, नाउ इफ आरबीआई सेल दिस डॉलर्स इनटू रुपीस, द वैल्यू विल बी ह्यूमंगस. Okay, because initially RBI might get 89 rupees, now RBI is getting 100 rupees. So this is how RBI can earn profits if rupee depreciates. And of course, if RBI invest in other currency bonds, then RBI can earn income from them also. And RBI can earn from where? From foreign currency exchange stability. So from this also RBI can somehow earn income from foreign exchange stability. So RBI को function करने के लिए income की requirement है, and yes, RBI can generate income through various such sources. Even if banks deposit, that is also a kind of income for the RBI, because उससे ना उसको नहीं deposit से नहीं, loans से जो interest आएगा ना वो income बन जाएगा RBI के लिए, right? Deposits, their liability, and of course I don't want to tell them as income. Okay, so these are the main 4 areas: investment, ignorance and depreciation of currency, and that is foreign exchange stability. They are RBI's income. And RBI expenses, कहाँ पे expenses करेगी RBI? Operational expenses and deposits and borrowings. So of course deposits के लिए interest तो pay करना पड़ेगा, ये एक expense हो गया. Operation cost और officials को wages देना, ये सब भी expenses है. So these are the expenses of RBI. Now let us see what is RBI surplus. This is very important. See, RBI surplus, after RBI made provisions for bad and doubtful debt, and after RBI made all its expenses, certain amount will be remained with RBI, right? That certain amount is called surplus, okay? It is basically the balance of the profits after all the expenses are met. Okay, that is surplus. Now, this surplus, this shall be paid to the central government. Whatever surplus that RBI is having, that surplus shall be paid to the central government. And the surplus calculation, whatever it is there, it is based upon ECF, Economic Capital Framework. And it is recommended by Bimal Jalal Committee in the year of 2018 to 19. Of course, this RBI surplus, it is already mentioned in the RBI Act of 1934 in section 47 only, that this surplus it shall be paid to the central government after RBI meets all its expenses. So Bimal Jalal Committee, it classified the RBI's economic capital into 2 parts. Okay, one is realized equity and other is revaluation balances. See, what is realized equity and what is revaluation balances? Realized equity is funded by retained earnings. This realized equity is also called CRB, contingent risk buffer. So required contingency risk buffer must be around 6.5 to 5.5%. So why RBI is keeping such separate funds? Because it wants to avoid any risk it might incur in future. So for any potential risk and losses, RBI is creating a safety net, that is realized equity. So this must be around 6.5 to 5.5%. 6.5 to 5.5 of what? 6.5 to 5.5 of total balance sheet. Balance sheet of RBI, it will have assets and liabilities, and after subtracting you will get some balance, right? Whose balance में 6.5 to 5.5%, it must be maintained as realized equity or contingency risk buffer. Actually the committee recommended to widen it to 4.5 to 7.5%. Okay, and there is revaluation balances. Now currently I think central board actually widened it also. Anyways, revaluation balances, right? It includes unrealized gains or losses in foreign currencies, golds or securities. So unrealized, see, there might be some losses or some gains that you might have thought, you might have not expected. So they are in the revaluation balances. So you're evaluating where they must go. For example of revaluation balance, let's say that RBI is owning some branch house, and the value of that house is so high now. So RBI even did not expect. So that is revaluation gain. But you know what? That whatever gain is there, RBI it cannot spend also. That is why they are added into this. Why it is kept separately? The only reason is that you cannot distribute them. इसका profit बढ़ गया, अब क्या distribute कर सकते हैं RBI इस profit को? नहीं कर सकते हैं, because they cannot be held in the form of cash. They cannot be given as dividends to the government. So that's not possible. Therefore, they are kept as revaluation balances. And of course, these revaluation balances are very volatile. You can gain or loss. So such kind of surplus, it is kept in a separate economic capital. Anyways, the economic capital in total has this realized equity and revaluation balances, which is around 20 to 25%. 20 to 25% of total balance sheet. So this Bimal Jalal committee, it said that for every 5 years this must be reviewed. The economic capital must be reviewed, and only if this CRB is met, then only RBI should ensure that okay, हमने पूरा meet कर लिया. Because this realized equity is also important. So whenever you are taking income equal to expenses etc. and you are calculating balance sheet, you must also consider the realized equity. Contingency के लिए हमने कितना रखा. So only if this contingency risk buffer is met, then only RBI can transfer this surplus to to government. Okay. What is the prompt corrective action of RBI? There are two parameters. One is CAR and net NPA. It is net NPA, not gross. Net implies liability minus asset. So you are seeing the actual non-profit assets that bank is having, and you are subtracting its assets from it. Then you are seeing कि okay, इसके पास NPA बहुत ज़्यादा है. Assets subtract करने के बाद भी इतना सारा liability है. That is net NPA. Next, based upon this, RBI can suggest some guidelines to that bank. And also there is CAR. CAR implies capital to risk weighted assets. Okay, these are the two parameters on which RBI can issue prompt corrective action. अब बहुत हो गया RBI के बारे में. अब चलो देखते हैं बैंक्स के बारे में. Okay, see banks. I will classify in my own style. We have commercial banks and cooperative banks. See, but commercial banks, they are profit oriented, and cooperative banks, they are social welfare oriented. तो दोनों के बीच में कुछ तो चाहिए हमें. That is why we are having regional rural banks. It was set up in the year of 1975. Okay. And commercial banks, if you see, there are 12 public sector banks right now, and we have private banks and foreign banks. And cooperative banks, they can be split into rural cooperatives and urban cooperatives. And again, in the rural cooperatives also, we have single state rural cooperative and multi-state rural cooperative. And if it is multi-state, of course, it is regulated by center only. Okay. And what else? पहले कोऑपरेटिव बैंक्स के बारे में ऐसे होता था कि ड्यूअल कंट्रोल होता था. ड्यूअल कंट्रोल इंप्लाइज सी कोऑपरेटिव इज अ स्टेट सब्जेक्ट. दैट मींस इट बिलोंग्स टू द स्टेट लिस्ट, राइट? तो इसका मतलब स्टेट गवर्नमेंट कंट्रोल करेगी ना कोऑपरेटिव्स को. सो रजिस्ट्रार ऑफ कोऑपरेटिव सोसाइटी यूज टू कंट्रोल कोऑपरेटिव बैंक्स. एट द सेम टाइम बैंक को कौन कंट्रोल करेगा? RBI. सो कोऑपरेटिव बैंक इज सफरिंग फ्रॉम ड्यूअल कंट्रोल. बोथ स्टेट एंड RBI, they are controlling these cooperative banks. But later, after some reforms, what happened was that urban cooperative banks and multi-state rural banks, they were under complete control of the center, that is RBI. Okay. That was after Banking Regulation Act of 1949. Under this Banking Regulation Act 1949, there was this amendment. I think it's I don't remember the number, but in this only they did amendment, and urban cooperatives and multi-state cooperatives, they came under the control of RBI. So now only single state rural cooperative banks, they are under dual control. Okay, this is about the structure of banks that I want to tell you. I will give you a holistic idea. So you understood what is commercial bank, and you understood what is cooperative bank, and you also understood that regional rural banks in दोनों को common है. So what are called differential banks? Differential banks. See, differential banks are very different from commercial banks. They are also sometimes called as niche banks. Niche banks implies they are specialized institutions that serve specific customer segments or specific products. They are very differentiated and they serve only specific segment. They are differential banks, that's all. So local area banks, regional rural banks, they are differential banks. Small finance banks and payment banks, they are all differential banks. So after differential banks, we will study about non-banks. This is the map, right? Commercial banks, cooperative banks, RRBs, and then you have, RRBs, they are part of actually differential banks. Okay. And you have seen differential banks, RRBs, local area banks, I think small finance banks, payment banks. So they are all differential banks. So these are about banks. Now we need to see about non-banks. Non-banks can be widely categorized into all India financial institutions and NBFCs. NBFCs are also called shadow banks, and they don't have any banking license. They are not under Banking Regulation Act of 1949. Okay. So they are all non-banks. So NBFC, it is not a bank, non-bank. They are shadow banks. And all India financial institution, it is also non-bank. For example, NABARD, National Housing Bank, Mudra Bank, they are refinance institution. They are not banks, they are refinance institutions. NABARD, it was set up in the year of 1982, and Housing Bank, पहला house set up हुआ, उसके बाद NABARD set up हुआ. 1980 National Housing Bank. 1980 is also the year of banking ordinance. Round 2, nationalization of banks round 2. It was also 1980 nationalization of banks round 2. ऐसे याद करना कि nationalization of banks round 2
बहुत सारे बैंक्स नेशनलाइज हो गए, इसलिए हमारे पास एक हाउस की रिक्वायरमेंट है, एक बड़ा सा हाउस, दैट इज नेशनल हाउसिंग बैंक 1980. एंड देन इन 1982 नाबार्ड वाज सेटअप. ओके, एंड नाबार्ड इज सेटअप. उसी टाइम पे हमें लगा कि कोई एग्जाम चाहिए, दैट इज वाई एक्जिम. Exim was set up in the year of 1982. That is export and import related. That was in the year of 1982. And SIDBI, it was set up in 1990. Okay. And you also have IFSCI, we'll see, Mudra, NABFID. They are all India financial institutions. So as per our map, we need to discuss about commercial banks. See, whenever I'm thinking about public bank, private banks, etc., I remember about SBI merger thing. So initially, Imperial Bank was there. It has three presidency banks: Bank of Calcutta, Bombay, and Madras. But all of them, they were merged in 1921, and they got converted into State Bank of India. That's all. And it's the first national bank of India in the year of 1955. And to further widen that SBI Subsidiary Bank Act 1959, it merged even further more banks like State Bank of Hyderabad, Indore, etc., and they were all merged into State Bank of India. So if you see the current ownership of SBI, Government of India is a major stakeholder, approximately 60%, and 10% belongs to LIC. There are many private sector banks which I don't recommend you to remember, but yeah, there are many old private banks which were before 1968, and after this LPG, there are some new private banks like HDFC, ICICI, Kotak, Mahindra, Yes Bank, whatever they are. They're all new private banks. Okay, they're all about, that is about private banks, don't remember. And let us see foreign banks. So if a foreign bank want to open its branch in India, RBI tells that there are two cardinal principles. What they are? Reciprocity and single mode of presence. Implies, see, based on how you are treating us in the foreign nation, we will treat you like that in India. For example, if you are allowing us to open more branches in abroad, then of course that foreign country, if it is allowing Indian banks to open more branches abroad, then India will also allow that foreign company or foreign bank to open more branches in India. That is how it works. That is reciprocity. And next, single mode of presence. Single mode implies RBI allows either the branch or WOS, wholly owned subsidiary mode in India. इसका मतलब यह है कि फॉरेन बैंक्स अगर आए तो वो लोग या तो फिर एक ब्रांच ओपन कर सकते हैं या फिर एक WOS ओपन कर सकते हैं. सो होली ओन्ड सब्सिडियरी. Wholly owned subsidiary implies it is not a legal entity of any foreign bank, and it is a separate legal entity, and therefore it will be given more autonomy. More autonomy implies now a lot of restrictions will not apply on the WOS, and whatever taxation is there, it is similar to any domestic company. That is wholly owned subsidiary. So it can have anyone. Either it can operate as branch mode, where you will be subjected to restriction, like you are just opening a foreign bank in abroad, that's all. And or else it can be a wholly owned subsidiary where it is given more autonomy. So in 2013, RBI set up new rules. RBI said that whoever commercial banks, whoever foreign banks are there, if they came into India after August 2010, they must take WOS undertaking. WOS undertaking in place, they must be wholly owned subsidiary. That is what RBI said. So foreign banks, RBI is saying them to take a WOS undertaking. So for foreign banks who are before August 2010, they shall be having option either to continue as a separate branch or they can continue as wholly owned subsidiary. RBI has some more policies towards foreign banks. I mean, the banks must have minimum capital of 500 crores. There is a subsidiary foreign bank in India. Now that after conversion, it is not being equated to 500 crore. Let's say it's 400 crore. Then that extra 100 crore, it must be sent to India in the form of inward remittance. That is what RBI said to foreign banks. And also, the wholly owned subsidiaries, foreign banks in India, they must meet Basel III requirements. That is capital to risk weighted assets that we have seen. That Basel III requirement must be maintained. Okay. Actually, we have not seen Basel III. I will show you Basel III now after finishing foreign banks. Okay. And the bank shall maintain minimum CRAR of 10%. This capital to risk, which is in Basel III, that must be 10%. Okay. And the priority sector lending for foreign banks, it must be how much? 40%. So foreign banks, they must have a PSL of 40% and a CRAR of 10%. This is what RBI said to foreign banks. Also, if that foreign bank is maintaining WOS in India, it will have directors, right? Not less than 50% of directors must be Indians. So at least 50% of directors must be Indian nationals or NRIs or persons of Indian origins. And also, these foreign banks, they can open branch anywhere in India except in sensitive areas. So one more condition to them is that the foreign banks, they can open anywhere in India except some sensitive areas. Okay, and foreign banks, they have to follow norms set by the RBI. So after following all these conditions, a foreign bank can be set up in India. Okay, that is about foreign banks. Now I said I will discuss Basel III. Now let us discuss about Basel norms. Before knowing about Basel norms, you need to know certain basic concepts. One is AT1 bonds. Additional Tier 1 bonds, they are also called perpetual bonds. They have long maturity period. Long maturity period implies, sometimes it is also called no maturity period. Implies you can call, you can buy. There is a call option, but there is no sell option. So basically, I am issuing you AT1 bonds, additional Tier 1 bonds, also called as perpetual bonds. When I am issuing these bonds, I am not expecting you will return me immediately. And I am also even expecting you will return me one day. You can return me whenever you want. That is what I am saying you. But I am giving you that much of flexibility. Therefore, I will impose high interest rate on you. Okay. See, of course, you have call option and also you can sell also. But there is no maturity date. It's not like how do I tell you? See, I will tell you in this way. I am an investor. A bank is issuing it. So I have a call option. I can buy. But I cannot put. Implies I cannot give them back to the bank. What can I only do? I can trade. Okay. I can sell by trading it. Okay. That's all I can do it. Because I already said I will not ask money whenever I want. Therefore, I can only trade in the secondary market. And therefore, if I hold such AT1 bond, definitely the interest that a bank is going to give me is very high. AT1 bonds where they are very risky because banks can even skip out the interest payments and even reduce the bonds face value. That is why perpetual bonds they are risky. So banks whoever have issued AT1 bonds, sometimes of course AT1 bonds, if they want to be returned again to the public bank, it is a huge burden for the bank. Therefore RBI can even waive off or even write off these AT1 banks without even consulting its investors. So can you see how risky AT1 is? Even RBI can waive off these AT1 bonds or perpetual bonds. In case of liquidation, capital is first returned
capital is first returned to other bondholders and next to AT1 bondholders and then next to equity investors. So you have seen waterfall approach, na, bondholders greater than equity, right? So in that bondholders also, the perpetual bondholders, they are given least preference. See, as you can see, other bondholders are preferred over AT1 bondholders. Let us see some background of Basel norms. The Basel Committee, initially it was named as Committee on Banking Regulation and Supervision Practices. It was established by the central bank governors of the G10 countries in the year of 1974 and it has 45 members and India is also part of it. Okay, Basel Committee, its headquarters is in BIS, Bank for International Settlement in Basel, Switzerland. Okay, Basel Committee का headquarter वहाँ पे है. And Basel norms or Basel Accords are the international banking regulations issued by BCBS, Basel Committee on Banking Supervision. So who are issuing Basel norms? They are issued by BCBS. What is BCBS? Basel Committee on Banking Supervision. Okay, that is issuing Basel norms or Basel Accords. What does it do? It enhances financial stability.
So I think you got a clarity about Basel norm. Basically Basel norms का फाउंडेशन कंट्रीज है G10 कंट्रीज. तो इससे साफ साफ समझ में आ रहा है कि क्या ये इंटरनेशनल बैंकिंग रेगुलेशंस कैसे होना चाहिए वो डिटरमाइन करती है. सो इंटरनेशनल बैंकिंग रेगुलेशंस, to talk about international banking regulations, we have Basel norms. So Basel Committee on Banking Supervision gives Basel norms, and 45 member countries including India are part of it, and of course we stick to Basel norms, and this is all I can tell. And the headquarters of Basel Committee, it is in Switzerland, Basel. So Basel Committee talks about this CAR or CRAR. What is it? It's a capital divided by risk weighted assets. It can be tier 1 plus tier 2 divided by risk weighted. So what is tier 1 capital? I mean, if you take a bank, you will be taking its tier 1 capital and tier 2 capital. Okay, a बैंक के पास tier 1 tier 2 होगी. tier 1 मतलब मेन वो बैंक का शेयर कैपिटल कितना है, रिटेन्ड अर्निंग्स कितना है, परपेचुअल बॉन्ड्स कितना है, ये तीन हम लेंगे किसमें, tier 1 में. tier 2 it is less reliable but still we will add what example undisclosed, we don't know what they are. So those reserves are also capital for a bank. Revaluation reserves, for example land का property, bank is on some land, okay, that land का property बढ़ गया, so that is revaluation reserve, that can also be taken as tier 2 capital. And some other general provisions or some general lost reserves, which I mean NPS, which can be gained back. So they are all tier 2 capital and they are very less reliable. Okay, so you are taking tier 1 and tier 2 into consideration and dividing with risk weighted assets. We have seen what is tier 1 capital and tier 2 capital. Did we see what is risk weighted asset? So risk, what is the risk? See, it can be credit risk or it can be market risk or it can be operational risk. See, the assets which are under risk, example credit risk मतलब तुमने loan दिया लेकिन उस loan that loan can be converted into NPA. So the loans which are getting converted into NPAs, they are credit risk. So you are dividing with those loans, right, which you are given but they are getting converted into NPAs, that is credit risk. So denominator में credit risk को divide करेंगे. Divided by market risk implies so how your assets they are changing with exchange rates and interest rates. So that is market risk. And operational risk implies due to external environment and due to pressure from RBI etc. you are facing operational risk. You are not able to operate properly. So that will also be divided. When you are dividing with risk weighted assets and tier 1 plus tier 2 capital, that will be CAR. Okay. So in Basel norms, you need to know these terms. And next you need to know what is liquidity coverage ratio. Liquidity coverage ratio is nothing but high quality liquid assets divided by total net cash flow over next 30 days. So you are taking the cash outflow over the next 30 days. See, whenever you take a cash, there is some inflow in the next 30 days and there is some outflow. So if you are taking the net cash outflow, net implies outflow minus inflow. So when you are taking total net cash outflow over next 30 days, then in that what is the liquid assets? So that is LCR. So high quality liquid assets divided by total net cash outflow over next 30 days. Okay, high quality liquid assets, HQLA. It can be cash, government securities, which can be easily converted into liquid, and you have central bank deposits and also excess CRR with RBI. So banks, of course, they're having cash and government securities, and they might have also deposited in central bank, that can be converted into liquid, and also excess CRR with RBI. RBI ने 4% ही बताया, लेकिन आपने deposit किया 6%. So excess CRR that can be converted into liquid asset, right? So high quality liquid assets of a bank divided by total net cash outflow over next 1 month. It is called liquidity coverage ratio. Okay, what is leverage ratio? Leverage ratio shows how easily the capital of a bank can be liquidated if it needs funds. Yeah, this is also capital divided by asset, but it is not risk weighted assets and capital etc. So you are taking tier 1 capital, okay. What is tier 1 capital? Shares plus retained earnings, right? So you are taking this tier 1 capital and you are dividing with the total assets that the bank is having, and you are seeing how easily the capital of a bank can be liquidated. So tier 1 is the capital which can be easily liquidated, and assets, it is tier 1 plus tier 2. Of course it is tier 1 plus tier 2, right? This is tier 1 plus tier 2 capital, that is the total asset that a bank is having. So tier 1 divided by tier 1 plus tier 2, that is leverage ratio. How easily can a bank liquidate if it gets some funds? Okay, it should be around 3%. So I think you know liquidity coverage ratio, high quality liquid assets divided by total net cash outflow over next 30 days. Leverage ratio, how easily bank can be liquidated if it needs funds. Now we shall see net stable funding ratio. Net stable funding ratio is available stable funding divided by the required stable funding. It is basically measuring the amount of stable fund a bank is having divided by the required stable funding. See, banks of course they get some funding into their account. So some are stable, but इतना stable नहीं, हमें तो इतना stable चाहिए. This is the required stable funding, right? So that is what you are measuring. Net stable funding ratio, available divided by the required. Usually NFSR ना minimum 100% होना चाहिए. Implies our available stable funding must actually meet the required stable funding. But that is what you need to know. If you see liquid coverage ratio, what is it measuring? Liquid assets. How easily you can convert into liquid. So that is measuring over 1 month, right? But NFSR, it is checking your stability for next 1 year. So both of them, they are checking your stability. Liquidity coverage ratio, high quality liquid assets for in the next 30 days. Okay, this NSFR, that is net stable funding ratio, it is checking your performance for 1 year. I mean your stability, your liquidity standard for 1 year. So both of them are measuring liquidity standard only. Remember, both liquid coverage ratio and both liquid coverage ratio and net stable funding ratio, they are checking your liquidity stability. Both of them, they are checking your liquidity stability. And liquid coverage ratio, it's for 30 days, and net NSFR, it's for 1 year. Okay, that difference you need to know. दोनों फॉर्मुलास मुझे सेम ही लग रहा है, क्योंकि ना हाई क्वालिटी लिक्विड एसेट्स, तो ये होगा ना अवेलेबल, बैंक्स के पास ये अवेलेबल स्टेबल फंडिंग है ना अभी के लिए. एंड व्हाट अबाउट नीचे डिनोमिनेटर, टोटल नेट कैश आउटफ्लो ओवर नेक्स्ट 30 डेज. ये क्या है, ये नेक्स्ट 30 डेज में हमारा रिक्वायर्ड है कि नेट कैश आउटफ्लो कैसा होना चाहिए. सो यू आर मेजरिंग लिक्विडिटी कवरेज रेशियो, एंड NSFR, it is measuring what it is measuring. It is also measuring liquidity, how stable your liquidity is, liquidity standard only, but it is for 1 year, whereas LCR is for 30 days, next 1 month. You know the concept of bank run. When there is liquidity crisis and when there is a contagion effect, you will say that bank run implies, see, bank run can happen in various scenarios. Liquidity crisis implies suddenly a lot of people are coming into this bank and bank don't have funds to give them because it already gave us some loans. That is liquidity crisis. So in such situation, bank can go bank run. It can sometimes even declare as a bankruptcy. Okay, there is contagion effect. See, one bank, for example, there is a bank run in one. This bank might ask this bank immediately because it took loans from him. So this bank can approach this bank, but this bank might not have money. It will go another bank. So that will create a ripple effect and spread fear and panic among people in the banking system only. And also when there is loss of public confidence, then that is also a situation of a bank run. There are the three situations of bank run. Okay, if there is excessive credit growth, what can happen? So when there is excessive credit growth, then what banks do? That will really help banks to build up their capital, right? When a lot of people are demanding credit, of course, when there is excessive credit growth, the bank can use it to cover up with losses. That is counter-cyclical capital buffer. See, capital conservation buffer, you already studied about this in RBI also, that banks need to put certain assets, certain capital aside, so that whenever there are losses, whenever there is a risk, banks can use that buffer, okay? Banks are required to hold a capital conservation buffer to ensure cushion of capital that can be used to absorb losses during financial stresses. That's all. For example, you are having risk-weighted assets. उसके लिए ही हम CCB रख रहे हैं ना. At least 2.5% of this amount must be, I mean, from 0 to 2.5% of risk-weighted assets must be given to CCB. That is what CCB is about. Yeah, if you have higher CAR, what is CAR? Capital to risk. What does this mean? It means you are having a healthy capital. I mean, you don't have much risky weight assets. Even if you are having risky assets, you are having good amount of capital. So that is CAR norm. Now you have seen counter-cyclical capital conservation buffer and CAR norm, right? The counter-cyclical capital buffer is during excessive credit growth, you are using that excessive credit growth to fund your losses. Example, India is purchasing Russian oil, right? Because why? That is a situation where the prices have hiked and we are using that situation to cover up our losses. Something like that. Similar example, but not the exact example. Okay, you are using the excessive credit growth, using it, you are covering your losses. And capital conservation buffer, as we have seen, you are putting a certain cushion of capital so that it will help you during your financial losses or stresses. Okay, and next CAR norm, you have seen that most of the banks have a capital adequacy of more than 12%. Therefore, a bank with higher capital adequacy is considered safer because even if you make deposit into that bank, there is a chance that bank will give you back because it's a good bank. उसके पास उतना NPA नहीं है default करने के लिए. तो हाँ, that is CAR norm. Higher CAR, more safety. अब बैसल कमेटी के बारे में बात ही करेंगे. 1974 में कमेटी एस्टैब्लिश हुआ एंड वी थॉट दैट 45 मेंबर्स आर देयर एंड इट विल रिकमेंड सम बैसल नॉर्म्स. दैट्स ऑल एंड इट्स सिचुएटेड इन बैसल स्विट्जरलैंड. तो अब हम देखेंगे कहानी बैसल 3 कैसे एस्टैब्लिश हुआ. बैसल 3 से पहले हमारे पास तो बैसल 1 बैसल 2 भी होना चाहिए. तभी तो बैसल 3 2010 तक एंड गेम आएगा. तो देखेंगे एंड गेम के पहले थोड़ा 1 भी देखेंगे, 2 भी देखेंगे, तभी तो मूवी 3 समझ में आएगा, राइट? BCBS, see 1988 BCBS, what did it do? It suggested certain measures. They are called Basel I measures. Okay, it focused completely on the credit risk only. So it did not differentiate any debtors, and it focused completely on the credit risk. And it said that CAR it must be 8%, and in this 8%, see, you know the CAR formula. What is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets? So it said that Tier 1 must be 4% and Tier 2 must be 2%. So accordingly, we will take your CAR value. This is what it said, and it said that CAR value must not exceed more than 8%. It said that CAR value must be 8%. Okay, that is about Basel 1. That mostly spoke about CAR only. Next, we had Basel 2 in 2004. Okay, what did Basel 2 do? It measured banks' performance based upon 3 parameters. It is CAR, risk management, and disclosure norms. Okay, CAR minimum 8%. That is the same thing. But Basel 2 just said that risk management, it must have better risk management techniques. But better management implies both operational, I mean all three, operational, market, and capital. And it also talked about disclosure norms. Implies banks must mandatorily disclose all the risk that it is facing to the central bank. Mandatory disclosure of their risk exposure to the central banks. These are the 3 parameters that Basel 2 norms suggested. CAR, risk management, and disclosure norms. CAR तो वही percentage 8% ही बताया यहाँ पे भी. तो Basel 2 के बाद Basel 3 2010, this is the end game. So Basel 2 में यही है कि it ignored the systematic risk. Okay. बेसिकली Basel 2 it focused on individual banks. Banks के बाद कार कितना मैनेजमेंट कैसे है उसकी डिस्क्लोज कर रही है कि नहीं. So that is on individual banks. So what did it miss? It ignored the overall regulation systematic risk. Therefore to cover up with it, Basel 3 was proposed. Okay. Therefore to ensure banks don't take on excessive debt, of course banks can also take, but who is regulating it? No one. So for that we are taking this Basel 3. So Basel 3 में बहुत सारे पैरामीटर्स है. एक तो कार, and it also has leverage ratio. What is leverage ratio?
tier 1 T1 by T1 plus T2. How easily the capital can be converted into liquid, right? That is leverage ratio. And Basel III said that leverage ratio must be 3% and CAR must be 2.5%. पहले क्या बताया? CAR तो 8% बताया ना, अब तो CAR इसको इतना बोल रहा है 2.5%. So this actually reduced CAR a lot, Basel III. Low CAR implies less safety, but still they suggested 2.5 for CAR, and leverage ratio it was 3%. How easily capital can be liquidated. And counter-cyclical buffer. What is counter-cyclical buffer? From the credit growth, excessive credit growth, banks must observe their profit for financing their loans. Okay, that is counter-cyclical buffer. तो उसका buffer range कहाँ से कहाँ पे 0 to 2.5%. What is minimum liquidity coverage ratio? That is high quality liquid assets. HQLA, high quality liquid assets divided by total net cash outflow over next 30 days. That is minimum liquidity coverage ratio. Okay, liquidity coverage ratio LCR. And NLFR it is available stable funding divided by liquid stable funding. So NSFR नाम बड़ा है, 4 अक्षर है, liquidity coverage ratio में सिर्फ 3 है. That's why it is for the next 30 days only. Available stable funding, इसमें नाम पे ही stable funding दिख रहा है ना, stable funding. So available stable funding ratio, available stable funding divided by required stable funding in the next 1 year. That will give you the liquidity. That must be 100%. Okay, this must also be 100%. I mean, high quality liquid assets divided by the net cash flow over next 30 days. That must also be 100%. Okay. I think you are clear. What are all are the requirements in the Basel III? One is CAR. Anyone can guess that. And after that, it's leverage ratio. Leverage ratio it must be around 3%. What is leverage ratio? It is T1 by T1 plus T2. Tier 1 capital divided by Tier 1 total capital. So how easily the capital can be converted into liquid? That is leverage. And counter cyclical. So counter-cyclical buffer, how whenever there is credit growth, how the banks are using that credit growth as a buffer to fund their loans. Okay, and liquidity coverage ratio, high quality liquid assets divided by the net cash outflow in the next 30 days. And if you are taking it for 1 year, then it is net stable funding ratio, available stable funding divided by the required stable funding. Okay, now as you have seen, now let us see what did India and Basel III talk about. Just see one thing, that Basel III it was implemented from 2021. Okay, 2010 is the end game, but India and Basel, if you are talking Basel III, it was implemented in India in 2021, and RBI has announced that the value of CAR and counter-cyclical buffer, whatever they are for India. I mean, RBI just said that we will announce our own CAR value and counter-cyclical buffer values. Okay, and RBI it did not trigger counter-cyclical buffer. So whatever I was talking till now, they are for Basel, but it's not for India. RBI it has announced only CAR for India. Okay, it did not announce counter-cyclical buffer. So RBI whenever it is doing prompt corrective action, it will see 2 parameters. One is net NPA. It is not gross. Okay, it is not gross. It is net NPA. That is liabilities minus assets. And the second is CAR. Okay. So why are we discussing about banks? Because we are seeing this topic of foreign banks, right? RBI क्या करेगी? See. What did we see? We are seeing about foreign banks, no? Yeah. So we have seen that for a foreign bank, RBI will work on 2 cardinal principles. One is reciprocity and single mode of presence. And from 2013 RBI changed the rules. It said that after August 2010 only WS, the foreign banks with WS undertaking can only be in India. So but for the banks who are before August 2010, banks who came to India before 2010, they have the liberty to choose either WS or just a branch. Anything is fine. And RBI said some of the guidelines to the foreign banks that their minimum capital requirement is 500 crores. If they don't maintain that minimum 500 crore, then upon conversion, if it is not meeting this 500, there must be some capital infusion from the foreign bank which is abroad. Okay, and the WS whatever it is there, it must meet Basel III requirements. So जो भी हमने देखा CAR, leverage ratio etc., whatever Basel III is saying, all such are applicable to that foreign bank. Okay, and they must maintain a CAR of 10% and they must have a priority sector lending up to 40%. Okay. And they must have directors. 50% of board of directors must be Indians or Indian origins. They can be persons of Indian origins or even NRIs, and they cannot open branches in the sensitive areas. And they have to follow all the norms set up by the RBI. So we have seen that there are 12 public sector banks, there are private banks, so there are foreign banks also, and we have seen all the conditions. I mean, for a foreign bank, after August 2010, the rules have changed. What we have seen, it must be a WOS. And what else did we see? We saw that it must have minimum 500 crore capital. If it is not having 500 crore capital, then that foreign bank should infuse. I mean, the foreign bank must infuse capital into India in the form of remittance. And next, the CAR, it must have 10% CAR. And also we have seen priority sector lending. RBI fixed that PSL to 40%. So this is about foreign bank. And then what else do we need to see? We need to see about cooperative banks. No? Cooperative banks, you have rural and urban. Okay, rural cooperative banks, they can be what? They can be PACs or else DCCB or SCB. Okay, PACs is primary agricultural credit societies which are at local level, and we have DCCB, district central cooperative bank, and SCB, state cooperative bank. And next we have urban cooperative bank. Okay, urban cooperative bank can be split into single state and multi state. Okay, this is the map that everyone knows. Rural cooperative bank, it has PACs, DCCB and SCB, and urban cooperative bank, it will have rural urban में rural क्या है? Urban single state cooperative bank and multi-state cooperative bank. Okay, now we know that multi-state urban cooperative bank, it is completely regulated by RBI, whereas single state urban cooperative bank, it has dual regulation. One is RBI, the banking operations are operated by RBI. I mean, they are supervised by RBI, and the management functions, they are supervised by state government. Okay, that is about single and multi. And also rural, I think rural is again dual control only. Okay, so if you see this PACs, who gives more funding to PACs? So PACs gets major funding from scheduled commercial banks. Okay, ऑफ कोर्स कमर्शियल बैंक से ज़्यादा प्रॉफिट्स कमाएगा, प्रायोरिटी सेक्टर लेंडिंग की कुछ 40% है. So primary agricultural credit societies, they get major funding from PACs. Also, if not about major funding, the other fundings, if you see, district cooperative DCCB, that is sending funds to PACs. And where is DCCB getting funds from? It is getting funds from State Cooperative Bank. And where is SCB getting funds from? It is getting funds from NABARD. Okay, this you need to know. Now I'll tell you. Urban cooperative banks, you said that after Banking Regulation Act 2020, RBI is the one who is regulating urban cooperative banks. If cooperative, of course, a lot of them are multi-state. So usually whenever they are talking about urban, I will tick mark multi-state urban cooperatives as banking regulation. If ever they are giving urban cooperative bank, we will generalistically take it as a multi-state and we'll tell that it is having only single regulation. Okay, now let us see how funding mechanism occurs for urban cooperative banks. See, there is this body NUCFDC, which is National Urban Cooperative Finance and Development Corporation Limited. Okay, it was set up on the recommendations of Vishwanath Committee on Primary Urban Cooperative Banks. Okay, basically it serves as an umbrella organization for urban cooperative banks. Okay, for example, cooperative banks regional level में हमें पता है कि उसको पैसा कैसे आएगा, लेकिन urban level पे इस urban cooperative banks को पैसा कौन देगा, right? That's why there is this umbrella body NUCFDC. What it does is it gives bonds to public and it collects money. So this fund, it will be distributed to urban cooperative banks. So that is how NUCFDC functions. Okay. The membership of urban cooperative banks to NUCFDC, it is voluntary. So whoever are thinking that they will be benefited from NUCFDC, they can join that urban cooperative bank can join NUCFDC. Okay, this is basically an umbrella organization for urban cooperative banks. So as you can see, NUCFDC, this C stands for corporation, not cooperative. Therefore, it is clearly a NBFC. Okay. So there is this committee, Nachiket More Committee. It suggested for financial inclusion. Okay, it said that there must be some financial inclusion, and then in 2013 to 14, this committee was set up, and it said that for financial inclusion, let's create some banks. So they are this small finance banks and payment banks. They help for promoting financial inclusion. Okay, now let's see small finance banks first. See, one thing you need to know: minimum 200 crore capital wala resident, minimum 200 crore capital wala resident, and payment bank minimum 100 crore capital wala resident. Very important. I feel more comfortable with this slide, so I have changed. So we have small finance banks and payment bank. A small finance bank minimum 200 crore ka capital wala resident. Capital wala resident implies, see, capital, that bank must have at least 200 crore capital, and resident implies it must be some resident, not some foreigner. Okay, that is minimum 200 crore capital wala resident. And if it is a small finance bank, it must open at least 25% of its branches in the unbanked rural areas. So it is going to see rural areas and it is going to see, okay, these are the rural areas where there are no banks. So there small finance banks are going to set up. Okay, I think you understood. And next we have payment banks. Payment banks is minimum 100 crore capital wala resident. That is the capital must be 100 crore and they must be residents. Okay. Currently, if you ask me to give example for payment banks, they can be Paytm Bank, Jio Bank, Airtel, Jio, Airtel, India Post. So all of them are examples for payment banks. Okay. And the PSL, priority sector lending. Remember, yes implies 6. So priority sector lending is 60% for small finance banks. And for payment banks, have you seen a Paytm that okay, only Paytm must give priority sector to, I mean, Paytm should give loans to only agriculture. ऐसा कुछ priority sector norms सुना Paytm के लिए. Payment banks don't have any PSL norm. Also remember one thing, that there is no credit card. Payment banks cannot even give credit cards. If payment banks cannot even give credit card, if payment banks cannot even lend money, then how can they do this priority sector lending? Lending ही applicable नहीं है ना. So payment banks, they cannot even lend money. So priority sector lending, it is not applicable for payment banks. Okay, small finance banks, they are having 60%. Also, to whom small finance banks are for? They are for unserved, undeserved farmers. Okay, this is a UPSC PYQ. It asked that small finance banks are for young entrepreneurs. No, the answer is wrong. They are for unserved, underserved farmers. Okay, and payment banks, they are for promoting small savings. Okay, next, therefore small saving banks can accept deposits without any restrictions. क्योंकि a bank है, this is accepted, it can accept deposits. Payment banks can also accept deposits, but they are only demand deposits and they are only up to 2 lakh per customer. And NRI deposits cannot be accepted by payment banks, and time deposits also cannot be accepted. So payment banks को exemption है कि चलो तुम demand deposits per customer accept कर सकते हो, वो भी सिर्फ 2 लाख तक. You cannot accept any NRI deposits and you cannot give any credit card to anyone. Okay, this is what RBI said to payment banks. Okay, and next, after 5 years, small finance bank can even become universal banks. Okay, one more thing, urban cooperative banks now, they are having a priority sector lending of 60%. See, if there is an urban cooperative bank, if it wants to convert into small finance bank within 5 years, then of course it must have minimum net worth of 100 crore. But over 5 years, it must reach this 200 crore. Okay, that is about urban cooperative banks who are trying to become small finance banks. Both small finance banks and payment banks, they are suggested as recommendation by Nachiket Committee in the year of 2013 to 14 to promote financial inclusion. So if, for example, if there is new SFB, it must it must comply with this 25% unbanked criteria within one year of requirement. Okay, the requirement within 1 year, okay. Now let us see few more differential banks. We have regional rural banks and local area banks. Okay, RRBs, they are based on the recommendation of Narasimhan Committee. Okay, local area banks, they are based on the budget 1996. Okay, next thing, shareholding. Regional rural banks, earlier it used to be 50:15:35. 50 from the central government and 15 from the concerned state government and 35 from some sponsor bank. But after RRB amendment in 2015, they have changed this. Now they are saying that this is sponsor plus central, they must be not less than 51%. Okay, at least half of the shareholding must be central plus sponsor. State government can increase its shareholding if state governments want to. But anyways, for that, state government can also decrease its shareholding. That is also possible. But anyways, that regional rural bank must take permission from the state government before reducing its stake, right? Yeah. And now let us see the difference between them. The main thing that I can find is priority sector lending. So I think RRBs, they're having PSL of 75%. I think local area banks, they are having a PSL of 40%. Okay, actually chota mota local area banks hai ye. So these banks, they are regulated under Companies Act of 1956. Okay, lot of local area banks, they are getting converted into small finance banks, SFBs, that we have seen before. Why is that happening? Because the value of LABs, they have drastically reduced. That is why they are getting converted into small finance banks. For example, let's say there is a district, and in that district they can only open up to 3 branches, and their influence is only limited to that district and that local area. So for example, you opened a bank account in Vijayawada, but you cannot draw money in Delhi. Therefore, no one is preferring local area banks these days, and they are getting converted into small finance banks. Okay, and the regulator, regional rural banks, the regulator, ultimate regulator is RBI, but immediate regulator, if you ask, then it is NABARD. Of course, RRB's immediate regulator to NABARD hi hai, but ultimate regulator in the end it's RBI always. Okay, and local area banks, they are non-scheduled banks because they need not maintain such things like CRR and SLR, etc. Okay. See, even if they are non-scheduled, under banking regulation, they are given license to give loans, right? That is why they have a PSL of 40%. Okay. So now we have seen regional rural banks. We have seen that one is recommended by Narasimhan and other is recommended in the budget 1999 something. And earlier it used to be 50 to 15 to 35. But now they are saying that after RRB amendment 2015, central and sponsor, they must not be less than 51. So there must be at least 50% central and sponsor must be there. And RRBs, this priority sector lending is 75%. Okay. And what else? Regulator. Who are the regulators? RBI, it is the ultimate regulator, but when they're asking immediate regulator, it must be NABARD. And also local area banks, we have seen that their value is very reduced, and currently they are getting converted into small finance banks, and they are regulated under Companies Act of 1956. They are non-scheduled banks, but yeah, they have priority sector lending up to 40%, and they are limited to some local areas, and they can open branches in 3 districts. Okay. Actually, what I said you earlier is wrong. I mean, I said na ki they can open 3 branches in a district. No, I said it reverse. Actually, if you take a state, they can open only in 3 districts. One. That's all. So, एक state में सिर्फ 3 banks. So can you imagine? So I think you're clear. PSL for RRBs is 75, and PSL for local area banks is 40, and PSL for small finance banks, yes for yes, it is 60%, and payment banks वो तो lend ही नहीं करेगा, so 0. Now we need to see what non-banks, all India financial institutions and non-banking financial companies. Before proceeding into non-banks, I forgot to tell you one thing. In the cooperative, the customer, he is also ultimately the owner. This principle you already know. That's why I'm not telling you. So basically, customer, see, it's like a help group, and customers na help group implies, see, these people, they are giving their money. 5 rupee, total, it became 500 rupees, let's say. So this 500 rupees, out of this 500 rupees, someone needs loan. So this person will be getting 300 rupees, something like that. And that person who took 300 rupees will be paying back along with some interest. That is how they generate profit. And that profit will be again distributed among all the members. So the members are ultimately the customers and owners, and all the members have equal voting rights, and they get cheaper credits, and financial inclusion will also be there in the cooperative banks. So now we need to see non-banks, which are all India financial institutions and non-banking financial companies. But before that, I want to also tell you the issues of cooperative banks. They have lack of professionalism, and there is a contagion effect. So if one cooperative bank is affected, all other cooperative banks are also getting affected. And there is a lot of political interference, and there are frequent scams and money laundering happening in the cooperative banks mainly. And also there is dual control. Therefore, to eliminate this dual control, RBI introduced the Banking Regulation Act of 2020 that I already said, where RBI completely eliminated the dual control in urban multi-state cooperative banks. First, non-bank. See, non-banks, they are all India financial institutions and NBFCs. So let us first finish off NBFC. Okay, NBFCs, they do not have any banking license, and their supervision can be by RBI or SEBI or whomever it may be. It will actually depend based upon the business that NBFC is into. Okay, next thing, NBFCs, they raise funds through market-based instruments. Okay, and they can also raise deposits. They can also raise funds through deposits also. However, that is of lower share. The larger share is from market-based instruments such as commercial papers and debentures, etc. NBFCs, they can only accept fixed deposits. They cannot accept demand deposits, and the fixed deposits, they can be accepted only by NBFC D. Okay, and even those fixed deposits, they are not insured under DICGC. And NBFCs, their primary business cannot be into agricultural industrial activities or any services like sale or construction of immovable property. So their primary business cannot be into it. And yes, NBFCs, they can lend loans, of course, but they can also issue credit card. That is also possible because they can lend loans, and there is a prior approval of RBI mandatory for issuing credit card. Okay, and debit card, they cannot issue debit card. No, they cannot take money very easily from public. And is CRR applicable on NBFCs? The answer is no. No CRR is applicable on NBFC. But is SLR applicable? SLR, it is applicable only for NBFC D, which are taking fixed deposits. Okay, for them SLR is applicable. And then, are they part of payment and settlement? The answer is no. They cannot issue their own checks. So they are not part of payment and settlement. NBFCs, they cannot give a debit card, and they cannot also give checks. Okay, because they are not part of payment and settlement. And regulation, they are partly regulated or sometimes also called unregulated if it is normal NBFC, and they are less transparent. That is why they are called shadow banks. So simply putting, NBFCs, they can lend money but they cannot accept deposit. I mean, they can accept deposit, but they are only fixed deposits, and that fixed deposits accepting NBFCs are called NBFCD, to whom we are telling that they need to maintain statutory liquidity ratio of up to I mean, the maximum cap of SLR is 40%. Okay, yes, that's also they need to maintain certain SLR with them. That is what we are telling them. Okay, that's all. When we are talking about non-bank, I also want to tell you what is neobank. Neobank, they are new banks which don't want to follow the conventional traditional systems. Okay, I think I've already said about neobanks to you before. They don't have a 100% digital. I mean, they don't have physical presence, and they are 100% purely digital. Okay, they don't have banking license. Do you know what is a digital banking unit? For example, let's say you are going to a place where there are no people, there are no officials. Let's say there is only ATM machine, there is only deposit machine, etc. Everything is machine and automated. You just need to go to that respective counter and do whatever you want. There are no humans. Then such banking unit is called digital banking unit. I think they experimented this, and I think it was set up somewhere also. Now let us see all India financial institutions. Okay, NBFC के बारे में बहुत हो गया. इतना पता है ना कि NBFCs क्या नहीं कर सकते. They cannot issue credit card. This is all. No, they can issue credit card. They can even give loans, but they cannot accept deposits. Even if they can accept deposits, they can accept only fixed deposits, and such NBFCs are called NBFCD. Okay, now you have seen about NBFC. Now let us see all India financial institutions. Okay, all India financial institutions. There are three categories. Okay, ऑल इंडिया डेवलपमेंट फाइनेंशियल इंस्टीट्यूशन जो डेवलपमेंट के ऊपर फोकस कर रही है, एंड वी हैव स्पेशलाइज्ड फाइनेंशियल इंस्टीट्यूशन जो स्पेशलाइज्ड है, किसमें स्पेशलाइज्ड है, एक्सपोर्ट इंपोर्ट में, सो दैट इज एक्सिम. एंड वी हैव रिफाइनेंस इंस्टीट्यूशन, रिफाइनेंस इंस्टीट्यूशन प्लेस विच आर हेल्पिंग टू फंड बैंक्स, एग्जांपल नाबार्ड, हाउसिंग बैंक एंड मुद्रा. ओके, and the time period they have asked in the exam. For example, when is IFCI established? IFCI is Industrial Finance Corporation of India Limited. Since it is industry, it is part of development, so it comes under All India Development Financial Institution. Okay, IFCI. It was established before independence, no, just after independence. Okay, I का मतलब independence, just after independence. That is 1948. Industrial Finance Corporation of India Limited. And we have SIDBI. SIDBI, it was established in 1990. Okay, and EXIM, it was established in 1982. And NABARD is also established in 1982. And Housing Bank, it was established in 1980. I said you a story, remember? 1980 में क्या हुआ? Nationalization of banks round 2. तो बहुत सारा बैंक्स नेशनलाइज हो गया. एक हाउस का रिक्वायरमेंट है 1980 में, तो नेशनल हाउसिंग बैंक सेटअप हुआ. उसके बाद नाबार्ड, उस बैंक्स को फिनांस करने के लिए नाबार्ड सेटअप हो गया. एग्रीकल्चरल एरियाज को मेनली फिनांस करने के लिए नाबार्ड सेटअप हुआ 1982 में. ओके, एंड देन 1982 में एक स्पेशलाइज्ड इंस्टीट्यूशन भी चाहिए उस टाइम पे, सो एक्सपोर्ट इंपोर्ट, दैट वाज आल्सो सेटअप. ओके, एंड फाइनली 1990 सिडबी वाज सेटअप. ओके, दिस इज हाउ आई रिमेंबर. एंड द IFCI, I said after independence it was set up, I for I, so 1948. This is how you can try to memorize. Okay, now let us see all India development finance institutions. First, the bank that we are seeing is IFCI, 1948. It is the first development finance institution in India. Okay, and it provides financial assistance to whom? It provides financial assistance to manufacturing and industrial activities. That's all. Currently, it exists in the form of systematically important non-deposit taking NBFC. That's all. Systematically important non-deposit taking NBFC. That is Industrial Finance Corporation of India Limited. And SIDBI is also for development, right? So SIDBI 1990, it was set up as an independent financial institution under banking system in India to promote growth and development of MSME. If you remember, whenever you study about MSME, you will study about SIDBI. Okay, yeah, SIDBI was set up to promote independent financial institutions who are trying to finance these MSMEs, micro, small and medium enterprises. Okay, that is about SIDBI. It's for mainly MSMEs. जो banks MSMEs को finance करते हैं, उसको finance करना है हमें. That is why SIDBI was established. Okay, now you understood about Industrial Finance Corporation of India and SIDBI. It is IFCI is for general manufacturing and industrial activities, and SIDBI it is for MSMEs. Okay, and next, export import, that is for financing export and banks, that is for financing banks who are helping for Indian exporters. Okay, who not only exporters but also overseas investments, credits, all such things. Exim Bank will help. Okay, you are having the next one. What is that? Let's see refinance institutions. First one is NABARD. It is funding agricultural societies. बेसिकली जो भी एग्रीकल्चरल क्रेडिट फंक्शन है आरबीआई का, वो पूरा ट्रांसफर हुआ नाबार्ड के ऊपर. ओके, इट वाज एस्टैब्लिश्ड आफ्टर द रिकमेंडेशन ऑफ बी सीवारामन कमिटी. ओके, that is all I can tell for now. And NABARD, they act as supervisor for cooperative banks and RRBs. Why? Because they are majorly associated with agricultural activities. That is why they act as supervisor for cooperative banks and RRBs. And they also provide training and research facilities to the banks who are working for rural development. National Agriculture Bank, National Bank for Agriculture and Rural Development. So even for rural development and even for agriculture, NABARD will take care. Okay, not just agriculture. And then we see National Housing Bank in the year of 1980. It is a state-owned bank and a regulator of housing finance companies. So you know there are housing finance companies. So whenever they require money, this National Housing Bank will help them. Okay, and National Housing Bank, of course, it is regulated by RBI. Do you know what is housing finance company? Basically, if you need house loans, home loans, they are going to provide. They are housing finance companies. So National Housing Bank, it will finance these housing finance companies, and they are regulated by. NHB, it is regulated by RBI. I think NABARD हो गया, NHB हो गया, and बचा क्या है? मुद्रा बैंक बचा है. चलो, मुद्रा बैंक. What is मुद्रा बैंक? It is a Micro Unit Development and Refinance Agency Limited, Mudra 2015. Mudra, I think you have heard many times whenever you studied MSME. SIDBI and Mudra, they are mainly for MSME. Okay, Mudra is a refinance institution for micro enterprises. Micro enterprises who are dealing with manufacturing, trading, and service sector. Now just remember that SIDBI is Small Industries Development Bank of India. Development है, तो इसका मतलब that is All India Development Finance Institution. Next, SIDBI is for MSME. Okay, good. And Industrial Finance Corporation of India Limited. So industries, that means it is for development. So All India Development Finance Institution. Now next we have specialized financial institution, that is EXIM, specialized in foreign trade. Okay, and next, what is a refinance institution? NABARD. You are financing whom? Agricultural society and rural development. And National Housing Banks, you are financing national housing finance companies. And Mudra Bank, you are financing banks working for MSME. Okay, I think you understood. a priority sector lending, which can be direct and indirect way. Indirect ways include NBFC on lending, PSL certificate, and two funds, that is Rural Infra Fund and Urban Infra Fund. I'll tell you what is NBFC on lending. Let's take an NBFC, and this NBFC it is working on agriculture machinery, etc. Let's say tractor, which is part of priority sector, right? लेकिन ये एनबीएफसी के ऊपर कोई मैंडेटरी पीएसएल नहीं है. वी हैव नॉट स्टडीड एनी पीएसएल क्राइटेरिया रिक्वायरमेंट फॉर एनबीएफसीज. ये बस मजे के लिए कर रही है. नाउ देयर इज दिस एक्चुअल कमर्शियल बैंक व्हिच नीड टू फुलफिल दिस क्राइटेरिया. देयरफॉर व्हाट कैन इट डू? इट कैन इन्वेस्ट इन दिस. इन्वेस्ट मतलब कुछ नहीं, लोन देना इस एनबीएफसी को, बस उतना ही. सो दे आर गोइंग टू लेंड लोन टू दिस एनबीएफसी एंड दिस एनबीएफसी विल इन्वेस्ट इन प्रायोरिटी एग्रीकल्चरल एरियाज एक्सेट्रा. ओके, that's NBFC on lending, and that's how a bank can fulfill its PSL criteria. Now there is a maximum cap on it. Why there is a maximum cap? Because bank सब कुछ यही रास्ता अपनाएगा. That's why there is a maximum cap. That is 5% of PSL target of the previous financial year. Okay. लेट्स से प्रीवियस फाइनेंशियल ईयर इट्स 40%. वो तेरा टारगेट था प्रीवियस फाइनेंशियल ईयर में जो तुमने अचीव किया, उससे 5% करेंगे तो कितना आएगा? 2%. ओके, सो 2% इज द कैप. 2% से ज़्यादा हम एनबीएफसी ऑन लैंडिंग के थ्रू नहीं कर सकते. तो क्या क्या रास्ता अपनाना पड़ेगा? अब वी नीड टू गो टू पीएसएल सर्टिफिकेट्स. ओके, ये कुछ नहीं है. लेट्स सी, देयर इज अ बैंक. ये पागल बैंक है. ये पागल बैंक क्यों है? क्योंकि उन्होंने ज़्यादा किया. 40% इज द टारगेट बट दे डिड 60%, तो ये 20% एक्स्ट्रा है. नाउ दिस बैंक इज क्लेवर, इट विल गो टू ई कुबेर प्लेटफॉर्म. ओके, ई कुबेर प्लेटफॉर्म. इस ई कुबेर प्लेटफॉर्म में ये जाएगी और कस्टमर बैंक को ढूंढेगी जिन्होंने पीएसएल टारगेट नहीं फिनिश किया. तो ये बैंक आ गया एंड बोलेगी कि आई नीड अ सेलर हु कैन सेल पीएसएल सर्टिफिकेट. बोलेगी आराम से ले लेना मेरा पीएसएल सर्टिफिकेट, लेकिन मुझे फी भी चाहिए. सो दिस विल पे अ छोटू सा फी एंड इट विल टेक दिस पीएसएल सर्टिफिकेट. सो दैट्स हाउ अ बैंक कैन फुलफिल इट्स पीएसएल टारगेट्स. PSL certificate is also another way. Okay, great. But in PSL certificate, the amount you have given, it is not coming bank. Why? Because here you are giving fee to the e-Kuber portal, right? You are not giving some loan. So therefore, you cannot get your principal back, right? That's something. But banks actually prefer PSL certificate because, see, rather than converting my loan into bad loan and non-performing, it's better I pay chutku sa fee, right? That's what banks think. And next, Rural Infra Development Fund and Urban Infra Development Fund. Let's say banks, they were not able to fulfill this criteria from first and second. Now what's going to happen? Now they have the only option, that is investing in the NABARD. Okay, NABARD को लोन देगी और NABARD लॉक इन करेगी 7 years तक, 7 साल तक. एंड अगर लोन, व्हेन यू गिव लोन टू एन एंटिटी, ऑफ कोर्स यू आर गोइंग टू गेट इंटरेस्ट, राइट? सो देयर इज अ ग्रेस पीरियड. आई थिंक 2 साल का ग्रेस पीरियड है. उसके बाद इंटरेस्ट आना शुरू हो जाएगी धीरे धीरे. ओके, सो बैंक्स दे फील इट एज अ पनिशमेंट. सो दैट्स व्हाई दे डोंट वांट टू ऑलमोस्ट गो टू दिस. दे फील इट बैड बिकॉज अगर कोई फाइनेंशियल क्राइसिस आएगी तो मेरे 40% तो NABARD के पास है, NABARD की रूरल इंफ्रा डेवलपमेंट फंड के अंदर है, मैं विथड्रॉ नहीं कर सकता हूँ. सो दैट्स व्हाट बैंक थिंक, right? That's why they don't want to go to this option. And Urban Infra Development Fund is also the same thing, where your money will be locked in for a certain period. But Urban Infra से पता चल रहा है कि ये NABARD नहीं हो सकता, कोई और. That's National Housing Bank. Okay, that fund will go to National Housing Bank and it will invest in the priority sector areas. Got it? Now I would like to tell you, जब भी हम priority sector lending पढ़ते हैं, एक चीज भूल जाते हैं कि that is percentage of what exactly. That's what is ANBC, Adjusted Net Bank Credit. Adjusted Net Bank Credit is nothing but net bank credit plus something very important, that is non-SLR investments. This is what RBI did. RBI just did not take what is NBC? Net bank credit. Okay, so RBI just did not take net bank credit. It did some adjustment and it said adjusted net bank credit by adding non-SLR investments. I'll tell you, net bank credit plus non-SLR investment, right? Now, net bank credit क्या होता है? The credit that a bank is giving, the bank credit minus the bills rediscounted. Okay, if the bank has already sold some of its loan bills to RBI or some institutions to get cash, those aren't technically the bank's risk anymore. So they are subtracted. Okay, and then we have non-SLR investment. Non-SLR investment, this is a clever part. That is, if a bank pays corporate bond or commercial papers, it's technically an investment, but it functions like a loan to a company. So to prevent banks from escaping that PSL by just investing instead of lending, the RBI adds these back into the total. So that is why RBI is saying adjusted net bank credit. Okay, this ANBC, adjusted net bank credit, it is also sometimes called as CEOBE, I think, credit equivalent off balance sheet exposure. वो दोनों सिमिलर है, बस उसमें कुछ एक्स्ट्रा चीज़ें होंगे, लाइक लेटर ऑफ क्रेडिट्स, गारंटीज एक्सेट्रा, वेयर बैंक्स हैजंट गिवन मनी येट बट माइट हैव टू गिव. Okay, anyways, in most of the books we see ANBC, adjusted net bank credit. And one more thing I forgot to mention you, that you know the priority sector lending, right? For foreign and commercial banks, that is 40%, RRBs के लिए 70%, and it's 60% for small finance bank, which you can remember, and urban cooperative societies के लिए 60%. Okay, now this is in the news. Initially we used to think 4%, now it became 3%. Okay, CRR, currency reserve ratio or cash reserve ratio, that is 3% of net demand time liability. So when you're talking about priority sector lending, it is adjusted net bank credit, that is ANBC. Now if you're talking about banks, it is net demand time liability. Okay, got it?
These are some of the list of priority sectors. Agriculture, MSME, of course, everyone knows agriculture and MSME. Next are the housing, education, renewable energy, social infrastructure, startups, loan to weaker section, etc. And overdraft available Jan Dhan account holders, they are also under part of priority sector. Okay. List of agricultural loans which can be categorized as priority sector loans. Okay, list of agricultural loans. There are some agricultural loans, only they are categorized as priority sector loan. For example, crop loans, purchase of land and agricultural machinery, or investment in the post-harvest infrastructure, and loans to distressed farmers indebted to money lenders so that we can stop suicides, and loans under Kisan Credit Card. Okay, you remember Kisan Credit Card. Loans against negotiable warehousing receipts, loans for installation of solar agricultural pump set. Okay, loans are given to agricultural startups and food processing industries are also categorized as a priority sector lending. So if I give loan to a startup which is related to agriculture, then also it will be categorized as agriculture loan. Okay, now priority sector lending target. Great. Okay. Small finance banks, it is 60%. Urban cooperative banks, it is 60%. Regional rural banks, it is 75% to the regional rural banks, RRB. So we have commercial banks and foreign banks. Domestic commercial banks and foreign banks with 20 branches and more. I mean, foreign banks with 20 branches and more, and domestic commercial banks. Okay, they have a PSL target of 40%. Foreign banks with less than 20 branches, they also have 40%. Oh, come on. So basically, domestic commercial banks and foreign banks, they have a PSL target of 40%. Regional rural banks, they are in the rural areas for this priority sector lending only. Therefore, we are priority sector lending. It is 75% for regional rural banks, and small finance banks and urban cooperative banks, it is 60% as we have seen before. Now, okay. This 40% only they have split into different categories. For example, domestic commercial banks, in this 40%, 18% must be at least to agriculture, 7.5% must be to MSMEs, and 12% must be to the weaker sections. Okay, there is no split for foreign banks less than 20 branches, and they are all not important for the exam. Okay, on lending, 2019. In 2019, RBI enabled scheduled commercial banks to fulfill their PSL target of 40% through on lending. Okay, so what is this on lending? As part of on lending, the banks can sanction loans to NBFCs, who then would lend these loans to sector characterized as priority sector. Hence, in this case, NBFC act as intermediaries, enabling the banks to fulfill their PSL norms. Okay. For example, if NBFC, if it is financing any agricultural sector, I mean, it will get a certain PSL score. That score, it is going to give it to this normal banks. If normal banks, they are not able to do this priority sector lending, in such case, they can borrow it from NBFCs. Okay. Yeah, that is on lending. In 2019, RBI allowed it, and we have co-lending. Under co-lending, commercial banks and NBFCs come together jointly to extend loans to priority sectors. Okay, they both are coming they both are coming together and lending loans to priority sectors. Such a model enables the banks to reduce the risk in giving PSL loans. Okay, because they both are coming together, so it is basically reduced risk. That is about a priority sector. Now, if you revise the same question again, an amount of bank loans given to the individual household for renewable energy. See, this question, any amount of bank loans given to individual households for renewable energy projects. So any amount is wrong actually. There is a restriction of up to 10 lakh per borrower. Okay, therefore statement 1 is wrong. Actually, this is not our mistake because we cannot remember that much. But yeah, any amount, this becomes very extreme. Any amount of bank loan given to individual household for renewable energy becomes wrong. There is a cap of 10 lakh per borrower. Okay, and next, housing loans to banks' own employees are commercial. Okay. Housing loans to banks' own employees. See, this is wrong. Here is the catch. Housing loans is correct, but to banks' own employees, this becomes wrong. Okay. See, banks' own employees, they are specifically excluded from priority sector classification. Okay, this is wrong. Loans to individuals for education purposes not exceeding 25 lakhs. This is absolutely correct. It was in the latest news, revised 2025 guidelines. Loans to individuals for education purposes not exceeding 25 lakh rupees, they are qualified under the priority sector lending. Okay, not exceeding 25 lakhs. So there is also a cap of 25 lakh. If they should specifically mention like this. Okay, if they are mentioning renewable energy project, they must mention 10 lakhs. And if they are mentioning for education purpose, they must mention 25 lakhs. Okay, that is how it works. Loans that are given against gold as a collateral for undertaking agriculture automatically becomes, see, agriculture activity ineligible. I think it's wrong only. Loans given against gold as collateral for undertaking agricultural activities, they are eligible under priority sector lending. Okay, this is something that is known by everyone. Therefore, if banks own employees, you are going to eliminate at least. So if you take off 2 and if you take 2 and 4, I think let's try to eliminate and try. 2 we have eliminated, 4 we have eliminated, so there is only one option. That is option 3. Option 1 it is difficult, but if you are able to eliminate 2 and 4, that is enough, and you are able to eliminate. See, banks own employees you should eliminate, and loans that are given against gold as a collateral. See, this is something very easy. This also you eliminated. Therefore, you went to this only one option. Now shall we try attempting some MCQs? With reference to the rule or rules imposed by the RBI while treating foreign banks, consider the following statements. Okay, there is no minimum capital requirement for wholly owned subsidiaries. We saw that minimum capital requirement है कितना 500 crore. And काफी अजीब statement है. Even if you don't know this value, why do you think there is no minimum capital requirement when a foreign bank want to invest in India, want to open its branch in India? So this option is wrong. Logical guess. For wholly owned subsidiary bankings in India, at least 50% of the board members must be nationals. That is correct. So option क्या सही है? Option C. No, option B. Just mark into and correct here. Okay. Next, consider the following statements. Self-help group SHG program was initially initiated by SBI by providing microcredit to financially deprived. लग तो रहा है सही है, but I don't know much about it, so I'll mark it like this. Okay. So what is the focus area in this question? They're saying whether it's SBI or not. Okay, SHG is initiated by SBI or not? Is it RBI? No, I don't really remember. I did not study also, so I can't answer. Yeah, SHG, all members of a group take responsibility for a loan that an individual member takes. That is correct. All members of the group, they take the responsibility. And the RRB and SCB, scheduled commercial banks, they support the self-help groups. Why commercial banks are supporting self-help groups? Oh, this question is very difficult.
See, काफी अजीब है, but do you know SOP analysis? As per this, whenever there is this option none, all three will be wrong. Okay, so option will be either only one or only two. Definitely one statement is wrong. And self-help group, it is such a big initiative that I don't really think SBI is the one which initiated. That must be some all India financial institution or something else. Therefore, the first option is actually wrong. Okay, first option is wrong. It is not SBI, it is NABARD. Okay. Focus area you have identified it correctly, but you need to do your logic now. SBI नहीं हो सकती है. Okay, I have never seen SBI taking such mass initiative, so that's wrong. And next, RRBs and scheduled commercial bank they support SHG. See, there is priority sector lending, and you know that agriculture, yes, they are at least giving 18%. Scheduled commercial banks, they are giving 18% to priority sector lending. 18% of the priority sector lending out of 40% it is given to agriculture. So that agriculture it can be even self-help groups. So why not scheduled commercial bank support SHGs? That is possible. There is possibility. So therefore this is also correct. Option is B. See, whenever there is an option, that option should be correct in all the cases, in all the scenario. Do you think commercial bank will never support SHG? So इसका opposite यही है ना, लेकिन वो इसका opposite statement wrong होती है. So this statement is correct. Now let us see next option. In India, central banks function as the lender of last resort usually refers to. Lender of last resort meaning providing liquidity to banks having a temporary crisis. That is lender of last resort. This is correct. And lending to government to finance financial deficit is utter wrong. Eliminate third option and you need to see first option. Lending to trade and industry bodies when they fail to borrow. This is also wrong. So therefore option 2 B. They are asking about Bank Board Bureau. This was replaced with FSIB, right? Right. They are appointing directors. Okay. The governor. Who is the governor? FSIB का chairperson कौन है? We don't know who is the FSIB chairman, but he is someone who is expertise in finance and other things because he is the one who is appointing the chairpersons and directors of financial institutions, right? So this is what we have learned. Iska chairperson kaun hoga? Some financial expert. Okay. Now the governor of RBI is the chairperson of BBB. See, BBB it was very old, and I think FSIB it was established in the year of FSIB it was established in 2022 only. That is why they asked this question. Okay, they asked a question about BBB. I think they were planning to replace BBB or something. That's why they asked. Currently, it is not even important for you, but for your information, I will tell you. See, anyways, I'm thinking that Bank Board Bureau, it must be similar to FSIB that we know. Therefore, I'm marking first option as wrong and I'm seeing the other options. BBB recommends for the selection of heads of PSB. That's correct. BBB helps the public sector banks in development strategies. That is also correct. It will not help. Just see the opposite statement. It will not help. In all the conditions, it will not help. It seems to be wrong. Therefore, this option is correct. This option is also correct. Option B. Next, consider the following statements. The governor of RBI is appointed by the central bank. That's correct. Certain provisions in the Constitution of India, they're mentioning in the economics. They give the central government the right to issue directions to RBI. ये तो RBI एक्ट में है ना, कॉन्स्टिट्यूशन में कहाँ पे है RBI के बारे में? So that's wrong. The governor of RBI draws his power from RBI Act. That's correct. So 1 and 3 option A. Okay, 1 and 3 right? 1 and 3 fifth option A. Sorry 1 and 3 that's option C not A. Exam में यही होगा, option सही से देखना. Okay, next the next is about what? With reference to urban cooperative banks, consider the following. They are supervised and regulated by local boards, which are set up by state government. Urban banks, they are supervised by RBI, not state government. So the first option will become wrong. What is the second option? Second option, they can issue equity shares and preference shares. See, they cannot issue shares. That is why we are having NU, CL, DB something, right? They are the one who are issuing on behalf of urban cooperative banks. Therefore, I think this is wrong. And next, let's see. They were brought under the purview of Banking Regulation Act through amendment in 1996. Really? According to me, it's a difficult question for me. So I'll tell you a small story about RBI, not RBI, about urban cooperative banks. See what happened. What happened under Banking Regulation of BRA 1949? RBI made an amendment in 1996, and urban cooperative banks, they were under the purview of RBI. So that's how it happened. And later, in year of 2020, urban cooperative banks, they came under the complete purview of RBI. That during 1996, it was dual regulation. Okay, 1996, it was dual regulation. Because it's a cooperative, that doesn't mean only state can control. RBI should also control because it's a bank. Therefore, dual regulation was in 1996, and in 2020, finally, RBI took complete control of urban cooperative banks. So when I see the statement, they were brought under the purview of a Banking Regulation Act 1949 through an amendment in 1996. This statement is correct. Okay, and next thing, they can issue equity shares and preferential. See, NUCB, FCD, whatever you studied, it will help urban cooperative banks to further increase. But that doesn't mean that urban cooperative banks is not even having the power to even issue equity shares and preferential shares. So this is an exemption shock basically. This is also correct. So first statement, it's wrong. So when I eliminated first option, I easily got option B, right? That is very easy. Okay, and next is, let's see the seventh question. Consider the following in terms of short-term credit delivery in the agriculture sector. District central cooperative banks deliver more compared to commercial. As I already said, this triangular structure, PACs, DCCB, etc. Who are delivering more? PACs are delivering more, right? Who are delivering more to PACs? Scheduled commercial banks, they are delivering more to PACs. Okay, this is what you need to know. Next, one of the most important function of DCCB is to provide funds to PACs. That is correct. So only B. Next, interest coverage ratio. It is the ability of bank. It is the ability of bank to pay their loans. Okay, you are checking the interest coverage ratio. Earnings before taxation, EBIT, divided by interest payments. Okay, it helps in understanding the present risk of a firm that a bank is going to give loan to. That is correct. It helps in evaluating the emerging risk of firm that a bank is giving loan to. Arey, kitne baar? Sahi. The higher a borrowing firm's level of interest coverage ratio, the worse is its ability to service its debt. अगर इंटरेस्ट कवरेज रेशियो ज्यादा होगा तो अच्छा एबिलिटी है उसके पास, बट इट इज सेइंग वर्स इज इट्स एबिलिटी. सो 3 इज रॉन्ग. ऑप्शन 1 into option A. if you see NBFCs, so there are different types of NBFCs, right? As I said, the regulation of NBFCs, they are by different regulatory bodies. For example, housing finance companies, HFC, they are also NBFC, but they are not regulated by RBI. They are regulated by National Housing Bank. Okay. So NBFCs, they have different regulations. So I cannot necessarily say that they are RBI or they are SEBI. For example, if you see stock brokering, merchant banking companies, venture capital companies, they are all related to some stocking market, etc. Therefore, they are regulated by SEBI. Mutual funds, those companies also are regulated by SEBI. If you see insurance companies, and they are regulated by IRDA, Insurance Regulatory and Depository Authority. If you see HFC, housing finance companies, we have already studied, they are regulated by National Housing Banks. We have seen this in all India financial institutions. Okay, and chit fund companies, if you see, they are regulated by respective state governments. Okay, and the Nidhi companies, they are regulated by Ministry of Corporate Affairs. So different NBFCs you have. What is Nidhi company? This is important. But before Nidhi company, I'll tell you one thing. NBFC, before any organization, if it want to become NBFC, it must have minimum 20 crore capital. That's all. See, Nidhi companies, they you need to know about them. They are basically for members. It is just like a self-help group. These members, they will get mutual benefit by lending loans. Okay, they are Nidhi companies, and RBI is empowered to regulate these Nidhi companies. But till now, RBI it did not create any regulatory framework for Nidhi companies. So for a company to register itself as a Nidhi company, first of all, how can it happen? It should be a public company, private, not a private company. Only a public company can be a Nidhi company, and to be a Nidhi company, at least minimum 7 members must start it. Okay, next, minimum paid up capital, it must be 50,000. Sorry, not 50,000, 5 lakh, right? 1, 2, 3, 4, 5, 5 lakh. Minimum paid up capital must be 5 lakh. See, you know what is paid up capital again? If you see authorized capital, certain shares are issued and certain shares are not issued. So out of the issued shares, only certain shares are subscribed by the public. That subscribed capital is called paid up capital. Okay, this is what you need to know. The paid up capital must be at least 5 lakh. This is what RBI says. And minimum 7 members must start a Nidhi company. And there are no preference shares. I mean, no preference shares shall be issued. So Nidhi companies, they can be under different names such as Nidhi Permanent Fund, Benefit Fund, Mutual Benefit Fund, Mutual Benefit Company. So all of them, they are basically about Nidhi company only. And yeah, once the Nidhi company has been incorporated, it must follow certain requirements. So minimum number of members should be 200 within 1 year. When they're starting it can be 7, but within 1 year they must become 200 members. Okay, and next, and the net to owned fund, it must be at least 10 lakh or more. Okay, within 1 year, if they are having net to owned fund more than 10 lakhs, and if they are having minimum 200 members in 1 year, then they can be continued as Nidhi company. Okay, and then the ratio of net to owned fund to deposits. Okay, net to owned fund to the deposits, that must not be less than 1/20. Okay, that ratio, net to owned fund to deposit, it must not be more than 1/20. Okay, इसका मतलब क्या है? So deposits must not be less than 20 times of net owned funds. And who is regulating Nidhi companies? They are registered under Companies Act 2013. However, they are regulated under Nidhi Rules 2014 under Ministry of Corporate Affairs. Okay, Nidhi companies, they are regulated by MCA, Ministry of Corporate Affairs. Okay, and they come under the oversight of RBI. So if you are asking regulation, the rules are framed by Ministry of Corporate Affairs. But yeah, the rules of MCA are applicable, but oversight it is RBI. Nidhi shall not accept deposits exceeding 20 times of its net owned assets. ओके, दिस इज द सेम पॉइंट ना. 20 टाइम्स ऑफ इट्स एसेट्स से ज्यादा पैसे निधि के पास आ रही है, तो उसको निधि एक्सेप्ट नहीं करेगी. दैट इज व्हाट दे आर सेइंग. निधि शैल नॉट एक्सेप्ट डिपॉजिट्स एक्सीडिंग 20 टाइम्स ऑफ इट्स नेट ओन्ड एसेट्स. द फिक्स्ड डिपॉजिट्स शैल बी एक्सेप्टेड फॉर मैक्सिमम पीरियड ऑफ 6 मंथ्स एंड मिनिमम पीरियड ऑफ 6 मंथ्स एंड मैक्सिमम ऑफ 60 मंथ्स. दैट मींस 5 इयर्स. सो निधि कंपनीज में जाके तुम फिक्स्ड डिपॉजिट एफडी कर सकते हो, लेकिन दैट एफडी मस्ट बी मेंटेन फॉर हाफ ईयर. दैट मींस फॉर 6 मंथ्स एंड द मैक्सिमम पीरियड इट कैन बी 60 मंथ्स. दैट मींस 5 इयर्स. सो फ्रॉम हाफ ईयर टू 5 इयर्स. ओके, फ्रॉम 0.5 ईयर टू 5 इयर्स. ऐसे याद रखना कि from 0.5 year implies 6 months. From 0.5 year to 5 years, that is the time period for any fixed deposit. And Nidhi companies, they can only accept time deposits and they cannot accept demand deposits. No. Nidhi companies, they can accept demand deposits also. They can accept demand deposits, they can accept time deposits, but the demand deposits, they must be from the members only, not other than members, only members. This is the difference between a Nidhi company and a cooperative society, because both are working for mutual benefit, but I want to know differences. For example, Nidhi company, they are established under Companies Act. So therefore, they are different from cooperative society. They are established under Company Act and they must maintain a minimum capital of rupees 10 lakhs. Whereas the cooperative societies, their origin is from State Cooperative Societies Act or Multi-State Cooperative Societies Act. Okay. Now the purpose of Nidhi companies is to cultivate habit of savings, whereas cooperative, its purpose is to promote cooperation among the members. And Companies Act, Nidhi company, it was therefore a company. It comes under the Ministry of Corporate Affairs. Yeah. Whereas if you see cooperative society, they come under register of cooperative societies. In case of cooperative banks, it would be under dual control of RBI and register of cooperative society. You know, right? Cooperative bank, one is a corporate register of cooperative society, and the other is RBI. You know this. And members are just individual members. Okay, they're just individuals. But okay, they're individuals and cooperatives, leave it. Minimum number of members, 200 members must be there in a Nidhi company. That is mentioned in the Nidhi rules of 2014. Okay, 200 members. But yeah, cooperative society, chota cooperative, 10 to 15 members. This can vary from state to state, and they can accept depositors only from members, Nidhi companies. And similarly, cooperative societies can also accept deposit only from members, but they can accept deposits from public if they get a license of bank. That is possible. And but here in Nidhi company, only members, and they can give loans to only members. Similarly, cooperative societies can also give loans to only members, and they can also give loan to public if they get license of bank. See, public who get license of bank, they can give money to cooperative society, or they can take money from cooperative society. And the Nidhi companies, they can be established throughout the territory of India. They don't have any restriction. But yeah, cooperative society, they are very restricted. And voting rights, if I check, voting rates, they are based on the percentage of shareholding. Voting rates are based upon the percentage of shareholding. But cooperative societies, they have this one member one vote policy in the cooperative society. But Nidhi company, the percentage of shareholding determines your voting right. Now there is this question regarding the Nidhi companies in India. They're permitted to accept deposits and deposits from and lend to the members only. This is correct, and they are societies registered under the Cooperative Societies Act. Now we have Companies Act and they are not societies. Therefore, this is one. Now this is about Nidhi company, regulated by Ministry of Corporate Affairs and supervised by RBI. Chit fund companies, who are regulating chit fund companies, respect to state government. Let's see them. So chit fund companies, I mean chit funds, they are unorganized money market industry. For example, let's say group of investors, they are investing 100. चिट्टी किसी को एक मिलेगा, मतलब let's say total 500, and whoever says that I will take fund for 400 only and I will return 500, etc., they will get the chit. Okay, and that 100 rupees profit, whoever is earning, that will be divided equally among the members. That is chit fund, but it is unregulated. Okay. So there might be some frauds even happening. Therefore, current developments, there is this Chit Funds Amendment Bill 2018, Banking of Unregulated Deposit Schemes and Chit Funds Amendment Bill 2018. So chit funds, they are unregulated, and therefore RBI thought of bringing this bill. And Parliament, I think this bill, I don't know whether it's passed or not. I am not calling chit funds as illegal. Okay, they are legal only. That bill actually was successfully passed. Okay. They are unorganized, but they are legal. This is what you need to know about chit funds. Yes, you can participate in chit funds. If it is a registered chit fund, then of course you can participate. If it is not registered, then no, you should not participate. Okay, now let's see what is Ponzi scheme. Money circulation. Ponzi schemes are money circulation schemes. Okay, basically these schemes promise easy or quick money, and they collect money from you, and they will tell you that we will be giving you higher returns, and in the end they will be collecting many such money, and that money they will be giving to you back. So they will return the money that is collected from someone else. So Ponzi scheme happens in this way, and finally after a period of time, that bank, it will go into bankruptcy. So that is not a bank, that is a general guy or someone who is saying that I will increase your money. That is a Ponzi scheme. So don't be trapped when people are saying you that they will pay you higher returns. One day or the other, that will collapse. Who regulates Ponzi schemes? These schemes are considered as offence under price chits and money circulation schemes. Okay, price chits and money circulation schemes banning act of 1978. This Ponzi scheme, it is considered as an offence. And the regulator, if you are asking, they are monitored and dealt within by the state governments only. Okay. So NBFCs, based upon the scaling also, you can classify them. Base layer, they have less than 10,000 assets, less than 10,000 crore assets, and if they are more than 10,000 crore, then they are middle layer, and you have upper layer. They have further more enhanced regulatory requirements, and then there is top layer. Many NBFCs that I don't want to discuss. I think it as a time waste. For example, gold loan companies, they are also NBFC which accept gold as collateral and give you loans. And you have a NBFC peer-to-peer, P2P. For example, they provide a platform and connect to people. This guy can give loan to this guy. So that can happen peer-to-peer. And investment credit company, NBFCs that are accepting investments and they are selling their shares. Such kind of NBFCs are also seen. There is NBFC factoring again. NBFC factoring implies, see, let's say there is this NBFC. There are two firms, Firm 1 and Firm 2. Firm 2 sold items to Firm 1, and Firm 1 said that after a deferred payment, after a certain time, we will give you money. Not just now, but we are giving you one bill. Okay, come with this bill 2 years, after 2 years. But this Firm 2, it don't want to wait for 2 years. Therefore, it will reach this NBFC and it will sell, and this firm will get cash. So such kind of NBFCs are called NBFC factoring. Okay. But you know what? Each NBFC, it has different requirements. For example, if you see NBFC peer-to-peer, it cannot borrow more than 10 lakhs. Okay, a particular borrower, he cannot borrow more than 10 lakhs across all the platforms. Okay, and a borrower cannot lend more than 50 lakhs across all such platforms. So there are many such requirements that you need to fill in. So you don't need to go in depth about NBFC. So I think you have finished NBFC, non-banks, everything. Let's see non-performing assets. Okay, this is also important. See, assets, they can be standard assets. They can be either standard assets or non-performing assets. Two types. Okay. Let's say standard assets first. So standard assets, they can be classified into two types. One is regular asset, other is a special mention account. Regular asset, these assets are like general income for the bank. They can be through cash, loans, or securities or anything. Other is a special mention account. Special mention account, it is a category of loan account that shows a sign of distress. Okay, so you are thinking that let's say you have given a loan to someone, and that, of course, giving loan is an asset for a bank. So, but that loan, let's say even after 30 days overdue, you did not get it back, then that is SMA 0. Even after 60 days, you did not get it back, that is SMA 1. And even after 90 days, you did not get it back, that is SMA 2. So this is how asset can be classified into regular and special mention account. You are mentioning it special because they can be overdue for 30, 60, 90. Accordingly, you are subcategorizing them again. Okay, they are standard assets. Till now, they did not go into NPA. But after this 90 days, even then the loans are not recovered, then that asset is called non-performing asset. So they are not going to be returned back. You are getting that doubt. So that is non-performing asset. Okay, non-performing asset, it can be divided into again two types: non-agricultural non-performing asset, agricultural non-performing asset. Okay, non-agricultural implies they are substandard asset, they can be doubtful asset, or they can be loss asset. See, after 90 days, if even after 1 year, if that asset is not recovered back, then it is called substandard asset. Okay, after 1 year. If it is more than 1 year, even then that NPA is not returned back, then it is called doubtful. Okay, and after 1 year also, after a period of time, still it is not recovered, then it is called loss asset. Okay, and such loss asset, it is written off by the central government. Okay, waived off. It will be treated as like okay, now it is not your asset anymore. It's gone. So that is what a waive off. Okay, write off. And NPA agriculture. See, you are giving agricultural loans to farmers, but they are not able to pay loans. So even after 2 cropping seasons, farmer did not pay you loan back. Then for short duration crops, you are going to see and for 2 cropping seasons, and for long duration crop, you are going to wait for 1 crop duration. Okay. So this is how NPA is declared: 2 cropping seasons and 1 cropping season. 1 cropping season, for long duration crops and 2 cropping season for short duration crop. And even then it is not written, then it is NPA. That is for agricultural. Okay, 2 shorts, 1 long. And substandard less than 1 year, doubtful more than 1 year. Okay, doubtful more than 1 year. Remember, more than 1 तो doubt होगा ही, उसके बाद तो lost ही है. Substandard implies yeah less than 12. You are still taking it as a this. I mean 90 से ज़्यादा ही है तो चलो थोड़ा सा hope है. That is substandard. And also you have restructured loans. Okay, after NPS you have restructured loans. See, what are restructured loans? The loans that can be converted into equity. The written off in place, they are not even considered as assets of bank anymore. And both of them together, they are covered as stressed assets. NPS, restructured loans, written off, they're all stressed assets. Okay, that is about assets and loans. Now let's see basic concepts related to NPA. Gross NPA implies the liability of a bank. Provisioning implies PCR. Okay. So you're thinking, I have given loans, but certain loans, they can be bad loans. That is why I will put certain funds, certain amount of funds aside. Okay, that provisioning, that is called provisioning. Okay, provisioning is the practice of setting aside funds in expectation of certain bad loans that can happen. Okay, and the PCR must be more than 70% for a healthy bank. Okay, and next, what? Net NPA. Net NPA is nothing but gross NPA minus provisioning. Okay, this is actually good definition for net NPA. Gross NPA minus provisioning. Slippage ratio is the fresh NPAs during that year divided by the standard assets at the beginning of the period. So, what are the NPAs at the beginning of the financial year, and what are the assets that the bank is having? So, NPA divided by asset. That is a slippage ratio. How slippage means how the loans are slipping from us, how the assets are slipping from us. So, how the assets are slipping? They are slipping through NPAs. NPAs divided by standard advances. Standard advances are also called as assets. Let us use this info box to solve an MCQ question. Now, before going to that question, I would like to tell you that we have gross NPA and net NPA, two NPAs, right? So, those formulas are important. GNPA, gross NPA is total NPA of the bank. Total NPA. Net NPA is nothing but the gross NPA minus the provisioning. What is provisioning? Provisioning is nothing but certain percentage of the bank profit that is kept aside. Okay, provisioning is percentage of a bank's profit that is kept aside. Now, the percentages, if they ask there, the confusion arises. Now, if they are asking me gross NPA percentage, I will write it as gross NPA divided by total loans. Okay, and if they ask me net NPA percentage, I'm going to write net NPA divided by total loans. So denominator it has total loans. Okay, but if they ask me provisioning coverage ratio PCR, then I'm going to write numerator it is the same provisioning, but denominator I'm not going to write total loans. I am going to write gross NPA. This is important. A lot of people write it as total loans. No, these two are having total loans in the denominator, but PCR it is having gross NPA in the denominator. Now let us solve an MCQ. Suppose there is a bank with this year's profit of 500 crore. Total bank credit is 1000 crore. Rupees 100 crore worth of assets have crossed the stage of standard asset. Calculate the following gross NPA. देखो मुझे जो इन्फॉर्मेशन गिवन है बहुत कंफ्यूजिंग लग रहा है, बट आई नो ग्रॉस एनपीए का फॉर्मूला होता है टोटल एनपीए. तो क्वेश्चन से मुझे टोटल एनपीए क्या लग रहा है 100 करोड़, बिकॉज 100 करोड़ वर्थ ऑफ एसेट्स हैव क्रॉस्ड द स्टैंडर्ड एसेट. तो वो बन गया ना, क्या बन गया, एनपीए बन गया ना. सो आई एम गोइंग टू राइट इट एज 100 करोड़. ओके, व्हाट इज ग्रॉस एनपीए परसेंटेज दैट वी हैव सीन जस्ट नाउ? Gross NPA percentage is gross NPA divided by the total loans. What is the total loan that you have taken? The total bank credit is 1000 crore. Okay, बैंक ने कितना लोन दिया 1000 करोड़. तो 1000 करोड़ से डिवाइड करेंगे तो कितना आएगा इन द एंड? दैट इज 10%, right? 1 by 10 into 100 will become 10%. So that will be the gross NPA percentage. The next, net NPA. Net NPA is gross NPA minus provisioning. What is the gross NPA? It is 100 crore. Minus you need to do provisioning. And how much is the provisioning? That is not mentioned in the question. तो हम assume करेंगे. हम क्या assume करेंगे? In general scenario, ना provisioning coverage ratio, it is, if not given, I think it is usually taken as 70%. I heard somewhere. So therefore, if provisioning coverage ratio is 70%, what is the formula? It is nothing but provisioning divided by the gross NPA. So this is gross NPA, very important. Now we are going to find out our provisioning, which is 0.7 times gross NPA that we calculated as 100 crore. So it's going to be 70 crore. Now net NPA is how much? Gross NPA, which is 100 crore minus provisioning 70 crore, which is going to be 30 crore. Okay. Next, net NPA. Net NPA is an NPA 30 crore divided by the total loans. Total loans कितना? 1000 crore. So what is the answer? 3 by 10 into 100, which is 30%. So 30% is my net NPA. And the final thing, what is provisioning? PCR, which we have already assumed as 70% for calculating all of them. Okay. Following is correct about RRB. State government has majority stake in RRB. See, you know, right? 50 is to 15 is to 35. 50 kiska central government, 15 state government, and 35 sponsor. Okay. Now, if RRBs, if they're opening IPOs, then they have a new rule that this 50 is to 15 is to 35. Center and state, इनका stake 51% से कम नहीं होना चाहिए. Got it? Anyways, now state government it is 15% that you know. So therefore this is wrong. Central government is the highest, 50%. Next, gross NPA and net NPA of RRBs have declined recently. Not only RRBs, but for all it has declined. This is correct. There are more than 30 RRBs. See, central government it has come up with a recent mission, like one state, one RRB. So एक state में एक RRB. Now we have 28 states and 3 union territories. So they were able to implement this in 26 states and 2 union territories. I mean UTs with legislature. I'm talking about UTs with legislature. So 26 states, 2 UTs. Total कितना RRBs हुआ? 28 RRBs. So now currently we have 28 RRB, which is less than 30. Broad समझ के tick मत करना. Okay, third statement goes wrong. Only one option is correct. Which of the following statement is correct regarding FDI from countries sharing land border with India? Okay, that is recently in the news. That is why they have asked the question. I think initially it used to be only via government route, but now they have changed it. Now they are saying automatic it is allowed. Automatic is allowed. 10% through automation route is allowed, but that will be non-controlling state. कोई control नहीं होना चाहिए bordering states का. So controlling goes wrong. That is non-controlling, and that can be done through both automatic and government route. for states, I mean for countries sharing land border with India. Okay, the first option to galat hai. Third option is also wrong. Only one option is correct. Non-controlling stake implies you are going to give them DVR, differential voting rights. Usually, one vote, one value. That is the principle, but different value, that is differential voting right. That's all. So you are preventing hostile countries. I mean, the countries which might be threat to you, let's say Pakistan or Bangladesh. You are preventing them, and if they are having controlling stake now, what can happen? They might convert their loan. Sorry, they might convert their equities. Or they might convert their bonds into equities or whatever. They can do that, right? That's why we have given them non-controlling stake, and they don't even have the voting right. They cannot take over your company. Got it? Now we have another question. Suppose SBI's total credit in 2024 was 500 crore. In 2025, how much on lending to NBFCs can be done by SBI to fulfill PSL criteria? तो NBFC को PSL क्राइटेरिया फुलफिल करना पड़ेगा क्योंकि दे हैव कम टू 2025. ओके, तो सब लोग यही चूज करेंगे कि 40% ऑफ, पहले कैलकुलेट करेंगे कोई भी SBI का PSL कितना का है, कितने का है, 40% ऑफ 500 करोड़, दैट इज द PSL. तो कितना, दैट इज अप्रोक्सीमेटली 20 करोड़, राइट? हाउ आई डिड सो क्विकली? 40% का मतलब क्या होता है? 2/5. हाँ, 2/5 into 500. That is 200 crore. Okay, and next, that is the SBI priority sector lending objective. But they are asking how much on lending to NBFCs can be done. NBFC on lending, we have seen the maximum cap is 5%. So that will be 5% of total PSL, 200 crore, which is how much? 10 crore. So the answer will be C. बहुत लोग जल्दबाजी में ये करेंगे, 500 देखेंगे नंबर, उसके बाद 40% everyone knows, so they are going to do 5 4s are 20 and write 20 crore. कुछ भी करेंगे? No, you need to remember this 5% cap, very important. See, these ease reforms, they started in 2018 to make public sector banks more responsive and more responsible, as you can see, but they continued till now, and finally this became very important for our current affairs. Okay, let us see from the beginning so that you can understand the ending. Ease 1.0, that initial phase, right? So it focused on the responsible public sector bankings. तो किसके ऊपर फोकस करेंगे? कस्टमर सर्विस के ऊपर या फिर इंप्रूवमेंट एंड अकाउंटेबिलिटी के ऊपर फोकस करेंगे. नेक्स्ट वी हैड Ease 2.0 from 2019 to 20. That is clear and smart banking. That means it adopts a smart process and it ensures to reduce NPAs. So basically clean का मतलब होता है clear your NPA, and smart का मतलब होता है think smart. Okay, clean and smart banking. Next we have Ease 3.0. 3.0, that's during the COVID, as you can see, 2020 to 2021. तो COVID के टाइम पे collaboration की requirement है. That is why they came up with smart tech enabled banking for aspiring India. So collaboration की requirement है, so we adopted financial inclusion and along with technology. So smart tech enabled banking for aspiring India. Technology plus financial inclusion. That is Ease 3.0. COVID, during COVID we need collaboration, and even after the COVID we need a little bit of collaboration. So think of it like that. Ease 4.0 from 2021 to 2022, tech enabled, simplified and collaborative banking. Great, almost थोड़ा similar. And then Ease 5.0 2022 to 2023, you are having enhanced digital experience. And Ease 6.0 2023 to 2024, customer friendly banking. Chalo, we finally enter 2023. Now enhanced digital, everything is over. Now we require modern capabilities along with user friendly. See, you are having digital experience and all, okay, but if it is not user friendly and if users are not understanding, what's the use? Now we have generative AI, it talks to users, it is like a talky friend for us, right? So therefore in Ease 6.0 they focused on customer friendly banking, that is to improve the user interface. Next, the important schemes come here. I mean Ease 7.0 and Ease 8.0, they are important because because of what? Because this is in current affairs, that is Viksit Bharat. So customer delight and resilient banking to support Viksit Bharat. And then we have Ease 8.0, risk management. So सब खत्म होने के बाद finally risk management के ऊपर आता है, risk resilience, innovation and excellence. So focus that Ease 7.0 and Ease 8.0 are talking about risk resilient and customer delight banking. Why risk के बारे में बात कर रहे हैं? क्योंकि ट्रम्प है ना, ट्रम्प की वजह से he is doing lot of tariff and it is impacting Indian credit ecosystem. So risk resilience हमें चाहिए. That is the focus for Ease 8.0, which is very recent, 2025 2026. You can remember risk. Ease 7.0, it is resilient banking again. Notice that all of them, they are having number Ease 1.0 to 7.0, but if you see this year, I mean last financial year, Ease 8.0, it is given a name. What is the name? Ease Rise. एक rise की जरूरत है क्योंकि रिस्क है सोसाइटी में. Okay, Ease Rise, risk and resilience, innovation and excellence. Asset reconstruction companies, they are companies who take loans. I mean the companies who bring back the loans to the bank back. I mean loan वसूल చేసే companies. Okay, basically asset reconstruction companies, they send agents and they draw. I mean they recover the loans. Okay, they are sometimes also called as bad banks. Bad banks, they recover loans. Now let us see certain actions taken by the RBI to combat stressed asset problems. Lok Adalat. So to recover loans up to 20 lakhs, you can go to Lok Adalat, and Lok Adalat, even if there are check bouncings, etc., Lok Adalat will take care of such issues. Okay, Lok Adalat, they are statutory bodies established under Legal Services Authorities Act of 1987. LLSA, Legal LASA, I think. Legal Services Authorities Act 1987. Right? Okay, they can recover loans up to 20 lakhs and they can also take up cases of checks bouncing. And next we have Debt Recovery Tribunal 1993. Debt Recovery Tribunal and Debt Recovery Appellate Tribunals, they are listed under Recovery of Debts and Bankruptcy Act of 1993. This act provided statutory status to this Debt Recovery Tribunal. Basically, after 2018, it is said that more than 20 lakhs, I mean less than up to 20 lakhs, you can go to Debt Recovery Tribunal. I think it's the same for Lok Adalat also. Up to 20 lakhs, if there is any problem, you can go to Debt Recovery Tribunal and Lok Adalats. So banks and banks can go to, not only banks but financial institutions, they can go to Lok Adalat and DRTs to recover the loans back up to 20 lakhs. But you know there is a mild difference between a DRT and what? Lok Adalat. Okay, I'll tell you. There is the SARFAESI 2002, Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act of 2002. So for what RBI thought is that, see, we will introduce this act, and after this, what will happen? The courts will not be interfered. So SARFAESI Act, this act was passed by the parliament in hopes that the burden on court will be reduced. Okay, first, when a loan is classified as NPA, a notice will be sent to borrower, and if a borrower fails to comply, then what is going to happen? His collateral will be there, right? Of course, he's going to submit some collateral for that loan. So that collateral will be liquidized. Okay, that is, or else the ownership will be transferred to someone new. The rights of ownership will also be transferred. So that such things can happen. So this act was passed to reduce the burden on courts. Okay. After that, let's say that the collateral value, it did not match with the actual value. Let's say it's 500 crore is the loan, but the collateral, it is only 400 crore. So in such scenario, you can approach a debt recovery tribunal, and in such cases, it will give a judgment telling that the creditor, he must get money from. It will suggest guidelines on how the extra 100 crore can be recovered back. Along with SARFAESI 2002, we also have ARC 2002, asset reconstruction companies. You already studied, they recover loans from people. And asset reconstruction company, they function under the supervision and control of RBI. So if asset reconstruction company wants, it can do one thing. जो भी collateral है, ARC can send it even for auction also, or else they can participate in the auctions conducted by banks also. So ARC has many powers. You know what is strategic debt restructuring? Restructuring, it is you are converting loans into equities. That is strategic debt restructuring. It was introduced in 2015. That's all. Okay. And what you do, basically, whatever bad loans that the company gave, the company is not able to return, right? So the company will auction, and the company will auction what? The company will auction the equities of the company. RBI will auction the equities of the company, and whoever pays the highest bid, they will be given that equity of the company. And as for that, whatever equity is there, you are getting money, right? That money will be used to give back loans to the people who have borrowed from that company. That's all. Okay, that is how strategic debt restructuring works. But yeah, for this to happen, the banks must find a buyer within 18 months. Okay, one and a half year, right? Within 1.5 years, banks must find. If banks were not able to find, then that loan that a bank has given, it will be classified as NPA. I mean, only within this 18-month period only that this thing will happen, SDR. And after that, your loan will not be recovered anymore. Okay, and you have 5/25 refinancing of infrastructure scheme. What is this? This scheme was introduced in 2015. 5 implies inflation adjusted for every 5 years. 25 matlab amortization period is extended to 25 years. It means, for example, if a lender has given loan, but that loan is not returned back, then what can RBI do? It can refinance the infrastructure. I mean, see, infrastructure schemes, when they can be very large. So that period, it can be extended. For example, let's say you need to return back within 5 years, but this amortization period, it will extend up to 25 years, and for every 5 years adjusted with inflation, you need to pay interest, and after 25 years you need to pay the original amount. That is 5/25 refinancing of infrastructure schemes. So infrastructure, it's good for the economy. That's why RBI has come up with it. Okay, to extend the period of amortization. Okay, next. Asset quality review 2015. RBI emphasized AQR to verify that banks were assessing loans in line with RBI loan classification rule. That's all. So whether the loans are in aligning with the RBI loan classification rule, that's why RBI introduced asset quality review 2015. Now, 2 important schemes, Mission Indradhanush and first Mission Indradhanush. Okay, Mission Indradhanush is also called ABCDEFG reform. Basically, public sector banks, they are facing NPA issues and all. Therefore, PJ Nayak committee, it suggested for banking sector reforms. So Mission Indradhanush, PJ Nayak committee. So what did it suggest? 7 ABCDEFG reforms. So A stands for appointments. Who shall appoint? I mean, generally, the managing director and chairman positions, they must be held as the same individuals of public sector banks. This is what it is suggested. And who shall be appointing? It is B. B for Banks Board Bureau. However, in 2022, it was replaced with FSIB, Financial Services Institution Bureau. And we have C for capitalization. Capitalization implies capital infusion. If there is no minimum capital, then therefore, as per Basel III norm, gradual capital infusion must be sent to debt laden banks. So उसके लिए budget कितना दिया? 25,000 crore. Okay, that is A, B, C, capitalization. D for de-stressing the PSBs. So government restructures government can restructure the loans to de-stress the public sector bank. Restructure implies converting loans into equities. Okay, and next, empowerment. Empowerment implies you are hiring more manpower, and you are reducing the government interference in the public sector banks. That is how you can empower the public sector banks. And next, framework of accountability. How you are increasing accountability by introducing key performance indicators. And next, governance reforms. Government reforms, you have Gyan Sangam. Gyan Sangam, it will make sure of risk management and financial inclusion. Okay, this is ABCDFG reforms by the Mission Indradhanush. However, there is Indradhanush 2.0 which replaced the strategy with 4R. So what is this 4R strategy? It talks about recognition. Recognition implies banks are required to accurately value their assets, aligning with the true value. So the assets that bank is showing, it must align with actually the true value. And then recapitalization implies equity infusion. Okay, if they are debt laden, equity must be, those debt laden banks must be provided with capital infusion. Okay, and next, resolution. Resolution implies if there are stressed assets, those stressed assets must be recovered either by selling or rehabilitating. Implies making them again into proper original condition. You can convert them by converting loans into equities, whatever you can do, but there must be resolution of the stressed assets of banks. And next, reforms. See, you are doing resolution, it's fine, but such things must not be repeated again. Okay, that is a reform. That is about Mission Indradhanush. Mission Indradhanush, it was in 2015, and in 2016 there was Insolvency and Bankruptcy Code. There are 4 pillars for IBC. Insolvency professionals must be there. Information utility and adjudication. BI, that is Insolvency and Bankruptcy Board of India. What is Insolvency and Bankruptcy Board of India? So this board, it will set up infrastructure, and what will it do? It will also provide a provision for insolvency provision professionals and information utilities. See, let us see insolvency bankruptcy code. Let's say there is a default of payment of at least minimum 1 crore rupee, and anyone, either a creditor or debitor, they can initiate and they can apply for insolvency. And after application for insolvency, there will be an adjudicating authority. Adjudicating authority can be either NCLT or either DRT. NCLT is National Company Law Tribunal. And who is this other adjudicating body? This is DRT, Debt Recovery Tribunal, that you already know. So any one of them, either NCLT or DRT, they can take up this case. Okay. And if it is for corporates, it's usually NCLT, and if it is for individuals, it is usually DRT. And DRT, we have seen that they can take maximum up to 20 lakh rupee wala cases. Okay, if it is for corporate, it's very large, therefore it is NCLT, National Company Law Tribunal. So this NCLT adjudicating body, it will appoint a professional first. Who is that professional called? It is IP, I mean insolvency professional, or it will appoint interim solvency professional, whoever it can be. Okay, if it is insolvency professional, then he will assess the financial position of the company and will finally decide. If it is interim solvency professional, then he will control the firm's assets, or he will create a COC, committee on creditors, and he will decide whether to restructure or liquidate. Okay, that is how it works. So basically, anyone, creditor or debitor, he can raise the complaint, and the adjudicating authority will be appointed. If it is for a corporate, then the adjudicating authority will be NCLT, National Company Law Tribunal, and they will be appointing insolvency professional or interim insolvency professional. Okay, they are going to create committee on creditors, and they are going to decide or restructure, whether to restructure or liquidate. Now let us see how proceeds are distributed among creditors under the IBC. For example, see, you have given money to this company, and this company not returned you back. So of course liquidation should happen, right? So what are the type of creditors, how the waterfall approach is going to happen during liquidation? That is what you need to know. So creditors, they can be financial creditors and operational creditors. Okay, financial creditors are someone who gave money to that company. They can be banks or lenders, or they can be bond holders also. Okay, they have given money to the company. Financial creditors, again, they can be classified into two: secured and unsecured. Secured implies they have certain collateral of the company, and unsecured implies they just gave money to the company without even taking any collateral. Okay. And who are the next? Next is the operational creditors. I mean, for example, the company took certain goods and services, and it said that it will pay them loans, but it did not. I mean, it will pay the money, but it said that I'll pay you on a later date after 1 year, but still it did not pay. Delayed payments of goods and services, they are also operational creditors. And also employment. For example, you have employee. You are an employee of the company and you did not get your salary. The salary is pending. Therefore, you are also an operational creditor to the company. So you are all operational creditors. Now the waterfall approach is secured financial creditors. They will be prioritized over unsecured. क्योंकि उनके पास कोलैटरल है ना, तो पहले उसको प्रायोरिटी दिया जाएगा. ठीक है. Secured financial creditor, they will be given first priority, and then the liquid assets, they will be given to unsecured financial creditor. अगर उसके बाद भी थोड़ा पैसा बचता है liquidation के बाद, तो वो जाएगा government use to the government, and finally operational creditors will be getting the money. Okay, that is how the waterfall approach given in the insolvency bankruptcy code. And later we had Para 2017. This was only on the paper, and it was never actually implemented. It was supposed to be bad bank. Para implies public sector asset rehabilitation agency. It was only on the paper, so just leave it. And next we had in 2017 only we had this prompt corrective action, PCA.
Looking into the latest circular, RBI, PCA and NABARD. Okay, see, RBI sets PCA, but NABARD, it sets some other parameters for regional rural banks and regional cooperative banks. I mean, okay, now let us see the latest parameters of the RBI PCA framework. Now for the scheduled commercial banks, we are only having capital adequacy ratio, that is CRAR. Okay, capital to risk weighted asset ratio. Okay, and then asset quality, that is nothing but NNPA, net non-performing advances, and leverage, that is leverage ratio tier 1 by tier 1 plus tier 2. How easily you can convert your capital into liquid. Got it? Capital to risk weighted asset ratio, net non-performing advances, and you have leverage ratio. These three are for scheduled commercial banks, and we also have non-banking financial companies. For non-banking financial companies also this apply, but it is for not all the non-banking. See, NBFC 2, 3, 4. I mean, they are at the top level, so they are having they are under the PCA framework. But if you see the base layer NBFC, which is called NBFC BL base level, that NBFC, it is excluded from prompt corrective action, and the rest of the NBFC upper layer, middle layer, etc. They are all having prompt corrective framework. So for that we are only going to see CAR and an NPA. So remember, for NBFC only two parameters, that is CAR and PFCA. But for if it is scheduled commercial banks, we are having three parameters. The third parameter is the leverage ratio. And for primary urban cooperative banks also, we are having these three. For primary urban cooperative banks, we are having these three. Got it? That is effective from April 1st, 2025. Okay. So now I'm asking you, and it is covered under PCA framework. Scheduled commercial banks, it is excluding regional rural banks, small finance banks and payment banks. So small finance banks and payment banks, the regional rural banks are eliminated. Why? Because for regional rural banks, we are already having what? We are already having NABARD. NABARD is setting something else. So that is about scheduled commercial banks. And in non-banking financial companies, it is including only the middle, upper and top layers. That is, it is basically excluding the base layer NBFC. So remember what are all being excluded: small finance bank and payment banks, regional rural banks are also excluded, and we have base layer NBFCs that are also being excluded, and we have primary urban cooperative banks. So that is for which? That is for only tier 2, tier 3, tier 4. They are covered under PCA framework. So basically it is eliminating the base level again. So here also base layer NBFC is eliminated, here also base level, that is tier 1 urban cooperative bank, it is eliminated. Okay, I think it is clear, right? Yes, it is clear. Primary urban cooperative bank is also clear, and these are the three that are covered in the PCA framework. If you see NABARD equivalent framework, so that is talking about regional rural banks and rural cooperative banks. Regional rural banks and rural cooperative banks. So basically for regional rural bank, NABARD is setting SAF, supervisory action framework, and for rural cooperative banks, NABARD is setting TAF, that is turnaround plan. So we are having TAP for rural cooperative banks, and we are having SAF, that is supervisory action framework for RRB. So RRB or RCB, regional cooperative banks, both of them, they are not having PCA, and they are having NABARD ka SAF and TAP. Got it?
So this is what you need to know. Basically, this is very important. RRB, payment banks, SFB, NBFC base layer, UCB tier 1, they are all eliminated. Very important to memorize. Okay, and this is directly from the RBI circular. And remember that profitability, return on asset, it is not there anymore. It was removed in the RBI revised 2021-2022 framework, and we are only having these three: capital to risk weighted asset ratio, asset quality, that is net NPA, and finally we are having leverage ratio as the parameters for the scheduled commercial banks. And for NBFC, we are having only CAR and NNPA. NNPA, it is also called asset quality. So if a question gives asset quality, don't please stick it mark as wrong. Okay. So till now we have discussed all the actions that RBI has taken, the steps that are taken by the RBI, right? Now let us see the performance, how they performed and how the NPA recovery happened. So IBC, that is a big setup, as you have noticed. It provides for adjudicating authority who can appoint the case to a debt recovery tribunal or else to some NCLT if it is for cooperatives or companies, and then there is some other mechanism there. So it's a big setup in overall. Therefore, IBC is definitely going to have the largest NPA recovery compared to the rest of everything. That is approximately 30 to 35%. Very important. So basically, as per economic survey in the financial year 2025 to 2026, let's say IBC के पास 100% का बैड एसेट्स है, उससे कितना रिकवर कर पाया? 35%. इसका मतलब क्या निकलता है? हेयर कट कितना होगा? हेयर कट would be 65%. Okay. So the recovery rate is 35%. That means approximately 65% is the haircut. Anyways, 35% recovery from the bad assets. It's really great. That means it approximately resolved 12 lakh crore, more than 12 lakh crore. So the stats have changed. Now the next we see SURFACE. Through SURFACE, we can see 22% recovery rate is observed. And next we see BRT, debt recovery tribunal, 7%. So tell me what's the difference between SURFACE and DRT? See, there is a minor difference as we have seen. SURFACE, just remember like a surface. Surface पे क्या होगा? Loan equal to collateral. Okay. अगर loan equal to collateral, तो SURFACE handle करेगा. But if loan is greater than collateral, तो उसके लिए कुछ और मैकेनिज्म है, कोर्ट में जाना पड़ेगा. So you need to go to debt recovery tribunal where it is going to handle cases from 10 to 20 lakh. Okay, right? And then we have Lok Adalat, which is very old, Legal Services Authority Act, right? Which is 1987. तो उसमें कितना 3%, बहुत पुराना है, कोई नहीं जा रहा होगा. That's why it is 3%. Debt recovery, that is also very old. ये लोक अदालत कब का है? 1987, बहुत पुराना हो गया. And then debt recovery tribunal 1993, just थोड़ा सा मॉडर्न है लोक अदालत से कंपैरेटिवली. और SURFACE, it's better, which year 2002. So ये नया है, इसलिए शायद लोग SURFACE के पास जा रहा होगा. That is why it is 22. Remember it like that. Okay. Anyways, as per me, it is easy to resolve cases where loan equal to collateral compared to loan amount greater than collateral. उसके लिए collateral को बेचना पड़ेगा and 60 days का एक नोटिस बेचना पड़ेगा ना. SURFACE में वही होगा ना. SURFACE में लोन इक्वल टू कोलैटरल. तो यहाँ पे क्या होगा कि 60 डे का नोटिस भेज दोगे. नोटिस भेजने के बाद अगर कोई रिप्लाई नहीं आता है तो विदाउट द अप्रूवल ओनली यू विल जस्ट सेल ऑफ एंड यू विल क्लियर दिस लोन. दैट इज इजी. बट इन डेट रिकवरी ट्रिब्यूनल लोन अमाउंट इज ग्रेटर देन कोलैटरल, सो इट्स नॉट easy. You even if you sell, the amount is not sufficient, so you need to go to the court. That's why I think it is 7%. Okay, numbers you need to memorize for the exam. Great. IBC का नंबर तो याद रखना पड़ेगा. In the last financial year, FY 2025-26, we have seen 35% of recovery with approximately more than 12 lakh crore of the cases being resolved. If you see bad bank ecosystem in India, we have NARCL, National Asset Reconstruction Company Limited. So the majority of its stake is from the government. Therefore, it's a majorly public sector. Now we have IDRCL again. That is also a bad bank, but majorly it's a private because majority of 51% of stake it is held by private banks. Okay. We have two. National. It is National Asset Reconstruction Company in place. It's a public sector. And if it is India Debt Resolution Company Limited, then it is a private. Usually I said that if it is mentioned limited, it will be public only. Therefore, it is public. And here there is no private mention, but still it's private. So whatever I said you about public and private, it is not in every sense. Don't take it in all senses, but because that logic went wrong here. So see, there are certain challenges. For example, IDRCL, which is a majorly private stake, it is engaged in the resolution of stressed assets, whereas NARCL, it is the ultimate decision body. Therefore, even if IDRCL takes some decisions, it is again the NARCL who is going to finally take the final decision. So that's how it works. IDRCL, it works in collaboration with NARCL. Let us see different UPI types. Okay. First we have standard UPI. What is standard UPI? The UPI that we regularly use, and the key feature is that you can only do up to 1 lakh per transaction. Okay, and we have UPI Lite. What is the difference between UPI and UPI Lite? It is lightweight on device wallet. Implies for daily small purchases, you can use UPI Lite for small chota shopping. Okay, 500 rupee per transaction, and you need not dial any pin before doing transaction. Okay, and the daily limit it is 1 lakh, but yeah, for per transaction it is 500. Okay. That is chota wala UPI. Anyhow, both of them they are for our residents only. If you are doing chota UPI payments, then you can use UPI Lite for small shoppings, and for standard regular UPI payments, you can use standard UPI. And there is UPI X. UPI Lite X implies no. What is no? No network. No network. Okay, X. So it is offline version of UPI Lite. It works without internet, and it is usually for people in rural areas and areas of low connectivity, or people who are living in the hilly areas. UPI Lite X. And you have UPI 123 Pay. 123 Pay. 123 dial pad कहाँ पे होगा? डब्बा फोन है ना 1234, which is not a smartphone. So for them this 123 Pay is used. So I think they will be dialing 123, and accordingly they can do UPI payment, something like that. So it is for users without a smartphone. Okay. That works via missed call. You can do missed call or SMS for transaction to happen. Okay, we have UPI International. They are for global UPI payments. Only some countries like Singapore, Europe, Nepal, Bhutan, Sri Lanka, Mauritius, they accept Indian UPI. Okay, you can do UPI payments globally. That is UPI International. And you have Hello UPI. So you are just going to say Hello UPI, Hello Siri, Hello UPI. So if you say that it is a voice enabled UPI, and accordingly you can do voice enabled payments. Okay, that is about UPI. Let us see about transactions. See, you have NEFT, RTGS, IMPS. They are very important. First, you need to know National Electronic Fund Transfer. So it is fund. Fund implies mass bulk. So therefore, you know what? There is no maximum transfer value. There is no limit actually, but minimum 1 rupee वो तो है ही. And then if you want to transfer, of course, 1 rupee तो transfer करना पड़ेगा ना. So minimum transfer value is 1 rupee and maximum is no limit. But you know what? Since fund is bulk, therefore they cannot be transferred immediately. And based on the batch wise or half an hour basis, the funds will be transferred from bank. Okay, that is how it works. The payment options, they can be online and offline. Just leave it. You know, the settlement, it is based on the half an hour basis. Okay, that is about NEFT. And all these NEFT, RTGS, IMPS, they are 24/7 available. Okay. Next is RTGS, real time gross settlement. Since it is real time, that means it is instant. So only NEFT works on half an hour basis. The next everything, they are very instant. For example, IMPS, if you see immediate payment service, they are also very instant. And real time gross settlements, gross implies large amount. Okay, large amount implies, see, NEFT is not large exactly to be precise. NEFT का minimum 1 रुपए भी कर सकते हैं, लेकिन fund पे होगा. Half an hour batch wise fund. Remember this. Half an hour basis पे होगा. But real time gross is very large. Therefore minimum 2 lakh. Okay, minimum 2 lakh rupee you need to pay, and there is no maximum transfer value. And IMPS minimum 1 rupee and maximum it is 5 lakh rupee. Okay. I mean, per day you can transfer 5 lakh and minimum there is 1 rupee. So actually in immediate payment you are doing immediately, but you know what? I'm putting a restriction of 5 lakh for you. Okay. So NEFT, there is no upper limit. RTGS, there is no upper limit. And IMPS, there is an upper limit of 5 lakh rupee. Okay. Immediate payment service, there is upper limit. And real time gross and immediate, they are all immediate, they are all real time. Therefore, there is a immediate transfer of money. But you know, NEFT is a batch wise and it is very slow. It is a fund transfer on a half an hour basis. Okay. And next, who are the service providers? See, for NEFT and RTGS, the banks are the service providers. But if you're asking me about IMPS, prepaid payment instruments are there, right? PPIs, they are going to provide you service. Okay. And who is regulating NEFT and RTGS? Since the service is provided by banks, RBI is the one who is going to control NEFT and RTGS. But if it is IMPS, they are payment services, right? Therefore, they are controlled by NPCI, National Payment Corporation of India. NPCI is going to control payment services of IMPS, immediate payment services. Okay. And usually NEFT and RTGS, they are used by retail customers and businessmen. I mean, NEFT, it is used by retail customers only. But RTGS, it is used by businessmen, because minimum transfer value is only 2 lakh and they want to transfer it very immediately, that large amount. Therefore, they are generally used by the businessmen. Okay. And IMPS, it is just retail customers only, and they are regulated under NPCI. What is NPCI, by the way? NPCI is National Payment Corporation of India. It is an initiative launched by RBI and IBA, Indian Banks Association. Okay, the founder of NPCI, National Payment Corporation of India, is Payment and Settlement Act of 2007, and it is incorporated under not for profit company. So it is incorporated under not for profit company under the provisions of Companies Act of 2013. Okay, it is an umbrella organization for retail payments and settlement system, and its headquarters is in Mumbai. Okay, that is about NPCI. Now you have UPI. What is UPI? UPI, it powers multiple bank accounts into single app. For example, you have Paytm, GPay, whatever is there, they are all UPI payments, unified payment interface. So even if it is Paytm or GIM or PhonePe, whatever it is there, they are all linked with UPI, unified payment interface. Okay, it is an advanced version of IMPS. Now you have BIM UPI. What is it? It is even more advanced than UPI. In BIM UPI, you need not recharge your wallet. So initially for UPI, you used to always recharge your wallet, and accordingly you used to pay. But for BIM UPI, it means money is directly going to be deducted from your bank account. Okay, and it was developed in 2016 by NPCI only. BIM UPI, it was developed by the NPCI only. Okay, IMPS, UPI, BIM UPI, everything I think it is developed under NPCI from here on. And you have NACH. NACH is National Automated Clearing House. So for bulk transactions like subsidies and dividends, they are through NACH, National Automated Clearing House. And you have NETC, National Electronic Toll Transfer, enables customer use FASTag as a payment mode. See, it is a clearing house. Therefore, if you want to do any bulk transaction for subsidies and dividends, mainly लोगों को farmers को पैसे देना है ना, तो वो कैसे होगा? NACH से होगा. Or else people must get money, interest payment, salary, pensions, subsidies, all of them, they are NACH, National Automated Clearing House. Electronic toll transfer in place, FASTag payment mode. For example, consumers, they want to reduce the fuel consumption, and they can use this TT, I think, National Electronic Toll Transfer. Okay, it enables customer to use FASTag as payment mode. I think there is this FASTag on the car, and you need not stop the car. If there is this FASTag on your card, you can easily do the payment when you go near a toll. That is NETC. I think now you are clear with all the types of payments. There are 7 ATM colors. Okay, basically when you see an ATM color, you need to know who is operating and for what that ATM is being operated. For example, if there is white label ATM, it means ATM is owned by non-banking entity. Okay, it's not a bank, it's a white check, so it's not a bank. Non-banking entity, white ATM implies non-banking entity. Okay, and next, what if it is a brown labeled ATM? If it is brown, then it is saying that operations are outsourced. Business outsourced, operations outsourced imply the bank is not performing the ATM, some other third party it is performing. Okay, that is brown. So brown implies booked by someone, remember like that. I mean, some third party is third party booked this ATM. Okay, and next you have orange. Orange implies money is in form of shares. Okay, so orange labeled ATM implies you can transact shares here. Okay, and next green is agricultural transaction. Yellow is e-commerce. So yellow, orange, they are for money. Yellow is e-commerce and orange shares. And pink is women banking. Okay, pink label ATM for women. I think women can use that ATM. So finally they are the different 7 color ATMs. There is a question on e-rupee and e-rupee. Okay, what is e-rupee? E-rupee is a person and person specific. I mean, purpose and person specific. I mean, say rupee is just like a digital rupee, but rupee, it's like a government sent you some money, and that money can be only used for medical purpose, not for anything else. So person and purpose specific. That is e-rupee. And e-rupee implies a central bank digital currency, and it is a digital rupee issued by the RBI. That's all. So e-rupee is just a digital rupee issued by the RBI. Okay, and they are different from UPI because UPI involves transfer of physical currency, but e-rupee, it is a digital rupee issued by the RBI. So this is about central bank digital currency. They are just digital rupee issued by RBI, which is different from UPI. Okay, and we have CBDC, which should be compared with a cryptocurrency. Okay, CBDC, it is issued by central bank, therefore it is centralized, whereas cryptocurrency, it is decentralized. So CBDCs, they are legal tender because they are from RBI, right? Cryptocurrency, they are not legal tender. At least in India, they are not legal tender. And CBDCs, they are regulated by RBI, and cryptocurrency, they are very difficult to regulate. And CBDC, they have same value as physical currency. And cryptocurrency, their value changes based upon demand and supply. Okay, whereas CBDC, if 1 rupee है तो 1 rupee ही है digital currency का value भी. But cryptocurrency, its value changes based upon the demand and supply. And there is a question on merchant discount rate. What is it? It is the charge to a merchant by a bank for accepting payments from his account through the bank's debit card. Okay, that's all. It is a charge on the merchant, right? For example, that payment is 10 rupee, 1 rupee is deducted from what that must go to the merchant bank account. Okay, that's all. It is usually done when the merchant accepts payments using POS machines. That is all for today, and thank you very much. Okay, we will proceed with MCQs. I would like to discuss some questions from money, banking, and financial markets for you. Okay, see, before starting this question, I want you to have a general idea. United States, China, Japan, Hong Kong, India. They are the top 5 nations who are leading the global stock exchange. So yeah, they, for example, United States is in the top place, China, and if you see India, it's competing with Hong Kong currently, but it should overtake. So that's the catch. Now let us see what the question says. India accounts for a very large portion of all equity option contracts. See, it's a very generalistic statement, and therefore it usually would be correct. India's stock market has grown rapidly in the recent past, even overtaking Hong Kong at some point of time. See, Hong Kong is rival, so at some point of time it might have overtaken. Even if you don't know that news, you can still take it as right. There is no regulatory body either to warn the small investor about a risk or act on unregistered financial advisor. See, we have SEBI, so telling that we don't have any regulatory body would be wrong. So when you tick it wrong, tick simultaneously wrong. You have a tendency to tick it right, but don't do that mistake. Please remember, wrong, simultaneous. So the option would be 1 and 2, option A. Now let us see the next question. Before proceeding to the next question, I would like you to have some background information. This question is talking about liquidity trap. Okay, in this question, I want you to tell that, see, during liquidity trap, there is low demand in the market, so people are not buying anything. There is a low growth in the economy. Therefore, what central bank does, since there is economic slowdown, central bank tries to reduce policy rates such as repo rate, cash reserve ratio, etc. So when these rates are reduced, people get loans easily. But despite having a loan, so people, they have weaker sentiment about the future. They don't have confidence. Therefore, they try to save. They try to save and they try to spend less. And they don't have a demand for loans. They are just focused on savings and they're not demanding loans. Low demand for shares and bonds. They don't want money now. So since they're demanding, there is lesser demand for bonds. Obviously, when there is less demand for bonds, bond price must reduce. You know this. People are not demanding bonds. Therefore, bond prices will reduce so that people will take at least these bonds. So decrease in bond price. You know, if bond price increase, bond yield will increase. Why? Because bond yield is interest by bond price. If bond prices are decreasing due to lower demand of bonds, then bond yield is going to increase. So yeah, this is about liquidity trap. Basically, when there is economic slowdown, RBI will definitely try to reduce policy rates, but this is increasing the bond yield. Why? See, what happens usually when RBI reduces policy rates? When RBI reduces policy rates, people are going to have a lot of money in their hands, and bond prices, people are going to demand bonds, and therefore bond prices is going to increase. Then bond yield, what happens to it? If bond price increase, bond yield will decrease. This is a regular scenario. But during liquidity trap, what is happening? People are not demanding bonds, therefore bond price is getting reduced, and bond yield it is increasing. Therefore, this is about bond yield and bond price. I think you got a clarity. Okay, during economic slowdown, RBI definitely reduces policy rate, but this is increasing bond yield. Okay, now let us go to the question. Now let us see the question. If an economy is facing liquidity trap phenomenon, then the money demand in the economy at very low rate of interest becomes. See, they are asking about money demand. You know this demand, right? It's a change in quantity by change in price. I mean elasticity. How, not money demand, elasticity. Formula for elasticity is change in quantity by change in price. Okay. And one thing, they are not asking about bond demand. They are particularly asking about money demand. You know, money demand it is going to increase. Money demand it is increasing. It will increase. But bond demand it will decrease. What is the difference? See, bond means I need to give money to someone. I need to give money to the government or private sector, and they are going to give me in future. But currently during liquidity trap, I am not even believing in the future. I don't have confidence. Therefore, I am not demanding any bond. Therefore, bond demand will reduce. Bond demand will reduce, right? But during liquidity trap, people want a lot of money in their hands. Therefore, money demand will increase, right? So this is you need to note whether they are asking about money demand or bond demand. So since they are asking about money demand, let us see the question again. If an economy is facing liquidity trap phenomenon, then the money demand in the economy at very low rate of interest becomes at a very low rate of interest. See, low rate of interest meaning let us say central bank is providing loans to the people at very low rate of interest. So even then, yeah, definitely people want money, but they are not ready to take loans. Okay, people they want money. What about see? For in the economy there is economic slowdown, therefore there is even for a little bit, even for a no change in price, I am demanding a lot of money, something like that. Okay, this quantity is anyhow going to become infinity even if you write it as change in price. Okay, this quantity change in the money that I'm demanding, it is becoming infinity, right? The money demand during liquidity trap is becoming infinity. This is all you need to remember. So during that time RBI is going to definitely reduce the interest rate. Therefore the answer would be elasticity. You know there are different types of elasticity, right? Perfectly elastic, perfectly inelastic. Perfectly elastic meaning you are stretching a rubber band to infinity. So perfectly elastic meaning infinity. Perfectly inelastic means changing quantity by changing price will become zero. This is perfectly inelastic. Therefore my answer for this would be infinity. It is perfectly elastic. Now we are seeing the next question. Which one of the following is correct in respect of the above statements? Okay. First, there are 3 statements. Reserve Bank of India functions as the lender of last resort. That is true if you know about Reserve Bank of India. And next, Reserve Bank of India facilitates external trade and maintenance of foreign exchanges. Okay, true. See, look into the options. They are asking about reasoning. Okay. Reserve Bank of India provides liquidity to banks facing a this is also true. Yes, Reserve Bank of India provides liquidity to the banks facing a temporary financial crisis. So both all the 3 statements are correct. They are asking which explains which. See, both the statement 2 and 3 are correct, but only one of them explains or both of them explains? Okay, we are confused here. See, Reserve Bank of India is the lender of the last resort. It is lender of the last resort. Why do we call it lender of the last resort? Because it is providing liquidity to banks facing a temporary financial crisis. This is the reason. That is why it is called lender of last resort. The second option says Reserve Bank of India facilitate external trade and maintenance, but this is not the reason for option 1. Therefore, option A is correct. So now we are looking into the next question. How many of the following can be used by RBI as part of sterilization in India? Sterilization, okay. So basically, you read about sterilization. Basically, it is they are the RBI's open market operations to control inflation. This is what you know. That is sterilization, right? RBI's open. Okay. But you need to remember that open market operations of RBI to control inflation is sterilization, but not just open market operation. Any open market operation that can control inflation. For example, yeah, open market operation means buying and selling government securities in exchange of rupees. They are open market operations. But liquidity adjustment facility is also part of sterilization. How? See, liquidity adjustment facility, as I said, margin always comes first when you write something on a paper. So marginal standing facility minus standing deposit facility is a liquidity adjustment facility. So this MSF minus SDF. Marginal standing MSF is similar to repo, and this is a reverse repo. So basically, RBI is doing this adjustment to control inflation in the economy. Okay, therefore, this is also part of sterilization by RBI. And forex swaps meaning RBI buys dollar from banks and sells rupees to banks. So buying dollars and selling rupees, such kind of things are there to control the inflation. If there are a lot of rupees in the market, RBI is going to buy to control the inflation and going to sell dollars into the market. This is forex swap. That is also possible. So all of them are part of RBI's open market operations to control inflation in the economy. Okay, this is clear. Okay, the question is asking about which of the following are capital market. This is the easiest question if you have read about money markets and capital markets. See, financial markets are split into two types if you remember. One is money market and the other is capital market. Money market, there are many that you have studied. Capital market also you have studied a lot. They are usually short-term markets, money market, whatever you have studied in here. And capital markets, they are long-term market. Okay. Now, if we see capital market simply IPO, FPO, private equity, whatever they are related to stock market. They are all long market regulated by SEBI, capital market regulated by SEBI, and money market regulated by RBI. And the money market are short-term and capital market are long-term. This is the basic idea. So now, if you remember. Call money market, okay, government bond market. Government bond market, I don't remember, but I'll try to eliminate. Call money market is definitely in the money market only. And treasury bill market, of course, it's also in the money market only. And government bond market, see, you are not sure about this, but try to consider the time period. Government bonds, they are usually long term, and maturity period is usually more than 1 year for raising capital, right? But if they're specifically mentioning treasury bills, then they are short term. But the government bond market, usually they have maturity period for about 5 years, 10 years, or even more. So therefore, I will take it as under a long, they are for long term, therefore I'll take it as a capital market. And stock market, of course, it's capital. Therefore, only two options are correct. See here, there are some differences. If you are talking about examples, you have many call money, call notice term, certificate of deposit, commercial paper, LAF, a lot of things, cash management bill, they all come under money market, whatever you have studied. But related to share market, if you can see shares, bonds, government bonds, debentures, derivatives, mutual funds, InvITs, REITs, they're all investments which are usually more than 1 year. Therefore, they come under capital market. And capital market, they are regulated by SEBI, and money market, they are regulated by RBI. And RBI money market are short term, and capital market are for long term. And capital market, they are risky, and money market, they are not risky. So I think you are clear. Next question, it is asking about demand for money. And whenever I think of demand for money, I remember three types of demand: transaction demand, precautionary demand, and speculative demand. Do you remember the difference between them? Transaction demand is demand for basic needs. You are demanding money for basic needs. That is transaction demand. And the precautionary demand, you are demanding money for emergency purposes. That is a precautionary demand. And we also have speculative demand. Speculative demand is demanding money as a store of value, so that you are thinking when the prices fall down later in the stock market, you can invest. So that is a speculative demand. Precautionary, emergency, speculative, store of value, demanding money as a store of value, demanding money for emergency purpose, and demanding money for basic needs. So all this comes. Now let us see. With reference to the Indian economy, the demand for money increases in which of the following situations? When the income of the people increases. So when the income of people increase, then they are going to buy a lot of goods. Their demand is going to increase. Therefore, the transaction demand is going to increase here. And next, when the interest rate on deposit increase. So when the interest rate on the deposits is increasing, I would like to invest in that bank, right? Why would I demand goods and service? Because I am getting higher interest rate from the deposits. Therefore, I will not demand anything, and I will deposit instead. Therefore, here the demand for money, it reduces here because I am demanding. Okay, the interest rate, then this option will go wrong because money demand is not increasing here. And the third option, it says when there is inflation in the economy. When there is inflation in the economy, I feel like I want more money to buy goods, right? Therefore, of course, transaction demand, it is going to increase. Precautionary demand, I think money will not be sufficient for emergency. That will also increase. And speculative demand, I think in future, stock market might rise. Somehow I need to store money for it. So speculative demand, it is also increasing. In total, when there is inflation in the economy, it will increase. Therefore, be careful when they are asking to demand for money. And for deposits, it is like you are saving instead of depositing. Therefore, you are saving instead of demanding money. Okay, when you are saving, obviously, it's not like you are demanding. Therefore, that option will go wrong. So remember to eliminate options very well. Okay, when the interest rates on the deposits increase, definitely I'm not demanding money. Instead, I'm depositing money. Okay, therefore, eliminating two, we are having 1 and 3, option C. Okay. The next question feels very simple for me. With reference to Indian banking system, which of the following are correct about the RBI? It acts as custodian of foreign exchange reserves, very correct. It decides the minimum account balance, a requirement for saving banks account. See, my saving bank account is RBI going to decide minimum average balance. For example, for SBI, I think it was 1,000 or 2,000 rupees. I think it's 2,000. But for Canara Bank account, it was for me it was 500 minimum when I was at IIT Madras. Therefore, I think they depend upon the bank, not by the RBI. This is logical, and I will mark it wrong. If I eliminate two, there is only one option C. The third option, let us see. It maintains a banking account of all scheduled banks. Yeah, true. If you remember RBI Act of 1934, it has a second schedule, I think, where it defined the criteria for scheduled bank, and in that second schedule of RBI Act, you will be able to see the list of banks that are in schedule, and therefore they are called scheduled banks. These banks, they maintain banking accounts with RBI. Now this question is asking, consider how many of the following above are considered as the assets of commercial bank. So you need to first know what are assets and what are liabilities for a bank. Okay, for any commercial bank, see, if I notice, we have assets and liabilities. Okay, assets for a bank are the loans and advances it gives to the public. They are assets for any bank. And after that, the cash that currently a bank is holding, and the investment it has in the form of shares, bonds, and the cash and balances that has with RBI, and the money at call and short notice that it has given to some banks. They all come under assets. But if I see liabilities, liabilities are deposits from the public. Public might have deposited into that bank, and that bank one day need to return it to the public. So therefore, one day I need to return with interest. Therefore, it's a liability for me. And next, borrowings. The borrowings, the borrowings can be from anyone. See, borrowings are liability definitely. They can be from another bank, interbank borrowings, or they can be from RBI or NABARD. Okay. And next, deposits. Deposits also, they can be deposits from the public, or they can be from non-residents and deposits, or they can be certificate of deposits. Certificate of deposits, they are issued by the banks to the public at an interest rate that you know. So they all are assets and liabilities. Now let us see this question. Which of the following, with reference to the banking in India, consider the following: loans given to customers, are they assets? Yes, they are assets because they are going to pay me with interest. Therefore, loans given to customers are assets to a commercial bank. Reserves deposited with the Reserve Bank of India. Yeah, the reserves that a bank deposited with RBI, definitely RBI is going to give me with interest. Therefore, yes, they are an asset for me. Overdraft amount availed by a customer in a savings account. See, overdraft amount, they are also like similar to borrowing. For example, if you take PM Jan Dhan Yojana, under PM Jan Dhan Yojana, even if you are having a 0 rupee balance, you can withdraw a certain amount of money from your bank account. Maximum up to 10,000 rupees, you can withdraw from your 0 rupees bank. Of course, you need to have some eligibility. That is overdraft amount. So even with the 0 rupee balance, you are able to withdraw 10,000 rupees. Anyways, you took 10,000 rupees. That means you borrowed 10,000 rupees. It is basically a loan given by banks to you. Overdraft amount, therefore, is an asset to the bank. All three are correct. The next question is asking about liquidity adjustment facility. This you already know, right? LAF is nothing but margin से start होती है. Marginal standing facility minus liquidity adjustment. Marginal standing facility minus standing deposit facility. Marginal standing facility minus standing deposit facility. They must have a difference of 50 basis point. For example, if I take repo rate as 6%, so standing deposit facility, let's say it's 5.75, reduced by 25 basis point, and now this must be around 25 basis point, so that the total difference between marginal standing and standing deposit facility would be 50 basis point. Okay, this is about a liquidity adjustment facility. MSF minus SDF, around it must be around 50 basis point. So. Now, liquidity adjustment corridor is one of the important instruments used by the RBI to implement monetary policy. In this context, the upper bound and lower bound of this corridor are very easy question. It's a marginal standing facility and standing deposit facility. Okay. Now let us see next question. This is also a previous year question. Consider the following statement. Which one of the following are correct? Okay. The governor of the RBI of India is appointed by the central government. This is true. We have seen this. And certain provisions in the Constitution of India give central government. See, whenever you find the Constitution of India in an economic question, please take that option as wrong immediately, because RBI, it is they have this power from the RBI Act of 1934. Okay, so this gives power to the central government, the right to issue directions to RBI. Okay, it's not in the Constitution of India. You already read Constitution of India, but by overlooking, you might take it as correct. In the exam, our brain don't usually work in a proper manner. Therefore, whenever you find Constitution of India, please take it wrong in an economic question. The governor, or else whenever even in the political question, if they're mentioning Constitution of India, be very careful. Okay, the governor of the RBI draws his power from the RBI Act. Do you think it's correct? Governor of the RBI, does he draw his power from the RBI Act? Yes, of course. Of course. If not RBI Act, from where? Okay, therefore 1 and 3 are correct. Option C is correct. The next question is about a legal tender or not. Okay, so in India, how many of the above are legally tenderable for discharge of debt or obligation? For example, if you want to go to shop and pay, which is easily acceptable and which is not acceptable. I mean, if you want, you can accept, or else you can reject. But for example, I am giving a 1 rupee note and it is signed by the RBI governor. It is something legally tenderable. Anyone will accept. But if you are giving a check, someone can reject this check because I think this check will bounce, and it is very hectic for me to go to the bank, convert it into cash. So therefore, it is up to me to decide whether to accept or reject. But it is usually 1 rupee note. People are going to accept. It is legally tenderable. Okay, that is difference between a legally tenderable or not. Certain things are limited and certain are unlimited. For example, let us discuss limited legal tenders. For example, 50 paisa. How many 50 paisa I can accept? See, I will accept till it becomes 10 rupees. So 50 paisa, 20 coins. If I take 20 coins, they are going to make 100 paisa. 100 paisa means 1 rupee, right? What 1 rupee means how much? How many paisa? No, 250 paisa. Oh, sorry, this is 1,000 paisa, right? 1,000 paisa. And 250, 100 paisa implies 1 rupee. Therefore, if I take, it will become 10 rupees. Yeah, correct. So 50 paisa. I need to have if I have 20 coins of 50 paisa, it will make 10 rupees. I don't want those many coins. I don't want more than 20 coins. It is very hectic for me to count. Therefore, I can accept up to 10 rupees, but it is voluntary up to me. It's on me to whether I accept more than 20 coins or not. But yeah, after 20 coins, I can reject. So 50 paisa up to 10 rupees. It is a limited legal tender, and other coins like 1 rupee coin, 2 rupee coin, all the coins above the 1 rupee, all the coins above 1 rupee, they are limited legal tender up to 1000 rupees. 50 paisa is limited legal tender up to 10 rupees. All the coins above 1 rupee like 1, 2, 5, etc. They are limited legal tender up to 1000 rupees. Okay, this is about limited legal tender. Unlimited legal tender, all the notes, whatever notes I'm saying, 1, 2, 5, 10, and so on, all the notes, they are unlimited legal tender. Okay. One unlimited legal tender. All these notes are unlimited legal tender, but coins they are limited legal tender. Notes they are unlimited legal tender. Remember this, okay? Therefore, by this observation, I can say that 1 rupee, this coin is a limited legal tender, but this note, if they're mentioning note in the question, 1 rupee note, then I'll think it as a unlimited legal tender only. Okay. And next is that, next, what is next? Okay. Okay, that's all right. Print, who printed? See, RBI, I already said you this trick that all notes except 1 rupee note, it is printed by RBI. Okay. Remaining coins and this 1 rupee note, they are printed by the central government. Printed by the central government under the Ministry of Finance. Okay. This is about legal tender. Now let us see the question. Consider the following. Payments in 1 rupee. 1 rupee coin. Payments in 1 rupee coin. Okay, they're asking about 1 rupee coin. 1 rupee coin, I know it is limited legal tender up to 1000 rupees. Okay, payment in 1 rupee coin for any sum not exceeding 1000 rupees in any single transaction. This is legally tenderable. Not exceeding 1000. Therefore, it is legally tenderable because they are mentioning not exceeding 1000. And also payment through checks drawn. See, check drawn, as I said, it is not legally tenderable because it might bounce. I will reject. Payment through credit card. Oh, you are giving me loan. That is loan basically. You are giving some amount by taking loan. I don't want to accept. So payment through credit card is also not a legally tenderable. And next, payment using e-rupee, digital rupee. See, I am paying through Paytm. I am using digital rupee. Yeah, most of the shopkeepers they are accepting it. So it's a limit. It's a legal tender only. It's a legal tender. Payment done in 2000 rupee denomination for any sum. See, all notes, even if it is a 2000 rupee denomination note, it is legal tender, right? So this is also legal tender. Therefore, I am only having 3 options that are correct. Okay. All the next questions. Okay, in India, the Reserve Bank of India, in consultation with the central government, determines the inflation target. Okay, they're saying that RBI determines the inflation target. Be very, very careful. If they're saying RBI, no. Specifically, when I already mentioned that central government is going to determine the inflation target, which is going to be 4 plus or minus 2%. According to this, you have Monetary Policy Committee (MCC), which has 6 members in total, 3 from RBI and 3 from government. Okay, in this 3 from RBI, you are going to have RBI governor, deputy RBI governor, and some RBI officer. So this Monetary Policy Committee, consisting of 6 members, is going to fix repo rate according to the target given by the central government. Repo rate is going to fix the repo rate. Rest all other rates, all the other rates like cash reserve ratio, whatever you have, those policy rates, they are going to be fixed by the RBI. So this is something you need to remember. However, before central government fixes this inflation target, it must consult RBI. Okay. Now the question is asking, in India, the RBI in consultation with the central government determines the inflation target. Okay, it's not the RBI, you need to be careful. It's the central government. They have swapped it. It's the central government which is going to consult RBI to determine the inflation target. And next, as per the RBI Act 1934, monetary policy framework in India shall be operated by the Reserve Bank of India. Yes, that is correct. Therefore, first option is wrong. It is assertion and reasoning. Option is D. Most of the people will take it A, but option is D. Be very careful. Okay, 15th question. When you see stock market, you notice 2 terms. One is alpha and beta. Alpha is investment's extra return compared to its benchmark index. For example, if you have positive alpha, it means you are having an outperforming market, and if you are having negative alpha, it means a lagging market. Basically, alpha is determining the investor's strategic ability to beat the market. How much extra returns he has with benchmark index. Okay, so investor's strategic ability to beat the market. Positive alpha means his stock market, his portfolio, it is an outperforming market, and if he's having negative alpha, it is lagging market. You are comparing your market with the benchmark index market. Okay, outperforming market and lagging market. That is about alpha. What is beta? Beta, it is the measure of volatility of stock compared to the market as a whole. See, this is alpha is your portfolio, right? How your portfolio market is outperforming the benchmark index. So you are comparing, and if you're checking if it's positive or negative. Alpha similarly is just comparing the stock price. Volatility, it is not just your stock, but it's the volatility of your stock. Volatility, measure of volatility of the stock compared to the market. Market volatility. For example, if I say share market, my share that I purchased, it's going at 10% up, but Sensex, if I see, it's going at 5% only, Sensex. So that means beta value would be 10 by 5. So I'm performing 2 times better, something like that. So beta, I mean, my stock is 2 times better than the Sensex. So it is basically measuring the volatility of a stock compared to market as a whole. Measure of volatility of a stock compared to market as a whole. Beta, if it is 10, if it is 5, then beta is going to be 10 by 5 too. So I'm saying that my stock is 2 times volatile, 2 times volatile than market. Okay, 2 times. Okay, that is something like that. Something like that. Okay. Let us see the options. A process of simultaneous buying and selling an asset from different platforms. Since this is a technical question, options are going to be easy. For example, the process of simultaneous buying and selling of an asset from different platforms. This is wrong. And an investment strategy of a portfolio manager to balance risk versus reward. No, right? That is not an investor strategy only. That is just a volatility of a stock compared to the stock market. I said a type of systematic risk that arises where perfect hedging is not possible. Is it a systematic risk? No, right? Still, let's see all the options. A numerical value that measures the fluctuations of a stock to change in the overall stock market. This is what I said. A numerical value that measures the fluctuations of stock. It measures the volatility of your stock with the overall stock market. Okay, that is what I'm saying. Numerical value that measures the fluctuation of stock to change in overall stock market. Okay. The next question, it is asking about the commercial papers. Whenever I'm seeing this commercial papers, the only thing that I can remember is paper, they're risky. They're given by the companies and they're risky. I can differentiate with the certificate of deposits. Certificate of deposits is they're issued by the banks, and the commercial papers, whereas commercial papers they're issued by companies, which are very risky because they are not you do not require any collateral. I mean, they're unsecured. Commercial papers, one thing I remember is they're risky, and they because they're issued by the company and not banks. Whereas the certificate of deposits they're issued by banks, they're issued by the company, therefore they're risky as they're unsecured. This is that I remember about commercial papers, and also I can differentiate with certificate of bills. Commercial paper you're going to give to the individuals or households, and they're going to give rupees in exchange at market determined interest rate. Of course, interest rate is determined by the market, and companies, so if they're going to exchange between companies, then it is bills of exchange. They are between company to company, and this company they must be credit rating agency. Okay, now let us see. Of course, credit rated agencies only, they can only issue. Now the first option, it is saying that they're unsecured money market instruments. That's very true. Unsecured money market instrument. Corporate houses issuing commercial paper should be listed companies on a recognized stock exchange. Did I anywhere tell you that they must be listed? See, I said that they must be a credit rated a company, any credit rated company, and listing is not a criteria, but yeah, credit rating is a criteria for this. This is wrong. Financial institutions shall obtain credit rating for issuance. Yeah, they must obtain credit rating for issuance of a commercial paper from any one of the Secured Exchange Board of India. Funds raised through commercial papers cannot be used to finance operating expenses. Is this true? See. I got commercial paper and I have given money to the company. Now it's up to the company to use the money however the company wants. Cannot be used for operating. I don't know why they ask such silly questions, but yeah, this is wrong. So the options are 1 and 3, B. Now let us proceed to the next question. Consider the following liquidity management tools for implementing a monetary policy by the RBI. Which of the following liquidity management tools allow banks to deposit their excess funds with RBI without any collateral by the RBI? Okay, without any collateral, which one of the following tools will allow? So collateral and without collateral, I've already said you before. You need to be very careful. First of all, I'm confused, so I'll let you memorize this through a trick. Repo rate and reverse repo rate. The repurchase obligation. Repurchase obligation of what? Of collateral. So banks are going to repurchase the collateral. So something. These both are something that involves collateral for sure because the name itself says. And next, but the entity similar to this repo and reverse repo, I noticed that they mostly don't have collateral. That means, for example, bank rate. Bank rate is something similar to repo, but it is for long term. Okay, repo it's for usually short term, but whereas bank rate it's for long term. Since it is similar to repo, therefore there is no collateral required. And but you know there is a marginal standing facility also, which is also similar to repo. But unlike a repo, you are asking for overnight loans from RBI. Okay, overnight loans. Overnight loans means somewhat it's very urgent, but if it is very urgent, I am not going to demand you for collateral which you don't have. So but I might ask you to use your statutory liquidity ratio security, meaning see what security comes under SLR. Under SLR, I asked you to put some liquid assets under SLR, right? They can be gold or anything that can be easily converted into cash. For example, government securities, all such things are there in your SLR, right? So take some of the government securities from your SLR and deposit with RBI. Then RBI is going to give you short term overnight funds for you. Okay, this MSF is going to be very high because you are demanding in an overnight from RBI. But yeah, for that you need to use your SLR security. You need not use collateral. Yeah, you are using collateral, and I'm giving you an exemption to even use SLR security because you are demanding it. This is okay, and this is about MSF. As I said, entities similar to our repo and reverse repo, they're usually not going to have collateral. But MSF is an exemption because they are overnight loans that you're demanding, and that is why I'm exempting you to even that you can use SLR security, not a problem. Okay, SDF, statutory deposit facility, it is similar to reverse repo. So entities similar to it, they do not have any collateral. Even logically speaking, I can tell this because statutory deposit facility, banks are putting their extra funds with the RBI, and no, I don't think RBI is going to give any collateral to the banks. That is not logical. Also, RBI, Reserve Bank of India, should it really? No, it's not like RBI is taking loans from the banks. Okay, it's just that the banks they are depositing their extra funds with RBI. Therefore, no collateral is required by RBI to deposit. Okay, no collateral is required. Banks are just depositing their extra funds. This is about statutory deposit facility. Now let us see the options. They're asking without any collateral. Okay, statutory deposit facility, they don't require any collateral. And reverse repo, as I said, repo and reverse repo, they have collateral. Bank rate, they don't have collateral. Anyways, the option 1 is only correct. Now the next question is asking something very good. How many of the above mentioned entities are eligible to participate in the call money market? Call money market. They are asking about call money market. Okay. See, one thing you need to notice is that we have a call money market, and in this call money market, mostly all the banks they can call any other bank, and they can draw some money. I mean, they can borrow and they can exchange money, something like that. So call money market is interbank. Now this call money market is not open to certain banks. You need to remember those certain banks. For example, if I take local area banks, they are exempted from the call money market. Like scheduled commercial banks, they are allowed. Payment banks, small finance bank, regional rural banks, cooperative banks, primary dealers, all of them they are allowed. But local area banks, they are not allowed in the call money market. Not only local area banks. If I see, for example, in the cooperative banks, there is also this land development bank. But land development bank, this is also excluded from call money market. It's a cooperative bank, but this is excluded from call money bank market. Okay, so it cannot call and ask any other bank for overnight loans. That is not possible. So land development banks and local area banks. If I say local area banks, they are almost diminished nowadays. Nowadays they don't even exist. Anyways, they are excluded, and the land development banks, they are excluded because local area banks are limited to 2 or 3 local areas, and they are not so trustworthy. I mean, how can such banks participate in the call money, and how can they take advantage of call money market? No, because they are not so trusted. I mean, they just operate into 1 or 2 local areas, and I'm not really sure whether they're going to return my money or not. Okay, now let's see. Consider the following: how many of the entities are eligible to participate both as borrowers and lenders? Is Is there any local area bank? So exclude it. Is there any land development bank? No, there is no option of land development bank. So the options, regional rural bank, payment bank, urban cooperative bank, they come to be right. So option only 3 are correct. So RBI imposes prompt corrective action on banks based upon capital to risk weighted asset ratio and net non-performing assets. So the option would be 1 and 4. It's option C. Oh, the next question is very interesting. It is asking me about the instruments that FPI is permitted to invest. You know what? Let me tell you one thing before proceeding this. I want you to know the difference between FDI and FPI. Okay. Okay. FDI is foreign direct investment and FPI is foreign portfolio investment. Basically, foreign investors who want to invest in Indian stock market, they're going to register with SEBI and they're going to invest in our Indian stock market. So this FPI investors, they can invest in only the companies that are listed in the stock market and the companies that are going to be listed. Going to be listed meaning, for example, let's say IPO. Yes, foreign portfolio investor can invest in IPOs. That is possible. So only in listed and going to be listed and not in unlisted. So foreign portfolio investors cannot listed in unlisted. But if it is a foreign direct investor, he can invest in both listed companies and unlisted companies. There is no such strong binding rule that they cannot invest. Okay, but FPI, remember, they cannot invest in unlisted companies. The second rule that I'm going to tell you is very important. For example, this foreign portfolio investor, he has invested in more than 10% share. See, usually he must invest in only less than 10%. Okay, he must invest in only less than 10% of company's equity. So if less than 10% of what is this 10% total paid up capital equity. Okay, paid up capital equity. So if you take a company's total paid up capital equity and if you are investing less than 10% of it, then it is okay. You are an FPI. But this FPI, therefore you come under the regulation of SEBI. But as soon as this 10%, if it crosses, if a foreign portfolio investor is crossing this 10% limit, then he comes under FDI. More if he's invested in more than 10% of investment, more than 10% of FPI. So if it is more than 10%, then automatically you come under FDI. And FDI, they are regulated by RBI. Okay, you're going to come under the regulation of RBI because you're investing more than 10%. But before you exceed this 10%, SEBI and RBI, they're going to send you notification to withdraw some of them or sell some of your assets and become less than 10% so that you come under the regulation of SEBI. But they're increasing more than 10%, then they become FDI. They come under the regulation of RBI. And one more thing you need to remember is about the Nidhi companies. FDI and FPI, they are not allowed in Nidhi companies. Okay. What are these Nidhi companies? See, Nidhi companies, they work under the principle of mutual benefit. I think you know about this principle of mutual benefit very well. Let's say the investors, it is like a circular loop, and the investors are going to be the creditors also. I mean, basically the debtors are the investors. I mean, see, these people who are going to invest, they're going to invest certain amount. Let's say I invested 2 rupee, everyone invested 2 rupee, 2 rupee, etc. Now this person, he wants some 5 rupee loan for building something. So he can take 5 rupee loan because we all together we gathered a lot of amount. So from this, I am going to take 5 rupees out. I took 5 rupees out from this, and later I repaid along with interest of 3 rupees. Let's say I repaid later. So this by withdrawing 5 rupees, I got this got 8 rupees now. So 8 rupees went back. The benefit of extra 3 rupees are distributed among all the members. That includes even me. Okay. Therefore, this is the functioning of Nidhi companies. It works in a circular loop under the principle of mutual benefit. So no outsiders are even involved in the Nidhi companies. So FDI and FPI, they are not allowed in the Nidhi companies. And that is all I can recall. And there are some sectors where FDI is prohibited or only up to some percent FDI is included. Such kind of questions we will see next later. For now, let's try to answer this question. How many of the above instruments question? How many of the above instruments is a foreign portfolio investor permitted to invest? Okay. First option is saying equity shares of unlisted companies. So as I said, unlisted companies, they do not fall under FPI, only listed and going to be listed. And next, dated government securities issued by central government, of course. Central government, it can issue government securities, and foreign portfolio investors, they can come and buy our central government securities. It is profit for Indian government. Why would it not allow? Therefore, this is correct. Commercial papers issued by Indian companies. Indian companies, if they want some money, that is why they are issuing commercial papers. And if FPI, foreign portfolio investors, want to buy, who is going to stop them? No one is going to stop them. Commercial papers issued by the Indian companies, they can be invested. I mean, they can be bought by a FPI. Okay. And next, we are having equity shares issued by Nidhi companies. As I said, this Nidhi companies, they are exempted from FDI and FPI because they are based on the principle of mutual benefit. Units of mutual funds registered with see, when you open stock market, you also find mutual funds, right? Why cannot a foreign investor buy mutual funds that are in the stock market? Of course, units of mutual funds. I mean, see, mutual funds, they invest in some other listed stock markets only, right? Therefore, you can definitely invest in mutual funds. A foreign portfolio investor can invest in mutual funds. So only 3 options are correct here.
Now, to look at this question is asking about how many of the following are treated as alternate investment funds. Okay, first, to know this, you need to know what is AIF, alternate investment funds. They are registered as a trust or company under SEBI. They are basically a group of investors who invest in 3 different categories. Category 1 are usually socially and economically desirable, and category 2, they investments are done in this category 2 to meet operational requirements, and category 3 are very highly risky. So category 1 funds, they are socially and economically desirable, and we raise fund through this category 2 to meet our operational requirements, and category 3 are hedge funds which are very highly risky. Okay, so alternate investment funds are nothing but group of people who are registered as a trust or company under SEBI. They are investing in 3 different categories. Okay, and let us see what are the funds in category 1. InvIT, venture capital, and SME fund. Infrastructure fund. Infrastructure investment fund is investment in hard assets like road, bridges, airports, and power plants. Okay, that is infrastructure fund. And venture capital fund is investment in it focuses on startups and early stage companies with high growth potential. Okay, that is venture capital. If you are investing in some venture capital, that means if you are looking into startups and early stage businesses which have potential high growth, then that is venture capital. For example, this is the next fund is SME fund. Okay, SME fund. usually you focus on investing in a small and small and medium enterprises. So if you are targeting to invest in small and medium enterprises, to help them elevate their small businesses, then such funds are called SME funds. So basically, you are if you are investing in infrastructure, it is an infrastructure fund. If you are investing in early stage companies and startups, then it is venture capital. If you are investing in small and medium enterprises, then it is a SME fund. Okay, you are not investing in this just for free. You will get equity, and in exchange for equity, you need to provide them your expertise, and you need to you are giving them basically some investment as a loan, and also you are helping them with your mentorship and expertise. Therefore, this is venture capital and SME fund. You know about them very well. You know about the infrastructure fund. Now these three come under category 1. Now we have category 2 funds, which are usually used for meeting operational requirements. Basically, you are just acting like a bank, and you are earning interest out of it. That is debt fund. Okay, you know about the real estate fund. You are trying to generate profit by investing in real estate after increasing its property value. SME fund, you are trying to get the profits from small and medium enterprises by helping them. Okay, venture capital, you are trying to get profits from early stage businesses and startups. Infrastructure fund, you are trying to invest in hard assets like bridges, airports, power plants, etc., and earn profit from them. And hedge funds, you can earn very high returns, and at the same time they are highly risky. What are hedge funds exactly meaning? They are just like a mutual funds. They are similar to mutual funds, but they are very highly risky. Okay, this is about alternate funds. Now let us see. We have seen that there are only 3 categories, and we have discussed all the funds in those 3 categories. Now let us try to answer this question. How many of the above are treated as alternate investment funds with reference to investments? Okay, bonds. Did we discuss bonds anywhere? No. So therefore they are not there. Stocks. Did we discuss about stocks, investing in bonds and stocks? No, anywhere. No, not anywhere. Okay, what about hedge funds? Hedge funds, it's a category 3. Okay, category 3 funds, it's correct. And venture capital, did we discuss? Yes, it comes under the category 1. Okay, therefore only 2 are correct. So before going to this question, I want to revise some concepts with you. First, Monetary Policy Committee. It is set up under RBI Act of 1934. Okay, and this consists of 6 members in total. 3 members from the RBI who are the ex officio members. As long as they are in the RBI, they are going to be members of this. Who are they? RBI governor, deputy governor, and some official from RBI, and 3 members from the government. And 3 members from the government, they are nominated based upon the recommendation of committee headed by the cabinet secretariat. Okay, central government is going to nominate some people. These 3 members are going to be there. These 3 members are specific conditions how they are going to be appointed and all. For example, the 3 members nominated by the central government, their tenure is only up to 4 years, and after these 4 years, they are not eligible for reappointment. Okay, different members are going to come to the Monetary Policy Committee for every 4 years. These 3 members, okay, their tenure is for 4 years, and they are not eligible for reappointment. And one more thing, there is important provision that they must meet at least 4 times a year. They must meet at least 4 times a year. You know what? Currently, they are meeting 2 times a month, almost 6 times a year. Therefore, this is we are satisfying this. Okay, and one more thing, this is recommended by the Urjit Patel Committee. Okay. Now let us see the question. You know these points, right? Inflation target is fixed by the central government in consultation with RBI, and the repo rate is fixed by the Monetary Policy Committee. All other rates are fixed by the RBI, and the repo rate that Monetary Policy Committee fixes is binding upon the RBI to accept it. Okay, the inflation target set up by the center is a flexible inflation target, 4 plus or minus 2%. If we do this, we are getting 2 or 6. 2 is the lower tolerance limit, and 6 we call as upper tolerance limit. Now let us see which one of the following with regard to the Monetary Policy Committee of the RBI are correct. The governor of the RBI is the ex officio chairperson of the committee. Is this correct? Yeah, it's correct. As I said, 3 members are going to be the members from RBI, right? Out of which RBI governor is also executive official, and he ultimately becomes, he automatically becomes ex officio chairman. Now, the governor of the RBI is the ex officio chairperson of the committee. This is correct. The committee shall determine the policy rate required to achieve the inflation target. This policy rate is nothing but repo rate. Okay, and yes, the committee is determining the target rate to achieve the inflation target. The members of the committee are appointed by the central members of the committee appointed by the central government are eligible for reappointment after the completion of 4-year terms. Just I said, after 4 years they are not eligible for reappointment. So this is wrong. Okay, this is a wrong statement. Now the next, the Reserve Bank of India shall organize at least 4 meetings of the Monetary Policy Committee in a year. At least 4 meetings is very correct. Currently they are meeting 6 times. The answer for this would be 1, 2, and 4. B. So Taylor's formula is basically a blind trick which tells you that during recession all rates will decrease, and during inflation all rates are going to increase. All rates like cash reserve ratio, they are going to be increased because you need to control you need to control money in the economy. So this is the Taylor's formula blind trick. Okay, you need not think about whether it is repo or reverse repo. This logic will still apply. For example, if I take reverse repo rate, what is repo rate? Repo rate is rate at which RBI lends loans to banks. Okay, RBI is lending loan to bank. But what is reverse repo rate? Rate at which banks banks put their excess funds with RBI. Okay, that is reverse repo rate. Okay, and during reverse repo rate, collateral is involved. Okay, this is about reverse repo rate. So during reverse repo rate, RBI puts government securities, pledges its government securities with the banks, and banks, they are going to give money to the RBI. They are going to basically deposit their funds with the RBI. This is about reverse repo rate. Which of the following RBI would implement during contractionary monetary policy? Okay. Increasing the repo rate. Okay, as I said, contractionary monetary policy meaning there is currently recession. There is currently inflation in the economy. Therefore, I need to use contractionary monetary policy to control the inflation. Therefore, I will reduce all the rates. Contraction meaning I need to increase all the rates, right? I need to increase all the rates. For example, I need to increase cash reserve ratio so that I can control money in the economy. Therefore, increasing in the rates. As per Taylor trick, it is increase all the rates. Okay, now let us see. Increase the repo rate. It is increasing, correct. Increasing, just take it correct. And decreasing the statutory liquidity. Decreasing it to wrong here. Or next, buying. So Taylor trick don't work here because there is not asking about increasing or decreasing. It is asking about buying government securities under open market operation. Okay, now you should use your logic here. For example, under open market operation, let us say RBI is buying government securities. So RBI bought government securities. So if you take government securities, you need to give money, right? So you are giving money. So if people are getting money, will inflation increase or decrease? It will increase. So how will it become a contractionary monetary policy if you are giving money to the economy? Therefore, buying government securities is a wrong option. Only 1 and 2 are correct. 1 and 2 are correct.
So the next question talks about non-banks. So I want you to revise this once. So non-banks are classified into two categories. One is All India Financial Institution. Other is NBFC, non-banking financial corporations. I think. So we are having NBFC and All India Financial Institutions. Example: Exim, NABARD, CDB. They all come under All India Financial Institution. And if I talk about NBFC, primary dealers, mutual funds, insurance fund, pension fund, they all come under NBFC. So these are the two categories under NBFC now. Now, as we have seen, there are two categories: all Indian financial institutions and NBFCs under non-banks. Non-banks. Okay. Now, I want you to know the difference between conventional banking and non-banking financial companies. Okay. So conventional banking is our normal banks where the source of funds are deposits. So in any bank, a customer usually deposits, and that is the source of funds for these conventional banks. But when I see this non-banking financial companies, they are also called as shadow banks. So if you see shadow banks anywhere in the question, they are nothing but NBFCs. So NBFCs, their method of raising funds is different. They raise funds through market-based instruments such as commercial paper, debentures, etc. So you have seen commercial papers, etc. things, right? Commercial papers are issued in the market, and then people are going to buy this commercial paper, and then they're going to give the rupees, and they are unsecured and they're very risky. So they are basically issued by these are non-banking financial companies only. They raise funds through market-based instruments such as commercial paper, debentures, etc. And they can also raise funds through deposits. But the funds they can raise to deposits has very low share because RBI will not allow it, because you are not registered under this RBI Act. So you do not have this banking license. You are not registered under banking regulation. You are not you are not the bank that we are regulating or supervising. Therefore, you cannot raise funds through deposit, and even if you are raising, the share must be very low. So that is the condition. Basically, they do not have banking license. NBFCs, they do not have banking license. This is the source of fund. Okay, now we have seen source of fund deposits. So conventional banking, do they have deposits insured? Deposits insured, are they insured? Yes, they are insured. For example, DICGC. You know DICGC? It is Deposit Insurance Credit Guarantee Corporation. So for example, if I am going and depositing in a conventional normal bank, then okay, it is fine. But the amount, for example, let's say I invested 10 lakhs, and out of this 10 lakhs, 5 lakhs, up to 5 lakhs, my bank, this conventional bank, it is going to put it in DICGC, that is Deposit Insurance Credit Guarantee Corporation. So up to 10 lakhs, I will get insurance under Deposit Insurance Credit Guarantee Corporation. And this insurance, it is not applicable to NBFCs. So even for if I deposit in a conventional bank, it is fine. My money will be insured up to 5 lakhs. But if I invest in an NBFC, then my money will not be insured. Okay. Source of funds, deposits. Okay, and this is a market-based instrument. Deposits insured, yes. Are my deposits insured under NBFC? No. Can they accept demand and fixed deposits? See, conventional banking, they can accept both. See, we are doing fixed deposits for a certain period of time, lock-in time, and we are also doing demand deposit where we can withdraw from on demand. So both are possible in conventional banking. But deposits, only fixed deposits are possible in NBFC. That fixed deposits, the NBFCs which are allowed for fixed deposits, they are called NBFC D, where fixed deposits are happening. Demand deposits, they don't happen in NBFC. Okay, there is this NBFC D companies which accept fixed deposits. Anyways, okay, and next, they cannot accept demand deposits. Fixed deposits are being accepted in only NBFC D. Anyways, fixed deposits are possible, but yeah, demand deposits are not possible. And even if you are depositing, they are not insured under DICGC. DICGC is Deposit Insurance Credit Guarantee Corporation. Department Insurance Credit Guarantee Corporation. Okay, do they lend loans? Banks, they lend loans, yes. What about NBFCs? Do they lend loans? Yes. NBFCs also lend loans. That is how they make profit. Okay. That is about NBFC. One thing you need to note is that NBFC, their primary business cannot be agricultural activity, industrial activity, sale or construction of immovable property. Agricultural activity, industrial activity, agriculture industries, okay, primary, secondary, right? They are banned. And sale and construction of immovable property, they are also banned. So NBFCs, they are very sensitive businesses. So NBFC is banning agricultural, industrial, and sale and construction of immovable property. Their primary business cannot be in these activities. Okay. So banks can issue loans, but NBFCs, they can also issue loans. Loans can be given. That is how they are making profits. Loans can be given. Okay, if a normal person is able to give loans, why do you think NBFCs can't give loans? They can give loans. Can NBFCs issue debit card? That's my question. Can NBFC issue debit card? See, you are not having demand deposit only. You cannot withdraw on demand. Then how can you have a debit card? It is not possible. So there is no debit card for NBFC. What about credit card? Credit card. See, I am giving loan to people, right? But yeah, I need to get prior approval from RBI, and then only I can give loans. Yes, credit card is possible for NBFCs. Both debit and credit cards, they are possible for a normal conventional bank. Now let us see, is the CRR and SLR applicable? See, they don't come under the banking regulation. They are not coming under the banking regulation of RBI, and they don't have a banking license. So CRR, it is not applicable for NBFCs. Yes, CRR and SLR, of course, are applicable for conventional banks. Now SLR, is it applicable for NBFC? SLR, statutory liquidity ratio, it is applicable only to NBFC D. Statutory liquidity ratio, it is nothing but a liquid asset that bank should keep it with itself. So for the safety of that company only, RBI is telling them to keep certain amount as a liquid asset, certain percent of liquid amounts. I think it's 18% statutory liquid, 80% of net time demand. See, CRR is around 4% of NDTL, I think, net demand time liability, and I think this is 4 or 2%, I don't remember. And statutory liquidity ratio is around 18% for conventional banks. So but for NBFCs, I am not sure. But anyways, the CRR, it is not even applicable because you need to deposit with RBI, and they don't even have a banking license. But this SLR, it is applicable only for NBFC D for their own safety, because they are accepting fixed deposit also. So RBI is a bit concerned about this NBFC D companies. Anyways, so this statutory liquidity ratio, it is not applicable to non-deposit taking NBFCs. What is payment and settlement system? For example, I'm going to a shop and I want to purchase something. I can use a debit card and I can draw some money, or else I can get money. I can get the commodity that I want. Or else what can I do? I can use GPay, and GPay that is linked to some conventional bank. And using GPay, I can pay. I can pay to that shopkeeper, and I can get the commodity that I want. So basically, conventional banks, they're part of payment and settlement system. And the conventional banks, they can issue their own checks also. But when I see NBFCs, come on, tell me, can I take a commercial paper and ask that shopkeeper to give me the commodity that I want? It is not possible. So they are not part of a payment and settlement system. NBFCs are not part of payment and settlement system, and they cannot issue their own checks. They cannot issue their own checks, and they are not part of payment and settlement system. Now let us see regulations. Banks are very strictly regulated because they have banking license and they are come under the purview of RBI. Therefore, they need to strictly maintain their CRR, SLR, everything. Okay, so they are part of payment and settlement system, and they have very strict regulation. NBFCs, they are partly regulated. For example, NBFCD need to maintain SLR, right? They're partly regulated or unregulated. There are also NBFCs that are unregulated. Example, Goldman Sachs. So there are certain NBFCs that are not regulated, transparent. Our banks are very transparent. Their accounts must be shown properly. The checks and balances, everything must be shown to RBI. They're very transparent banks. But NBFCs, they are less transparent. We exactly don't know who is funding that NBFC, or what are the money market instruments. I mean, how did they raise their funds? What are and the debentures? So we don't know a lot of stuff. So they are less transparent. That is why we are calling them shadow bank, because they are less transparent. So this is the main difference between conventional banking and NBFC. The main differences you need to note down is that they cannot issue checks, and they are not part of payment and settlement system. This is one thing. And yeah, that means can they lend loans they can lend. So you need to use your logic and try to answer the questions. But one thing people tend to forget is this. But yeah, since you remember with logic, it's not a problem. The question, NBFCs, which of the following are correct, cannot accept any type of deposits. Okay, NBFCs, they can accept fixed deposits. They are called NBFCD, but demand deposits, no NBFC can accept. Okay, oh sorry. Therefore, cannot accept any type would be wrong, and are part of payment and settlement system, are not part of payment and settlement. Yes, NBFCDs are not part of payment and settlement. This is correct. And cannot issue checks drawn on themselves. Yes, they cannot issue checks drawn on themselves. This is also correct. That is what I said. This is something people tend to forget. The NBFCD, I also illustrated with an example, so you can't forget. Cannot issue credit cards to its customers. See, as I said, NBFCs can lend loans. That is how they can make profit. And also I said normal commercial banks can also lend loans. Therefore, cannot issue credit cards would be a wrong statement. Only 2 and 3 are correct. Option A. This question is asking us asking us about bank run. Okay, bank run. The option is already highlighted, but let us see all the options. The net balance of money a bank has in its chest at the end of a business day. See, net balance of money, it is wrong. Bank run means bank do gaya. So this is wrong. And next, the ratio of banks to total deposits and total liabilities. This is NDTL, na? Something like that. Total demand and liabilities. This is wrong, anyways. And the panic situation when the deposit holders start withdrawing the cash from the banks. This is correct. The period in which a bank creates the highest credit in the market. Oh my God, these are all wrong, but they might have some other meaning. So the question is asking, with reference to the treasury bills in India, consider the following. No periodic interest is paid on treasury bills. As I said, treasury bills, they are zero coupon bonds, and they are issued at a discounted value and redeemed at face value. This is something you need to remember about treasury bills and cash management bills. Therefore, no periodic interest is paid on treasury bills. That is correct. It can only be issued by the central government and not by the state government. Yes, as I said, treasury is with the center. Therefore, they can be only issued by the central government. It cannot be sold or traded in the secondary market prior to its maturity. No, they are basically treasury bills. They can be traded. See, all the money market instruments, I have not seen anything that cannot be traded in the secondary market. Therefore, this option is wrong. Next, so I finished only 1 and 2 are correct. See, the next question, it is talking about currency deposit ratio. See, there are many confusing terms in economy. So I'm going to give an overview. There are 3 terms mainly that confuse me. One is currency deposit ratio, and the other is reserve deposit ratio. And we have cash reserve ratio. Okay, they're very confusing for me because see, this is reserve deposit ratio. Now, whether it is for public or bank, that is the question. This is reserve. So reserve implies reserve deposit ratio. Of course, reserved. That word is used for banks. Therefore, reserve deposit ratio of bank. Okay, and cash reserve ratio. You are again selling. You are again saying that cash. You are reserving the cash reserve. So reserve, this word is used for the banks. So this is of bank, cash reserve ratio of bank. Now this CDR. CDR is what? CDR is currency deposit ratio. This is the catch. This is currency deposit ratio. Okay. Currency deposit ratio. This currency deposit ratio is not by the bank because it doesn't have this word reserve, right? Therefore, this currency deposit ratio of a public. This is something you need to remember. Don't forget. Okay, this is not of bank. It is of public. Currency deposit ratio. See, that is why the questions, they don't mention whether it is for the public or whether it is for the bank, because they want to confuse you. They want you to know this concept. Okay. And the question asks, in the context of Indian economy, consider the following statement. And this is an assertion reason based question. Okay. Statement 1. During the festive season, the currency deposit ratio of public, this is public, they did not give, but CDR is with public. So CDR is what? Currency held with public in the form of cash, currency with the public in their hands divided by demand deposits, money of public in the form of demand deposits. Okay. Money held by public in the form of currency divided by money held by public in the form of demand deposits is currency deposit ratio. Now, during the festive season, the currency deposit ratio most likely increase. I think yes, because during festive season, I need a lot of money in my hands to buy commodities. Therefore, I think this is correct. During the festive season, the transaction demand of the money increases. That is correct. I think this is only the reason why CDR increases, because transaction demand of money increases. Therefore, option A is correct. So, in context of liquidity management tools for implementing monetary policy of RBI, consider the following statements about the cash reserve ratio and statutory liquidity ratio. CRR is mandated by RBI Act 1934. SLR is mandated by Banking Regulation Act of 1949.
This is actually correct, but I think I need to discuss some information with you. See, this slide talks about the difference between CRR and SLR. Okay, CRR for the scheduled banks, it is discussed in RBI Act of 1934. So CRR the legal framework for the scheduled banks about CRR, it is in RBI Act of 1934. Whereas non-scheduled banks, they come under the Banking Regulation Act of 1949. The CRR provision for non-scheduled banks, it is in Banking Regulation Act of 1949. Whereas the statutory liquidity ratio for both scheduled and non-scheduled bank, the statutory liquidity ratio, it is present in Banking Regulation Act of 1949. Okay, next, applicability to non NBFCs. Okay, now they're asking about NBFC. Is CRR applicable to NBFC? As I said, CRR is not applicable to NBFC. We have studied in NBFC. It is not applicable. But SLR, it is applicable to NBFCD. This is NBFCD. It is applicable for NBFCD, and other NBFCs, it is not even applicable. So CRR to applicable है ही नहीं. SLR, it is only applicable for NBFCD. We have studied in NBFC topic. And maximum and minimum limit. There is no limit, like a maximum limit and minimum limit. Okay, CRR की maximum limit कितना वो है mention नहीं है. But SLR, yes, maximum limit is up to 40%. Okay, now maintenance. Cash reserve ratio, of course, is maintained in the form of cash. But statutory liquidity ratio, it must be maintained in the form of liquid assets like cash. Cash the first पहला liquid asset है. After cash, gold, which can be converted into liquid, I mean money. Government securities. So these three are the main liquid assets, and we also have government securities, which include treasury bill. Government securities. These government securities, they include treasury bills, dated securities, sovereign gold bonds, sovereign green bonds. All of them, they come under the government securities only. And special government securities, they also come under government securities. So all these government securities can be used in the statutory liquidity ratio. Now, this CRR, it is maintained with RBI. Of course, banks need to deposit that cash with RBI in CRR, but in SLR, they need to keep with themselves. Banks need to keep with themselves only. Okay. Scope for earning profit. See, under CRR, if you are depositing with RBI, you are not going to get any interest. So RBI do not pay any interest on cash reserve ratio deposits. What about SLR deposits? Does RBI pay interest to banks? Yes, banks earn interest on government securities. See, RBI, they are not even depositing with RBI. They are depositing with themselves only. So banks, they can earn interest on the government securities that they are depositing with themselves, right? And also banks can earn profits when the gold value appreciates. So somehow they are earning profits. There is a scope for earning profits in case of statutory liquidity ratio. See, how are you earning money? Interest to government securities. See, banks, they give money to someone. That is why they are holding this government security. So after this maturity period, they are going to get their money back along with a certain profit only. Therefore, yes, banks, they can earn interest on government securities if they are holding SLR. If they are holding G6 under the name of SLR, it is profitable for them only. And banks, they can also earn profit when the gold value appreciating. Therefore, yes, through SLR, you can have some interest. But CRR, it is just that you are putting certain amount of money with RBI. That's it. So this is the main difference between CRR and SLR. Now let us go to that question. So the question is asking us to differentiate. Now let us see. CRR is mandated under the RBI Act 1934. SLR is mandated under Banking Regulation Act of 1949. The question should have definitely mentioned scheduled banks, because for scheduled banks this is absolutely correct. But if you are asking about non-scheduled banks, then for non-scheduled banks, CRR is mandated under RBI under Banking Regulation Act of 1934. Therefore, this option. Now let us think for a period that they are talking about scheduled banks only, because the question mentions nothing, implies we need to take a general scenario. Under a general scenario, that yes, of course, non-scheduled, they are maintained under banking regulation, but it's an exemption. And economic questions, they work on the generalistic views rather than exemptions. Okay. Reserves maintained by banks under both CRR and SLR do not earn any profit from RBI. See, CRR definitely they do not earn from RBI, and SLR also they do not earn from RBI, but they earn profit by putting them with themselves. See, this is wrong. Why? Because the thing that they are saying they do not earn any interest is wrong. Just don't put it right, because they are not earning profits from RBI. RBI is only forcing them to put indirectly. RBI is helping them to gain some profits, right? So reserves maintained by banks under CRR and SLR do not earn interest from RBI. So SLR, they are getting some profits by keeping government securities with them. Unlike SLR, there is no statutory upper limit on CRR. Yes, that is correct, because see, we have seen SLR, it has a what is the statutory limit for SLR? It is 40%. 40% of net demand time liability. But we have seen there is no limit on CRR. This is also correct. So option 1 and 3 are correct. See, this question is giving us a definition and asking what does this refer to. You know all this. What is preferential issues? Let's revise. Preferential issues. I remember telling you this, the difference between ordinary shares and preferential shares. Do you remember? Preferential shares versus ordinary shares. Yeah, there is a difference. What is the difference? Ordinary shares, I have ownership, but here I am not a owner, I guess. And why I am not owner? Because I am sacrificing my voting rights, and I am asking for giving me guaranteed dividends instead. Guaranteed dividends. Guaranteed dividends. I am asking for dividends instead of voting rights. But here on the ordinary shares, I get my voting rights also, but I am not sure whether I get dividends or not. Not sure about this. May or may not. So in case let's say there is a case of liquidation, and the company is getting liquidated, during that time, who is going to get priority over shares? I mean, let's say it is getting liquidized. Now I need to get certain amount of money, right? Because I am the owner of the company. But see, you are the owner of the company. This is the reason why your company went into loss. Therefore, after all the people take money, you will be given the last preference. So basically, if I have ordinary shares, I have right of last claim. Right of last claim during liquidation. But in the preferential shares, I have priority over ordinary shares in case of liquidation. Priority over ordinary shares in case of liquidation. That is about ordinary shares and preferential shares. Preferential shares and ordinary shares are clear for you. Now, you know equity stock option. Equity stock option I discussed you with along with sweat equity. Okay, sweat equity versus you have sweat equity, and you also have employee stock ownership plan, right? ESOP, employee stock ownership plan. Employee stock ownership plan is nothing but they are issued by the company. Some shares they are issued by the companies to employees involving growth process. For example, company is growing, you should also grow along with me. This is when employee stock ownership plan is mentioned. Okay, employee stock ownership plan is nothing but a plan by the companies to involve employees in the growth process of the company as a part of remuneration. Okay, now sweat equity. Sweat equity are nothing but shares in the form of rewards. You are giving shares in the form of rewards to the employees in exchange for their hard work. Some employees पसीना निकाल के काम किया होगा, तो ऐसे employees के लिए कोई तो reward होना चाहिए ना, कुछ तो reward होना चाहिए. Therefore, you are giving rewards in the form of shares to employees in exchange for their hard work. This is called sweat equity. Okay. That is about employee stock option plan and sweat equity. You need to know the difference. Sweat equity, they are reward for you, and employment stock option plan, you are involving an employee in the growth process of the company. Now, what is private placement? Private placement, if you remember, I think I also said this. See, basically, I discussed right issue with you, right issue, and I discussed right issue, private placement. I discussed right issue, private placement, and anchor placement also. Anchor placement also. These three I have discussed with you. Right issue, private placement, and anchor placement. What are they? See, right issue, they are part of FPO. What is FPO? Follow on public offering after IPO. Let's say this is IPO. In the IPO, I thought of giving 10% of my company shares to the public, and now it is in the share market. So initial public offering, 10% that I'm giving. IPO is over, but still I think अरे मुझे 10% नहीं 20% देना चाहिए. Therefore, what I will do follow on public offering FPO. I will issue some more shares to the public under FPO. So right issue, they are part of FPO. A part of FPO meaning, see, it is basically invitation to people who are already shareholders of the company. मतलब, see, people who have purchased shares through IPO, they can purchase some additional shares in the company. So basically, companies are doing right issue. Companies are inviting people who have already purchased IPO. They are issuing this right issue. Come, you can buy some more additional shares. We are giving you this right issue because you are already our customers. You can purchase even more shares under our company. This is a right issue. Okay, this is given to the people who are already existing shareholders. So remember, part of FPO. Part of FPO, basically, right issue is nothing but an invitation to purchase new additional shares who have already purchased. So, invitation to already existing shareholders. Invitation to already existing shareholders to purchase additional shares in the company. Invitation to already existing shareholders to purchase additional shares in the company. This is right issue. What is private placement? It is not for retail investors. For example, let me say I am a retail investor. And the retail investor, I invest only less than 2 lakhs max to max. In the stock market, one-time investment also I will do only less than 2 lakh rupees. So, I am a retail investor, and this is not for retail investor, but this is for qualified institutional buyers. Private placement is for qualified institutional buyers. Example, very well-known companies, insurance companies, mutual funds. We are giving opportunities for them to invest in our company. This is only for qualified institutional buyers. So when we see qualified institutional buyers, this is going to boost the confidence of people also. People also will think, okay, wow, such a good qualified institutional buyers, such good insurance companies, LIC, they are investing in this company. That means this company must be really great. So it will invest the investors' confidence and it will make them further invest in this company. So that is about private placement. It is only for qualified institutional buyers and not for the retail investors. Okay, this is about right issue and private placement. Right issue, it is issued to already existing shareholders to buy additional shares in the FPO. Okay, and the private placement, it is not for retail investors but for qualified institutional buyers. And now anchor investors. Anchor investors are also qualified institutional buyers only. They are also qualified institutional buyers, but they buy large chunk of shares a day before IPO opens. That is the difference. Of course, private placement is for institutional buyers. I agree. See. But if you are asking me the difference between this QIB in the private placement and anchor placement, in the anchor placement, they are buying a day before IPO. A day before IPO, if people think that, oh, Procter and Gamble and Amazon, Google, a lot of international companies, they are investing in this company. That means during IPO, initial stage public offering, definitely it is going to boost consumer confidence, right? Therefore, a day before IPO, you are inviting qualified institutional buyers to invest in your company, and you are giving them a lock-in period also. They are having lock-in period. So this qualified institutional buyers, they cannot draw money in this lock-in period, say 1 year. So in this 1 year, they cannot withdraw money. Okay. So that is about right issue, private placement, and anchor placement. See, also you understood the main difference between private placement and anchor placement. Anchor placement, it is a day before IPO, but private placement, it is done by the qualified institutional buyers so that the companies can raise funds secretly. But however, it later, after a day, if a company is listed, it must definitely show who are the qualified investors to the people. That information must be disclosed. But initially, they work as a secret. How much fund they are doing, everything will be secret. But later, it might be out. That is main difference. The confidence boosting, it is mainly through anchor placement and not through private placement. Okay. Anyways, now let us see the question. A company offers its existing shareholders company offers its existing shareholders the option to purchase additional shares at a discounted value within a specific time period. Okay, simple. It's a right issue, right? Already existing shareholders are purchasing additional shares within a specific time period. This refers to rights issue. There is no other option because already existing shareholders तो सिर्फ right issues ही है. Private placement, anchor placement के साथ कोई confusion नहीं है. और preferential issues तो they are completely different concept. They are just they talk about the ownership and getting dividends. So this option is wrong. Equity stock option plan, it is like involving employee in the growth process of the company. This is wrong. Private placement, involving qualitative institutional buyers for raising money. So this is also wrong. And rights issue, yes, offering additional shares to the existing shareholders. Okay. Now let us see the next question. Okay, the next question, it is asking about certain things. Before that, you need to know about the structure. See, we have primary credit societies at the bottom, and then we have district central credit society. Okay, DCCS. District Central Cooperative Banks, DCCB, Primary Credit Society, District Central Cooperative Bank, and this is State Cooperative Bank. So these are all cooperative banks, and we are having Primary Credit Society. So the main function of this District Central Cooperative Bank, it is to give funds to this Primary Agriculture Credit Society at the bottom, whose main function is dealing with agriculture. Okay, so now if we see the contribution that it is getting, basically if you are talking about contribution to agriculture, contribution to PACs or contribution to agriculture, Primary Agriculture Credit Society, if you are talking, we have observed this data that scheduled commercial banks under RBI Act, second schedule, there are scheduled commercial banks, right? They are giving approximately 79%. 80% if you take the 79%, almost 80. 79%, it is through scheduled commercial banks only. It's an interesting data. Therefore, contribution to agriculture, it is not through rural banks or anything like that. It's a scheduled commercial banks that are contributing to 79%. Great. So the other 1%, see 80% to 1% to bacha. This 1% is this micro 1%, microfinance institution, NBFC microfinance institutions. These are NBFC, MFI. They are only just 1%. Okay. They provide collateral free loans to the agriculture sector, but they are only 1%. Therefore, they remember it as micro. Okay, these are the least contributed. NBFC, MFI. Okay, great. 79% is scheduled commercial banks. Next, who dominate next? Who is contributing most to the agriculture after scheduled commercial banks? It's District Central Cooperative Bodies. See, they are contributing to 15%. So 15% contribution to the agriculture is from this District Central Cooperative Banks. Great. Okay, now what? Now we have 5% contribution from the regional rural banks. Okay, great. So see, this is total 80, and 15% is through District Central Cooperative Banks. Then the next 20, the remaining 5%, it must be through what? It must be through RRB. That's all. Now let us see. In terms of short-term credit delivery to the agriculture sector, District Central Cooperative Banks deliver more credit in comparison to scheduled commercial banks. Okay. District Central Cooperative Banks हमने देखा कितना percent? 15%. Okay, great. DCCB 15% and deliver more credit in comparison to scheduled commercial banks. Scheduled commercial banks कितना? It is 79%, and RRBs it's around 5%. Even see 15% is less than 79 plus 5. Therefore, this option is only wrong. Yeah, one of the most important functions of DCCB is to fund Primary Agriculture Credit Society PACs. This is correct. So option 2 is correct. This question, it is asking about P notes, right? Okay, P notes. You know about P notes? If you don't know, I'll tell you. Let me tell you, foreign portfolio investor, right? See, I said you difference between FDI and FPI. If you remember, I said you difference between FDI and FPI. And FPI, they can invest in listed, going to be listed, and then they cannot invest in unlisted. And if they are listing, they should invest in less than 10% of that company's capital. Okay, this is less than 10% investment must be there. If they become more than 10%, they come under FDI, which is regulated by RBI. This information you know, right? Now that I'm saying, this FPI, he is not some foreigner who is investing in Indian portfolio. No, it's not. This there is a big background behind this foreign portfolio investor. So let us study that now. So if I'm taking this foreign portfolio investor, see. Okay, great. For example, say this is an FPI. Okay, this is an FPI, foreign portfolio investor. He's a foreign portfolio investor. So this entity, they are going and they're getting money from different foreigners. And this money, this FPI is going to use this money that they got to invest in India. So if a lot of overseas foreigners, they want to invest in India, then they are going to register with FPI, and this FPI is going to invest in India. Okay, this is not this easy as how it seems to be. These foreign entities, foreign investors, they want to invest in India's hedge funds or else India's stock market, whatever it might be there. Okay, then but they don't have this license. But this FPI, it is registered under SEBI, and this has license. Therefore, these foreign investors, they are registering with FPI to invest in India stock exchange. This is clear for you. And one more thing, if these foreign investors are giving their dollars to this FPI to invest in Indian stock exchange, there must be something that FPI must also give in return. There must be some agreement, right? That agreement copy is called P note. Okay, P note. So this P note is also called as what? Is also called as offshore derivative instrument. Also called as offshore derivative instrument. Simply putting ODI, offshore derivative instrument. P note is also called offshore derivative instrument. They are issued by the FPI to these overseas citizens. Okay, clear. So this is P note. You understood what is P note. Now let us see the slide. Okay, great. So a lot of investors, they are coming and investing in India's. They want to invest in Indian stock market or India's capital market. Therefore, they are registering with FPI, which is registered with SEBI. This FPI, they can invest in shares, bonds, real estate, and infrastructure, etc. Okay, and these FPIs, they issue offshore derivative instruments or P notes against their investment in the Indian capital market. This is all about P notes. Okay, there are some guidelines by the SEBI to these offshore derivative instruments or P notes. Just don't remember this heavily. Just remember that FPIs registered with SEBI can definitely issue this ODI. But this permission is given only to category 1. See, there are two categories in FPI. One is category 1 and category 2. Only FPIs under category 1 registered with SEBI can issue P notes. Okay. See, very simple. Category 1 FPI, they are registered with SEBI, and category 2, they are not registered under category 1. They are category 2. See, category 1, if you observe, they are mostly government agencies and central banks. Therefore, we are giving them some liberty and some benefits also. But category 2, they are moderately risky because they have some banks, unregulated banks, or else mutual fund entities, or foreign investment managers, a lot of them, which are not in the category 1. See, in category 1, we have put some safe players like government agencies and foreign central banks, insurance pension fund. They are all very safe. Okay, that is why these P notes, they can be issued only by category 1 FPI. And these P notes that are issued by the category 1 FPI, they are tradable outside. Okay, the investor 1, foreign investor 1 can trade it to foreign investor 2 outside India. Yes, they are tradable. Okay, there's a category, only category 1 FPIs can issue P notes, and they are tradable. I think this is what you need to remember. And also there is a compulsory KYC. I mean, I don't know where it's mentioned, or else I'll write it here for you in the side. See, only category one can issue P notes. Only category 1 FPI can issue P notes, and the P notes issued, they are definitely tradable outside India. They are tradable. And what else? Compulsory KYC norms are there. Know your customer, because it might lead to money laundering issues also sometimes. Therefore, P notes are very highly risky and they lead to money laundering. Therefore, there is compulsory KYC norms that need to be signed by the foreign portfolio investor with the SEBI. Okay. Now there are some questions. Let's try to answer. Do ODI investors hold security directly? No. FPI remains the owner of the underlying security, but economic benefits are transferred to that investor. Clear? Controversy. P notes can be used for money laundering through round tripping. Okay. Criteria for issuing ODI. Okay. So to issue this P note, FPIs must fulfill the KYC norms to reduce the anonymity of the investors. Monthly reporting of issuance of P notes must be given to the SEBI. Okay. These two criteria must be followed for issuing P notes. Okay. Can P notes be traded outside India? Absolutely yes. But only among the entities based in the FATF member countries. FATF member countries, Financial Action Task Force. Okay, I think most of the countries are in the FATF. Okay, SEBI's guidelines. SEBI guidelines 2024. There are new guidelines under SEBI. FPI issuing P notes shall have special type of registration with the term ODI as suffix. Okay, so there are category 1, category 2, right? This category 1, when they are registering, they will get a special suffix name. This FPI, ODI as suffix. Okay, ODI, FPI, something like that. It is going to be there. This is SEBI guidelines in 2024. FPI cannot issue P notes against derivatives. Okay, P notes, they cannot be issued against derivatives. That is the new guideline. Okay. So there was a news that P note investment surged to near 6-year high at 1.5 lakh crore. So great. I mean, foreign portfolio investors, there are many. That P note investments, they are surged to 1.5 lakh crore. It was in the news. Now let us see. Consider the following statements regarding the P notes in India. Investments flowing in India through P notes are considered as offshore derivative instruments. The other name of FPI is ODI. This is correct. I'll use another pen. Yeah. And the share of P notes in overall foreign portfolio investment has consistently decreased over the last 5 years. The news says it increased. Why will it decrease, by the way? India is becoming more and more stable. Anyways, this is wrong. And the answer is only one. So the next question, it is particularly talking about social stock exchange. So you need to know about what the social stock exchange exactly is. Okay, let us try to understand. Social stock exchange, SSE, it is a specialized segment of existing stock exchanges. Like for example, we have Bombay Stock Exchange, National Stock Exchange, right? Under SEBI, there are many various stock exchange like Bombay Stock Exchange, National Stock Exchange. Similarly, we have social stock exchange also. Okay, this is designed to help social enterprises to raise funds from the public. See, through BSE and NSE, it is the commercial companies that are raising funds. Okay, this social stock exchange, it is created for social enterprises to raise funds. For social enterprises to raise funds. Okay, this is created for social enterprises to raise funds from public. To help the public, we have created social enterprise, just a specialized segment of existing stock exchanges. Okay, social stock exchange is a specialized segment of existing stock exchanges like BSE, NSE, etc. Specifically created for social enterprises to raise funds through public. Now, basically, if you are seeing this, it is a social stock exchange. It is acting as a bridge between donors or social investors who want to do donations to social, who want to do donations to bring social impact. So basically, these donors and social investors, they can be these social investors. They can be non-profit organizations or anyone they can be. So they want to bring some impact. That is why they are investing in social stock exchange. So this is acting as a platform to bring social impact. Okay, now you understand about social stock exchange. Okay. So I want to know the working of this social stock exchange, how it works. So the primary goal is not financial profit, but it is a primary goal is what? Social return on investment. See, profit return on investment, it is for general stock exchange, but social return on investment, it is also called SROI. So its objective is SROI. Social return on investment is its objective. Okay, this is the objective. Clear. Okay. Now, anyways, the social stock exchanges, they have a very regulated environment, and they are governed under SEBI. Okay, to ensure transparency and mandatory reporting and auditing, they are governed under SEBI. Now, listing. See, if they are getting money. That money, if they want to register if an organization want to register in social stock exchange. If an organization want to register under social stock exchange, then definitely they need to prove that they are not here to raise funds for their profits, but they are here to raise funds for social intent, like to eradicate poverty, hunger, to promote education, or to encourage environmental sustainability. So if they are able to prove to SEBI, then they will be listed. At least 67% of their goals, they must be these social activities. Okay, clear. Great. Now, if they are registered under SEBI, they must also publish this AIR meaning annual impact report. This is audited by accredited social auditors to verify the actual social change they have achieved. So every year they must publish this. The organizations registered under a social stock exchange, they must publish this AIR annual impact report. Okay, great. Now this is what you know about social stock exchange. So their objective is not ROI, but it is SROI, social return on investment, and they are registered under SEBI, and at least 67% of their activities must be social, and every year they must publish this AIR. AIR is what? AIR is annual impact report, the impact that they are bringing. Okay, and definition of social stock exchange is a platform to connect social investors to to bring the social impact. Or basically, you can say, you can also give another definition, a specialized segment of stock exchanges, just similar to BSE and ENC, to help social enterprises raise funds through public. Any definition you can give. Okay. Now I'm asking you, how can they raise funds through social stock exchange? So what are the instruments that the organizations registered under social stock exchange, SSC, are having? First thing, they can issue zero coupon, zero principal bonds. What are the zero coupon zero principal bonds? They are specific to NPOs. Okay, they are specific to non-profit organizations. The zero coupon zero principal bonds, they are specific to non-profit organizations, which can be societies or trust or companies registered under Company Act, charitable companies and non-profit objective-oriented companies or trust or societies. They can be anything. Basically, they are directed towards NPOs. So zero coupon zero principal bonds can be issued by NPOs. First thing, and these bonds they carry zero coupon, means they carry zero interest. So even if you are investing, you're getting 0% of interest. Next thing, zero principal. You invested, but you are not getting this invested money back. No repayment of the original amount. Basically, NPO is doing donation to that organization under social stock exchange. That donation bonds, they are called zero coupon, zero principal bonds. Clear? Great. Now the next type of funds that organization under SSE can get is social impact funds. Social impact funds, they are basically a type of alternate investment funds that pools money to invest in social sector. See, alternate investment funds, it pools money into different sectors, right? Social impact fund is a type of alternate investment funds that pools money to invest in a different social sector, and the minimum investment is 2 lakhs. So under social, if an organization wants to fund an organization which is under SSE, it must at least do a minimum investment of 2 lakhs under social impact fund. Of course, they are going to get some CSR grants if a company is doing this social impact fund. If you have this much of CSR, then you will get tax exemption also, right? Okay. CSR is nothing but corporate social responsibility. Yeah. Now we have mutual funds. Okay. Mutual funds can also, funding can also happen through mutual funds. For example, so let's say there is a mutual fund and it invested in multiple portfolios, and finally it generated some returns. So if this returns, they are directed to invest in NPO, and if this NPO is investing in the social organization registered under SSE, then that kind of fund is also funding under social stock exchange. Okay, these are the 3 types of funds for a NPO, through an NPO. Okay, zero coupon, zero principal bond, social impact bond, mutual funds. I think you're clear. The next type of funds are for profit organizations. These are for non-profit organizations. We have funds for profit organizations. Okay, profit organizations, what type of funds they are? They are equities and shares. Shares, equity and bonds, debt. They are also called equity and debts, or else shares and bonds. Okay, shares and bonds can be issued in the social stock exchanges. For example, for profit social enterprises, they can raise capital through more traditional means like shares and debts, but they must still meet enhanced social reporting standards. Okay, yes, they can still raise money by issuing shares and bonds. Okay, but yeah, they must show their reports in the end. Yeah, through shares and bonds also they can raise money. That is why they are in the stock exchange. Why not? Clear? Now let us see the question. With reference to stock exchanges, social stock exchange considers the following. Okay, a non-profit organization or for-profit social enterprise registered in India that are engaged in the activity of creating positive social impact and that meets the primacy of their social intent will be eligible to be listed under social stock exchange. This is true, right? See, if there is an NPO and if its intent is to create a positive social impact, and this is also an NPO, then yeah, they are eligible to be listed in the social stock exchange. Next, similarly, the National Stock Exchange and Social Stock Exchange in India has been established as an independent social stock exchange. CCC, they are registered under SEBI and they are not independent stock exchanges. Okay. See, you don't have a because national social stock exchanges, first of all, they are not independent, or did I see it anywhere? They are within this NSE BSE only. They are, for example, if you see NSE, there is a separate specialized segment for social stock exchange. So they are registered under SEBI. Both are registered under SEBI, but National Stock Exchange, it is independent, whereas social stock exchange, it is built within NSE or BSE. Okay, they are specialized segments. Okay, therefore they are not independent. This is wrong. Next, unlike a not-for-profit social organization, for-profit organization, unlike not-for-profit means NPO, unlike not-for-profit social organization, for-profit organization can issue zero coupon, zero principal bonds for raising funds through SSE. See, as we have seen, this zero coupon, zero bonds, they are issued by NPO and not through profit organization. Profit organization, they can do what? They can use instruments such as shares and loans. Okay, something, shares and debt, equity and debt. So these instruments can be or shares and bonds. These instruments, they can be used by profit organizations. Non-profit organizations, they can go through zero coupon principal bond, or else what we have seen, social impact funds and mutual funds. So they have given this wrong. Only first option is correct. See, this is talking about a scenario question. For example, we can easily say that this lengthy question is a short selling. But anyways, let's see. An investor thinks that the company is overvalued right now, and he thinks that it will be down. It will go down later. Therefore, he's very intelligent. This investor, he borrows 100 shares. He don't have money. Therefore, he is borrowing 100 shares. 100 shares at what price? We don't know. But see, it is very overvalued, right? It is overvalued and it is going up. Therefore, he borrowed 100 shares from somewhere and he sold it. Therefore, he sold it at some market price and he generated some profits. Okay, great. And later, what happened? He got some profit, and then he, after getting profit, what he thought is that I need to give those 100 shares back. Therefore, I need to buy them again. Therefore, when he needs to buy those 100 shares again to give back to this guy from whom he borrowed those 100 shares, therefore, what he's going to do? This 100 shares, he thought that this is overvalued. It is going to come down anyway. Now he purchased it when it came down. To 50 rupees. So, and then he returned it to this borrower. So basically, this borrower, he got 100 shares, but this value of 100 shares, it is at a devalued price. Okay. See, one thing you need to remember is, I am just borrowing, not to sell it at this lower price. Okay. And the question now, it's very clever question. It is saying that he or she borrows 100 shares of the company from a broker. Okay. And then sells the share at the market price of same 100 rupees. So what is the profit that this guy got when he's selling at the same 100 rupees? He's not actually making it by selling it here. He bought it and immediately he sold it. Okay, he sold it. Now, what is this that he got? See, from this broker, he just got shares. But by selling immediately that 100 shares, he got this 100 rupees. You got it. Now 100 rupees are in my hands. Now, therefore, with this 100 rupees, what I'm going to do? I am going to buy those 100 shares again. But when I'm going to buy shares again, when the share market price goes down, see, I just bought those shares to convert it into money. I bought those shares, 100 shares, and I sold it to someone. So I generated 100 rupees. Okay, even if it now my intention now is to not make profit. Okay, but I can make profit later when the price goes down. Okay, so I currently after buying 100 rupees, I sold it to someone and I got some money. But I know currently the money that I got is a lot, and this the share of this company is going to reduce. And after a period of time, this share value actually got reduced to 50 rupees. So 100 shares are now at 50 rupees. Therefore, the investor now he has 100 rupees and he's going to buy those same 100 shares, but only for 50 rupees. And this 100 shares is going to give to that broker from whom he initially borrowed. So we are going to give him the shares, not the money, right? Of course, we are going to give him those same 100 shares, but the profit that I made is 50 rupees here. So this entire process is called short selling. Important concept.
Let's see the difference between small finance bank and a payment banks. Okay, small finance bank, they must meet a minimum 200 crore capital wala resident. What is this 200 crore capital wala resident? Meaning these small finance banks, they must have a minimum of 2 crore capital and they must be residents. This is the minimum entry ticket. 200 crore. This is the 200 crore capital is the minimum entry ticket to become a small finance bank, and the entry ticket for payment bank is minimum 100 crores. Okay, urban cooperative banks, they usually transition into small finance banks after a period of time. So urban cooperative banks transition into small finance bank. They have they must have capital of 100 crore, but they must increase their capital to 200 crores within 5 years. Okay, so that is the condition. And one more thing about the priority sector lending. Urban cooperative banks and small finance banks, they have a priority sector lending norm of 60%. Whereas payment banks, such a PSL criteria is not applicable. One more thing, urban cooperative banks, they are cooperative banks, and the small finance bank, it is a commercial bank. Both are different. Okay, but they sometimes transition into small finance bank. That is the story. Now, after 5 years, small finance bank, they can become universal banks. Okay, important to remember. This is the future potential. Okay. One more thing, let us see more in depth about payment bank. Payment bank, they require minimum 100 crore capital and they must be residents, and more than that, yeah, they cannot lend money or issue credit cards. Have you seen any credit card of a payment bank? See, currently there are six active payment banks. Okay, in India there are currently 6 active payment banks. These banks were established following the recommendations of Nachiket More Committee. Nachiket More Committee is there. So these banks were established after the recommendations of Nachiket More Committee to promote financial inclusion. Okay, we have Airtel Payment Bank, India Post Payment Bank, and Geo Payment Bank, Fino Payment Bank, NSDL Payment Bank, and the most famous Paytm Payment Bank. Paytm is very well known. Okay. So these are the 6 active payment banks: Paytm Payment Bank, Geo Payment Bank, Airtel Payment Bank, India Post Payment Bank, Fino Payment Bank, and NSDL Payment Bank, National Securities Depository Limited Payment Bank. Okay, so these are the 6 active payment banks. For example, let us take Paytm. Now, did you see Paytm giving credit card or lending money? So can you take a credit from Paytm? No, because they cannot issue credit card and we cannot take money from them. Payment banks, they do not lend money. First thing to remember. And next, therefore, they don't have any credit card. And remember, payment banks, they do not have any NRI deposits and they can accept only demand deposits. For example, let's say I am depositing in Paytm. You know Paytm wallet. So what you are depositing in the Paytm wallet, it's demand deposit. But there is no time deposit for a fixed period of time. There is no lock-in period like that. So, and you know, the maximum balance up to which that me as a customer can deposit in a Paytm payment bank is 2 lakh rupees only. Maximum up to 2 lakh rupees only. It is just for a payment service. Okay, that they are payment banks and they cannot issue a credit card and they cannot lend money and they accept only demand deposits but not time deposits. And there are no NRI deposits. There are no NRI deposits. Of course, no, right? There are no NRI deposits in the payment banks, and they can they have a valid balance is maximum up to 2 lakh rupees per customer. This is about payment banks and priority sector lending norms. No such things are applicable. अरे priority sector lending कैसे कर सकते हैं? Lending ही नहीं कर पाएगी तो PSL norms कैसे हो सकता है? See, you are not even able to lend. How can you lend it to agriculture and priority sector? No, so no such things are applicable. But PSL norms here, small finance banks, they are for underserved farmers. They are for unserved and underserved farmers. There is a UPSC 2017 question which said that small finance banks are to help young entrepreneurs. No, small finance banks, they are to help unserved and underserved farmers. Okay, important to remember. And they have a priority sector lending norms of 60%. Okay, now let us see. Yes, they are normal banks, therefore they can give credit card and debit card to our underserved farmers. Cannot accept deposit without any restriction. Oh, can accept deposits. Yes, they can accept deposits. That is why we are having debit card. They can lend money. That is why we are having credit card. And they are for underserved farmers. Small finance banks are for underserved farmers, and that young entrepreneurs, that is absolutely wrong. And minimum 200 crore capital wala resident. But if an urban cooperative bank, if it is converting into small finance bank, there is a 200 crore capital, and there is an important clause that a small finance bank must at least a small finance bank must have at least 25% branches of the total number of banking outlets open during a financial year. They must be located in a unbanked rural centers. Okay, 25% of the branches of the small finance bank in a financial year, they must be located in where they must be located in unbanked rural areas. Okay, what is this unbanked rural areas? See, they are basically unbanked rural areas are basically Tier 5 and Tier 6 villages which do not have any scheduled commercial banks. So they do not have scheduled commercial bank. Tier 5 and Tier 6 villages which do not have any scheduled commercial bank are called unbanked rural areas. So there is a compulsory clause that in a financial year they must definitely open 25% of the branches in an unbanked rural areas. Okay, for example, there is new small finance bank. They are typically required to meet this 25% quota in 1 year of commencing operations for a new finance bank. if a small finance bank, if it fails to adhere to this 25% by end of 3 business years also, RBI will give time till 3 financial years. And if it fails to adhere to this even after the end of 3 business years, RBI may impose penal measures, including the restriction of further opening of the branches. Okay, that is small finance bank versus payment banks. Immediate overview: 200 crore, 1000 crore, unserved farmers. It is for promoting small savings and easy payment. And yes, it is for credit and debit card. It cannot issue credit card, but yes, debit up to 2 lakh rupees per customer. And there are no NRI deposits in the payment banks. One more thing, they do not have any PSL. Payment banks do not have any PSL, but yeah, small finance banks and urban cooperative banks, they have a PSL up to 60%. And after 5 years, a small finance bank can become a universal bank. So this question demanded me to explain that again. Okay, let's see. Consider the following statements regarding the payment banks and small finance banks in India. Which of the following statement given is correct? Okay, unlike payment banks, small finance banks cannot issue checks drawn on themselves. See, okay, they're asking about checks. See, small finance banks, saying that small finance banks cannot issue checks and payment banks can issue checks is absolutely wrong. This is for sure. Because small finance banks, as we have noticed, they are just similar to regular banks, which can issue credit card, debit card, and everything. If I need to doubt, then I will doubt this payment bank only. But they have already said that payment banks, they can issue checks, but small finance they cannot. So let us see. See, small finance bank, they can definitely issue checks. Therefore, this is wrong. But let us see whether payment banks can issue checks or not. Payment banks, they can deposit up to 2 lakh rupees and they can also issue checks. Okay, they can also issue checkbooks. But yeah, they primarily operate digitally and yeah, they can draw checks on themselves and they can accept deposit from customer up to 2 lakh rupees. Of course, checks they can be issued by payment bank. Don't confuse with NBFC. If you take NBFCs, they are not banks. Okay, payment banks are banks, but NBFCs, they are not banks. Therefore, they are not part of payment and settlement systems, and therefore they cannot issue checks. Whereas payment banks, they are part of a payment and settlement system. We are using payment, and yes, they can issue checkbooks. Okay, both small finance banks and payment banks, they can issue checks. Next, neither payment banks nor small finance banks can accept time deposits from the public. See, I know one thing that I've studied. Payment banks, they can only accept demand deposits and they cannot accept time deposits, that we have read particularly. Therefore, okay, this neither they can, both of them. Yeah, payment banks, it is correct. They cannot accept a time deposit, nor a small finance bank. No, they're asking about small finance bank. They can accept a time deposit. What's the problem? It's just a regular bank. It can accept a time deposits. Therefore, this option will become wrong. And then, unlike a payment bank, small finance banks, it can directly lend money to the customers. Yes, lending money. Payment banks don't lend money, but small finance banks, they lend money, right? We have seen that. Payment banks cannot issue credit or cannot lend money. Therefore, they don't have any priority setting lending criteria also. This is unlike payment banks, small finance banks can directly lend money. That is correct. This is actually correct. And unlike small finance banks, payment banks are required to invest 75% of the total deposits in government treasury bills. This is something that I have not explained you, but this is true. Are required to invest 75% of the total deposits in government securities and treasury bills. Therefore, after they deposit 75% in the treasury bills, the remaining they have 25%, and this 25% they can deposit anywhere else. That's up to there. But the 75% they must be deposited with government securities and treasury bills, and they are eligible for SLR also. So they are meeting this minimum SLR criteria, 18%. So all such that criteria, under SLR criteria, these securities are eligible. Okay. So to earn a return from this remaining 25% of the funds, they are not locked by the government securities because they also need to generate some profit, right? Therefore, what they do, they go to some commercial banks like SBI, ICICI, etc., and they surplus their extra cash. Okay, this rule for payment banks, it is mandated in this Banking Regulation Act of 1949. Okay, therefore, this is something you need to remember about the payment banks. Their 75% is in government securities and 25% they are going to use for earning returns. So this is about the payment banks. So small finance banks, they don't have such a criteria. Okay, now the option is only 3 and 4. This question is very easy. Scheduled commercial bank has been in. See, second schedule of Banking Regulation Act or second schedule of Reserve Bank of India 1934. Whenever I was discussing this about RBI, powers of RBI, I always said RBI Act of 1934, and I always said about second schedule, which has a list of scheduled commercial banks. Okay, and the eligibility criteria to become a scheduled commercial bank. I always said you. Okay, so therefore, Banking Regulation Act, this is different. Don't get confused. It is in the year of 1948, transfer of ownership, and so transfer of ownership, basically all the private banks, they transferred their ownership of the RBI to the government. So RBI became government. Basically, more than 51% of RBI ownership is with the government. That is the RBI transfer of ownership 1948. And in the 1949, there was this Banking Regulation Act which gave RBI powers to issue licenses on the companies in India. Okay, that is in the year of 1949. So the answer for this would be, don't get confused with that. Second schedule, it is clearly in the RBI Act of 1934. The answer would be C. Consider the following in respect of digital rupee. Okay, let us see. It is a sovereign currency issued by the RBI in alignment with its monetary policy. Correct. It appears as a liability on the RBI banker sheet. Correct. It is insured against inflation. Even a normal rupee note is only not insured against inflation. So this is wrong. Just they are confusing you. It is freely convertible against a commercial bank. Freely convertible against a commercial bank. Yeah. See, digital rupee, they can be converted into cash also. Let's say you can use your UPI, pay some digital rupees, and get 5 rupees in return in the form of cash. That is possible. Therefore, answer is 1, 2, and 4. So before going to the next question, I would like to see what is Financial Service Institutional Bureau, FSIB, Financial Services Institutional Bureau. So in 2016, the government established the Banks of Bureau (BBB) on recommendation of a PJ Nayak committee. Its mandate was to recommend the names of persons for appointment of chairmen and board of directors. Okay, so BBB, based upon the recommendations of this BBB, government used it to make appointments. Okay, government has now replaced this BBB in 2016 with FSIB. Okay. BBB meaning Banks Board Bureau. Banks Board Bureau was replaced with the Financial Services Institution Bureau. Okay. Now question: is FSIB a statutory body? No, it is non-statutory body under nationalized banks. Next, nodal department. It comes under the Department of Financial Services under the Ministry of Finance. Okay. For example, Ministry of Finance has various departments. Department of Economic Affairs it takes care of budget. Similarly, Department of Financial Services is a nodal department handling Financial Services Institution Bureau. And next mandate, it recommends names of persons for the appointment of chairpersons and the board of directors of public sector banks, public sector insurance companies, and financial institutions such as NABARD, NHB, CDB. So it basically recommends the names for the appointments of all these board of directors. Okay, appointment for the chairpersons of directors of all these board members. Okay, next, advise the government on the matters relating to the transfer and termination of services and code of conduct, performance appraisal. So advices related to transfer and termination, code of conduct, performance appraisal, they are being taken care by Financial Services Institutional Bureau. What is the difference between BBB and FSIB? The role of BBB was limited to making recommendations of public sector banks. Okay, only PSBs was there for BBB, but FSIB, it recommends not only for the public sector banks but also for public sector insurance companies and financial institutions as NABARD, CDB, Exim, etc. Now the composition, this Financial Services Institutional Bureau, it contains 11 members. All the members, including the chairman, are part-time members. Okay, that means there might be some ex-officio members, right? The chairperson is appointed by the government and is usually a person expert in the field of banking and finance. This is about Financial Services and Institutional Bureau. This is a non-statutory body, and Union Finance Minister, it seems to be correct because we did not study, but it is wrong. It is some secretary of a Department of Personnel and Training. He or she is going to be the chairperson of Financial Services Institutional Bureau. Okay, that is about first option. And second option, it recommends persons for the appointment as whole-time directors in the PSB. See, FSIB, basically it has 11 part-time members. Don't confuse with this whole-time directors. Okay, 11 part-time members. These 11 part-time members who are ex officio of something, they are going to appoint these whole-time directors. They are going to appoint whole-time directors of public sector banks and other. Okay, so this is whole-time directors in public sector banks. This is correct. It recommends persons for appointment. Okay, do not get confused. It issues binding directives to banks for reducing their gross non-performing assets. Okay, it is saying binding directives. You know, FSIB from the beginning I said it is a recommending body. So binding directives, when binding is already extreme. Okay, so such options will be wrong. Okay, binding directives for reducing NPA will be wrong. So there is only one option. B is correct.
The next question talks about DICGC. Let us cover some points about it. First, all the banks like cooperative banks, commercial banks, regional, rural banks, payment local banks, whatever, all these banks, they come under the purview of DICIG, meaning DICIG covers insurance under these banks, but DICG do not cover insurance for NBFC, rural cooperative societies, and we also have deposits of foreign banks. They are also not covered under DICIG, central and state government and interbank deposits. Therefore, these 5 categories, they are not covered in DICIG, and the remaining, yes, they are covered. What type of deposits are covered? They can be saving or current, or they can be fixed or recurring. So they can be demand deposits or time deposits. So all of them are covered under this DICIG. And once you pay the premium, that premium is borne. You should not pay the premium. On behalf of you, bank is going to pay the premium for to DICIG. You are just going to give 10 lakhs to the banks, but bank, it is going to pay premium and insure 5 lakhs with DICIG. Okay, that's all. And I think it is not better to remember than the remaining point. It is just saying that if ever there is a moratorium, then rupees 5 lakh can be withdrawn by the depositor within 5 days of placing that moratorium. This is what is mentioned in DICIG Act. And also one more thing, it is mentioned that repayment by the bank to the corporation, meaning let's say DICIG is going to pay you 5 lakhs. Then what about this bank? This bank one day or the other must pay 5 lakhs to that insurance company back. Okay, this is what is mentioned. So the premium that banks need to pay is 0.1% of total outstanding deposits, which they don't ask, I guess. So don't remember. Now, these are all the exemptions that we know, which are all not permitted in DICIG, NBFC, rural cooperatives, central or state government, interbank borrowings, and what else? Foreign banks. So interbank borrowings, because see, you're borrowing from another bank and keeping with you, and you're asking me to insurance for insurance in DICIG, that is not possible. So all these 5 are not possible. Let us see. The DICIG insures deposits like deposit of state land development bank with state cooperative bank. See one thing, state land development, this is not in DICIG. State land development is also an exemption in DICIG. Please remember, and therefore this is also not covered. Deposits of state land development banks with the state cooperative bank, they are not covered, and interbank deposits, they are not covered. See one thing or the other. Even why did I even write specifically deposits of state land development bank with state cooperative bank? It is an interbank, and interbank deposits, they are not covered. Therefore one is wrong naturally. Okay, interbank deposits, they are not covered, and current account deposits of individual with a commercial bank. See, as I said, commercial banks, they are included in DICIG. This is correct. I think only one. We are having so here it's the same. We are having RTGS, NEFT, and IMPS and UPI. You know, right? RTGS, real time gross, since it is gross minimum 2 lakhs, and we have NEFT. NEFT and IMPS is just 1 rupee minimum limit, but since it is immediate, therefore maximum limit there is 5 lakhs. Yeah. Now let us see the question. The UPI, does it also have some limit? UPI, yes. Actually, UPI has maximum amount of 1 lakh rupee. Therefore, but under exemptional circumstances, you can transfer up to 5 lakh rupees. Okay, but anyways, it is only up to 1 lakh rupee for UPI. So in a day, you cannot transfer only 1 lakh using UPI. Now consider the following statement in respect of RTGS and NEFT. Real time gross imply bulky. Therefore, minimum it is how much? 2 lakh. I think 2 lakh minimum transfer value. And NEFT is immediate. Okay, great. And it is on half an hour basis, no? Because it is funded, it is very old. Therefore, half an hour basis. Yeah, these are the points that I remember. Now let us see. In RTGS, the settlement time is instantaneous. RTGS, the settlement time is instantaneous, while in case of NEFT, it takes some time to settle payments.
Yeah, NEFT is half an hour basis, and RTGS it is real time gross. Therefore, it is instant. This is very true. And in RTGS, the customer is charged for inward transaction, while it is not in case of NEFT. Okay. See, we have seen that there are no inward charges for any most of the transfer payments, but I think we have seen for IMPS that banks are going to decide the charges. So for only immediate payment, there are some charges, and they're going to be determined by the bank. Anyways, both RTGS and NEFT, according to me, they don't have any inward transfer charges. And then operating hours for RTGS are restricted on certain days, while this is not true for NEFT. Operating hours, I think I have studied only 24/7 for all of the transactions they had 24/7 operating operations. Therefore, this is also wrong. According to me, only one is correct. They are asking how many of them were operated by NPCI. Okay, this NACH. Well, after immediate payment system, we had NACH, right? Yeah. And as I said, they are incorporated by NPCI only. At least IMPS, you know that it's incorporated. I mean, it is operated by NPCI. Okay. NACH is National Automatic Clearing House. It is also operated by NPCI only. What about financial switch? Toll collection. Toll collection we have studied. It is operated by NPCI. We are having national switch, financial switch. See, we have UPay, whatever we have studied after IMPS, most of them they are operated by NPCI only. So we have studied about these three. That is why I'm taking as a NPCI. Now we are having financial switch and RuPay card payment, RuPay card network. Actually, this question you need to just memorize that all the five of them they are operated by NPCI only. National Financial Switch also it is operated by NPCI, and RuPay card network is also operated by NPCI. So all five. The question is asking about debt recovery tribunals. Okay, recovery of debt, and we have this act. You need to see this Recovery of Debt and Bankruptcy Act of 1993. Debt recovery tribunals and debt recovery appellate tribunals established based on the recommendations of Tiwari Committee and Narasimhan Committee. Okay, this debt recovery tribunals and debt recovery appellate tribunals they are based on the recommendation of Tiwari Committee and Narasimhan Committee. First point, and the next point talks about the scope of these debt recovery tribunals. Okay, applicability of banks. Example, they are only applicable to scheduled commercial banks. Of course, I mean commercial banks mean scheduled commercial banks, cooperative banks, and NBFCs. Okay, and minimum amount for recovery, rupees 10 lakhs and above. So if the recovery amount is more than 10 lakhs, then you can go to debt recovery tribunal. That means this tribunal do not handle cases less than 2 lakh. The next, modes of recovery: attachment and sale of the movable or immovable property, appointing a receiver for the management of the property, and arrest. Okay. So related to these things, you can go like movable or immovable property, etc. And maximum time for the disposal of the case is 180 days. So you started this case due to some bankruptcy, and there is 180 days period. Within this, you need to dispose this case. And this debt recovery tribunal, the chairperson of debt recovery tribunal is he must be qualified to be a district judge. Okay, and must have also served as district judge. Then only he or she is eligible to become the chairperson of debt recovery tribunal or debt recovery appellate tribunal. Now let us see the question. Remember which act? It is 1993 Act. Now they're established under the provisions of the Securitization and Reconstruction of Financial Assets and Enforcement of SURFACE Act. So it is not SURFACE Act. They are established under the Recovery of Debt and Bankruptcy Act 1993. Debt and Bankruptcy Act of 1993. Okay, therefore this is wrong. Okay, maybe you can try because this did not have the name of this. Mostly such options will be wrong. You must definitely have the name of the body in that act. The chairperson of the DRT must be qualified to be a district judge or must have served as a district judge. Well, it's true. Therefore, only B. They are talking about convertible bonds. Okay, as there is an option to exchange the bond for equity, convertible bonds pay a lower rate of interest. They're saying that convertible bonds pay a low rate of interest. Is it true? This is true because see, you have taken a bond from some entity and you are asking them that you want to convert it later if you feel risky or something. So such type of bonds, they're definitely going to have low rate of interest, right? The option to convert to equity affords the bondholder a degree of indexation to raising consumer prices. That is true. If you think that it's better to sell the bond now, it is like you are getting this flexibility to act in accordance with the consumer price inflation or something. I think you're clear. This is both 1 and 2. So basically, you can convert that bond into equity if you feel like you want to convert it because you think that company is rising. Therefore, this will enable the bondholder a great degree of indexation to raising consumer prices. Which of the following policies help to raise interest rate unambiguously and thereby leading to appreciation of currency? Okay, appreciation of currency. They want to appreciate our currency, therefore there must be less rupees in the market, right? Therefore, rupees must go to the bank. Then only rupee can appreciate. So if currency wants to appreciate, there must be less number of rupee. Less number of rupee implies contractionary monetary policy and contractionary monetary policy. That's true. Unfortunately, there is only one option with contractionary monetary policy, option D. What about expansionary fiscal policy? Up to some extent, I can think of this because so basically during expansionary fiscal policy, the output of the economy is increasing. Since the output is increasing, therefore it is natural that the demand for a rupee increases and therefore it will lead to appreciation only, right? So this is the natural thought anyways. Option D, contractionary monetary policy, there is only one. In context of Indian economy, consider the following. Okay, how many of them are part of high-powered money? High-powered money, we have seen that it is a currency. It is with the public and banks. Currency in circulation, which is with the public and bank, plus deposits with RBI. Deposits with RBI. Deposits of whom? Deposits of banks and deposits of foreign central banks and multinational banks. They are deposits with RBI. So all of them together constitute currency in circulation. Now let us see. Currency held by the public. Net time demand, no. And there is no option. Cash reserves of the commercial bank. Okay. This is true, I guess, because currency with banks also come for. Therefore, only 2. As I said, cash held by bank in the currency in circulation. There is also CUB. Therefore, only 2. We are having one more question. Priority sector lending is an example of which of the following qualitative instrument control used by RBI? I think it's credit rationing. That's a very easy question. Credit rationing, PSL. Okay. With reference to marginal standing facility, a monetary policy tool of RBI, consider the following. Okay, marginal standing facility. Consider the following is always fixed above repo rate. See, you have repo rate. 25 basis above you will be having marginal standing facility, and 25 basis point below you will be having standing deposit facility, and together their difference must be 50 basis point. Okay. Now marginal standing facility rate is always fixed above the repo rate. This is correct. And under this facility, the banks can borrow from the RBI without pledging any collateral security. I said rate similar to repo will not have repo or reverse repo will not have collateral, but there are some minute exemptions. For example, if I say bank rate, they don't have collateral, but marginal standing facility they are overnight loans, therefore they need to pay collateral. But yeah, they're given exemption to use collateral mentioned in the statutory liquidity ratio (SLR). Okay, they can use SLR securities. That is possible for MSF and SDF. As I said, they do not require collateral, just like reverse repo. Reverse repo and repo they require collateral. Now, they're saying under this facility, banks can borrow from the RBI without pledging any collateral. This is false. Only one is correct. Okay, let us see some more questions from the money and banking. Okay, there are two statements. As regards return from investment in a company, generally bondholders are considered to be relatively at lower risk than stockholders. I'm saying that bondholders considered to be relatively at lower risk than stockholders. This is very true. Bondholders are lenders to a company, whereas stockholders are its owners. This is also true. For repayment purposes, bondholders are prioritized over stockholders by company. This is also very true. 2 and 3 are correct, and both of them they explain statement 1 according to me. The next question: what would be the impact of the economy if people start holding more currency in hand and withdraw more money from the bank savings and time deposits? If people are having a lot of money in their hand, how can the money multiplier increase? So it will decrease. This is correct. And currency deposit ratio decreases. See, what is currency deposit ratio? Amount of currency held with the public in their hands divided by what? Demand deposits. Currency held by public has a demand deposits. Okay. Therefore, this option is wrong, because see, this numerator is increasing. Currency held as a cash in the form of cash with the public it is increasing, and demand deposits with the banks it is decreasing. Therefore, CDR it should increase. Therefore, this option is wrong. One option is only correct. So a lot of people tend to do this second option as correct, because they think that currency deposit ratio is amount deposited in the bank. They take it in the numerator and they take this second option as correct. The second option is wrong. You need to be very careful. It is with the public. Cash held by the public is currency deposit ratio. So the next question, it's asking about liquidity overhang. Liquidity overhang, a lot of people they tend to get confused with liquidity trap. For example, where can I write? Let me write it here. You have liquidity trap. What is liquidity trap? See, RBI is adopting some expansionary monetary policy, but despite RBI's efforts of expansionary monetary policy, people they don't want to accept loans and bonds of the banks, because they are trying to save more money. They want more money, but they don't want to take any loan because they are not certain about the future. So this is a liquidity trap, because people have lost confidence and RBI policies they are not working. That is liquidity trap. But this question is not talking about liquidity trap. Okay, it's talking about liquidity overhang. Liquidity trap. The second option is matching with my liquidity trap. Adverse economic conditions where expansionary monetary policy fails to stimulate credit growth and economic activity. This is liquidity trap. Okay, don't confuse. Now liquidity overhang. What is liquidity overhang? Liquidity overhang is a situation in which excess money supply in the banking system poses a potential risk to fueling inflation. That's all. This is a normal term. Liquidity overhang. This is a normal term that when a bank is doing excess money supply in the economy, this will lead to inflation. That is natural. So therefore, that is liquidity overhang. Lot of liquid, therefore overhang. Liquidity overhang. Fueling inflation. Option C. Don't be confused with liquidity trap. Trap means you got trapped and you don't want to accept expansionary. So expansionary monetary policy is basically trapped. RBI is trapped. But overhang, a lot of money supply in the economy. Overhang ho gaya. That for inflation. Okay. This question, consider the following statements. See, you have 3 people here. Suppose an IT professional spends ₹fruit on 100 rupees on fruit. I am an IT professional and I am spending 100 rupees on a fruits guy, and I give 100 rupees to this fruit guy, and he thought of purchasing clothes from a shopkeeper, and therefore this 100 rupees went back to this shopkeeper, and the shopkeeper he want to upgrade his IT system, and therefore he again gave this 100 rupees to this IT professional. Okay, so in the end the money is being circulated among these 3 people only, but still this is being counted in the GDP. So what is this called? I mean, it is like, exactly to be precise, there is no output generated, but still I am counting it as in the GDP. That is right. See, number of sales is only GDP, but still the same thing is being circulated there. Basically, there is no output in the economy. So this is called neutrality of money. I'll show you here. Neutrality of money. Changes in the money supply affect only the nominal variables, but do not affect the real variables. Nominal variables like prices and wages, they are going to be affected. Wages, yes, you bought money from me, therefore I am going to get 100 rupees. My wages increase or something like that. So they affected nominal variable. Nominal meaning money, but not real. Real meaning output, GDP. That is not affected. That is called neutrality of money. So the next question is about CRR and SLR. You know the differences already. CRR it comes under RBI Act 1934, and SLR it comes under BR Act of 1949. But if you take non-scheduled banks, they are also falling under BR Act 1949 under CRR. Okay, this is the main difference between CRR and SLR. And one more thing, SLR they have a maximum limit of 40%, and there is no limit for CRR. Okay, present rate is 3% for CRR, and SLR it is 18% of net demand time liabilities. 18% of net demand time liabilities and 3% of net demand time liabilities is the rate that banks should keep with RBI. Okay, now let us go to the question. With reference to statutory liquidity ratio, consider the following statement. Okay, it is a reserve in which banks have to maintain with the RBI. See, with the RBI becomes false, because SLR banks need to maintain with themselves, and CRR banks need to maintain with RBI. That is the main difference. Okay, this is wrong. It is used to control the expansion of bank credit and ensure solvency of commercial banks. See, this first part is true. Okay. Anyways, I need to eliminate first option. Okay, next. Cash management bills are considered eligible liquid assets for SLR requirements. Fourth option says state cooperative banks are exempted from mandatory maintaining of SLR. I have not studied anything like such, but still, if I need to go between B and C, I think 2 and 3 they are automatically correct, because both of them have them in the common. But see, let us see second why it's correct. It is used to control expansion of the bank credit. SLR will control, yes, and ensure solvency of commercial banks. So basically, solvency, you are confused about this term, right? Solvency. Solvency refers to a company's capacity to fulfill long-term debts. Okay, therefore, if you are controlling the expansion of a bank credit, you are ultimately controlling the company's capacity. I mean, you are increasing the company's capacity to fulfill its long-term debts and financial commitments. So indirectly, you are helping that bank. RBI, when it is helping with the statutory liquidity ratio, what is it doing? It is basically telling the banks to have government securities with themselves. Put government securities with themselves. 18% you must put it with yourself. So from this government security, they are definitely going to earn interest in future, and it is going to help those banks to raise its future capacity, right? Therefore, SLR is indirectly helping banks. That is ensuring solvency of commercial banks. That is solvency meaning banks' capacity to fulfill long-term financial commitments, reflecting good financial health of banks. Okay, that is solvency. Now this is correct. And cash management bills are eligible liquidity assets. See, liquidity assets, they are just government securities. Okay, and cash management bills, they are also government securities. Why are they not eligible under liquidity assets? They are eligible. And the fourth option says state cooperative banks are exempted from mandatory maintaining of SLR. I have not studied anywhere about SLR being exempted for certain cooperative banks. Therefore, I cannot mark this for sure. If there had been such thing, I would have studied. Since I did not study, therefore, I will not go for this option and I will choose B. Okay, now the next question is about money multiplier. Okay, in a fractional reserve bank system in an economy, the money multiplier is always less than 1. Oh, the banks in the fractional reserve system have to hold a fraction of the deposits as reserves. Since the next question is talking about money multiplier, let us look into the concept of money multiplier. Okay, see, money multiplier, let us say that initial deposit is 10,000 rupees. Okay, and the reserve is the reserve ratio is 20% for any bank in India. Now let's say I deposited 10,000 rupees in one bank, and it must reserve 20% at least. That is the minimum required reserve, including CRR and SLR. Let's say it's only 20%. So 2,000 rupees out of 10,000 is going for reserving only. Therefore, 8,000 rupees could be lent by the bank as loan. Let's say this bank lent all this 8,000 rupees as loan to another bank, bank B. Okay, bank 2. So the deposit in bank 2 is 8,000, and but for any bank it can reserve up to 20%. So 20% of 8,000 becomes 1,600. So this bank 2, it can reserve up to 1,600 and can lend loan of 6,400. Now this 6,400 will be again deposited in bank 3, and so the loop gets repeated and so on. So when we come together and add all these deposits, they are coming out to be 50,000. And let's say there are only 5 banks in our economy. Okay, now I tried of adding the deposits in all the banks. They are roughly around 50,000. This reserve money, if I did this summation, I'm getting 10,000, and the money lent as loan by these banks is around 40,000. Now the formula for money multiplier says that money multiplier is deposits created by initial deposits. So in the economy, the total deposits created are 50,000. But the initial deposits, they are only 10,000. Therefore, 50,000 by 10,000, this is going to give me the money multiplier. Deposit created in the economy divided by the initial deposit, that is 10,000. So 50,000 by 10,000, it is going to give me 5. Therefore, money multiplier will be 5. So tell me one thing, are you always going to do this calculation? This will definitely be very bulky. Therefore, there is a shortcut formula. Money multiplier is nothing but 1 divided by cash reserve ratio. 1 by 20%. 1 by 20% becomes 2 5 13. Money multiplier you will get is 5. Okay, that is the shortcut for money multiplier. Okay, simply putting, we can say money multiplier is the multiple by which initial deposits increase, right? Multiple by which the initial deposits increase is called money multiplier. Okay, now see, in a fractional reserve bank system, of course, fractional, 20% is put as reserves, therefore it's a fractional reserve banking system. In the fractional reserve banking system in an economy, the money multiplier is always less than 1. Okay, I don't think. And the bank in a fractional reserve system have to hold a fraction of the deposits as reserves. I think 2 is correct, 1 is false. Okay. Under the Fiscal Responsibility Budget Management FRBM Act 2003, the Reserve Bank of India may describe the primary issues of. Under the Fiscal Responsibility and Budget Management Act 2003, the Reserve Bank of India may subscribe to the primary issues of central government securities under which of the following exceptional circumstances: to meet temporary mismatches in cash receipts and payments of the government, correct, and during a state of war or national security emergency, correct. When the fiscal deficit of the government exceeds the target by more than 10%, monetization of the deficit, I don't think this is correct. During structural reforms in the economy is correct. I think only 1, 2, and 4. Do we have an option? See, 2 is definitely correct. Therefore, 2 is definitely correct. 2 and 4 are definitely correct. We have 3 options. Great. I'm saying 2 and 4 are correct because state of war and national security emergency and structural reforms, this is something we studied just now. But to meet temporary mismatches in cash receipts and payments, as I already said you before also, RBI is not going to encourage fiscal deficit of the government by monetizing it. Therefore, only under the exceptional circumstances it can be triggered. Therefore, to meet temporary mismatches, we cannot use. RBI cannot give loan to central bank. No, this is not possible. And the third option is also like RBI encouraging government during fiscal deficit. That is also wrong. Therefore, option B is correct. So the next question is about merchant discount rate. Okay, merchant discount rate. There is certain rate that business households, business people, they need to pay. That is a merchant discount rate. Why? Basically, MDR. This is the percentage of each debit or credit card transaction that a business pays to process payments, and the fee typically includes around 1% of the transaction. Between 0.4 to 0.9% of transaction, depending upon the category of the merchant and mode of acceptance. Whether he is using physical POS or QR code, all such factors depend. See, you are using, for example, a merchant, he is using easy access, right? Transactions happening very quickly. Therefore, banks, they are charging this merchant. That charge is approximately 0.4 to 0.95%. Currently, UPI doesn't use any merchant charge. Therefore, even if we are going and paying in some retail shop, there is no merchant charge on this person because there is no MDR fixed by the UPI to the merchants. So currently, they are being very liberal, but I think over a period of time, this merchant discount rate will also be implemented by UPI. Okay, so this is customer who is going to this merchant and doing his transaction. And this MDR, which is fixed by the RBI, ranges around 0.4 to 0.95% of the value of transaction. And later, very interesting thing happens. The proportion of MDR, it is not only borne by the merchant but also by different banks. Like see, MDR definitely merchant is going to pay, right? But this MDR gets disputed among some entities. For example, this MDR is shared by the merchant's bank, and for example, let's say it's HDFC Bank. It will be shared by the merchant's bank, and there is a customer's bank, the customer who came to us, his bank account, and payment system operator like UPI. Okay, 3 people are going to be involved in this MDR, so that MDR will be distributed among these 3 people, and the proportion of MDR which gets shared with the customer's bank is called interchange fee. Okay, as I said, you have this MDR, and it will be distributed among the merchant bank and the customer bank, and what next, and the platform providing this, let's say UPI. So the proportion of MDR which gets shared with the customer's bank is called interchange fee. Okay. And this is fixed by the payment system of operator, PSO. Card networks such as Mastercards and Visa, they all provide a platform. Okay, for example, card issuers, they compete with each other for interchange fee to the bank. For example, if Mastercard offers interchange fee to ICICI Bank, more interchange fee to ICICI Bank, and Visa is offering less interchange to ICICI Bank, then obviously this customer bank wants more interchange fee because they want more profit, right? Because as I said, there are 3 people involved. One is the customer bank, one is the merchant bank, other is the customer bank, and other is the platform. So if this platform is providing more income to this customer bank, more income meaning more interchange fee, then obviously that card is going to be accepted by the customer bank, let's say Mastercard, Visa. So accordingly, this customer bank will accept. For example, ICICI Bank may only accept Mastercard. So you see these symbols. So these are the transaction providing platforms. Currently, there is no such merchant discount rate that is being fixed. So this is the exhaustive overview of a merchant discount rate. It is a fee that banks charge merchants for processing payments in real time. This is correct. And presently, no merchant discount rate is levied on BIM UPI transactions. Correct. So we have the same question against NEFT and RTGS. One thing I forgot to tell you is that this NEFT, RTGS, and IMPS, whatever they are domestic services, and they cannot be used to transfer funds abroad. Just use your brain. Using UPI, can you transfer money into your sister's account who is in America? No, that is not possible. Okay, remittances, we have separated different system. Okay, therefore, very easy question. Let's see. It will be a revision. Unlike NEFT, which processes transactions individually, RTGS transactions are collected and settled. No, RTGS is real time and batches. This is utterly wrong. And unlike NEFT, there is a minimum amount below which money cannot be remitted through RTGS. Yes, real time gross. Therefore, minimum 2 lakhs amount it is there. And unlike NEFT, RTGS can be used to transfer the funds abroad. Funds abroad, they can be both NEFT, RTGS, IMPS. All of them they cannot transfer abroad. So only 2 is correct. Option A. I don't know why there is a polity question here, but let's see. The chairman and members of Lokpal of India are appointed by the President of India on the recommendations of selection committee. Acha. How many of the above are part of selection committee that recommends Lokpal? Lokpal have studied it in the polity. Fine, let me try. One thing I remember about this Lokpal selection committee is there are total 5 members, Pal meaning 5, and I remember that Lok meaning Lok Sabha. So Lok Sabha, there is an emphasis of Lok Sabha, and I remember that leader of opposition of Lok Sabha and the speaker of Lok Sabha, they are going to be members of the selection committee. So option 4 and option 5, they are going to be there. Yeah, I remember. And the chairperson, it is going to be the Prime Minister. We have 3 members now and 2 members from the judiciary. One is Chief Justice of India, other is the eminent jurist. So this is what I remember. Currently, the options don't mention CJI and eminent jurist. So there is Prime Minister of India. So only 3 are there. Well, don't bother about that question. It's from polity. In India, the central bank's selection. In India, central banks function as the lender of the last resort. Okay, usually refers to which of the following? Lender of last resort meaning lending to governments lending to second option, providing liquidity to the banks having temporary crisis. Only this is the only emphasis of this statement. I think B. Okay, joint stock company. What are the following? Okay, it has a legal existence. There is a limited liability of shareholders. It has a democratic management and it has collective ownership. See, I don't know about types of companies. Honestly, to be saying, I don't want to read about the types of companies. It is useless for UPSC. Anyways, it has illegal existence would be wrong. Think of taking a guess, okay? For taking a guess, you need to have a skill of analyzing the alternate statement. It has a legal existence. What is the alternate statement? It has illegal existence. What feels correct? This feels correct. Therefore, I'll take it as correct. There is a limited liability of shareholders. What can be the alternate? Unlimited liability of shareholders. Since this is a joint stock company, maybe one company might not have a full liability on the shareholders. That is possible. Therefore, limited liability of shareholders would be correct, according to me. I'm guessing. And unlimited liability it is sounding wrong. And it has a democratic management. Okay. Undemocratic management would be wrong, according to me. So, alternate statement is feeling wrong. Therefore, I'm taking it right. It has a collective ownership. Alternate statement would be it has a solo ownership. See, joint stock company, it means that there might be 2 CEOs and there might be some collective ownership. But a solo ownership, it is for feeling wrong. So, therefore, I am taking it as correct only. I'm taking this correct. According to me, all options are correct. This is statement of purpose analysis, SOP analysis. This is how you try to approach correct answer by analyzing the alternate statement and feeling which is most correct. Question is about a digital rupee. This is in use because of a CBDC, Central Bank Digital Currency. Okay, let us see some details. For example, CBDC, it was introduced through RBI Act of 1934 based on the recommendation of Subhash Chandra Garg Committee. This can be asked, and they have the same denomination as physical notes and coins, and they this concept of a minimum reserve system, it is also applicable to CBDC, and it is a legal tender and liability of RBI. Okay, this is something you know. Now let us see. It is a liability of RBI, digital rupee. This is correct. It is available in the same denomination as a physical currency. Correct. No interest is paid to the customer on the digital rupee balances in the e-wallet. Come on. They are just asking you to differentiate. See, for example, there is a deposit and there is a CBDC. CBDC, it is not a deposit, first of all. Therefore, you will not be getting any interest. But deposits, they are deposits. Therefore, you will be earning interest. They are just comparing with the deposits and confusing you. Therefore, all the three options are correct. How is Payment Regulatory Board different from Board of Regulation of Payment and Settlement System? Payment Regulatory Board is different from Board of Regulation of Payment and Settlement System. Yeah. So, see, they both are constituted under this Payment and Settlement System Act of 2007 only. But Board of Payment and Settlement System, it functioned as committee within, okay, see, BPPS functioned as committee within the Central Board of RBI, while PRB, it functions as an independent regulatory body within RBI. So PRB, it is functioning as independent regulatory body, independent regulatory board, whereas BPCS, it is a committee within the Central Board of RBI, okay. Within the Central Board of RBI, we are having some committees, and one of the committees, Board of Payment, Board for Regulation of Payment and Settlement, that is BPCS. But whereas PRB, it is an independent regulatory board, okay. Unlike PRB, BPSS includes only the representatives from RBI. It does not include government representatives. The composition is also different. For example, if you take BPCS, it has only 3 members. Board of Regulation for Payment and Settlement System has only 3 members. Those 3 members are representatives from RBI, and it is a committee within Central Board of RBI. So RBI has Central Board, and this board has many other boards, and one of the board is Board for Regulation of Payment and Settlement. Okay, and the members, they are 3 representatives from RBI only. But Payment Regulatory Board, it is an independent regulatory body within RBI. Okay, that is the difference. Now let us see the question. It is established under the RBI Act. No, just now we have seen it is PSS Act of 2007, Payment and Settlement Act of 2007. This is wrong. Reserve Bank of this is wrong. Union Finance Minister is the ex officio. No, it is headed by the RBI Governor. This is wrong. And it is responsible for regulation of both the domestic and cross-border payment system. Basically, I don't know about the third option, but since 1 and 2 are wrong, obviously we are only having a third option as correct. Okay, so the payment, simply putting, yes, it is responsible. It is responsible for the regulation of both the domestic and cross-border payment system. Payments Regulatory Board is responsible for the regulation of both domestic and cross-border payment system. Something that you need to know. This question is from UPSC Prelims 2024. In India, which one of the following can trade in corporate bonds and government securities? Okay. Corporate bonds and government securities. I don't think anyone is restricted in these activities. I don't think anyone is restricted. So I think D is correct. Some questions are easy scoring if you have confidence to answer them or confidence to mark them right. As per Economic Survey 25 to 26, which of the following are likely to cause a decrease in the long-term interest rate in an economy? So these are the different variables which are affecting the long-term interest rate, long-run interest rate. So let us see what are these variables. For example, let's take any variable. Let's take GDP growth. Okay, what happens if GDP growth increase? If GDP growth increase, then output in the economy will increase. Therefore, there will be demand for more number of goods. Therefore, there will be demand for more credit. GDP growth implies increase in output. Okay, I'll write this. GDP growth, output increases. Therefore, more demand for credit. There is a lot of demand for credit, right? There's a lot of demand for credit, and therefore, what will banks do? Banks will increase the rate of interest. Rate of interest on loans will increase. So, impact of independent variables on long run interest rate. Therefore, it is positive. Okay, the coefficient is positive. We have 0.67. That is how GDP growth impacts interest rate in long term. Now, let us see one more variable. Let us take this is given in economic survey only. Let us take this variable government debt. Okay, what happens if government debt increase? It will lead to crowding out, right? Private investors are not going to get the money, and corporate sector they feel disadvantaged. So it will lead to crowding out effect since corporations are moving out because they are not getting debt for investment. Okay, so it will lead to crowding out effect. Then what will happen to the loans that are left for the private sector? Obviously, they are not going to get. Therefore, banks are going to increase the interest rate. ROI, rate of interest on loans, it is going to increase. Why? Because a lot of business people, they are asking for more loans. Therefore, banks, they are going to increase the rate of interest. It's better I denote it with I. Okay, the rate of interest on loans, it will increase. So that is about government debt. Now let us take any other variable. Let us take a current account balance. Let's say current account balance is increasing. That means there is more inflow than outflow in the economy. That is why current account balance increased. If current account balance increase, then what is going to happen? There is a lot of money in the economy, so people are going to demand less loans. Therefore, what will banks do? Banks will decrease the interest rate on loans. Okay, that is how this happens. What about financial debt? Financial debt. Do you know what is financial debt exactly? So we need to understand about the financial debt. Financial debt is nothing but efficiency of mobilizing savings is called financial debt. So efficiency of mobilizing savings is called financial debt. Okay, great. So this can be seen in two perspectives. One is in the perspective of bank or in the perspective of any bond issued by any entity. Okay, let us see it in the perspective of bank. Now, what happens if financial debt FD if it increase? If financial debt increase, it means that indicates that efficiency of mobilizing savings it increased. Therefore, banks are going to get more deposits, right? Mobilizing savings, people are saving a lot. Therefore, deposits will increase. Deposits, more number of deposits. Okay, financial depth increase, then there are more number of deposits with banks. Therefore, they can lend more money to the people. Implies rate of interest on loans, it will decrease because they have a lot of deposits. Now they can lend loans at lower rate of interest. Okay, that is in perspective of bank. Now let us take perspective of bond also. It's the same thing. For example, efficiency of mobilizing savings in perspective of bond. If it increase, that means financial depth is increasing, right? If financial depth is increasing, you would like to invest in more bonds to save. So you are investing a lot. Therefore, I can say more investments. More investments. If you are finding, then what is going to happen? See, now there are more number of investors, right? So if there are more number of investors, that means you need to use your logic here. If there are more number of investors, of course, the demand for bond will increase. That will increase the bond price. Therefore, what do they think? They have a lot of bond. Our bonds are in demand in the market right now. We need not pay more interest on bonds. Therefore, we shall pay less interest to the people. That is what the perspective of bond, the person who is issuing bond would think. Therefore, he is going to decrease the bond interest because you don't want to give more money to the people. You don't want to pay more interest. Therefore, he is going to definitely reduce the interest rate. Therefore, increase in financial debt, it will reduce the interest rate, whether it is a bank deposit or whether it is a bond investment. Okay, it is in the end negative. It is having negative relation, and current account balance, it is also having negative relation. So these two, financial debt and current account balance, are having negative relation. Let us see the question now. Okay, as per the economic survey in 25-26, which of the following are likely to cause a decrease in long-term interest rate? They are asking about a negative. Just now we have seen a current account balance. If it becomes surplus, then it will decrease interest rate. Why? Because there is a current account surplus, more money, inflow is greater than outflow. Therefore, interest it is going to reduce. Long-term interest it is going to reduce. Okay, rise in the government debt levels. Corporates are going to have less money with their hands. Therefore, interest rate is going to increase. This is wrong. And increase in the GDP growth. If GDP is, there is a lot of output in the economy, people are demanding more credit, therefore interest will increase here. This is also not correct. Only one is correct. I skipped this topic with you, types of companies in India, because I think it is not important to study. But at least we can study the difference between a private limited company and a public limited company. This differences is must to learn. For example, both of them, they are under Companies Act 2013. But with respect to the minimum number of members, there is a difference. For example, private limited company can have minimum two members, but a public limited company, they must have minimum 7 members. And next, private limited company cannot have more than 200 members, and there is no such limit for a public limited company. It can have any number of members. And the next thing is registration. Private limited company and public limited company, their registration is mandatory. Both must register. And what else? Advantages, so they can raise a capital from multiple investors. And public limited company, they can be listed on the stock exchanges, and their ownership is also transferable from people to people, because they can be listed on stock exchanges. However, private limited company, they cannot enter into stock exchanges because they are not a public limited company. Therefore, their shares are not transferable. This is the main difference between a public limited company and private limited company and a public limited company. Private limited company has a cap of only 200 members. Okay, and they cannot list in a stock market. And also, I wanted to tell you one more thing. Okay, see, I said that I said you about money multiplier, right? Did I say? Yes, I said money multiplier. I said what did I say? Deposits created by initial deposits. So money multiplier is simply M3 by M0. Okay, it is nothing but the multiple by which initial deposits have increased. That is money multiplier. One thing you need to remember in money multiplier is this can be simply written as 1 by cash reserve ratio. This is what I said. Actually, instead of cash reserve ratio, better remember it as reserve ratio. For example, reserve ratio, it includes a lot of things. For example, statutory liquidity ratio, cash reserve ratio, and deposits with RBI. So all such things, because they are not using for loans, right? They are reserving somehow in some way. So all such come under reservation. In case in extremely situational condition, if you want to choose only one option, if you want to choose whether it is CRR or SLR, any one in between, then you are going to choose CRR usually. But yeah, reserve ratio, it is everything CRR, SLR, and deposits with RBI. That is all I wanted to say. The next question, very important. Reserve Bank of India reduces cash reserve ratio by 100 basis point. Okay, see, you know what happens if Reserve Bank of reduces cash reserve ratio? Obviously, there is more CRR, reduce it whatever basis point it is. Therefore, there is more money in the economy right now, right? More money in the economy. What is the impact? Let us see. The government borrowings from the commercial banks will drastically reduce. Okay. See, if CRR is reduced, that means banks are willing to lend more loans. How can government borrowings reduce? I mean, this is not linking. Then foreign institutional investors will bring more money, more capital into the country. This is also like there is more money circulated in the economy, but that doesn't mean foreign institutional investors are coming and investing more capital into our country. This is also not a direct impact. Scheduled commercial banks may cut their lending rates. See, CRR is reduced. Therefore, for example, if there is any scheduled commercial bank, may cut their lending rates. They are saying so. Loan interest rate, let's say it is 7%. Now, after CRR is reduced, it might be reduced to 5% because now they can lend more loans. So, scheduled commercial bank may cut their lending rates. This is possible. It will reduce inflation in the economy. If there is more money, how can it reduce inflation? This is also wrong. This next question is a previous year question. I said many times that with reference to Indian economy, RBI implements market stabilization scheme primarily through open market operations by buying and selling government securities. Okay, that is how market stabilization scheme is operated. Okay, government securities, market stabilization scheme primarily through open market operations. Okay, OMO. Okay, the next question is talking about push transactions. See, if you take UPI, there are two types of transactions. One is a push transaction. You are actually pushing money, and pushing money means this is initiated by the user. Initiated by user. Okay, I am initiating to push money into some shopkeeper account. Okay, I am pushing money into shopkeeper account. That is push transaction. And there is also pull transaction. I mean, that shopkeeper, he is pulling money from my bank account. So that is pull transaction. That is a request for payment. Request for payment, it is initiated by shopkeeper. Okay, so there are two types of payment. One is a push transaction, another is pull transaction. Two types of transactions. Now let us see. With reference to transactions carried out through unified payment interference, consider the following: a customer scanning a QR code at a grocery store to make a payment. So is it push? Yes, it is push. Okay, next. A e-commerce platform sends a collect request to a user's UPI application. That is a pull transfer, right? Because e-commerce platform, they are sending a payment request. That is pull transaction. So this is wrong. Now next. What's next? A user enters a mobile number or UPI ID and transfers money to another person. This is again push transaction, right? Therefore, only 1 and 3 are correct. See. This question, I think it's from ancient history or something. The national motto Satyameva Jayate inscribed on the lion capital. See, we have 3 lions, right? Standing 3 lions, and 4th lion it is in the back side. And on this lion capital of Ashoka, we are having Satyameva Jayate, right? Satyameva Jayate. Actually, this is borrowed from ancient text of Mundaka Upanishad. Okay, Mundaka Upanishad. How do you remember this Mundaka Upanishad Satyameva Jayate? See, it is very difficult to remember, I know, but I don't know why this question was asked. But yeah, remember that truth comes out on Monday, because Monday is the starting day of week. Truth comes out on Monday after Sunday. Okay, Monday. Monday is Mundaka Upanishad. So truth is Satyameva Jayate. Satyameva Jayate comes from Mundaka Upanishad. Okay, so remember something like that. Mundaka Upanishad. This question, core banking solution, is a previous year question. Core banking solution is sometimes seen in the news. Okay, it is a network of bank branches which enables customers to operate their accounts from any branch of the bank on its network, regardless of where they open their accounts. This is actually the definition of core banking solution. There is nothing else to do here. The second options all say that it is an effort to increase RBI control, and it is a detailed procedure by which a bank with huge non-profit assets is taken over by other bank. See, it is not to actually increase the RBI control by imposing CRR, not something like that. See, core banking solution, it is basically, I have Canara Bank, right? Now, what can I do? this Canara Bank account I opened when I was in Chennai. Okay, but anyways, I want to access something related to it when I came to Delhi. So I will go to the Canara branch in Delhi and open it. So such kind of provisions they are mentioned in core banking solutions. Okay, it's basically the network of bank branches which enable customers to open their accounts from any branch of the bank on its network, regardless of where they open their account. Okay. See, the question is asking about credit rating agencies. So you know there are what are the global credit rating agencies that are very famous? Just example, S&P. We have Moody, and we also have Fitch. They're the global credit rating agencies. What are the Indian credit rating agencies? Indian credit rating agencies. We have ICRA, and we also have CRISIL. ICRA, CRISIL, and Brickwork. This is very famous, Brickwork. So these are the Indian credit rating agencies: Brickwork, ICRA, and CRISIL. Okay. Apart from credit rating agencies, there is also one more term: credit information agencies. Credit information agencies. What are credit information agencies? I will give some examples of foreign credit information agencies. Example: CIBIL. We talk about CIBIL score, right? That is a foreign credit rating agency. It gives information about your credit score. Okay, how frequently you are able to pay your loans back. CIBIL. So this is credit information agency. Similarly, we also have Experian. There is this Experian and CRIF High Market. This is also there. CRIF High Mark, CRIF High Mark. So these three they are credit information agencies. Anyways, these agencies they are foreign owned, but they got a license from RBI. Okay, they got license from RBI, and therefore they are regulated by RBI. But yeah, they are all foreign owned. These credit information agencies. They are also known as credit information agencies or credit information companies. So they operate under the CICRA Act, Credit Information Companies Regulation Act of 2005. Okay. Since they are registered in India, for example, CIBIL, in India it is called CIBIL India, and CRIF High Mark India, they are labeled like that, Experian India. Okay. Now let us see. They are regulated by SEBI. See, I am talking about credit information agencies. Information they are regulated by RBI, but credit rating agencies they are regulated by SEBI. Remember. Therefore, option 1 is correct. And next, yeah, they are regulated by SEBI, not RBI. Information agencies, yes, RBI. They access the ability and willingness of the entity for the timely payment of interest and principal of debt instruments issued by the entity. Yeah, that is how they rate, right? They will they will assess not only the ability but also the willingness to pay the debt. Okay, all such parameters like the ability to pay and willingness to pay, all such parameters are analyzed by the credit rating agencies. Okay, instruments rated in the speculative grade are considered to have a higher probability of default. Of course, the instruments that are rated in the speculative grade, they are definitely going to have higher probability of default compared to instruments that are rated in the investment grade, right? This is also correct. This is a natural. Everyone should answer. They are asking which one of the following are wholly owned by the government of India. That means 100% by the government of India. There is none option. Thank God, because I used to think only more than 50%, 51% always. So, okay, CDB, I know that only 20% is owned by the government. Therefore, 3 is wrong. And I think other than CDB, National Housing Bank, Exim, Export Import Bank of India, NABARD, they are all fully owned by government of India. Yeah, so you know, government of India in CDB it is 20%, and the remaining they are owned by, for example, other agencies. 40% is by other only. The rest 40%, if you see, I mean, 50% State Bank of India, LIC, NABARD, they are going to take a shareholding in the CDB. So CDB is a Small Industry Development Bank of India, and the government it has only 20% share. Whereas Exim, if you see, Exim or National Housing Bank and NABARD, they are all wholly owned by the government of India. The question is about urban cooperative banks that you already know. You know, what do you know? Okay, they're asking about what? Whether it comes under the Banking Regulation Act of 1949 or not. See, you know that Banking Regulation, cooperative bank first. Cooperative bank, you studied that in the cooperative bank, they are dual regulated. One is by the Register of Cooperative Societies and the other is RBI, state government and RBI. So this is what you remember, dual control. And however, this dual control was removed for urban cooperative banks. This is removed for urban cooperative banks and multi-state cooperative banks. Under which act? Of course, the Banking Regulation Act only. This act, I think it was amended later, and later it gave more powers to RBI. Okay, Banking Regulation Act only. Therefore, urban cooperative banks, they require license from RBI under the provisions of Banking Regulation Act for commencing a banking business. This is correct. And next, presently, they are allowed to lend money only for non-agriculture. This only becomes extreme, and they are saying it is excluded. It is exclusive only for non-agriculture. I think this is absolutely wrong. And the National Urban Cooperative Finance and okay, they are talking about NUCFDC. That the NUCFDC for these banks has been established with the objective to accelerate the digitalization of cooperative banks. Okay, first you need to know what is this NUCFDC is. Now let us see the content. The NUCFDC, National Urban Cooperative Finance and Development Corporation, it was set up on the recommendation of Vishwanathan Committee on Primary Urban Cooperative Bodies. Okay, it acts as an umbrella organization for urban cooperative bodies registered for non-deposit taking NBFC with RBI, right? Therefore, unlike rural cooperatives which operate in a three-tier hierarchy, primary urban cooperative banks operate on a standalone basis. Due to the limited area of operation, they cannot mobilize more deposits and hence have a low capital. Lower capital implies lower investment in IT infrastructure or a low skill set for employees. Therefore, authorizer capital. Due to these reasons, we implemented this NUCFDC. Now it can get loans from issuing bonds. Now, capital. Authorizer capital of rupees 500 crores. Capital would be contributed by the member UCBs. Okay, NUCFDC would also mobilize capital from banks and capital market. That is how that is why we have NUCFDC to mobilize capital from banks and capital market. Okay, is membership of NUCFDC mandatory? Yes, membership is voluntary. However, UCBs would benefit by becoming members if they join NUCFDC, but yeah, that is voluntary only. Next, a role of umbrella organization acts as a self-regulatory organization for UCB and accept deposits and provide loans to members. Okay, therefore it is voluntary, but yeah, UCBs are willing to be part of NUCFDC. That is about NUCFDC. Now let us see the question. Okay, the NUCFDC for these banks have been established with the objectives to accelerate the digitalization of cooperative banks. Okay, they're talking about digitalization. Digitalization, I'm not sure, but one thing I'm sure is that if it is, I mean, if for example, if UCB is able to get loans via NUCFDC in some primary or secondary market by the digitalization, then that is also good, right? I mean, NUCFDC can help accelerate these UCBs to get to be digitalized. Okay, that is possible because this looks very generic. If I think of the alternative statement, NUCFDC for these banks has been established with no objective to accelerate digitalization of cooperative banks. This feels wrong. Therefore, I will take it as correct. Okay, there are many criteria for which NUCFDC might have been originated. The main thing is what we discussed, but certain things we have not discussed, but that doesn't mean it is not included. Okay, you need to be careful for generic statements. Whenever you are marking generic statements as wrong, think of the alternative and think of which feels right. So this is in use because 20 years of establishment. Okay, consider the following statements with reference to the World Health Organization Framework Convention on Tobacco Control. Framework Convention on Tobacco Control. Okay. So it is the first international treaty negotiated under the auspices of the World Health Organization. It was in 1996. Now this is 2026. Therefore, I'm saying 20 years of this convention, and this convention is also important because it is really the first international treaty. See, WHO, it might have done many treaties because it was established in 1948. However, they do not have any legal basis. WHO got a legal basis at the very latter stage. So therefore, yeah, this is the first international treaty negotiated. Auspices meaning support, under the support of WHO. Yes, this is the first international treaty negotiated under WHO. That is why this is important. Framework Convention on Tobacco Control. Okay, once a country ratifies the treaty, it becomes legally binding. See, meaning of ratification means legally binding on the country. So the meaning only they said legally binding on the country. This is also correct. It has not yet ratified. Okay, India has not yet ratified the treaty. Okay, see, whenever ratification comes, you need to see whether India ratified it or not. This WHO FCTC, it was negotiated in 1996. However, it was finally adopted in 2003, and in that 2003 only, India passed this COTPA. This is Cigarettes and Other Tobacco Products Act 2003. Okay, which aligned with the treaty goals. So we had this COTPA 2003. Okay, and India, it has ratified the treaty. That is why in India you see health warnings on tobacco products and no smoking in the public places, all such things. So you are able to see because India has ratified this treaty COTPA and it has launched this COTPA 2003. Okay. Not yet is wrong. Therefore, only 1 and 2. This question is very simple. It is asking difference. Okay, it is asking about MSF, right? MSF rate is the penal rate at which banks can borrow on overnight basis from RBI. That is correct. They are overnight loans from RBI, similar to repo rate, but overnight loans they are borrowed at an interest rate higher than repo rate. One thing you need to remember is that repo rate it is issued to the banks on the discretion of RBI. So banks can borrow from RBI only on the discretion of RBI. RBI will decide when to give repo rate, when to not. Okay, but this MSF rate it is not on the discretion of RBI. Usually the banks they are asking RBI for overnight loans and therefore they are borrowing at an interest rate higher than the repo rate. And banks can avail loans under the MSF without providing any collateral. I said they need to provide collateral. They can even use a collateral under statutory liquidity ratio for overnight loans. Okay, therefore this is wrong. MSF rate serves as the upper bound or ceiling of the liquidity adjustment facility called that is correct. LEF equal to MSF minus standing deposit facility, right? There is no limit on the amount a bank can borrow under MSF. Is there any limit on which I have never studied that there is a limit? I think this is in news or something. See, this no limit is wrong. Actually, RBI said that up to 2% of NDTL you can borrow from me. There, RBI put some restriction on the amount you can borrow from MSF. That is 2% of NDTL. Okay, up to 2% of NDTL can be borrowed by a bank from RBI using MSF. Okay, 2% of NDTL. Therefore, there is no limit would be wrong. So option 1 and 3 are correct. Option C. Financial market instruments and how many of them are money market instruments. Okay, see, we know commercial papers and treasury bills, they are money market instruments, and you are listening this intercorporate deposits very newly. Actually, we have not discussed in the money market instruments, but it is a money market instrument, unfortunately. So it is similar to intercorporate, meaning so it is from one company to another. So that means it is a intercorporate, meaning company to company. It is similar to bills of exchange. Bills of exchange, you are exchanging rupee and security. That is how it is. And one more thing, this intercorporate deposits, they are unsecured. They are unsecured. You need to remember. And what else? And moreover, the bills of exchanges, you know that they are tradable, but this intercorporate deposits, they are not tradable. They are also not tradable. And this regulation, it is given in Companies Act of 2013, intercorporate deposits. Okay. And so this is all that I know about intercorporate deposits, and they are part of money market instrument only. That is basically companies are taking loan from one company to another company. That is all without any collateral. Okay, therefore without any collateral, and that such instruments they are not tradable. For example, if I say intercorporate deposits are tradable, I'll say no. Now, what about Indian depository receipt? You might have heard similar terms like American depository receipts. What are they? Okay, see, for example, there is a foreign company, and if it wants to invest in India, but it is not able to invest directly. Why? So therefore, what shall this foreign company do? It will deposit in a overseas custodian bank. Okay. Now, for example, a company in the UK, it wants to invest in India, therefore it will invest in a company in UK. Invest in a bank in UK. Okay, it deposited something. So the shares that this company deposited, they will be converted into IDR by our Indian NSDL or CSDL. Okay, National Securities Depository Limited or Central Securities Depository Limited. Okay, they are going to issue this IDR. IDR meaning Indian Depository Receipts in stock exchange, and people like us, they are going to buy this IDR, and accordingly, their price might increase also. And after a certain period, they might they take back the shares and they can receive their profits. So that is how this Indian depository receipts work. Similarly, if an Indian company wants to invest in wants to invest in America, then of course such kind of depository receipts issued by issued in the American stock exchange are called American depository receipts. So they are different. Now, anyways, Indian depository receipts, they are not money market instruments. Okay, that mechanism is only completely different, and they are not money market instruments used by the RBI to control or to bring any monetary policy measures. No, therefore this is wrong. IDR is wrong. So this is always important. Many PYQs were asked. List of agricultural loans and that can be categorized in the PSL. Okay, crop loans, agricultural machinery, post-harvest infrastructure, loans under KCC, and to the distressed farmers, or loans against negotiable warehousing receipt. Warehousing receipts are also part of PSL. Important to remember. And loans for installation of solar agricultural pump, loans for agricultural startup and food processing industries. It is questioned directly from the news about Mission 300. This is recently launched by the World Bank and Asian Development Bank to provide electricity access to 300 million people in the sub-Saharan Africa. That is to provide electricity. Mission 300, electricity to 300 million people in sub-Saharan Africa. Okay.
See, this ETF, they're talking about exchangeable traded funds. See, when I used to invest in a stock market, I know this famous fund, CPSE ETF. That is similarly, I just invested in CPSE ETF like any other stock. Okay, that CPSE ETF is just like a mutual fund, which is raising by investing in other stock markets. So basically, it is investing in other stocks and raising its value. So CPSE ETF grows. CPSE ETF is a company which is a mutual fund company growing by investing in other companies. That's all. That's all. But mutual funds, it doesn't have its own shares in the market. If you take a mutual fund, it is just gaining profits. It is just gaining profits by investing in various stocks. That's all. But yeah, you cannot invest you cannot trade with mutual funds. For example, I can trade with CPSE ETF. I can buy 30 shares of CPSE ETF. That I can do. But I cannot buy mutual funds like tradable stocks. No, that cannot happen for mutual fund. They are different. And CPSE ETF, this electron exchange traded fund, they are different. Now let us see. Okay, they're asking about exchange traded funds. They generally have higher daily liquidity and lower fees than mutual funds. It is very obvious that they are having higher daily liquidity because they are being traded as a stock and lower fees than a mutual fund. They're saying lower fees. Yeah, well, true. They are having lower fees because it's just a stock and you are freely entering that, right? Just like any other stock. Okay, one I'll mark it as correct. Their trading value depends on the net asset value of the underlying assets that they represent. That is also correct. Similar to the mutual fund, they can be bought and sold in the fractional units on stock exchanges. No, you cannot buy and sell in as fractional units on stock exchanges. That is not possible for mutual funds. Okay. See, mutual funds, you can buy mutual funds in either grow, but or else you can buy normally also. Basically, they are not like a ETF. I mean, they cannot be tradable in the stock exchanges. Okay. In the stock exchanges, you are basically trading. You are giving some shares of you are selling some shares of your ETF to some other person. But mutual funds, are you really sharing? No, you are losing your ownership. So that is different. Mutual funds are different. The answer for this would be 1 and 2. So if you want to see the basic differences, demat account, it is mandatory for ETF, definitely. But for mutual funds, it is not mandatory. And ETFs can be traded like stocks and stock exchanges. However, mutual fund units can be purchased or sold at the end of the day. So you can sell the ETF in the secondary market, but the same is not for mutual funds. And one thing is ETF and mutual funds, they are both regulated by SEBI only. Okay, and they derive their value from the underlying asset. Both yes. And investors do not directly own the underlying asset. Very true. The underlying asset meaning, let's say ETF or mutual funds. Both of them, they are investing in some underlying asset. So you are not the owner of this underlying asset. You are the owner of this ETF share. That's all. that is the difference. Okay, in both mutual funds and ETF, you are not the owner of the underlying asset. So again, the question is about alternate investment fund, which you already know. AIF, they are registered as a trust or company. Group of people who are registered as a trust or company under SEBI. Trust or company under SEBI. Okay, that is about alternate investment funds, and they can invest in 3 categories that we have already discussed. Category 1, which are socially and economically desirable. Example, InvIT. They are InvIT and venture capital. InvIT, venture capital, and SME fund. Okay, small and medium enterprises. So this is category 1. We also have category 2 in alternate investment fund. Example, real estate fund and debt fund. Okay, real estate fund and debt fund, they come under category 2, and we have category 3 funds, which are hedge funds. Okay, hedge funds, they are category 3 funds. Okay, with reference to alternate investment funds, consider the following. They are privately pooled investment vehicles which collect funds from Indian as well as foreign investors. Okay. I don't know about this angel fund, CC. From whatever I learned, okay. First, I can answer option 2. Venture capital fund, yes, it's under AIF, and hedge fund, it is very risky. The third one, I don't know about the angel fund to be precise, so I'm not able to answer this. But yeah, these two, they are AIF only, and yes, they are the privately pooled investment because a lot of people together they are coming and investing. But they are talking about the type of investors, whether they can be foreign or not. This I am not sure, and this also I'm not sure. The answer is correct. I mean, foreign investors, they can also be pool of investors. So group of investors who are investing, they can also be foreign investors. Okay. And next, yes, angel funds are also examples under AIF. I mean, I think it would be in the category 1 only, even if I add angel fund. Yeah, angel fund, venture capital, both look very similar. And yeah, these all come under AIF, are the examples of AIF only. Option will be C. So the next question is talking about Interpol. What is Interpol? Interpol is, I think it's in the news. Interpol is an intergovernmental organization that facilitates the international police cooperation. One of the key functions is the issuance of notices, which are international alerts used by the member countries to share critical crime-related information. Okay, which are international alerts. So Interpol, it issues notices, which are international alerts used by the member countries to share critical crime-related information. So in this context, there are different type of notices by the Interpol, intergovernmental police. Okay, whatever. So you need to match. For this, let's see some of the notices issued by the Interpol. Red notice. Red notice implies wanted. Okay. Red implies wanted person. Now yellow implies missing, and blue implies additional information. Black implies unidentified, dark matter, black unidentified. Okay, and we have green implies warnings and intelligence. Okay, and we have orange notice implies imminent threat in the future. Okay, imminent threat. And purple notice is modus operandi. Modus operandi meaning method of operation. Okay, that is purple notice, method of operation, modus operandi. Silver notice, it is about identification and tracing of criminal assets. Interpol and Security Council special notice. Entities and individuals subject to UNSC sanctions. Interpol UN Security Council special notices. Entities and individuals subject to UNSC sanctions. Okay, International Union, UNSC, United Nations Security Council. Interpol, UNSC notice. That is called Interpol UNSC notice. Entities and individuals subject to UNSC sanctions. Now we have red notice, wanted person, yellow notice, missing person, blue notice, additional information, black unidentified, green implies warning, and orange implies imminent threat, purple implies modus operandi, and silver implies identification and tracing of criminal assets, and UNSC notice implies individual subject to UNSC sanctions. Now the question, let us see.
Which one of the following are correct? Okay, red notice. To request the location and arrest of a person wanted for prosecution or to serve a sentence. Yes, it is for a wanted person. This is correct. Blue notice. To collect additional information about person's identity. Yes. Just remember blue blank B for B. Therefore, additional information. You need additional information. Okay. Yellow notice. Yellow implies missing. So missing person. Okay, it is to locate a missing person. That is yellow notice. And silver notice. Silver gold assets. Okay, but gold means assets, silver means criminal assets. So identification of criminal assets, that is silver notice. Okay, but this is talking about warning an event. Warning of an event, a person or an object representing a serious imminent threat. It will go to which notice? Orange notice, right? Orange notice. Therefore, criminal assets, that is silver notice. Fourth option is wrong. Only 3 are correct. What is the primary function of the agency bank of Reserve Bank of India? See, I said agency banks, they are there to help RBI for government-related banking transactions. Okay, government-related banking transactions. So then other options say foreign exchange reserves and currency chest, monetary policy regulation. These are all wrong. I mean, this is the direct implication. Government-related banking transactions on the behalf of RBI. They are called agency bank. The next question is just a general guess. In India, banks can only lend money that they receive as time deposits. I did not listen anywhere. Even demand deposits, they can be given as loan to the customer. Therefore, first option is wrong. And time deposits are deposits for a fixed period of time. That's correct. Okay. The next option. See, illegal implies that is obviously dabba trading. Dabba trading, it is box trading. It is illegal because it doesn't come under the regulations of SEBI. I mean, so SEBI do not overview. I mean, SEBI do not control dabba trading. What is dabba trading exactly? Dabba trading is basically a zero-sum game between this dabba guy and an investor. He is the client. So client, he want to do some corruption. Therefore, if he shows excess money by trading in the stock market, obviously enforcement directorate ED is going to come into his house. Therefore, what he does, he gives his illegal money to this guy to invest in stock market, and this guy will play this dabba game with him. Zero-sum game. It is basically like a betting. It is basically like betting. So if the price goes up, you are going to take the profit, but if it falls down, then I'm going to take the profit. So basically, they're going to invest this much of amount, and they're going to place a bet. And if this guy wins, if this dabba wins, then of course the client is going to lose. But if dabba loses, then client is going to get the money. So that is a zero-sum game. Dabba trading is illegal. Therefore, which one of the following are considered illegal? 4 is definitely illegal. 4 is in everything. Okay. So there are 2 options which are talking about insider trading and front running. Let us see the difference. There is a news in 2023 about this front running and insider running. Okay, insider trading is like buying or selling shares by individuals who have access to the confidential information about the company. For example, you already studied about insider trading. I am a person in the company and I know that my company stocks, they are going to rise due to some news information. Therefore, I am going to invest in that. That is insider trading. Front running is buying or selling shares by the brokers or fund managers based upon the orders placed by the clients. So this is front running, and this is a normal thing because brokers are going to do what their clients. Brokers are going to act based upon the orders of clients. Okay, that is front running. But I think insider trading will be legal, and front running, it is normal. I don't think it is illegal. And next, company's insider, meaning they can be director of the company or even the employees. Okay. And front running, usually brokers and fund managers, they are involved, and the source of information is confidential information who work in the company. And the source of information here, if I say a client who places the orders. Okay, scenario 1, there are 2 scenarios how this insider trading is done, and there are also 2 scenarios how buy sell orders are done. Fine. Anyways, after seeing all this, I don't think front running is illegal. There is no insider trading, na. That means we need to see this in depth. Why? Okay, insider trading to mention again. एक बार देखते हैं front running क्या होता है. Scenario: big client such as LIC places a big order with a mutual fund company. Okay, with a mutual fund company to purchase shares of a particular company. The share prices are expected to increase in future due to bulk order. The fund manager would first buy shares on his behalf. The buy shares on the behalf of the client. Okay, 2 shares, one on his behalf and one from the behalf of client. Once the share price increase, the fund manager would sell the shares at the highest price and make profit. That is buy sell. Okay, sell buy is also there. For example, the fund manager would first sell his own shares in the company and then sell shares on the behalf of client. Once the share price decrease, the fund manager would buy the shares at the lowest price. So that is sell buy. So what's happening here is that front running. So they are placing themselves as first. The financial intermediaries like broker and fund managers, they are placing themselves first, and they are buying their shares on their own behalf first because it is profit, and then they are placing order for client. By the time already value might have lowered. And similarly in the sell buy also, they are placing the order of their own shares first and next on the behalf of client when there is a profit. Therefore, this front running is considered illegal. Fine. For front running, if I see, this is also illegal. Dabba trading and front running, they are illegal. Okay. Short selling, we have already seen how short selling happens. This is not illegal, and impact investing is also not illegal. Therefore, C is correct. This is from the judiciary. I think this might be in the news. Doctrine of merger. The absorption of lower court's decision into higher court's ruling upon appeal is called doctrine of merger. See, if this question, it is asking about a business responsibility and sustainability report. Whenever it is related to business, capital and all, I don't think it is RBI. They are confusing you between RBI and SEBI. So think of the alternate statement and exchange this RBI with SEBI, and you will find that SEBI will be the right answer. So this is wrong. And if you eliminate one, you have 2 options left. Okay. In India, company submitting BRSR makes disclosures in the report that are largely non-financial in nature. नाम देखने से लग रहा है कि ये तो non-financial ही है, sustainability के बारे में और responsibility के बारे में. Yeah, so I think 2 is correct. Therefore, I'll mark B. Right. So basically, this BRSR report is going to have general disclosures like management, how it is happening, and performance, how company is performing. They're non-financial in nature. They're just general disclosures. So before going into that next question, Gift City, I wanted to underline certain features. Oh, we lost it. So what I know about GIFT City is it is basically launched in Gujarat in last year only in October 2025. That is why this question is being asked. So this FCCS, it is introduced even at the GIFT City that will allow international banks to do a real-time settlement very very quickly. I mean, for example, initially for the transactions they need to go through multiple nostro accounts and finally finally make the transaction done. But this foreign currency settlement system at a GIFT City, this will enable real-time settlements in foreign currency. Okay, that is made possible at a GIFT City in Gujarat. Okay. It would help in reducing the settlement time of transactions in foreign currency by entities located within the GIFT City. So the entities which are located in the GIFT City, they can do real-time settlements using the foreign currency only. They need not go through multiple nostro accounts and make the transaction, and that will take almost 2 to 3 days. Okay, so yeah, that should not be the case. Therefore, this GIFT City introduces a foreign currency settlement system. Statement 1 is correct. And it would enable the local settlement of foreign currency transaction between International Financial Service Center Banking Unit, this IFSC banking unit, they are also called IBU. This is what actually FCSS did without routing through overseas corresponding banks. So without going into those multiple nostro accounts in the abroad foreign countries, this FCCS, it is integrating IFSC banking units, International Financial Service Center IFSC banking units with domestic Indian banks. So that is how this is working. So statement 2 is also correct. Both statement 1 and statement 2 are correct, and 2 is explaining 1. That is how you are able to do fast, because you are not routing them through overseas correspondent banks. This is something you need to know. This is about curve trading. In context of financial market in India, the term curve trading refers to. Okay, there are curve trading. Fourth option is correct. First of all. Okay, let us see. The answers are also given. Okay, curve trading is unofficial trading in securities outside the recognized stock exchange. Okay, that is curve trading. Unofficial trading in securities outside the recognized stock exchanges is curve trading. You're curving it. You're curving the trading, something like that. And what is insider trading? It is a use of unpublished price sensitive information to trade shares for personal gains. Okay, that is of course insider trading. You already know. What is circular trading then? Buying and selling the same security simultaneously to increase the profit. That is circular trading. Buying and selling the same security simultaneously to increase the profit. You are buying it and you are selling it. You are just doing the same thing repetitively simultaneously so that you can generate profit. You are only buying it, therefore you know it is going to rise, and therefore you are going to sell from some other account. That is circular trading. Artificially inflating a stock price using false or misleading information. Yes, that is price rigging. You are artificially inflating a stock price by some misleading information. That is price rigging. And unofficial trade in securities outside the recognized stock exchange is curve trading. Okay, one important news which is not in the syllabus. Bungus Valley, it is in Jammu and Kashmir. It was in the news because CM Omar Abdullah, he said that this will be a great tourist destination. Bungus Valley, Bungus or Bungus. Okay, that valley. It is in Jammu and Kashmir. So if ever the match and following comes, tick that Bungus Valley is in Jammu and Kashmir of India. Okay, and then we have this Taranaki Maunga mountain. Maunga. Taranaki Maunga. So the name feels similar to a name of the person. Therefore, it is given legal personhood. Okay, it is given the status of legal personhood. Taranaki Manga. Therefore, all the rights that a person will have, this mountain will also have. This is a mountain in New Zealand. This is creating something new things. Okay, giving Taranaki Manga. Giving the status of person new. Therefore, it is in New Zealand. New, remember like that. And you also have Lake Naivasha. So most of the lakes raising water mirror in the world's climate crisis. Okay, see, a lot of lakes they are in Africa and Naivasha, Kenya, ma'am. So all such names they are in mostly in Kenya. So Lake Naivasha, Lake Victoria, Lake Naivasha, Lake Victoria. These two madams they are in Kenya. Okay, Lake Victoria. Lake Naivasha, they are in Kenya. They are in Kenya. Lake Naivasha and Lake Victoria, Kenya. Okay, because I remember it like that. Victoria, ma'am, is cute. Matlab KUT, Kenya, I think T for Tanzania, and U for maybe Uganda, I don't remember. But yeah, Naivasha, it's in Kenya. And we also have Dukono, Mount Duko. It is in Indonesia. Dukono, Indonesia. Okay. I think this is the match the following. For example, if you see Bungus Valley, it is not in Myanmar. This is wrong. It is in India, in Jammu and Kashmir. Bungus Valley, Mount Taranaki. Just now have you seen Taranaki, Maunga? Taranaki, Mount Taranaki, it is in New Zealand. Mount Dukono, it is in Indonesia, and Naivasha, it's in Kenya. Okay, therefore only 3 are correct. Thank you very much.